Bank, Commerzbank, BNP Paribas, and on. But we also have to mind BP, which of course has made Meg O'Neill its first female big oil CEO in a bid to catch up with its rivals. Notable that this is really a sudden management shake-up for the company, so we'll keep an eye on that stock. But also Rheinmetall. The past few days we've been watching the defence stocks given the situation in Ukraine being discussed in Brussels, but we know now that Rheinmetall is going to divest its remaining civil businesses, and it's also boosted its outlook for the year. So just a few stocks, Anna, to keep in focus at the open.
Absolutely. We will certainly keep those in focus. Yeah, really interesting story around Rheinmetall there. Also, drug stocks out of Switzerland in focus because of some of the news flow that we have around the United States and their businesses there. Let's get to the market open then. The FTSE 100 jumping into the green at the start of trade, waiting for the other European equity markets to follow suit. As Lizzie was saying, Bank of England, ECB, a lot of things to wait on the sidelines for perhaps today, these big set-piece events that the market still needs to get through for the year. We're not done there, though. We'll still have the BOJ tomorrow, but then after tomorrow, maybe then we get to take a breather for 2025. Dangerous thought, perhaps. So European equity markets just getting started. The Stoxx 600 looking pretty flat, pretty appropriate perhaps for this time of year, even if we are waiting for some big events. We're also keeping a close eye on all of the developments in Belgium, in Brussels, around the conversations around Russian assets and what can be done for Ukraine. And Belgium, of course, crucial and central to that conversation, as we were just hearing about from Kaya Kallis with Oliver there. So we'll certainly keep an eye on all of those conversations that are taking place in Belgium around the geopolitics. We'll watch oil prices. We'll watch the defence names with anything that is said there. European equity markets, I'm giving them some time to open, but they're not doing a whole lot, Lizzie. So maybe we'll come back to you and find out what the sectors are doing. Waiting for this SMI to open. Interesting in the context of some news flow surrounding those big drug makers there. But things looking faintly positive, I would say, across European equities.
Yeah, we've only got about just over half of sectors in positive territory this morning. Energy leading the gains, as you might have expected, given the oil moves up for a second day on Brent because of the geopolitical situation, both Venezuela and Russia. So Brent at $60 a barrel, up 0.7%, and energy up 0.9% as a sector. Outsized gains for BP as expected. Actually, now just really in line with the rest of the sector. So not really giving much of a boost, despite the naming of Meg O'Neill as the first big oil CEO. We're also, as I said, minding the defence names, and we're looking at Rheinmetall up 0.2%, but other names in that basket actually have bigger gains. So Leonardo up 0.4%, BAE Systems up 0.5%. So really not that much reaction to the news that I flagged. But just going back to the sectoral basket, the likes of travel and leisure, autos and parts, healthcare are your laggards this morning.
Yeah, there is a certain oil flavour to what's going on here. When you look at the top of the sectors board and it's energy, and the bottom of the sectors board and it's travel and leisure, you get a sense of one of the trades that is taking place there. And yesterday we saw this focus as well, this focus on higher energy prices as a result of some of the Venezuela news lines. In fact, we were higher on oil prices today, but some of the gains we made earlier being paired as President Trump didn't decide to double down on some of that geopolitics and talk about Ukraine or talk about Venezuela in his speech overnight when he addressed the nation. So that came as something of a comfort perhaps to those who had been expecting or fearing that oil prices may go a little bit higher. Let us talk about these markets a little bit more broadly. Banu Baweja joins us, Chief Strategist over at UBS, on set with us this Thursday morning. Banu, nice to have you with us. Thanks so much for joining us. So we are tantalisingly close to the end of 2025. We are not there yet, but let's pretend we're nearly there. And let's look at 2026. You actually think that 2026 might not be bad bad for equities and for risk appetite, but you think that in the very short term, there might be a few bumps along the way. What are you watching?
We're going through those bumps, right? The market has consolidated for the better part of the last 2 months, and I think this consolidation will probably last for a little bit longer. What we're watching is the growth inflation mix, right? We are looking at the sort of the K-shaped economy in the US and the lower part of the K beginning to have its say. The labor markets are weakening. At the same time, you're going to get a CPI release today, which probably will show core inflation at 3.2%, slightly north of 3.2%, at a point when the Fed is already priced for 2 or 3 cuts from here. So the markets are already expecting the Fed to cut, and inflation is going to go higher at the same time as growth coming lower. And this is, I think, is going to put some pressure on equities in the very near term, right? And along with the fact that, you know, as capex to sales have continued to increase for all the AI names, the market has become slightly less forgiving in terms of valuations, right? Oracle is not just the only problem. The market's become slightly less forgiving for the worrying about IPOs coming next year, and then that could be a problem for the tech trade. So all of these concerns near term, I think equities do consolidate. So we could be waking up in March with the S&P still at about 6,750 or 6,800. But once you start getting the checks in the mail, once you start getting the fiscal boost, the refunds, we think that probably is going to lead to the broadening trade.
So the fiscal side is important. You want sort of evidence of that. But what about evidence on the AI side? So we have this huge capital investment taking place right now. But yet the benefits of this are maybe a little bit delayed. The productivity bonus, the productivity boost we're going to get from this we're all waiting for, Banu. So what do you watch specifically to get an early sense of whether we've expected too much or too little?
This is very important. I think everybody understands that AI is going to impact every company at some point in the future, but which companies will be impacted first, right? Surely these are companies that have a lot of data that they can harness, and perhaps a lot of labor that they can replace. So what kind of companies have a lot of data and a lot of labor? These are asset managers, insurance companies, retail companies, commercial and professional services. So this is what we're going to be watching. We're going to be watching financials, and we're going to be watching retail. We're going to be watching commercial and professional services. These industries, we're going to be looking at sort of at a bottom-up level where the sales per employee in these companies are rising. Because I think these will be the vanguards, right? This will be sort of the leading indicators of tech love moving from the producers of AI to the consumers of AI.
Okay.
And we're hoping that this comes through the course of 2026. That's going to be a necessary condition for this trade to carry.
Okay, so that's sales per employee, watching what the banks do with this, watching what financial services do. One concern some people raise, though, about that particular sector is that, yes, they have a lot of data, but they have to be extremely careful with that data, and some of it is on quite legacy systems. Certainly some of the older banks, you know, maybe on many, many legacy systems, and that kind of data is not necessarily in a format where you can do a lot with it with AI. But are we going to get through that?
I think the market will look through that. I think what we will need to see is that these companies are investing. So the capex is not just with NVIDIA or with Micron, that the broader universe is engaging in capex, which actually is not happening right now. So if you look at capex in the US, it's very narrow. In fact, narrow is the metaphor for the U.S. economy, for U.S. markets. Everything is in a tiny sliver. I think you need to see capex from companies that are the consumers of AI to start using the productivity of AI. I think the market will look through the fact that they are legacy systems.
But then when you look at it from a macro perspective, does it come with job losses?
The labour market is already under strain, and we think the unemployment rate could go higher still. So we're already at 4.5, 4.6. There's a possibility we get to 4.8%. The question of whether or not the consumer comes back in a big way through the course of next year is a really, really important one. So we think the consumer is going to weaken before it strengthens, because we think real disposable income is already weak. The number of people that are getting employed is lesser and lesser. I mean, outside of education, outside of government, you actually have seen sort of negative payrolls, including healthcare. And so once you see real disposable incomes bottoming out, and that's going to happen with CPI peaking out, which is going to be somewhere around Q2, that's when I think the consumer can start doing better. But here and now, we are actually quite cautious on the consumer. The market disagrees. The market is already playing the broadening trade in financials, in the consumer. We think it's a little bit early, so that's why in the near term we're more cautious. Whereas from Q2 onwards, I think the fiscal side is going to help the consumer as well.
Okay, let us not forget that it is a big day for central banks today, not just the BOE and the ECB, but others as well. If we look at the BOE, Banu, we had that CPI print yesterday, weaker than expected. Did it change the vote split that you're expecting, and more importantly, I suppose, your outlook for cuts next year?
We were actually thinking that inflation is going to come lower. I mean, if you look at what's happened with inflation in the UK, it was annualizing at about 4% 4.7% in the first half of the year. It's annualizing close to 1%, right? Inflation's come off really hard. And this is not just food. This is also core inflation elsewhere. It's services as well. And the labor market outlook is such that you should expect low inflation to continue. So the vote split, 9-0, I think.
9-0, it should be, or it
Wow.
will be.
I think it will be. I think that today you could actually see everyone looking for a rate cut in December. But also, I think beyond that, you could see 2 further rate cuts.
Okay, let's just test this, Bano. I mean, we've got inflation above target.
Yeah.
The PMIs actually didn't look that bad, even if some of the GDP data has looked pretty dire. The wages story isn't necessarily telling us a crumbling wages story, even if unemployment is higher than you'd want it to be. And we have had hawkish comments not all that long ago from someone on the Bank of England. So do you really expect 9-0?
What on earth happens to the pound, Barry? If you have a
You're
9-0 split.
but you're going to get a 25 basis points either way, right? So 8-1, 9-0, I don't think it's going to make a material difference, but I think with that kind of a CPI report, you could get a 9-0 vote, and I think euro sterling therefore goes higher. The ECB is not going to hike, but the outlook for growth in Europe is improving at the same time as the outlook for growth in the UK is mixed. It's not dire, but it's mixed. And I think the outlook for inflation in the UK, the delta, the change, is much more important here than the level, and the delta is way more negative. Again, it's annualizing at a very low level, and from here on, I think the inflation rate is going to remain quite low. So we're looking for 2 more cuts next year as well.
Okay, well, I'm very excited that Banu's here, because this just got a whole lot more exciting.
I just had to pick my jaw off the floor.
So that's that one. I mean, that's interesting, what we're expecting there, what you're expecting there. I know there are other things you're watching in 2026, Banu, that I do find really interesting as clues as to where the economy goes. So private credit delinquencies, we've seen this be a topic this year, it was a big topic, but it sort of faded away. Is 2026 going to be a year where private credit delinquencies are an issue? But rates are coming down in the States, so maybe not.
Well, rates are coming down in the front end. What's really interesting is rates are not coming down in the back end. And this is something that I think equity investors and credit investors really have to grapple with, because we keep focused on the Fed, right? And they say, oh, look, the Fed is cutting, and therefore we must buy risk assets, we must buy low-grade credit, and we must buy equities. But in fact, the long-end yields are not coming lower. The market is asking for higher term premium. The market is steepening the curve. So the long end is not coming lower. I actually think this is almost the exact opposite of what happened 20 years back with Alan Greenspan. You remember the years of the conundrum when Greenspan was hiking rates and nothing happened to the long end. Now, fast forward 20 years, the Fed might be cutting rates, and again, nothing happens to the long end because the supply and demand for treasuries has completely changed. The supply is going exponential, and people are not buying that. So I don't think the cost of equity is coming lower. So I do think that you will see higher private credit delinquencies, and that will put pressure on publicly traded credit, so high yield spreads, to move wider. And that does have implications for valuations in equities. We think valuations are going to contribute negatively next year. So it's all earnings.
We talked about this on the programme a few times, Lizzie, about the fact that the long end has not been responding as much as it maybe has in other cycles to those cuts from the Fed. And you wonder how that sits alongside the priority that President Trump has made of bringing CPI down. And part of that is mortgages and car loans, and some of that tied to longer dated treasuries and longer dated markets. So this all comes together, and you wonder where the politics takes that.
Yeah, I mean, we've had all this data this week, but I do wonder how important it actually is, Barney, when, it's patchy, it's imperfect, not to mention it's delayed. And then you talk about the politics, Anna. There's politics around the Fed itself. I mean, I wonder who's most credible to the markets, and I wonder if actually the contest to be the Fed chair matters more than any of the data we'll get till January.
I think that's a fair point, but if you cut through the noise, Lizzie, right, the markets are not concerned about Fed independence, right? The markets are not, right? There's a lot of narrative around that, but the one indicator that we must watch to see if the markets really care is the 5-year inflation swap. The 5-year inflation swap in the US is coming lower, not higher, and it's actually at a level which is below a long-term average. If the market was genuinely... Look, the Fed is already a dovish institution. You don't need to take away independence from the Fed for the Fed to be a dovish institution. If the Fed had the same data as we've had in Europe for as long, ECB rates would be much lower. So the DNA of that institution is already quite dovish. They do care about long-term funding. They do care about interest rates in the economy. I think January 21st is going to be a really, really important day, right? So what happens with Lisa Cook from the Supreme Court, I think that's going to be really, really important. But if the Supreme Court at that time says that she can continue as a Fed governor, and you can't willy-nilly replace Fed governors, I think the market's fears about Fed independence would be allayed. Now, who comes in next? I think a dovish chair comes in next, right? And a dovish chair could be very, in a sense, Greenspan-esque again, in that they talk about productivity, they talk about the supply side, and therefore try and rally consensus to cut rates. But the market is pricing that in. So I'm not sure that based on what's happening with the Fed chair, that you really want to receive front-end rates in the U.S. right now. I don't think, because I think you are already pricing that in.
So we know there'll be a dove, and we have a 66% chance they'll be called Kevin, is what we know about the new Fed chair. Banu, thank you very much. Thanks very much for joining us. Banu Buwaja, Chief Strategist over at UBS. Things we do and don't know about 2026. Let's talk about the Core 6 this morning, in the midst of not much earnings news, bit of tech news, certainly a lot of geopolitics. Let's have a look at where we are on the Core 6. Not a huge amount of movement in some of these big names. Nestlé, actually, the biggest mover to the upside, which tells you something perhaps about the market's wait-and-see mentality this morning as we wait for those central bank decisions. Let's get a check on some individual stocks on the move. Here's Chloe.
Good morning, Anna. BP is actually edging a little bit lower this morning. It opened higher this morning at the open, but is now a little bit lower after naming its first female CEO and the first female CEO of a big oil company. So she is now tasked with reviving the fortunes of BP that has been really lagging behind its rivals. And some analysts had said that this appointment would be actually received quite well by the market because of her track record at Woodside, where she had made some aggressive moves and had a strong record of execution. But it seems that this original enthusiasm that we had at the open has been now pared back a little bit on the back of this appointment, and we are down about 0.7% this morning for BP. Moving on to Argenx, which is a biotech company that's also a little bit lower this morning, about 2.3%, and that is because the ADRs were downgraded by analysts at Baird, saying that the valuation was actually quite stretched for Argenx, despite what has been a really amazing growth story over the last year for the company. And this comes just a few days after the company also had to discontinue a big trial for its flagship drug, and that had already sent the shares lower. So back-to-back setbacks for Argenx, and it's down this morning. Moving on to Rentokil, which is a pest control company, and it was upgraded at Bank of America this morning, and so we are up 3.3% on the back of the upgrade. And we have got another upgrade as well, this time from UBS, and that is for Rational, a company that makes kitchen appliances for hotels and restaurants, and that is also driving those shares this morning. And we are up also about 3.5% for Rational this morning.
Right, Chloe Melly from our equities team, we thank you so much. And coming up, we're going to dive into the BP story. The company appointing its first outsider, Meg O'Neill, to lead the oil and gas giant. More on the management shake-up and where it leaves BP's oil and gas strategy next. This is Bloomberg.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. We're 19 minutes into today's session, and not a lot is happening here in European equities. You can see the Stoxx 600 there, flat to the upside. Same story for the DAX in Frankfurt. Bit more gains in Paris off the CAC, but the FTSE 100 pretty much unchanged at the moment. One stock that is moving a lot this morning is Currys. It's up more than 10% at the moment after the retailer reported profit for the first half of the year that beat the average analyst estimate. And joining us to talk more about that and the broader retail picture is our Bloomberg opinion columnist, Andrea Felstead. Good to see you, Andrea. I think you were excited about Currys before their numbers dropped. Why so? Why is it moving so much?
I think it's just a better performance, particularly on the Nordic regions. I'm always interested in Currys because it gives us a bit of a read from Black Friday through to the run-up to Christmas. They actually said in the statement that the UK consumer was subdued, which is definitely what I've been hearing. People took a bit of fright in the run-up to the budget. Maybe for consumers it wasn't quite as bad as feared, but I fear that came a bit late. We saw a lot of discounting in the UK over Black Friday. A few people have moved back to full price. Still quite a lot of discounting out there. Lots of clothing, fashion's already been discounted. Lots of beauty offers, fragrance offers. So Christmas always turns out to be better than you expect. But I'm not expecting a turkey and I'm not expecting a cracker, probably somewhere in the middle.
Okay, you'll find a new metaphor for that one then.
Yeah.
So that's the retail story here in the UK. Let's talk about fancy, expensive yoga pants, shall we?
Exactly.
Andrea, because Lululemon is in focus. Investors, Elliott, have revealed that they have taken a big stake in the sportswear maker. What do we know?
Very little. They're working with a retail executive called Jane Nielsen, who seems to be a CEO candidate. They got rid of their CEO last week. Now, she seems to have some quite good credentials. She was at Ralph Lauren, which has done a very good turnaround.
They're having a moment.
They are having a moment. She was finance director there. She was COO. So she's definitely got the financial and the operational skills. What I think that is a bit of what Lululemon needs, but what it really needs is someone who's good on product, someone who can create those leggings that people want to spend $100 on. And I'm not sure she's the product person. So at Ralph Lauren, obviously, you have very good operations, but you have Ralph Lauren himself very visibly, very visible look, still active on the creative side. So she was able, and the CEO, Patrice Lemay, were able to do a very good operational turnaround. But you had, Ralph kind of helming the look and the feel of the brand. You don't have that missing piece at Lulu.
I came in my Ralph Lauren bear jumper this morning, Andrea, but Anna says I'm not allowed to wear it round the desk. Maybe on Christmas Eve. Watch out.
That makes it sound like I'm in charge, which is really not the case.
Look, we also got to talk about Nike because they've got numbers coming later. What are you expecting?
I'm expecting maybe a bit of improvement, particularly on the inventory side. They were getting rid of a lot of those kind of out-of-fashion sneakers. They've already said they're making progress on that. What we really need to see is whether the broader turnaround is happening. He's been there just over a year, October 24. Takes probably 18 months, 2 years for all the product to come through. We need to see that's on its way.
Andrea, thank you very much. Andrea Felsted from Bloomberg Opinion, of course, with all you need to know about retail and luxury, some of the news behind us and some of it still to come. Let's pivot from that to the oil major BP, oil and gas major, and we will check in on the share price. The share price down just a touch this morning, down 0.1%. BP, the news overnight is that BP has selected the Woodside Energy CEO Meg O'Neill to lead the London-headquartered global oil and gas giant. The move makes her Big Oil's first female chief executive and comes as the British firm struggles to revive its fortunes after what could be described as a botched pivot to renewables under previous management. Let's speak now to Bloomberg's big oil reporter, Mitchell Gurman, who's with us here on set. Very nice to have you with us, Mitchell. So, shareholders were expecting an announcement, weren't they? We'd heard from the current CEO that he might be prepared to step aside if that was something that was necessary. So what do we know about Meg O'Neill, who's been selected?
Yeah, well, first on the shareholders, we just heard about Elliott, building a stake in Lululemon, and one of Elliott's biggest bets globally is BP.
They have diverse tastes.
Yeah. and the only public remarks they've made on BP since entering is welcoming the new chairman when his appointment was announced over the summer, basically saying he needs to urgently fix the company. And when he took over in October, that's what he told staff on his first day. The strategic direction was correct, but they need to move faster and with more urgency. He's a couple months into the job, and he's moved fast with the change. And this, Meg O'Neill, she's an American. She is from Colorado. She worked at ExxonMobil for 2 decades, spanning the globe, and then she took over Woodside, Australia's biggest producer, and she shed low-carbon projects, she doubled oil and gas output, and she really focused the company on a global liquefied natural gas portfolio.
So given that experience, what do you expect now under O'Neill to happen at BP?
Yeah, BP earlier this year reversed its strategy from low-carbon ventures back to focusing on oil and gas. The expectation is they will focus on oil and gas. She did that in her last job, and the chairman had said that the strategic direction of oil and gas focus was correct, so we can expect more focus on that.
Murray Auchincloss not in the post for very long. I mean, was he too tainted, if that's the right word, too unable to draw a line between the previous management under Bernard Looney and his tenure, given that he'd been such a part of Looney's team?
Yeah, no, he was definitely part of the previous tenure, and he kind of struggled to break from that in some ways, and he did make the strategic reset, but that reset came after Elliott called for major change. So even if he was prepared to make that, it looks like Elliott, had some influence. And then the announcement of the new strategy received a lukewarm reaction from investors at the time, and really struggled to make any major moves.
Okay, really good to get your analysis, Mitchell Furman, there on the BP story. The shares are now down 0.25%, but other names in the energy space actually up. The likes of Shell up 0.5%, Total up 0.7%, as we look at Brent up for a second day at $60 a barrel. Coming up on the programme, EU leaders expected to try and agree on the release of frozen Russian assets to assist Ukraine today. We're going to bring you the latest on the Ukraine war and path to peace with Fabrice Poitier, CEO at Rasmussen Global. That conversation next. This is Bloomberg.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal, with athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back. This is the opening trade this Thursday morning. We're 30 minutes into our European session, and things are green, but not all that convincingly so. We've just been flicking between red and green on the DAX, for example. We're almost entirely flat on the Xetra DAX, almost entirely flat on the FTSE 100 as well. The CAC 40 is up by 0.1%, and the Stocks Europe up by 0.1%. We are waiting for some big central bank decisions coming through from the ECB and the Bank of England today. In the meantime, we've had some news out of Sweden's Riksbank. They have left their policy rate unchanged at 1.75%. The estimate was for 1.75%. So that's pretty steady as she goes. We are expecting new estimates, though, coming through from the Riksbank. So there could be some volatility around those. What do they tell us about expectations for growth and inflation from the Swedish Central Bank? Last time we heard from the governor, he was sounding as if the bar for any change in policy was pretty high. So we will keep in focus the exchange rate for the euro against the Swedish krona to see if we get any movement on the back of those estimates as they come in. But not a huge amount of movement right now, Lizzie.
Well, reflecting the green on the screen that you showed us, Anna, when it came to the European equities picture, we have more members higher than lower on the Stoxx 600 this morning. Not that big of a split, but lower volumes, notably, as we head towards the holiday period. But flip over and you can see who the leaders are this morning. We've talked about how the oil price is higher for a second straight day. And indeed, we have Total Energies up 0.7%. A different story, mind you, to BP, as we were just discussing. That stock actually not getting as much of a boost as perhaps expected when it's now got its new CEO. But you're also seeing ASML up 0.7%. This linked to the overnight story. We had the encouragement from Micron overnight, so changing the fortunes perhaps for US stocks today after the disappointment yesterday on Oracle and Blue Owl. But flip the board and we can look at the laggards as well. And I believe they're going to take a healthcare flavour. So Roche, Novartis and GSK all suffering this morning, Anna.
Yes, you mentioned the tech story around Micron, Lizzie. Let's get a bit more detail on that and other news that we have in focus this morning. Micron shares rallied in late trading after the largest US maker of computer memory chips gave an upbeat forecast for this current quarter. The company's CEO said in a statement that Micron is, quote, an essential AI enabler. The PC chip maker is benefiting from the AI boom and a surge in demand for its products, with supply shortages allowing the company to charge higher prices. The US President Donald Trump looked to reassure Americans concerned about the cost of living in a primetime address to the nation last night. President Trump announced plans to award a special holiday payment to military service members and told voters they would see the benefits of his tax cut legislation next year. Investors look ahead to more information on prices in the United States. The US CPI print is due today at 1:30 p.m. UK time. Both the Bank of England and the European Central Bank have rate decisions today. The BOE is expected to deliver a pre-Christmas interest rate cut later today as focus shifts from inflation towards the UK's struggling economy and jobs market. Then the ECB is widely expected to hold its rates steady, with investors looking to President Christine Lagarde's press conference 30 minutes later for some guidance. Lizzie.
Plenty in the diary then on the central banking front. But in the meantime, we have EU leaders meeting in Brussels to discuss whether to loan billions of euros to Ukraine funded by frozen Russian assets. Now, Belgium has been opposed to the plan, and a short while ago, the EU Commissioner for Foreign Affairs, Kaja Kallas, told us that she was aware that the Belgian government was coming under pressure from all sides.
As I see it, Belgium is under a lot of pressure from Russia, from all of Europeans, also from United States. And in order to, release that pressure, we should do the European legislative proposal.
Well, that conversation brought to us by Bloomberg's chief Europe correspondent, Oliver Crook, who joins us now. Ollie, just lay out the scene for where the talks stand in terms of the European position.
Yeah, absolutely, Lizzie. The scene here as we watch European leaders, literally as we speak right now, file into the European Council chamber. They have yet to decide whether or not they're going to move forward with this plan to use those frozen Russian assets to lend Ukraine 90 billion euros to fund their war effort, to fund their economy, to two-thirds of the entirety of the needs of Ukraine over the next 2 years. Whether or not they're going to move on it is still, frankly, a completely open question. It's rare that you go into these summits with something quite as important, quite as consequential, and also without any certainty of whether they're going to agree to it or not. We've heard from the Belgian Prime Minister a little bit earlier today, speaking in his own parliament. Of course, one of the other pressures of some of the domestic audiences within Belgium, doubling down on this idea that he has not yet received the assurances he requires from the European Union in order to say okay to move forward on these assets. We also heard from the Chancellor of Germany walking into the meeting just a few minutes ago, and I'll quote directly. He says that, in my view, this is the only option, that is seizing the assets. Ultimately, we are faced with the choice to use European debt or Russian assets for Ukraine, and my opinion is clear: we must use the Russian assets. What he is basically alluding to is that there is not a plan B for funding Ukraine. So this is a question not just about funding Ukraine, but about European credibility. Can they get their act together? Can they clear these sort of hurdles in order to act collectively in the face of Russia's war in Ukraine?
Yes, well, if others might suggest that shared debt might be a plan B, Ollie, then perhaps we might preempt the German response to that. So there's Friedrich Merz, the German Chancellor, throwing his weight behind the use of frozen Russian assets. So this is a difficult conversation for Europe. Everything around Ukraine then on the table, but also the trade narrative, also a difficult conversation.
Yeah, that's right, Anna. Going on in the background, this is not officially what these leaders are here to discuss, is the Mercosur trade deal. This is a trade deal that has been negotiated for the last 25 years between Latin America and the European Union. The aim here will be to bring a free trade agreement to a market of about 800 million people. For the Europeans, and from their perspective, it's extremely important because obviously the economy has been struggling for some time in Europe, but it also gives another sort of avenue of trade for the Europeans in the face of an America that does not seem terribly interested in trading with the Europeans. This is seen as a very key way to diversify the economy. This was all set to go to be signed on Saturday, and starting last week, we started to get some doubts from the French, from the Italians, and some doubts indeed from the farmers. We're on my way over here. You can just see outside of the council building, just down the road, there's black smoke rising, there are tractors, there's massive protests going on in the face of this Mercosur signing deal. So it's not clear whether or not this key issue is going to get on the line. And I'll quote Friedrich Merz just one more time here, because he's been a lot more sort of outspoken in recent days, both on Russian assets and on Mercosur. He says that if the EU wants to remain credible in the global trade policy, decisions must be made now. We heard from the president of Brazil. The French want to delay the signing. Brazil says basically, we sign this weekend or we don't sign at all during my presidency. These are the stakes for the Europeans as they gather today here at the council building in Belgium.
Okay, OK, Bloomberg's Oliver Crook, we thank you so much for setting up. You've got a busy day ahead of you, so thank you. Well, for more on the UK-Russia conflict and Europe's role in a possible peace plan, we're joined, I'm pleased to say, by Fabrice Potier, CEO of Rasmussen Global and former NATO Policy Planning Director. Welcome to the programme, Fabrice. Thank you for making time. Ollie was speaking to Kaya Kallas earlier on in the programme, and he asked her what Article 5-like security guarantees actually are. She said, if you're attacked, others will come to help you. I wonder, surely Putin doesn't care about semantics. Is he surely going to treat Article 5-like security guarantees as tantamount to NATO membership?
I think Vladimir Putin does care about semantics, because if you look at the past 10, 15 years, he has towed the line of actually respecting Article 5. He likes to probe, he likes to test, but he never crossed the line. So I think it does matter, but obviously, as you know, some allies and some members of the European Union are more equal than others. And security guarantees without the United States support, be it, for not necessarily front role, but at least a backstop role, is critical to make those guarantees credible. So I think this is really where the negotiations between Kiev, Europe, and the United States lie. And we have to see what will emerge in the coming days and weeks.
And so how close are we to getting a deal on the table, Fabrice? Because we've also had the news of the US planning to step up its sanctions on Russia.
Well, the problem is you have a US administration that is clearly zigzagging on its Ukraine policy. 1 month they are very pro-Zelensky and willing to put pressure on Vladimir Putin, and then the next month President Trump and some of his acolytes are actually embracing Putin and his ideology. So this is obviously very confusing and very frustrating for both Ukraine and the Europeans. But clearly the discussion over the past few days have circled around the willingness of Ukraine to make some difficult compromise, provided they are given the security guarantees that this will not happen again. We have to remember, this is the second attack, invasion by Vladimir Putin against Ukraine over the past 10 years. So I think it is quite legitimate that any Ukrainian leader, being Zelensky or any other one, will say, listen, if I am to make some hard compromise for peace, I need a guarantee that this is not going to happen again, and I won't have to tell my people they have to again sacrifice themselves. So we will have to see how President Trump is taking this on board, and whether he's willing to put a bit of skin in the game.
How far, good morning to you, Fabrice. How far off or close at hand is a peace deal, do you think?
It's very hard to say, because, as you know, there is a lot of information operation from all players here on, posture that are declared, but in fact you have slightly different positions behind closed doors. It's hard to say. I think the very bottom line here lies with two men, Donald Trump and Vladimir Putin. And if you look at Putin, clearly he doesn't see the need to go for compromise. He still sees that there are more benefits than costs in pursuing this war through military means rather than diplomatic negotiations. Why? Because the second man, Donald Trump, has not been willing to put additional cost on Vladimir Putin's action. And as long as this happens, I think Putin is still going to be willing to go with the war and military means rather than to sit at the negotiation table.
And with that in mind, Fabrice, what role do you think this conversation around using frozen Russian assets, what role does it play? Because the United States has been saying that if Europe makes this decision, then it really complicates this peace conversation. Is that just playing into the Kremlin's playbook, or do they have a point?
I think it's playing into the Kremlin-Vitkov playbook of seeing, business opportunities and wanting to potentially unfree some of these assets and commit them to some kind of joint investment. But putting this aside, I think this, whether European leaders can come to an agreement on leveraging the immobilized assets is actually very critical. You were talking about security guarantees at the beginning. I think security guarantees and this are the two key to actually Ukraine, an independent sovereign Ukraine surviving. Why? Because basically it will give the fiscal depth for the next years that Kiev needs to actually get through this war, and it will send a signal to Moscow that actually Kiev has what it takes to be resilient fiscally, which is obviously crucial. Remember, this is an industrial war. This is not just a kinetic war. This is about how much you can produce, how much of your economy you can keep together. So this decision today and tomorrow in Brussels will be critical for Ukraine's future.
But what about the role of President Zelensky, Fabrice, in agreeing to a deal? He said this morning that he's not ready to withdraw troops from Donbass. He said that the US offer on Zaporizhzhia as a compromise is not fair. Has he got some part to play in holding back a deal?
I think the very bottom line is that President Zelensky, obviously, making any form of territorial compromise is extremely difficult for any Ukrainian leader and for the Ukrainian population at large. And he can only do so if he feels that he has the guarantees that, okay, we have accepted some temporary realities, let's put it like this, but we did so in exchange for knowing that the unoccupied parts of Ukraine are safe. They are guaranteed. They have a long future. And I think it's his way to keep on exerting pressure on the Europeans, but essentially on the United States, to be more forthcoming when it comes to security guarantees, which is something being negotiated right now.
Fabrice, how quickly do you think the thinking in lots of European capitals is evolving on what they are prepared to do to secure peace for Ukraine? I was interested yesterday to hear Chancellor Friedrich Merz in Germany talking about how German troops could participate in a coalition to secure a demilitarized zone in Ukraine. Is this something we're going to have to see from a lot of other leaders?
I think we have to put this into the broader context. Having a German leader saying this now today is almost historic, given Germany's history vis-à-vis Ukraine and reluctance to be put in a position of possible direct confrontation with Russia. So this, I think, tells you a lot about how the Europeans realize this is theirs, and they have to really put the skin in the game, and they have to actually solve it. Of course, they need the United States because the US brings some capabilities, some what we call enablers, satellites, intel, some missile technologies that the Europeans don't have at scale. But essentially, this is going to be on between the Ukrainians and the Europeans. So I think Chancellor Merz saying that is very important signal of the willingness for the Europeans to go further. The coalition of the willing is obviously shows that there is this will, at least among a dozen European leaders and countries. However, I think we should be willing not just to wait for a ceasefire, but probably do some pre-deployment in the air, in the maritime domain, where there's less risk of confrontation, and there's a way to signal to Russia that this is game over.
Tremendous pressure on Brussels today. Fabrice, thank you so much for your analysis. Fabrice Potier, Rasmussen Global CEO and former NATO Director of Policy Planning, as we look ahead to that meeting. Well, coming up, central banks are in focus as well, of course. The Bank of England and the European Central Bank set to announce rate decisions later today. We'll take a look at what to expect next. This is Bloomberg.
cidade estava sitiada.
Nisso, ao começo, eu tremia, não sabia o que fazer. Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome back to the opening trade. We are 49 minutes into that opening trade for this Thursday, the 18th of December, and the picture across European equity markets looks tentatively positive across European stocks. We're waiting for some big set-piece events today. Let's get into those. We've got an EU Leaders Summit taking place. We've had some contributions from that already this morning. The Bank of England rate decision, the ECB rate decision, we will talk about those more now, and US CPI. We'll also discuss that because that also lies in our future today, this Thursday, Lizzie.
Well, let's start across the road, shall we? The Bank of England expected to deliver a pre-Christmas rate cut today as focus shifts from inflation towards the UK's struggling economy and jobs market. Joining us now is Dan Hansen, our chief UK economist for Bloomberg Economics. And Dan, you wouldn't believe what Banu Baweja just told us, the UBS chief strategist. He's expecting a 9-0 vote split in favour of a cut.
He said it could be, didn't he? It could be, yeah.
Could it?
That shocked me slightly. I mean, look, it's not our base case, and it's not the market's base case. I think there is definitely now, following the CPI yesterday, a risk that more of the hawks flip. Well, I think the ones that we'd be watching, if we were, and thinking this might mean February's on for a cut as well, would be Claire Lombardelli and Hugh Pill as well. And I think particularly Claire Lombardelli would be the one to watch. And I think the two that are most likely are potentially Megan Green and Claire are the two most likely to flip. It's possible Catherine Mann does as well, because we know she likes to be activist. I think Hugh Pill's probably the least likely to flip. But anyone, any of those, particularly Claire, as I say, would be a significant signal.
That would be a bit of a signal for the markets about what the beginning of next year might bring. And what does the economy look like to you as we turn the corner into 2026 then, Dan? Because on the one hand, sure, the GDP data has been pretty bad. But we've got this PMI data just recently that looked a little bit more hopeful. Yep. And the labour market story, although deteriorating, it's not all worrying signs. So what do you focus on?
So I think the fourth quarter is going to be a pretty bad quarter for the economy. I think you're probably going to get no growth, perhaps even a contraction in the economy.
Do you think they'll change their forecast on that?
Yes. So the bank in November had 0.3 for the fourth quarter. That just isn't going to happen. But what I do think you could get, and I think is quite likely actually, is a bounce back in the first quarter. We've had that in the past 2 years, remember, and there's a bit of a question about the seasonality of the ONS data. We tend to get quite a big jump in 1Q, and there are also some temporary factors that will help that. So we've got the doctor strikes at the moment that will obviously weigh on GDP in December, but lifted in January. You've got the stuff around car production as well. And also you had the uncertainty around the budget, and the PMI, going to your question, Anna, gives some sense of, or effectively, the economy has done a lot better coming out of this budget than it did coming out of the budget in 2024 when the PMI nosedived. So I think
that is important.
That is important. All of that said, I think it's definitely the case that the risks for the economy next year are to the downside, not to the upside.
All right, thank you. Thanks to Dan Hansen, Chief UK Economist for Bloomberg Economics, regular contributor to this programme, of course, and we'll be diving into the Bank of England, of course, in future hours of programming on this channel. Let us go, though, from the Bank of England to the ECB. Traders are betting the ECB is done with interest rate cuts, but recent hawkish noises have spurred markets into pricing the next hiking cycle, just starting to, in a far-off kind of way. Alex Weber, Bloomberg's ECB and European economy reporter, joins us. Alex, so a hold is widely expected. We're also going to get some new forecasts today. So what should investors be looking out for?
Yeah, indeed, as you said, the actual decision is not going to be the most interesting thing about today's event. But the forecasts that you just mentioned, they are going to be quite interesting because we expect them to show an undershoot of inflation for the next 2 years, actually. And investors will be looking closely at just how deep and how long this undershoot is going to last. And it will be up to the president, Christine Lagarde, to explain why the ECB doesn't need to cut despite such an undershoot. She will likely argue that it's quite small and that inflation is going to be back to 2% at the end of the horizon. But that is certainly one thing to watch. The other thing is the recent market moves. As you just said, markets have started to bet on a hike. One economist explained to us that this sort of repricing is actually equivalent already to one hike. And the question for the ECB is whether this is what the economy really needs at the moment, given this inflation undershoot of the next 2 years. So it'll be really interesting to hear what Lagarde has to say about this, whether she wants to pour a bit of cold water on these kind of bets or whether she kind of endorses them, even implicitly. So that would be very exciting. Another thing that could come up in the press conference is actually Lagarde's succession. In a recent interview with us, Executive Board member Isabel Schnabel threw her hat in the ring, even though Lagarde's still in the job for another 2 years. But this is a topic that could come up in the press conference.
Not backward about coming forward, is she, Isabel Schnabel? Alex, thank you so much. Happy ECB Day. Alex Weber, Bloomberg's ECB and European economy reporter in Frankfurt. Well, shortly after the breaking of the ECB decision, we're also going to get a double release of US CPI. That's at 1:30 p.m. UK time, and we can get a preview now with Valerie Teitel. She's back. Val, I wonder how much confidence this print could give us that actually the peak of inflation is past or passing soon.
Yeah, well, our own economist here at Bloomberg, Anna Wong, does think there will be hints that goods inflation is peaking in this report today. It might be something that could give some confidence to the equity market, which has seen so many wobbles this month of December. However, the big risk out there is that this print could be just as noisy as the non-farm payroll print was 2 days ago. It is a double print, so we are going to get some components from October. Some will be interpolated. We'll get all the data for November. But even Powell himself said at the press conference last week that a lot of this data has a lot of distortion in it. So the market might shrug off the data it doesn't want to think about, essentially. And that would be an upside reading on core goods that might show us some hints that maybe tariff-induced inflation should still be one of our main concerns next year.
Well, that's interesting in the context of Christopher Waller, who seems to be focused on the dovish side.
Yeah, exactly. We heard from Chris Waller, another candidate tipped for the Fed chair. He said yesterday that he is quite confident that inflation won't reaccelerate this year, and that's why he is in the camp that the Fed should continue cutting into next year to protect the labor market. But again, a theme like this could really be disrupted by what we see today if perhaps we do see an unexpected rise in core goods, leading us to perhaps worry that maybe tariff-induced inflation still has more to come in the next few months.
Okay, Valerie, thank you very much. Valerie Teitel joining us there with the latest on some of the things we're looking ahead to in the US trading day. Also in the US session ahead, NASDAQ futures are up by 0.7%. The Micron story, it seems, turning a corner from yesterday. We were all worried about AI valuations, and that sent stocks lower in the United States. Well, today looks a little bit different. US futures pointing a little bit higher. European stocks are pretty flat as we wait for the ECB and the Bank of England. The Pulse is next. This is Bloomberg.
key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. EU members meet in Brussels as they seek to approve a massive loan to Ukraine backed by frozen Russian assets. The focus turns to central banks later, with the BOE and the ECB both set to deliver their final rate decisions of the year. Plus, BP appoints Meg O'Neill as chief executive as the oil major looks to revive its fortunes following a botched pivot towards renewables. So there is quite a lot going on. It is also the last full trading week of the year. There's a lot going on in the world of central banks, but also we always look at valuations, and we'll have a little bit of a focus on Ukraine and on AI as well. Now, stocks, look, they're trading a little mixed after an upbeat forecast from the largest U.S. memory chip maker, helping, I guess, to put the brakes on this tech-driven sell-off. It's a busy day for data. It's a busy day for central banks. Traders waiting for the U.S. inflation data, reading for pointers on the path for interest rates. So, of course, the data risks being less reliable than usual due to the government shutdown disruptions, and it is a little bit backward-looking. The U.S. 10-year yield at 4.1334. You can see yen. Big decision tomorrow, 155.87. Also, breaking news out of Germany. Germany plans to sell a record 512 billion euros in debt in 2026. Now, the other story we're watching out for is the Norges Bank leaving its benchmark interest rate at 4% as expected. Let's also take a look at the European markets map. A lot of the valuations will follow what we're seeing in the U.S., but China, Micron Technology shares climbing some 8% in late trading after giving a revenue prediction that actually beat estimates. So we're seeing a little bit of a lift for some of the European stocks that are tied to the world of tech. Micron Technology, you can see pre-market getting some 9.9%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacroix here in London. Now, investors are retreating from tech ahead of key central bank decisions. So we discuss in just a moment with Catherine Nice, Chief European Economist at PGIM Fixed Income. But first, we start with geopolitics and the Russian invasion of Ukraine. Now, the President of the European Commission, Ursula von der Leyen, says the EU aims to agree funding for Kyiv by the end of the day. For more, we're joined by Stephanie Baker, Bloomberg senior writer and author of Punishing Putin. Let's also bring in, of course, from Brussels, Oliver Crook, Bloomberg's chief Europe correspondent. Ollie, bring us up to date with the latest developments. You also had a great conversation with the foreign chief of the EU.
Yeah, that's right, Francine. As we're watching all the European leaders walk into the council building here this morning, there's a big question before them. In fact, there's a couple of them. But the main one, will they or won't they? Will they move to seize these Russian assets, to monetize them, to get a 90 billion euro loan to Ukraine? The Russian assets and that loan is seen, and this is what Zelensky told me just about a month ago, as a matter of survival for the Ukrainians. At issue here is whether or not the Belgians will fall in line. We spoke to the Belgian Prime Minister, or we didn't speak to him, but he was speaking in Parliament a little bit earlier this morning, basically doubling down on his position that the EU has not done enough to reassure his concerns about the possible fallout of seizing those assets. I spoke to Kaja Kallas, as you mentioned a little bit earlier, about whether or not we will get a deal. Have a listen to what she had to say just a little bit earlier.
As I see it, Belgium is under a lot of pressure from Russia, from all of Europeans, also from United States. And in order to, release that pressure, we should do the European legislative proposal.
The question is, if they fail to reach an agreement on the Russian assets, what is the path forward for financing for Ukraine? And the answer to that question is very, very difficult to answer. Right now, the member states, most of them do not have any space in their own budgets to move forward with it. The other option would be joint debt at the European level. And Francine, that's probably the only question that is a lot more difficult to solve than seizing the Russian assets. We know how difficult the issue of joint debt is. To fund Ukraine is going to be one that's very difficult. We heard from Friedrich Merz just a few minutes ago walking in, saying that basically the only viable option forward is going to be those Russian assets.
What's the likelihood of the Mercosur deal happening, Ali?
Yeah, Francine, that's the other thing that hangs over this sort of figuratively and also quite literally at these meetings. As I was walking over across the street, all the way down the street, down the council building, a little further down, you see tractors are lining the streets here in Brussels because the farmers are here to protest, among other things, the signing of this trade deal with Latin America. The aim for the European Union is to expand the trading bloc to basically a trading bloc of about 800 million people, in part to reduce its reliance on the American trading relationship. Their idea is to open up trade with Latin America, get this trade deal signed on Saturday, but that has been thrown into doubt as well just over the last couple of weeks. We've had the French who stood up and said that, they may not be on board. I spoke to Maro Sefcovic, who's the trade commissioner for the European Union. He said he's done everything in his power to get the French on board, but still we do not know if we will get a deal. So there's a big question of whether or not Ursula von der Leyen will go to Brazil and sign this trade deal on Saturday. The French and the Italians have said that they want to delay. We heard from the president of Brazil, though. Right. He said that if we don't sign this weekend, we are not signing at all during our tenure as president. So that is the stakes right now for these European leaders on Ukrainian assets and that trade deal with Latin America.
Ollie, thank you so much. Oliver Crook there, our chief Europe correspondent. The EU summit comes as the Trump administration pushes for Vladimir Putin to accept a peace agreement with Ukraine. It's understood that the U.S. is considering further sanctions on Russia in the event that Moscow rejects a deal, including targeting vessels in its so-called shadow fleet of tankers used to transport oil. We're also joined by Stephanie Baker, our senior writer and author of Punishing Putin. So, Stephanie, it's just been a big 5-6 weeks to understand where the conflict goes next. How likely is the U.S. putting extra sanctions on Russia?
Well, what we've seen, just intense negotiations and a flurry of meetings over the past few weeks, and European leaders with Ukraine and the U.S. seem to have come to some sort of agreement. So the big question is, what is going to be the response from Moscow? And what you saw yesterday was Putin give a very aggressive speech saying that, calling European leaders swine and vowing to fight for what he saw as Russia's heartland. So it doesn't sound like Moscow's ready to accept the kind of agreements that were drafted between Europe, Ukraine, and the U.S., and I think there's division within the Trump administration as to how to respond. You have the sanctions hawks, which are Treasury Secretary Scott Bessent and Secretary of State Marco Rubio, who I think are pushing for more sanctions so that if there is a negative response from Moscow, that they will go ahead with that.
Is there anything else that they can do to pile on the pressure on Putin for this moment, especially if they want something by Christmas?
I think the sanctions are probably the the main signal they're planning on using, and it would be for the U.S. to finally catch up to Europe and the UK in terms of blacklisting these shadow fleet tankers. The U.S. has only blacklisted about 215. Trump hasn't done any of that since he entered office, while the EU and the UK have pushed ahead. They've sanctioned between them more than 500. And so I think if the U.S. does go ahead with that and really signals we are going to enforce these sanctions, that if India and China accept these blacklisted tankers, they will be subjected to U.S. sanctions as well. And of course, this has a huge impact on oil prices, right? We've already seen oil prices go up a bit on the expectations that there will be additional sanctions that would take some Russian oil off the market.
So do you think we get a deal by Christmas? I mean, it's like 7 days away.
I am very skeptical. The real sticking point remains this whole issue of territory, which Putin seems to be insisting on, that Russia gets this bit of Donbass that it's been unable to take militarily for more than a decade. And that's just unacceptable to Ukraine. Zelensky said he would have to put that to a referendum under Ukrainian constitution. And just the prospect of having forcible transfer of population, in Europe as a result of this deal is just unacceptable to Europe as well. So I just don't see how they're going to get an agreement on that. It's the proposals to make that a demilitarized zone also don't make any sense. There are a lot of question marks over how that would work, who would govern administratively that territory. So I just think that the details here are super difficult to work out.
Okay, Stephanie, thank you so much. Stephanie Baker, they're a senior writer and author of Punishing Putin. She has a really incredible, actually, look at the Russian economy and how they've managed to change into a war economy. It's a big day for the Bank of England and the ECB, both delivering their final interest rate decisions of the year. Well, joining us now is Catherine Nice, Chief European Economist at PGIM Fixed Income. It's also a big day for central banks. I feel like it's a big week, but we look into 2026 more than anything. Should we start with the Fed, because it's the big one? I mean, the data that we have today is going to be a little bit backward-looking, but the market is firmly priced on like 2 or 3 rate cuts. How will that inform the rest of central bankers around the world?
So my sense is that we will see probably some mild acceleration in growth going into 2026, both on the back of this easing of policy rates and fiscal support. That is a pattern I think we will see not only in the U.S. but also in the Euro area, the U.K. and elsewhere. And the interest rate decisions might be a bit more going in 2 separate ways. So the risks on inflation, I think, are quite different. In the U.S., probably a bit more to the upside, given the prospects of overheating, whereas I think in the U.K., the Euro area, Japan, elsewhere, maybe the risks are a little bit more to the downside on inflation. No. So even though globally we might expect on the real activity side things to kind of move in tandem, those inflation risks and hence the policy outlook could be somewhat diverging in 2026.
Catherine, I mean, overall, and I want to get to the ECB and the Bank of England, but we haven't really, seen the fears of tariffs and trade played out on inflation. Could there be just a delayed effect and we see it into the first and second quarter and beyond of 2026?
I think that is absolutely a prospect, because I think with the kinds of lags that you would have expected, you might not have I think it would have been quite reasonable to anticipate that wouldn't have really shown up decisively in the data until Q4. Now we have this issue that in the U.S. we don't really have quality data in Q4 in a timely manner. So that adds, a whole layer of additional kind of uncertainty that may only become more apparent, as we get into the early part of the year. That said, since we didn't really have a lot of retaliation on these tariffs in other parts of the world, I don't really expect to see a lot in terms of an inflation impact elsewhere. But in the U.S., I think very much it's still a bit of a question mark.
What's your expectation for the ECB? I know Isabel Schnabel gave us an interview last week, which kind of moved markets significantly.
Yeah, woke people up, didn't it?
Yeah.
So
I like that, woke people up.
So because, you know, the messaging from the ECB has been, you know, we're in a very good place, we're staying at 2%, et cetera, et cetera. And I really expect her to, you know, essentially, you know, hammer these messages again today. They are in a good place when it comes to inflation. I think, though, that on the back of this speech from Schnabel, because I think, you know, up until then, the risks, as I mentioned, were very much to the downside. We know that there are base effects coming through in 2026. We now have this delay in the emission trading scheme that's probably going to weigh on inflation in 2028. So if anything, you know, risks to inflation to the downside, and then here comes a governing council member that actually says, well, maybe the next move is up. So I think people will be very focused on any hint in terms of President Lagarde's tone and discussion at the press conference today that would suggest that, you know, this kind of goes beyond just a single member of the governing council and is you know, starting to gain traction amongst them. So I think that would, you know, be you know, something that the market would focus on.
But Catherine, I mean, there's a bit of concerns, for example, in France. But actually, if you see any, you know, bond movements, it's contained to France. It's not kind of, you know, permeating in the rest of the euro zone. What are you buying in terms of bonds right now? What looks attractive?
Well, honestly, you know, this is a triumph. This is a triumph. Post-pandemic, you know, the EU and the ECB, they broke through some political red lines to really, you know, fill in some of the fault lines and to remove some of this fragmentation risk. And we're seeing this. And, you know, although we've seen these bond spreads from peripheral bonds come down quite a lot, I think there is more space to go. And I can't see that there is, you know, that these trends are going to wane. There's a lot of inertia in the periphery that I think can carry us well through to 2026, and that we will sort of see very clearly that, you know, France is the weakest link, and that Italy will have decisively lower spreads than France. It feels like, you know, bold prediction to make, but, you know, we're seeing hints of it already, and that would be my expectation.
I mean, December 18th, we like bold. Yeah, it's like what we're here for right ahead of the holidays. Where do you see the Bank of England going? I mean, it's so the votes are so close every time.
Yes, and it's maybe less of a shoo-in today than many people are now expecting after the CPI print, which really was, you know, a downside surprise. And the reason why I say that is because what you need is the center of gravity within the MPC. That is the governor, the deputy governor. So people like Andrew Bailey, Claire Lombardelli, you need them to be voting in favor of a cut. But if you look at, you know, these new blurbs that we have, you know, post the Bernanke review, both of them really mention concerns around nominal wage growth, that yes, it's easing, but maybe not as quickly as they would like, and still obviously at levels that are too high relative to a 2% inflation target. And here, you know, the data, again, they're easing, but very gradually. And so I think some of those concerns could linger in their minds. I do expect on balance that they will vote for a cut today, but I'm expecting, you know, this old phrase, you know, the hawkish cut, where they reference, you know, lingering concerns around nominal wage growth. It's easing, yes, but is it easing fast enough? Can we really be confident?
And Catherine, what happens for the Bank of England into the first 6 months of 2026?
So my view has been, I've always been more dovish on the Bank of England than the market, and I'm sticking with that. I was feeling pretty good when the CPI data came out. And the reason for that is there's a lot of slack in the UK economy. And I think if you look at near-term inflation trends, so smooth kind of 3-month on 3-month moving averages, it really doesn't look that different from the ECB and what you're seeing in the US. It's not clear that the UK really needs to have such higher rates relative to peers, and I think there is quite a bit of catching up there. So my guess is, my call would be that the Bank of England is at 3% by the summer. Okay. But we shall see. We shall see.
Okay, I like that. Catherine, thank you so much. Catherine Nice there, Chief European Economist at PGIM Fixed Income, with some pretty good predictions. Coming up, AI bellwether Micron surges after the largest U.S. maker of computer memory chips delivers a blowout quarter. More on that next, and this is Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Micron surging after the AI bellwether delivered a blowout quarter and even stronger guidance, a stark contrast to the recent rotation away from some of the tech darlings. Now, for more on all of this, we're joined by Peter Elstrom, our executive editor for Global Technology. Peter, as always, thank you for joining us. So Micron suggesting that the AI boom is continuing.
There is plenty of demand out there. Yeah, Micron gave its earnings results. Revenue was up 57% in the last quarter, and then they gave a forecast for the next quarter that was really far above what analysts had been expecting. They're predicting $18 to $19 billion in revenue. Analysts were more down in the $14 billion range. What they're talking about is there's a serious shortage of memory chips right now. They're not able to supply as much as what the customers want at this point. That's both in the high end, the HBM, the AI-related chips that are out there, and then also in the low end, too. As they talked about on the call, they said this is the most significant disconnect between supply and demand they've seen in 25 years. So they say that it's a very big deal for the industry.
Peter, I feel like, we're trying to reflect on the year that we've had, and it's, a little bit of retail, it's a lot of Liberation Day and the tariffs, and then this idea of AI valuations, especially with data centers, keeps on surfacing, and it's been the theme since September. We have a little bit of news on Oracle when it comes to data centers and CapEx.
Yeah, investors are wrestling with this very idea. What is the AI opportunity out there? How do we value it in stock prices? Micron has been on a tear even faster than NVIDIA. But on the Oracle front in particular, after they reported earnings last quarter, there have been some questions about what are their obligations and do they have the financial resources to be able to meet those obligations? So one issue that came up recently is their rent obligations soared to $248 billion, where they're renting out space in these data centers. These data centers around the country. Now what we found out is for this project in Michigan, Blue Owl, which is supposed to be the equity partner, is pulling out. Instead, they have a replacement. Now, Oracle says everything is still on track. They still think that they're going to be able to meet demand for the construction of this and be able to roll out these leases. But the financing looks a little precarious to some investors, and Oracle shares gave up some of their gains yesterday.
Peter, 2026, is it all about valuations, data centers, and actually what the Chinese players are doing?
I think it's about execution. execution right now in the AI front. Companies like Oracle, like OpenAI, Microsoft, and the others have to prove that the tens of billions, hundreds of billions of dollars that they're pouring into this industry are going to begin to pay off. There will be some winners and there will be some losers. I think some will be more successful than others.
Okay, Peter, thank you so much. Peter Elstrom, our executive editor for Global Technology, who I know will continue being busy for at least the next 5 to 10 years. Now, UK retailers have been bracing for a bumpy Christmas with inflation and uncertainty over the government budget, potentially hurting sales, at least for those who like to do their festive shopping early. So let's go over some of the corporate stories this morning and how the sector is shaping up next year with Andrea Felstedt, our Bloomberg opinion columnist for consumer goods and the retail industry, who's been very generous with her time in 2025. You always bring us up to date with what's going on in your world, so thank you, Andrea, for that. So what's going on with Currys?
Currys have had a better performance and the shares skyrocketing, but it's mainly to do with the Nordics. They said the UK consumer is muted, subdued. They are still spending, so health and beauty is doing well. Those LED face masks that are everywhere, they're selling well for Christmas. Coffee machines, gaming, and AI computing. But the consumer, was a bit more subdued with the budget.
Yeah.
Maybe it wasn't quite as bad as feared, but it probably came too late to save Christmas. We had a lot of discounting over Black Friday. The discounting has continued. I don't think it's going to be a cracker. I don't think it's going to be a turkey. Maybe like a ho-hum Christmas.
But that sounds about right. Microwaves are out and LED masks are in.
Yeah.
What are we expecting from Nike?
It's all about, are we seeing any signs of the turnaround coming? He's been there for sort of just over a year, October 24. It takes 18 months to 2 years for the products to come through. He's been making progress on running. He's been making progress on clearing out those stale, out-of-fashion sneakers that nobody wanted. We had Nike Skims launch eventually after a delay. It's really all about, are there any signs of a turnaround? And it's a big year next year. We've got to see some good products coming. We've got the Winter Olympics. We've got the World Cup on Nike's home turf. It's going to be a big moment. It's all about what he says about the outlet.
Okay, that's exciting. And then no one wants an activist investor on your back. Elliott revealed they have a big stake in Lululemon.
That's right. And it's interesting, they have a CEO candidate, Jane Nielsen, who worked at Ralph Lauren. As we discussed, Ralph Lauren's had a brilliant turnaround. She's certainly got all the credentials. She was ex-finance director. She was COO. She certainly could do a lot of the things that Lululemon needs, but I think the thing it needs most is someone who's good on product, to really, bring people in to buy the leggings, to buy the gym wear, and really get excited about the product again. And I'm not sure she's the right person. If they bring her in, they need to also bring someone else in on the product side.
Okay, that's so interesting. Andrea, overall, 2026, it was a bit bumpy for luxury, but then actually we ended up in a better place than we thought we'd be at the beginning of the year.
Exactly. I think luxury, it's all about, do the Chinese come back? Does the Chinese... And we have had some tiny signs that China is stabilizing, is improving a bit. The US consumer, the top-end US consumer is back. The aspirational middle-class consumer is still nervous, but the top-end US consumer is back. We saw Chanel do their show in New York. That was a real signal that, these top luxury brands are really catering to the US big spenders. After 2 years of decline, the analysts are expecting a bit of growth next year. But then this time last year, we'd had a bounce after the US election. Everyone was expecting, particularly the US, to do well in 25, and then we had Liberation Day. Everything sank. So at the moment, it's looking happier. We never know what's around the corner.
Andrea, I have to ask you, by popular demand, because the gallery and the producers love Oasis. So that's a starting point. And thanks to Oasis, the 1990s fashion is a bit back, and that's been good for Adidas.
It's been amazing for Adidas, but it comes back to product. Bjorn Gulden, he's been brilliant on product. Probably after the Yeezy debacle, Adidas were in a really bad way, and he spotted that the Samba was trending, and he sped up production, he pumped it out, and it was a tremendous success. You need someone who's good on product.
Yeah, never throw your anything away, because it always comes back in fashion.
Exactly.
Thank you, Andrea Felstead from Bloomberg Opinion. Coming up, in a year marked by mega deals, the battle for Warner Brothers has been a blockbuster finale. We'll be discussing the outlook for deal making with Richard Madden from DC Advisory. That's next, and this is Bloomberg.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
On a visual.
And the analysis you need.
China's not going anywhere, nor are we.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. EU members meet in Brussels as they seek to approve a massive loan to Ukraine backed by frozen Russian assets. The focus turns to central banks later, with the BOE and ECB both set to deliver their final rate decisions of the year. Plus, BP appoints Meg O'Neill as chief executive as the oil major looks to revive its fortunes following a botched pivot towards renewables. Now, tensions over Hollywood's biggest deal are spilling out into the open. Warner Brothers has advised its shareholders to reject Paramount Skydance's hostile takeover bid, saying software billionaire Larry Ellison and his son David, quote, constantly misled them. The battle for the media giant is a grand finale in a blockbuster year for mergers and acquisitions, while Bloomberg data shows global transaction values rising to about $4.5 trillion, the second highest tally on record. Now, for more insights into the M&A sector, we're joined by Richard Madden, European Executive Chairman of the investment bank DC Advisory. Richard, thank you so much for joining us. So first of all, I hear that in the previous world you advised companies on media sales. Is this a political, actually, showdown, or is this a deal like any other deal?
They're never, ever deals like any other deal because they're big and they're high profile. And what they actually reflect is a very, very long-standing battle. And the battle is between content and distribution, whether it was movie theatres to begin with, and then it was cable networks, and now it's streamers. And if you've got content, you need more of it. And if you're a streamer, you want to have the power. So it's a power struggle in the age-old way of Hollywood.
I mean, there's a lot of M&A in media, full stop, because it's quite hard to do media that's profitable, but it has a huge influence. Is that going to be the main theme for 2026 when it comes to media deals?
Yes, I mean, unfortunately, it is not quite two drunks propping each other up, but media companies are struggling.
I like the analogy.
Yeah, and therefore they just do need a bit more scale. They've lost power in the relationship everywhere. They've lost consumers, they've lost their route to market, and it's really, really tough. And therefore coming together to build scale and have more financial weight is a very legitimate defense strategy.
So compared to 2025, how will 2026 be different? Will it still be led by private equity, or private equity then going to sit on a lot of the companies they buy instead of pawning them off?
So 2025 has been a disappointing year. We started with high hopes, and then the tariff tornado blew through and left us with a really very weak M&A market. And so we're down 10%. And there's a little bit of a sign that it's coming back now, but M&A is a long lead time business. So it takes a long time for stuff to happen. Yeah. But we do believe it will begin to happen because private equity have to do deals. If you look at their business model, they buy businesses, they grow them, and then they sell them. That's 2 M&A transactions right there. And so far they've been buying, but they haven't been selling. And so they have to start selling.
But they haven't been selling because of valuations, or they haven't been selling because the business model, frankly, for private equity has changed and they just sit on it much longer?
Both. So they haven't been selling for valuations because essentially they believe that valuations will be disappointing, and they're probably right, and better to carry on than realise that kind of loss. And then the second one with private equity, yes, it is a longer game. It's a 10-year lifespan already. But with 53,000 businesses owned by private equity, it's going to take a long time to clear that through.
Richard, I like the way you basically split a lot of the companies between the highest quality assets, so the best, and the rest.
Yeah.
Is there much more of a divergence than there was 5-6 years ago? And what happens to the rest?
Massively more, because essentially, well, most businesses have. A lot of businesses have struggled during a difficult macroeconomic environment, so they've underperformed. But the real problem is the expectations of the seller, because they look at the best and they think, well, we're a little bit less good than that, so let's have a marginal discount to that. But the buyers are coming from another place. They're coming from the bottom and saying it's a dreadful market, it's a really difficult macroeconomic environment. I'm not inclined to be extravagant. And so that conflict is more marked than I think I've ever seen.
So it's a valuation problem.
It's a valuation problem. And the best do get extraordinary valuations, both in the public and the private markets. But the best is a very, very thin layer.
Richard, how can you tell the difference between the best and the rest? I mean, is it management? Is it just weathering some of the uncertainties? Or is it simply what, in the space you are? So if you're AI for the moment, you're fine.
Well, if you're picks and shovels in the AI gold rush, you're fine. I think that's a great place to be. But actually, AI is a really interesting point, because the first question that most investment committees ask when they're thinking to invest in a new business is, what's the AI risk?
Right.
Because that goes back to what really makes the best and the rest. The rest, you need to have recurring revenue, you need to have good margins, you need to have strong cash flow. And if AI is a threat to your model, it's pretty hard to invest.
What do you tell them? Because we don't really know where AI concretely ends up. I haven't seen, and I was speaking to a strategist at one of the big banks, we haven't really seen the figures of anyone saying, I'm going to implement AI, and you know what, in 2 years, I'm going to lose 20% of my workforce.
Do you know what, Francine? We're guessing. That is the real issue, is that we're guessing, and it's very hard to put numbers on these things. And when people buy a business, they want to be able to put numbers on it. So it's another break on activity. People have a feeling for it, but they can't add it up.
When do we stop guessing, and is that going to be the catalyst?
No, I think the catalyst is actually going to be pressure from the investors in private equity for cash. So the major driver will be that the LPs have been waiting for their cash for years longer than they expected. And so that will be the pressure that will be brought to bear on private equity to start selling businesses at reasonable valuations.
Where do you expect the most M&A to happen next year?
So this year, interestingly, everyone was down by almost exactly the same amount.
Everything was for sale.
Every value was down. And so I think you have to go back to the age-old, there is going to be more technology in the future than there was in the past. There is going to be more defense spending in the future than there was in the past. And with aging populations, healthcare will be popular. So those will be the sectors that people seek to invest in because the long-term secular trend is so strong.
Yeah. Is it money from abroad coming to the UK and Europe, or is it domestic intra-plays?
That's an interesting one. It is my perception that there has been less money coming in from internationally because there is a view that it's not very exciting in Europe. And the excitement is in Asia, particularly Japan, actually. And the growth is in the US. And so the money's really going there.
I was going to say that we're a perception that we're a bit of a mess, but you were much more diplomatic than I was.
Well, I think there are very strong strategic assets, and I do think that corporates will start buying into Europe for strategic market and product-driven reasons.
And how's the UK doing?
The UK's doing okay. But yeah, I think I'm surprised that it's doing as well as it is, but we've always got France to look at and think, well, it's got to be better than that.
I mean, that's what everyone says, the budget. Well, at least we're not France. Richard, thank you so much for joining us. Richard Madden, European Executive Chairman of DC Advisory. Now, BP has selected Woodside Energy Chief Executive Meg O'Neill to lead the global oil and gas giant. The move makes her Big Oil's first female chief executive and comes as the British firm struggles to revive its fortunes after a botched pivot to renewables. Well, for more, we're joined by Mitchell Furman, Bloomberg's Big Oil reporter. I'm sure everybody calls in and says, we're not Big Oil, we're something else, we're renewables. Mitch, thank you so much for joining us. Were shareholders expecting this, and what do we know the new chief executive wants to do with the company?
Yeah, good morning, Francine. This was kept pretty tight. The board, as we understand, has been working on this, and very few other people were looped in. But we do, we know that Elliott, the activist investor, is entered BP earlier this year, and the only public remarks they've made about BP since entering the picture was welcoming the new chairman, Albert Manifold, and calling for urgent fixes. And when Manifold took over on October 1st, he told staff that they needed to move, that the strategic direction was correct, but they needed to move with urgency. And Manifold, in his first couple months, has moved with urgency.
So what do we know about her specifically, and does this have an impact on BP's petroleum strategy or ambitions?
Yeah, I mean, Meg has been CEO of Woodside for 4 years. She expanded the company's global footprint. She had a big focus on liquefied natural gas. She doubled the company's oil and gas output. So the expectation is that she is going to stick with this petroleum strategy for BP. How she goes about that is in question. BP has never hired an outsider for CEO, and so there is bound to be change one way or another.
How are analysts reacting?
Yeah, analysts are a bit surprised, and but they're basically, the timing is a bit surprising, how fast Manifold moved, given he has little direct oil and gas experience, but because there was this major activist in the shares, one analyst said that this was a matter of when, not if.
Okay, so interesting. Mitchell, thank you so much. Mitchell Furman there, Bloomberg's Big Oil reporter. Should we call you like oil reporter in general, or companies oil, or Big Oil? We like Big Oil. Now, the FT is reporting that Elliott Management is preparing a multi-bound flotation of booksellers Barnes & Noble and Waterstones. The paper says a fund manager has spoken to potential advisors about an IPO and could appoint investment banks early next year. The report says London was likely to be favored over New York, given the steady income being generated by the businesses, which could be attractive to yield-seeking UK funds. Coming up, we talk about the importance of philanthropy and giving back with PIMCO's John Studitsky. That's next, and this is Bloomberg.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
For the first time in years, wages are rising much faster than inflation. Remember that. The wages, just look at it. Wages are going up much faster than inflation. How big is that? Very importantly, there are more people working today than at any time in American history.
Well, that is, of course, the U.S. president addressing the nation ahead of the U.S. CPI coming out later today. Now, it's the season for giving, and my next guest is a firm believer that we can all use our talents to give back, regardless of financial background. In his new book, A Talent for Giving, John Studinsky introduces a concept of entrepreneurial giving, an approach to philanthropy that goes beyond financial donations and harnesses skills, expertise, and resources to make a positive impact. Well, joining us now is John Studinsky, author of A Talent for Giving and vice chairman at PIMCO. John, as always, thank you so much for joining us. So why did you find it important to write this book now in 2025?
Well, at the beginning of the book, it's interesting. I referenced Seneca, the Roman poet, who said, "Nothing is worth having unless you share it with others." And I think when I look back to my life, really, I started a food security or a food bank or a soup kitchen when I was 6 years old with my mother, and I was the catalyst in that. So it's always been something I've always been interested in giving, and I've always been interested in human dignity. So it's not really a reaction to 2025. This is a reaction to something different, which is we all have talent that goes well beyond money. And I think to a certain extent what's happened is lots of young people don't think about themselves as being able to give because they associate giving with charity and philanthropy and ultimately money. Money's an important tool, but it doesn't start with money.
But, John, is it more important to do it now because there's a kind of social contract that hasn't really been fulfilled, or that there's a wealth gap that's increasing? We talk about affordability. Do you find it harder for a lot of people now?
I think it's more important now for the planet to embrace it. And I was listening to your last guest talking about artificial intelligence. And one of the things I'm really mindful of, and this is, again, serendipitous, as I was rereading my book a couple of weeks ago, and I was thinking about the AI owners, the AI users, but the AI people who are going to be left behind. And I was thinking, wow, we really need to empower every individual on the planet, particularly those who are gifted to use AI, to understand from a generosity standpoint how to embrace the rest of the planet in AI. So that's one element of giving. So I think it's time. To your other point, you know, we talk about entitlements in budgets. Whether you talk about the European budget, 70–80% of the EU's budget are entitlements in terms of pensions, educational cost, other social welfare. I think that whole system needs a rethink. but it's going to have to go back to starting with the individual and empowering the individual. This book is not a political book about the EU or anything else. This goes back, this is a personal book about how individuals can look at themselves.
Yeah, you talk about the 5 T's.
Yes.
What are they?
Well, there's the obvious one, time, which is the most powerful one. I think we all have time, and teaching children in school to volunteer 2 hours, 4 hours, 6 hours a week when they're 10, 12, 14 years old will be transformational for life. Treasure, of course, you say that's money. You know, treasure is not entirely money. It's money that's been engaged in some type of partnership where there's an element of trust. But there's also more rigorous T's like temerity, not giving up, tenacity, and there's a whole host of others. Tribes, the power of 2. I mean, I love the T's, but actually it's all around different ways to approach harnessing your talent.
I like that because it makes it very real instead of the concept of charity, which people maybe find hard to know how they can get involved with. Because you talk about technology again extensively in your book. Is it also a way to reconnect with humanity?
Well, it's interesting because I've had a lot of focus groups of young people between the ages of 15 and 30. And that group is probably the most facile on technology and social media. But it's also the group, as you know, that is the most challenged through depression and mental illness as a result of social media. The Jonathan Haidt book, wonderful book, Age of Anxiety. Having said that, when you ask them what they're passionate about, young people generally cannot respond in a very quick fashion. If you ask them what they're angry about, they are very articulate. This group is one of the best groups at the power of convening, which is using ties. So I actually think, and you saw this in China during COVID, the ability to use technology to convene people's reactions to the government's response of COVID. This young generation can do the power of convening, and that's a talent. I think one of the things, Francine, we think the word talent means you're a great broadcaster. You're born, and it's your 5-star talent. Most of our talent is gray. It's neither black nor white. You have brilliant talent. I have brilliant talent. But some of my other talents are probably even more powerful when it comes to, in my view, promoting the common good.
Which is also, I love this book because it's also about harnessing that. Thank you, John, for joining us. It's a brilliant book and actually so important in this day where maybe we do get lost in all of the news and all the things that goes wrong in the world. John Studinsky, PIMCO Vice Chair and author of A Talent for Giving. Now, EU members are meeting in Brussels as they seek to approve a massive loan to Ukraine backed by frozen Russian assets. Belgium has been opposed to the plan, and earlier we spoke exclusively to Kaja Kallas, the EU Commissioner for Foreign Affairs, and asked her if the bloc can finally get a deal over the line.
We have to. Putin is banking on us to fail, and we can't give him that.
And so what gives you that sort of confidence in terms of getting there? Do you think that have you heard anything from the Belgians? Do you think that there is the sort of will there? We've heard Friedrich Merz in the last couple of days really throw his weight behind this. Is that going to be helpful?
Well, there are a lot of European leaders who are supporting this, and of course also addressing the concerns that Belgium has. I mean, over the last weeks and days, there have been a lot of negotiation. Hopefully we'll get there. President Costa has said that we are not leaving the meeting until we have a deal. How long the meeting will last, that is a question.
So I guess you'll be locking the doors. In terms of the agreement, we're hearing now from the Belgian Prime Minister speaking before Parliament. He appears to be doubling down on this idea that they're still very resistant to using the Russian assets. Is there a path that excludes Belgium that would touch those assets? Is that on the table?
Well, Belgium has the majority of the assets, so I think many member states have also said that they want to be confident that Belgium feels comfortable with the solution. But as I see it, Belgium is under a lot of pressure from Russia, from all of Europeans, also from United States. And in order to, release that pressure, we should do the European legislative proposal, because then it's Europe that is responsible, all of us responsible, and it takes the the burden off Belgium.
But this is something I think I found very confusing from the very beginning. The Belgian sort of concerns about this seem very, very reasonable. And, you know, of course, 27 member states, or let's say 25, backing up 140 billion euros doesn't seem impossible. It's hard for me to understand really the crux of what is at issue here, because this seems like a reasonable concern and something that the EU is really eminently able to resolve.
Absolutely. Yeah. And that's why I think, again, you know, if we have the European proposal, then Belgium is just abiding the law. So anybody who has anything to say against can go to court against the European Union, which means that everybody, all the European countries are liable.
And I'd like to see, sort of frame this in a much larger context and how you see this, because I think it's very hard, no matter how you feel about the Russian assets, to hear every day for 4 years from European leaders how important it is to support Ukraine, and then the moment of leverage for the Europeans, really their last remaining point of leverage on the Russian assets, unable to get it over the line. What does that say about European power and about sort of cohesion within Europe if they're not able to get this over the line, just given the rhetoric we've heard for the last 4 years?
Well, it shows that we are 27 very strong democracies. I mean, and in democracies you have discussions and debates, and everybody comes with their domestic issues as well. But I think, you know, also we have had some very difficult moments in the past, but eventually we all come together and come to the decision. Considering that Belgium's concerns also have been addressed recently, I really truly hope that we get this over the line.
Kaja Kallas, the EU Commissioner for Foreign Affairs. Now, the Bank of England and the European Central Bank are set to deliver their final rate decisions of the year. Let's bring in Ven Ram, cross-asset strategist for Bloomberg Markets Live. Ven, great to speak to you. We have this news story saying that Germany will boost a lot of its debt sales to a record because they then need to use that money to spend. How will that change dynamics in Europe?
Morning, Francine. I think that, you know, it is a game changer for Europe in terms of its growth trajectory and, you know, in terms of Germany's own fiscal rectitude. I think that, you know, because Germany is going to be spending a lot more on infrastructure and defense, it's going to push up growth. And I think we are going to hear from the ECB's President Lagarde later this afternoon saying that, you know, the ECB's economists expect the Eurozone economy to grow much faster next year. And also, it would be interesting to see what the ECB's economists think that implies for inflation. They penciled in core inflation of 1.9% for next year in September, but with Germany's heightened spending, I think there is a chance that they may revise it higher. And if they revise it higher, then certainly there is no case for the ECB to be cutting rates next year, albeit they may be on a long hold before the next move being a hike, as Isabel Schnabel alluded to recently.
Yeah. Yeah, that was quite a game changer. I think I had Catherine Eichsford-Pigeon that saying after that Isabel Schnabel interview, people were suddenly very focused. What should we expect from the Bank of England today, and how will that affect what they do next year?
Well, I think that, you know, the key question for the Bank of England is going to be the margin of rate cut. The markets have already considered that a rate cut is a done and dusted deal. We could get a surprise hold, but if they do cut, the margin of cut will be what matters for the markets. I think a 5-4 outcome in favor of a rate cut would be just about neutral. Anything like a 6-3 or a 7-2 even would be extremely dovish for the markets. The markets will then factor in a terminal rate of probably 3.25%, which I think may get a bit of pushback from some of the BOE members. I think 350 is more likely where they will end up. So I think that one more rate cut next year is likely, but that remains to be seen. It will come down to the voting pattern today because there is no press conference.
Yeah, Ven, overall, I mean, has everything changed actually with Isabel Schnabel saying that we're going to see a hike next year?
Well, I think that, you know, I think it speaks to a concern about the neutral rate. And I think that in a lot of research papers have pointed to the idea that the neutral rate has shifted higher, not just in the Eurozone, but globally. And I think that, you know, what we have seen, remnants of that ripple through in Australia and New Zealand recently with the Australian Central Bank saying that, you know, they are pivoting towards possible hike next year. So I think that, you know, we should be prepared for higher for longer rates.
Van, thank you, as always, for all of your time, and also thank you for being so available to us in 2025. Coming up, of course, we'll have plenty more from Bloomberg Brief. It's a big day on data, and then we had yesterday that President Trump speech on affordability. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger, in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know this Thursday. Stocks rise after nearly 2% drop in the NASDAQ 100 as investors look ahead to the latest inflation prints, plus we get rate decisions from the ECB and the BOE. Meanwhile, President Trump lays out plans for holiday bonuses and housing reforms as he attempts to ease price anxiety. And Micron out with an upbeat forecast citing surging demand and supply shortages, allowing the chip maker to flex its pricing power. And maybe we needed some of that good news for tech today after, as I mentioned, we saw a big drop in the NASDAQ 100 yesterday. Futures up 0.8%. Oracle rebounds after trading at a 6-month low yesterday. Those fears were apparent in this market. The S&P also rebounding after 4 consecutive days of declines, up 0.4%. For this bond market, we also get some buying on its way. We're down by 2 basis points for the 10-year yield, 2-year yield, 30-year yield goes down by 1 basis point. A lot of events today. You have CPI, ECB, BOE. By the way, we're going to speak with Callum Pickering of Peel Hunt later, who basically says all of those will be nothing burgers. We'll see whether that's the case for this market, too. In the meantime, let's get you some stocks to watch this morning. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with maybe the reason why we're seeing this positivity in the NASDAQ futures this morning. Micron higher by 10% after their earnings. They gave a very rosy revenue forecast for next year. And it's really this backdrop of memory chips, which Micron is known for making, essentially having an issue where demand is outstripping supply. The CEO saying on a conference call that they're only able to fulfill around 50% of their key customer orders. orders, and that comes after warnings from Dell and HP that we might see a memory chip shortage next year. So Micron shares trading higher this morning, dragging the NASDAQ with it. Let's move over to the retail sector. Lululemon, a new news here. We have Elliott Investor, the activist investor Elliott Management, taking a $1 billion stake in the company. We're seeing shares trade higher by 5.25%. Danny, they might be bringing a new CEO with them. That comes after Lulu announced just earlier this week that their CEO will be stepping down in January. Lastly, I want to talk a little bit about the energy sector. Sable Offshore. This is an offshore driller based mostly in California. Understood that they have a key pipeline that has now been regulated under the interstate rules to be regulated by the looser regulations of the federal government versus the more stricter regulations of the California state. So we're seeing shares of Sable Offshore leap higher by 37% in the pre-market trade. Danny?
Valerie, thank you for those, and we'll catch up with you later in the program as well. And also coming up this hour, we're going to drumbeat to CPI data. As I mentioned, Callum Pickering of Peel Hunt will be joining us. But first, let's get right to the primetime address from President Trump last night.
Here at home, we're bringing our economy back from the brink of ruin. The last administration and their allies in Congress looted our treasury for trillions of dollars, driving up prices and everything at levels never seen before. I am bringing those high prices down and bringing them down very fast.
Joining us now from Washington, D.C. is Mika Solner of Bloomberg Government. Mika, this seems to be a theme in this White House as of late, a hyper-focus on affordability. How far did President Trump go in trying to either explain or address those concerns? And I don't think we have Mika at this moment, so we will try to fix that setup and get back to her. But again, just to recap, President Trump last night, a primetime address, blaming some of the issues of inflation and affordability on past administrations, saying that he's going to be issuing a check to military families of $1,776 and would have housing reforms and would get a Fed chief into the government that is able to lower rates. We'll get back to that story when we're able to, but and let's do that now. It seems that Mika, I believe we have our sound back, Mika. I think you can hear us now, and hopefully we can hear you. Just give us what the upsum was of this speech from President Trump. I was just mentioning some of it, but how far did the president go in trying to address the issue of affordability?
Yeah, absolutely. Sorry about that, Danny. The president knows that affordability is an issue for the administration. This has been a sore spot for months as Democrats try to use this as a political talking.
It looks like we've lost Mika again. We'll try to get that, try to get some of that reestablished. For now, though, let's turn over to the story in Europe, because pressure is mounting for the EU to approve a loan to Ukraine without the support of Belgium. Bloomberg spoke exclusively to the EU Foreign Affairs representative.
As I see it, Belgium is under a lot of pressure from Russia, from all of Europeans, also from United States. And in order to, release that pressure, we should do the European legislative proposal.
And that is the latest. Again, there's a question as to whether this proposal will go through, the Mercurial proposal, and where the EU stands on this and how they push it through without Brussels. All right, let's get a quick check on your markets again this morning, because we have a lot going on between the different things of Trump trying to address affordability and what we are doing with different rate decisions. The S&P moves higher this morning by 0.4, NASDAQ 100 by 0.7%, and Russell 2000 moving up by 0.3%. Again, we're going to get CPI, but we're also going to be getting ECB and BOE decisions. Let's get some other top stories that are trending on the terminal this morning. U.S. prosecutors have charged the founder of bankrupt subprime auto lender Tricolor with conspiring to defraud lenders and investors. The indictment accuses executives of using various schemes, including double pledging auto loan collateral and manipulating loan descriptions. Tricolor filed for bankruptcy in September after shutting down over 60 locations across the U.S. Southwest. By the way that they found the fraud was a junior analyst at one of the lenders, not even one of the big ratings agencies. More money for OpenAI. That's according to the information. The maker of ChatGPT is said to have held funding talks with investors to raise tens of billions of dollars at a valuation of $750 billion. All of this coming after a report that Amazon is looking to invest $10 billion and sell its chips to OpenAI. And China has secured at least 7 million tons of U.S. soybeans after heavy buying in the past 2 weeks. It had passed the halfway mark towards meeting its 12 million ton purchase agreement with the Trump administration. China is yet to confirm the details of its deal with the U.S. Let's get back to another potential deal, and that is what's happening in Ukraine. Joining us now in Brussels at the European Council is Bloomberg's Ollie Crook, who is interviewing the EU Foreign Minister. Ollie, where does the EU stand as these talks begin?
I think that walking into this meeting, no one really has an answer to that question, Danny, which makes this meeting quite exciting, but also quite worrying if you're sitting in Kyiv and awaiting a 90 billion euro loan that will finance your war effort, but also your economy, 2/3 of that entire budget for the next 2 years, waiting in the balance. When I spoke to Zelensky just a month ago, he said that for them, getting this money over the line from the Russian assets is a matter of survival, and we have heard a vast panoply of different opinions walking into this chamber. We just heard Emmanuel Macron walk in. He said that there will be a deal of some description. There will be an explanation of some kind of how Ukraine will be funded, but not necessarily through the Russian assets themselves. We've heard from the Belgian Prime Minister speaking to his own parliament this morning. And remember, this is a decision that ultimately will come down to the Belgians. They have been blocking any European action on these Russian assets. They're not yet convinced of the legal safeguards that the country Belgium would get in order to move on these assets. That's where those assets are being held. And that is going to be the main debate here. We heard from Friedrich Merz, the Chancellor of Germany, when he was walking in. He says there's basically no other option. They talk about potentially issuing Eurobonds, doing joint debt at the European level. But Danny, you know as well as I do that that is probably the only issue that is more contentious than seizing these Russian assets. So going into this meeting, I'd say this is one of the most important EU leader meetings we've had in quite a number of years, and we really do not know which way the story is going to go.
It feels like that's been the case for so long, Oliver, that we've been at a stalemate with difficulty in actually getting an agreement done. So what happens in this case? What happens in the conflict if the EU can't agree?
Well, I think, Danny, there's a lot of different things that happen. The first priority is going to be getting that money to the Ukrainians. As you know, the French government's falling every 5 minutes because they don't have enough money in their budget to service their own needs. It's hard to imagine, them being able to pay for issues like funding the Ukrainian military for the years in the future. And that's the case for a number of different European countries. That will leave potentially funding from the European budget. There's not a huge amount of headroom there, which will then enter this conversation about joint debt at the European level. And Danny, as you know, from your time in London covering European politics, that is one of the most contentious issues that we get here in Europe. So as far as many of these leaders are concerned, really the only path forward is with the Russian assets. But I think it would add yet another sort of echo to this narrative that we're hearing from the Trump administration that Europe is basically in decline, it doesn't have its act together, and is basically weak. If they can't get this over the line, what good is it to hear from European leaders every day for the last 4 years, we need to support Ukraine, and when it comes to putting their money where their mouth is, they fail to do so?
Actually, Oliver, that's a good point, because there has been an attempt of pressure from the White House and a lot of American barbs thrown over Europe's ways. To your point, Trump warning about a total collapse of civilization. Is the U.S. playing any part in continuing to pressure, let's say, Brussels to get an agreement done?
There is definitely pressure from the Americans. The pressure that originally came from the Americans from the Biden administration was to move on those Russian assets and actually do that very quickly. The Europeans were too reticent to do that a couple of years ago. Ever since Trump came in and says, listen, we're done writing checks for Ukraine, Europe, you figure it out, that's when this debate was really sort of resurging here. But we've heard under the Trump administration that actually there has been pressure from the Trump administration on a number of countries within Europe, including the Belgians, basically saying, don't touch the Russian assets. We want the Americans to basically govern what happens there. We want that part of our own trade negotiation, our own peace deal with the Ukrainians. So they're coming under pressure from the Americans to not move on these assets.
Oliver, thank you so much for your excellent reporting. That's Bloomberg's Oliver Crook. Coming up on the show, we're going to count down to the BOE and ECB rate decisions. Stay with us. You're watching Bloomberg Brief.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
You're watching Bloomberg Brief. I'm Danny Berger in New York. The Bank of England is expected to deliver a pre-Christmas interest rate cut later today. The focus shifts away from inflation towards the UK's struggling economy and jobs market. Joining us with the latest on this rate decision and the ECB is Bloomberg's Lizzie Burden. Lizzie, set it up for us. How dovish a cut are we expecting?
Well, the expectation, Danny, going into this was that you'd have a 5-4 vote split on the Monetary Policy Committee. But then we had that weaker than expected UK inflation print yesterday. So actually, you could see more doves joining the rest of them. And it's set to be the Bank of England Governor Andrew Bailey, who was going to be the knife edge vote decider. But he could have some more backers this time. That split, that CPI print, of course, made traders add to rate bets for next year. Let's see if the guidance today encourages them even further. I don't think they're going to drop the language about the easing ahead being gradual, but I'm also interested to see how they assess that latest UK budget from Rachel Reeves, because she did loads of measures to try and weigh on the cost of living. Does the Bank of England think that that'll have a long-term effect, suppressing inflation expectations? Also interesting that you've seen growth contracting in the latest GDP figures for October. Does the Bank of England actually revise down its outlook for Q4 2025 off the back of that? And it comes back to the Chancellor again because of all of that speculation, Danny, leading up to her budget.
It's a busy time in that region, Lizzie, because we'll also get the ECB decision, 8:15 a.m. New York time. Any surprises expected?
Well, I must say, if I'm picking between the two, this is likely to be the more boring one, but do keep an eye on the press conference. They're expected to hold, but we get forecasts from the ECB this time, and the expectation is that they'll see inflation undershooting the target over the next couple of years. So Christine Lagarde's got to balance that messaging with pushing back against, if she wants to, Isabel Schnabel's commentary that the next move is going to be a hike. You saw such a hawkish repricing off the back of that. Jens Eisensmith at Morgan Stanley says it's the equivalent to 25 basis points of hiking. So if she doesn't, or if she does, it's going to be very telling. The euro extremely vulnerable today, Danny.
Lizzie, thank you so much for that. Looking forward to your coverage of those decisions throughout programming today. Bloomberg's Lizzie Burden. Again, we'll get that BOE rate decision 7 a.m. New York time, and then an hour and 15 minutes later, it's the ECB. Let's head back to Washington, where Mika Solner, Bloomberg Government, joins us now. Mika, it's not just the UK and the ECB having their day in the sun. President Trump giving a primetime address last night. What did the president say?
Yeah, Danny, the president is really focused on his affordability message, and he knows that this is a sore spot for the administration as he continues to downplay criticism about the economy, and polls show that this is a huge issue for the White House. Trump said that he inherited a terrible economy from his predecessor, Joe Biden, continued to blame Democrats for that, also announced military bonuses, which is a new announcement there, and then he says that people just need to be a little bit patient for the one big beautiful bill effects to kick in early next year.
Mika, can I ask about those military checks? because Scott Lincicome of the Cato Institute pointed out that there are at least 10 different proposals with Trump has said that he's going to pay for it, be it the checks, be it a tariff dividend that specifically he'll be paying back with the tariffs. How is this really shifting? Because this is also a White House that's facing tariff threats in court and has also been pulling back on tariffs, for example, to Brazil to try to address the affordability issue.
Yeah, absolutely. I think that the White House is very cognizant of the fact that the tariffs are not always popular, at least privately right now, with a lot of Republicans even supportive of Trump. So they're really trying to make this very positive, saying that this may, raise costs temporarily, but it's in the end, it's going to bring all this revenue. So I know that they're, closely watching legal actions around this as well with the Supreme Court and everything. So this is a huge issue. Trump is very passionate about this issue. He thinks it's a matter of fairness, and so he thinks that this is one way that he can make this a positive.
Hey, Mika, thank you very much. That is Mika Solner from D.C. on the latest from President Trump. Coming up on the show, BP appointing a new CEO, replacing the outgoing chief just 2 years into the job. We're going to have more on that next. This is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Welcome back to Bloomberg Brief. I'm Danny Berger. In corporate news, BP has appointed a new CEO. Meg O'Neill joins the oil giant from Australia's Woodside Energy. Not only is she BP's first female CEO, she's also the first outsider to lead BP. Joining us now is Mitchell Furman. Mitchell, what's the significance and why would BP turn to outside the company to put in a new CEO after not the longest stint of the prior one?
Yeah, good morning. BP is looking to turn around its fortunes, and they announced a strategic reset earlier this year to refocus on oil and gas after years of failed low-carbon bets. And while BP strung together a couple quarters of positive results recently, the new chairman, Albert Manifold, took over October 1st, and he told staff on day one that the strategic direction was correct, but that they needed to move with more urgency. And now he has moved with urgency in just a couple months, immediately appointing a new CEO.
Well, we've also had Elliott, the activist and manager, build up a stake of just over 5%. How much of this, Mitchell, is also purely just pressure from the activist?
Yeah, we received one analyst this morning said that, given that this new chairman does not have much direct oil and gas experience, it was a little surprising how quickly he moved. But because Elliott is in the shares, that this move was probably a matter of when rather than if.
So if we have this move and you have a new CEO who spent 4 years at Woodside Energy with a clear focus on fossil fuels, Mitchell, what does this mean about the lower carbon business of BP? Is this just done for? Do they have any sort of inkling of getting back to more of it? Or is this a clear shift in the company's direction, just really solidifying and putting a nail on that coffin?
Yeah, it appears to be a culmination of BP's, pivot back to oil and gas. In Meg O'Neill's previous job at Woodside, she did shed some of its low carbon businesses, and so, the expectation is after a long career at ExxonMobil, then building up Woodside and improving its oil and gas output, and coupled with BP's chairman saying that the oil and gas strategic direction was correct, that yes, BP will likely stick with petroleum.
Hey, Mitchell, thank you very much for your reporting this morning. That's Bloomberg's Mitchell Furman, as BP is up about 0.5% in the London trade. All right, let's look at some of the front page news, what's making stories across the major publications. First up on the Wall Street Journal, Warner Brothers is pressing Larry Ellison on bid terms. Warner wants Ellison to give a stronger personal guarantee that he's fully committed to the bid rather than relying on the trust. The message, if you want to buy the company, sign on the dotted line yourself. Warner Brothers urged shareholders to reject Paramount's hostile takeover bid. Next up on the FT, Elliott Management preparing a multi-pound flotation of bookseller Barnes & Nobles and Waterstones. The fund manager has spoken to potential advisors about an IPO and could appoint investment bankers early next year. The report says London was likely to be favored over New York. And New York Times, leading with the Trump administration, aiming to strip more foreign-born Americans of citizenship. An official with U.S. Citizenship and Immigration Services says that it would prioritize those who've lawfully obtained U.S. citizenship. Under federal law, people may only be denaturalized only if they committed fraud while applying for citizenship. And those are your front page stories. All right, as we head to the half-hour mark, here's where markets stand. Yields, you get a bid. Yields move lower by just under 2 basis points. We're at 413.53 this morning as the S&P future session bounces back after 4 consecutive days of losses. Does that change, though? Because coming up, it's a busy day ahead. CPI, BOE, ECB will break it all down with Callum Pickering of Peel Hunt. That's coming up next on Bloomberg.
would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later on over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger, in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know this morning. Stocks rise after a nearly 2% drop in the NASDAQ 100. Investors look ahead to the latest inflation print, plus rate decisions from the ECB and BOE. And Micron is out with an upbeat forecast citing surging demand and supply shortages, allowing the chip maker to flex its pricing power. And President Trump lays out plans for holiday bonuses and housing reforms as he attempts to ease price anxiety. Equities this morning bouncing back after 4 consecutive days of losses. Yesterday, dragged down by Oracle. This morning, pushed up by Micron, which Valerie Teitel will lay out in just a moment. You're up by 0.7% for the NASDAQ. S&P higher by 0.4%. Russell by 0.33%. Meanwhile, for your bond market, they get a bid this morning. Over the past month, they have been drifting higher, led by not only concerns about the extent of the Fed to cut, but also by international bond markets also moving higher. But this morning, we're lower by just under 2 basis points for both the 2- and 10-year yield. Your 10-year yield this morning standing at 4.1353. Let's get to some of those stocks to watch, including Micron. With that is Valerie Teitel. Hey, Val.
Good morning, Danny. Let's start with Micron. Shares are flying higher in the pre-market, up over 10% after they gave a rosy outlook in their earnings release yesterday. The CEO talking about the supply and demand imbalance when it comes to their memory chips that they produce. They are still unable to fulfill all of their key customer orders. Their backlog is continuing. It does spark some concerns, though, that we could see a memory chip shortage next year. That is something that both HP and Dell have been warning about of late, but it's rosy for Micron's outlook and their earnings. Shares are up 10%. Let's move on to the retail sector. I want to talk about Lululemon. And activist investor Elliott Capital Management is taking a $1 billion stake in the company and might be bringing a new CEO with them, an ex-executive from Ralph Lauren. Shares of Lululemon higher by near 5.5% in the pre-market trade, and it comes just on Friday that Lululemon gave a rosy outlook, upgraded their guidance, and did announce that their CEO will be stepping down at the end of January, and that comes amid essentially a sluggish sales growth for the retailer. Lastly, I want to talk about Instacart. This is a Reuters report that the FTC is probing their use of AI pricing tools. Now, Instacart has denied these allegations, essentially saying that they are false, but we are seeing Instacart sales fall by over 6% in the pre-market trade. AI pricing and the use of AI tools has become kind of a regulatory hot point of late. Danny?
Valerie, thank you very much for your work this morning. Valerie Titel. It's going to continue to be a busy morning ahead for markets. There's a Bank of England decision at 7 a.m. Eastern. ECB comes an hour and a half later at 8:15. Finally, then we'll get U.S. CPI and jobless claims 15 minutes later at 8:30 a.m. Joining us now is Callum Pickering, chief economist at Peel Hunt. Callum, any of those have the potential to be surprising or at the very least interesting?
Well, it's always interesting over here in Europe. Good morning, Danny. I think the Bank of England is actually the one to watch. We'll have an uncontroversial rate cut. Money markets put a 98% probability on a cut today. I think that's probably right. Question is the Bank of England prepared to send a signal to markets that they can expect a cut as soon as February, which would be the meeting to follow? I think there's a chance we could get a dovish surprise. Central banks care about three things: inflation, labour markets, and growth. And on all of those measures, looks like the Bank of England has space to do a bit more. We've got disinflation in the UK happening faster than the Bank of England and the market expect. We've had no growth since summer, and it's mainly a story of weak demand. And wherever you look in the labour market, you see weakening. Wages are coming down rapidly. Vacancies are dropping off. Remember, monetary policy works with a lag, so the danger is if the Bank of England doesn't get to neutral a bit quicker, we end up with some undershoot heading into next year combined with growth weakness. So I think the bank's going to signal today we're ready to do a bit more.
Can we talk about why U.S. CPI is less instructive, Callum? Is it an issue of just delayed data, difficulty understanding without having the month-on-month change because we lacked that other data from the shutdown? Or is it a Fed that's moved on from inflation? What makes this perhaps less significant than CPIs of the past?
Well, first, it's sort of expected. You'd need a really, really big surprise. The other thing is, we don't really have a Fed meeting now for a couple of months, and so there's a question of, well, there's nothing really that interesting going on in the U.S. economy. Maybe things are slowing down a little bit. I think it's just a matter of timing. My hunch actually is the Fed's probably in a similar situation to the U.K. I look at market pricing; it's for 2 more cuts from the Fed. I think we'll get 3 next year. I think the risk is that we get more. I don't think the Fed will tolerate a material slowdown in the U.S. economy heading into next year once inflation has passed through. And so when I look forward, actually, I think as long as we don't get big surprises in the next couple of months of data for the U.S., I think the market's going to start anticipating more cuts from the Fed. So the big story is the Bank of England and the Fed are probably going to be cutting a bit faster than we expect into next year.
Maybe with the longer term or medium term picture for the Fed in 2026, Callum, if you have a setup where the Fed is cutting, you have fiscal stimulus coming from the Trump administration, not just from the one big beautiful bill, but last night he was also talking about more housing reforms and checks out to military members, and you still have an inflation rate that's above 2%. How can inflation fall back to 2% in the face of dual stimulus? Are we undercounting the risk of sticky inflation?
I think that's actually unlikely. Generally speaking, inflation comes from 2 places. One is just a huge surge in demand where everyone just feels so optimistic that they just go out and spend. The problem is mostly that comes from the US consumer that's only saving, well, less than 5% of its income. There's not a great deal more out of income you can spend, and that income is generated through production. So the consumer's not going to generate a huge amount of inflation in the US. The second place is supply shocks. The 2 places you get supply shocks in energy or in the US's case through tariffs. That's a story of the past couple of years. So actually, I'm fairly comfortable next year that if we get to sort of 2.5% on CPI, the Fed won't be worried about a reacceleration. Of course, if there's a shock, you always get a little bit. But I think 2.5%, the market will start saying, actually, come on, Fed, give us a little bit more. We're not really happy with growth at 2% in the US. And I think the Fed will lean into that.
There are perhaps 2 corporate stories yesterday, Callum, that back up exactly what you're saying. One was General Mills saying that they're lowering prices across 2/3 of its products in North America. The home builder Lennar saying that they're cutting prices and offering incentives to try to draw consumers in to afford a home. Callum, these individual corporate stories, do they add up to something bigger?
Well, of course, I'm always an optimist. You know, I'm just totally optimistic on the US, almost always. I'm probably an optimist when it comes to Europe, too. The last 3 years in the US have been really important in helping us understand what the nature of the economy is. So we had a big stimulus from 2022 onwards that kept US growth at basically 3% year over year. This was a full employment economy, remember, and you didn't get huge inflation coming out of that. This was a world in which the Fed was able to cut. And so the idea that we stay at full employment but grow at 2% and have to worry about inflation risks without tariffs, I think this is not something that looks realistic. I think US potential growth is probably in the mid-2s with the AI wave. And so I think it's going to be very, very easy actually for policymakers to start feeding this growth story with rate cuts and tax cuts. And you're just going to see better growth over the next couple of years. The danger comes if you get the kind of supply shock which pushes inflation higher, just very suddenly, then the bond market starts to worry. We've had a bit of that this year. But this sort of stimulus story into next year that keeps the US economy doing okay, I think that's probably sustainable for a year or two.
Callum, though, what if you do get the scenario where you have a BOJ and an ECB that are turning more hawkish, pressuring long-term bonds globally, and you get bond yields moving higher in the US despite a Fed and a White House that's attempting to try to normalize policy? What difference will that make?
I suspect, actually, and so I put together a chart a couple of days ago, and it slightly surprised me because we've been worried all year about upsides to bond yields in both the US and the UK. We've seen a bit of action in Japan and Germany, but actually over the course of the year, you've seen quite a decisive spread narrowing where both US 10s and UK 10s are lower than they were at the start of the year, but for Japan and Germany, they're a little bit higher. I see no reason why this story can't continue, where in the UK, by the end of next year, we're sort of 40, 50 basis points lower on a 10, say 10 or 20 basis points lower in the US, but Japanese and German bond yields have normalized a little bit, and you've had this kind of great bond market normalization heading into next year. Those aren't inconsistent stories in my view.
Hey, Callum, we're going to have to end it there. Always a pleasure to chat with you. It's been far too long. Callum Pickering of Peel Hunt. Let's now get you some other top stories that are trending on the terminal this morning. U.S. prosecutors have unsealed the federal charges against auto subprime lender Tricolor. Among the details that emerged, the blunder that ultimately exposed the alleged fraud was a failure to fix numbers on an Excel file. The company's founder has been charged with conspiring to defraud lenders and investors. Activist investor Elliott Investment Management is said to have built a stake of more than $1 billion in Lululemon. Sources say that Elliott has been working with the former Ralph Lauren CFO, Jay Nielsen, who's said to be viewed as a potential new CEO. The struggling retailer is facing a strategic overhaul in the departure of its chief executive. In other CEO shifts, BP has selected Woodside Energy CEO Meg O'Neill to lead the company. She's the first outsider to lead the oil giant. The move makes her BP's first female chief executive and big oils, and comes as the British firm struggles to revive its fortunes after a botched pivot to renewables. Coming up, President Trump attempts to ease voter concerns on the economy and high prices. More on his primetime address coming up next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Here at home, we're bringing our economy back from the brink of ruin. The last administration and their allies in Congress looted our Treasury for trillions of dollars, driving up prices and everything at levels never seen before. I am bringing those high prices down and bringing them down very fast.
President Trump addressing the nation last night as he faces mounting public anxiety about his economic agenda, with voters worried about the cost of living and inflation. Back with us from Washington, D.C. is Mika Solner of Bloomberg Government. Mika, perhaps the more newsworthy item is not what Trump said, but the fact that Trump felt the need to make this primetime address at all. What does it say about either current approval numbers or how they're feeling about 2026, a midterm election year?
Yeah, the White House knows that affordability is a huge issue for them right now, even though they're not saying that publicly. But internally, privately, a lot of people in the West Wing are really concerned about this. Polls indicate that the president is really struggling on this, and voters are blaming him right now for the economic downfall, despite the fact that he's really trying to shift blame to Democrats and his predecessor, Joe Biden. I mean, he's named him so many times, but I also think it's very notable that, like you said, the president had to make a primetime address, and it was a lot shorter and more scripted than he usually is too when it comes to this issue.
Okay, so let's talk about the address itself. What did we get out of it, Mika? Are we going to see more stimulus coming from the White House in order to try to do something about affordability?
I think it's very possible that Trump is still pushing potential tariff revenue checks as well as military bonuses, which was an announcement that he made last night. I also think that we're going to see Republicans, led by the president, continue to say that Americans just need to be a little bit more patient while their policies start to kick in early next year. They're going to start getting tax relief and, you know, other benefits from the bill that was passed, the reconciliation bill that was passed earlier this year. And we're also politically just going to continue to hear them say that, you know, Democrats did this, we're fixing this, just give us some more time.
Hey, Mika, finally, also overnight, we learned that the U.S. has approved an $11 billion arms sale to Taiwan. Has there been a response from Beijing? What does this do to relations between the U.S. and China?
Yeah, I think it's really interesting, and it's going to definitely simmer some tensions here as China continues to pressure Taiwan. I mean, this is the largest arms sale that we've seen, I think, you know, in a very long time, potentially ever. And I think that this is going to be really interesting for the president as well, who is really trying to make sure that the U.S. stays an ally to Taiwan but also working to try and have a better relationship with China in many ways too.
Mika, thank you so much for your reporting this morning. Mika Solner of Bloomberg Government in Washington, D.C. Now, staying with President Trump's economic proposals, he's pledged to cut electricity costs in half within a year of taking office. Instead, they've spiked, and they are expected to rise even higher through 2027. Joining us now is Bloomberg's Noreen Malik, who's been reporting on this story. Noreen, I mean, I guess we can say why this is happening, right? Is this just all due to the demand that AI is putting on the electrical grid?
It's a big part of it. This particular auction and PJM interconnection serves nearly a fifth of Americans from the Midwest to the Mid-Atlantic. And prices really started to soar for this year, so an auction held last year. And the independent market monitor attributed the three auctions now since then, the two auctions since then, to big data center demand growth. And so this auction used to be for 2 years in a row, $2.2 billion. and now it's $16.4 billion a year. Those are very quickly escalating costs. It's just one component of what consumers in these states pay, but it is very notable and has become a bellwether.
Well, Noreen, as we were just talking with Mika about, when it comes to politics, there is a fear about affordability because that's how voters are voting at the moment. There has been pushback in Michigan. The Oracle data center deal with Blue Owl seems to have fallen apart in part because of politicians there raising some questions about tax subsidies for AI data centers. We also heard from Bernie Sanders earlier this week. Here's what he said in a statement. There's a whole lot about AI and robotics that needs to be discussed, needs to be analyzed. The process is moving very, very quickly, and we need to slow it down. And in part, he cited some of the concerns about not just the environment, but what's happening with prices around electricity. Noreen, are we about to get some serious pushback from lawmakers in what these data center build-outs are doing to the electrical grid?
Yes, we're starting to see that already in this election that just happened in November. The newly elected Virginia governor and New Jersey governors both ran on a platform that included making electricity prices more affordable. And it's widely expected that it will become a bigger issue in the 2026 midterm elections. Consumers are facing inflation from so many different ways, and electricity bills are something that consumers have very little control. And we're hearing from, like in Maryland, the People's Council saying that people are now making a decision between whether they're going to buy food versus paying their electricity bill. And the pushback is growing on a ground level across parts of the U.S., like the Midwest. Other data center projects have been pushed back or canceled.
Hey, Noreen, thank you so much. A really fantastic story. Bloomberg's Noreen Malik. One stock that we're keeping an eye on this morning, Micron, shares extending gains after the chipmaker gave an upbeat forecast for the current quarter and a sign that surging demand and supply shortages are allowing the company to charge more for its products. Bloomberg Tech Europe anchor Tom McKenzie joins us for more. Hey, Tom, great to see you. It's the narrative whiplash, right? One day it's concerned that AI is overhyped with Oracle, and then Micron comes to save the day after the close yesterday.
Yeah, and it's a reminder, Danny, that this is a disaggregated space, that you need to lift the hood and look at what the kind of chip makers are and what space and what role they play in the AI theme. And Micron still plays that essential role with these high bandwidth memory chips, these HBMs that you need in the data centers alongside NVIDIA's GPUs. And they are seeing still massive demand, but importantly as well, the inability to supply that demand. They almost kind of apologize to their clients for this, but what that's leading to is a forecast for the current quarter where profits on the forecast are 80%, a little over 80% above the estimates. They're looking at revenues at the top end of around $19 billion, well above the estimates of a little over $14 billion. And again, profits per share, more than 80% above the estimates for the current quarter. They're going to spend about $20 billion on CapEx to try to meet that demand. But the pricing means, because of that shortage, that inability to meet that demand, it means they do have that elasticity around price. They can push the prices up basically on HBM. They're benefiting for that. That is supporting profits. And most analysts that we've been looking at don't see the price pressures around HBM easing off, certainly through 2026. So they can continue to benefit, it seems, Micron, from higher prices on that demand and that lack of supply.
It's still the picks and shovels that are doing well, and question marks maybe around some of the use cases for other hyperscalers. And speaking of that, there continues to be this question around funding. The information reporting that OpenAI is looking at another funding round. This time it would value them at $750 billion. I suppose, Tom, maybe when this is happening in private markets, it's a little bit more easy to get some of these versus the scrutiny of public markets right now.
That seems to be the case, and it's a reminder as well that OpenAI is continuing to push for that investment. It's burning through cash. We know that, not expect to be profitable at least for a couple of years. And it follows on our own reporting, Bloomberg's own reporting, that Amazon was looking potentially at a $10 billion investment in OpenAI. We haven't had that confirmed yet. But clearly they're getting to the point where they're going to be locking in additional investment, it seems, and potentially with a valuation, Danny, of $750 billion. So not quite at SpaceX levels, but still one of the, if not the second most valuable startup globally if we come through with that valuation. The most recent valuation was $500 billion. So we've already had that $250 billion leap if indeed this valuation is confirmed.
Can we talk about some of the funding concerns, Tom? Because it was really brought to light with Oracle yesterday, as I was talking about with Noreen, with Blue Owl backing out, providing equity for that. Perhaps the fear shouldn't necessarily be a bubble in valuations, but a bubble in financing. Tom, what does it mean if you do have some of these key players? Blue Owl has really been illustrative of the private market spending or the private capital spending that's been going on these tech giants. Can they continue at the pace that they're spending if they don't get the support from those parts of these debt markets?
Yeah, and I think this is going to be such a key question for 2026, and we expect to see a lot more issuance of debt to fund and finance this build-out, Danny. So there are going to be more moments like this Blue Owl moment. There's going to be increased scrutiny from investors looking for that trigger point, the trigger point that says, hang on a second, there is concern in the markets, there's concern amongst some of these debt providers that maybe this isn't all stacking up. And it's worth noting that Oracle has become something of a canary in the coal mine because they've committed to leases of around $250 billion, almost $250 million in terms of lease commitments. That is way above their competitors and other hyperscalers out there. And so Oracle seems to be particularly exposed when it comes to this financing, given those commitments.
Yeah, and they are outright burning cash right now, whereas their competitors aren't necessarily. Tom, thank you so much. Bloomberg Tech Europe anchor Tom McKenzie. And that is it for me. You're going to catch me in just about 10 minutes time on Bloomberg Surveillance. In the meantime, Yahaira Anand will set you up for your trading day. That's coming up next. You're watching Bloomberg Brief.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
This is Bloomberg Brief. I'm Yahaira Anand in New York. Now a look at what's ahead in your trading day. A BOE rate decision coming at 7-8 a.m. Eastern. Then an ECB decision at 8:15, followed by President Lagarde's news conference, plus U.S. CPI and jobless claims at 8:30 a.m. Taking a look at your micro movers, Micron extending gains after giving an upbeat forecast for the current quarter, while Lululemon activist investor Elliott set to build a $1 billion stake in the athletic wear maker. That is your Bloomberg Brief. Surveillance takes it from here.
cidade estava sitiada.
Nisso eu começo, eu não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
There are a lot of tailwinds supporting the economy for next year.
You do have to see an economy that keeps chugging along. If it doesn't, you're going to have a problem.
One of the key themes that we've noted for this year is people really underpricing kind of the macro risk.
We still have a problem with inflation.
There's certainly a risk here that you could see inflation that's a bit more sticky.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome to Bloomberg Surveillance. Traders looking for this year to end as AI worries overwhelm enthusiasm. Stocks firmly in the red now for the month after 4 straight days of losses, looking for glimmers of optimism, whether from fiscal stimulus and central banks with the Bank of England and ECB on deck, and the state of the U.S. economy in focus as we await the first inflation read since September. Danny Berger alongside me for the next few hours. Danny, to me, this really is going to be the key tell, especially after what we heard from the president. CPI and jobless claims very much on deck.
It's a big day, but when you talk to people or even look at what's priced in to this options market, it's a shrug. It's outdated. Do we care? I think we have to care. Considering what we heard from the president, to your point, considering we're likely to get more cuts from this central bank, that is dual stimulus. How in that world can we get inflation back to 2%?
Yeah, are we in an economy where the labor market needs to be more in focus or inflation needs to be more in focus? Joining us for the rest of the hour, I'm so pleased to say, is ADP Chief Economist Neela Richardson. Neela, to what extent have we seen the market move on from inflation without the inflation data to justify that type of sentiment?
Today may pull it back to inflation, we'll see. But I think there has been a head shift to the labor market, rightly so, in my opinion. But the labor market is really the source of two things. It's the source of growth because the consumer is real well anchored to the labor market, but it also is the source of that maybe secondary rate cut that they're looking for early next year. So they're looking for two different things coming out of the labor market, but the inflation data today may change that story.
And it would be the first inflation read since September, and we aren't going to get month-over-month inflation reads because guess what? The government was shut down and we don't have that comp. In the meantime, looking for optimism, getting a little bit of a lift from Micron shares after they reported earnings that had a very different tone than what we saw from the likes of Broadcom or Oracle, talking about how demand is just so far outstripping supplies that essentially they can raise prices, which is why you're seeing those shares up almost 11%, a massive beat. Can this turn around some of the AI sentiment?
It speaks to just the narrative whiplash that we've had on AI, that one day we're worried about data center fundings and the next day there are shortages when it comes to chips. If anything, though, Micron just highlights it's still the picks and shovel trade, which is working so well. We've really tried to broaden out, be it with the hyperscalers, be it with maybe software plays that can benefit. That has been really volatile. What has worked are these companies who are saying there's still a shortage and prices are elastic because of that, so we're going to bring in a whole lot of cash.
So how much comfort can we get from this? Right now in markets, we do see a little bit of a lift. Futures higher. Let's try this again to snap a 4-day losing streak, although we did this yesterday and we did this the day before, up 0.4% ahead of the open on S&P futures. That euro-dollar cross 117. And you do see yields markedly inward. Maybe this will give some people a feeling of confidence as they await that sort of push-pull between jobs and inflation. 10-year yields at 4.13%. Coming up this hour, Beata Manthe of Citigroup as stocks look to find their footing. Henrietta Trey's of Veda Partners as President Trump defends the U.S. economy. And Terry Wiseman of Macquarie with a trio of global central bank decisions ahead. We begin this hour, stocks trying to climb higher as investors await the latest inflation data. Beata Manthe of Citigroup remaining constructive on equities in 2026, but writing volatility could remain elevated amid continued reassessment of the AI theme, cracks in the United States soft landing, and demanding valuations, which could cap upside. Beata joins us now. Beata, thank you so much for being with us. There was a new survey from Deutsche Bank talking about the risks ahead into 2026. The overwhelming consensus is that AI valuations and a potential popping of some of those elevated expectations is the biggest risk heading into next year. Do you agree?
Good morning. There are many risks, but as you've read out in our report, it is on the top of our risk list, definitely. What high valuations make to stock market prices, they make them more volatile and more vulnerable to any news flow. And as you've discussed before, the news flow on the AI story will remain volatile as well. So it's going to be a fight between good and bad news.
At this point, this is a reason why I think some people are saying, okay, what are we missing? Because ultimately, if there is such a consensus in one thing that usually makes people nervous, what is the thing people are not watching that could be a major market driver into 2026, whether it's a shift away from AI, whether it's a shift away from the United States?
So our view is that consensus is for over delivery of earnings, and that's how the market is priced in. So we have that model that is trying to capture what kind of EPS outlook is priced in by the stock market. And I have to say, across all the major markets around the world, all the equity indices are priced for over delivery of earnings. So the pressure is on for earnings not only to deliver according to analyst forecasts. Actually, the expectation is for them to go higher.
Not just earnings, Beata, but what about margins? There were two stories yesterday. One, General Mills saying that they were lowering the price of products among 2/3 of their products in North America. Then there was Lennar, the home builder, saying that they've had to cut costs and offer incentives to get Americans to buy housing too. Beata, are we going to start to see some serious margin pressure materialize next year?
We haven't seen too much happening yet, and where I sit in Europe, actually in the year when tariffs have hit, we actually have not seen too many margin pressures yet. Where it could come from, of course, is the issue of the tariffs on the US companies. So the fear beforehand has been that we would have double whammy here in Europe through strong effects and also tariff hit, i.e. exporters paying for tariffs. Now we know it's evident in the data that tariffs are being paid by the importer side, and for now 70% of these tariffs in the US is paid by the corporate side and 30% for the consumer. So if that continues on certain level, certain parts of the equity market, you could have some margin pressures. But overall, when you, and I'm quoting here our US strategist, Scott Croner, when you look at the composition of S&P, the margin, the companies that could have margin pressures are not the majority, and they are not the huge market caps, right?
And this comes back to AI, right, Beata? Because that's what's been driving this market. But their business models have also changed. They're not asset light anymore. They're taking out a lot of debt. Their cash flow has been substantially lowered. And in the case of Oracle, it's turned into a cash burn. Should these big tech companies get the same valuations? If you are analyzing high valuations, the justification came from the fact that they were asset light. Do we need to completely rethink how we model out the valuations and earnings of these companies?
You could have arguments for both ways. The valuations are too high, they should come down. But because of the arguments that you've just enumerated. However, an argument for continuation of seeing high valuations could be the fact that actually, when you look at valuations, what do they have in them? They only have 12 months forward EPS, right? For these mega themes, structural or themes like AI, perhaps it is justifiable to price in more than just 12 months forward EPS, and actually it should be, right?
Good morning. With AI being a huge driver of the equities globally, how important is the consumer and the consumer resilience going into 2026 in your outlook for the markets?
It is always very important, and of course, in the U.S., you could have some pressure. So our view is, the view of our economists is that there is more softness in the labor market in the U.S. that it's seen at the top level. This is why our economists have 2 consecutive cuts coming into the next year out of the Fed. When it comes to the consumer elsewhere in the world, in Europe, for example, where I sit, the consumer has been weaker and subdued. However, we have huge amount of savings in the bank accounts right now. Now, there'll be different drivers of the economic activity in different parts of the world. In Europe, actually, Europe is becoming, the growth in Europe is becoming more investment driven. So we have a huge fiscal stimulus going on. That's going to drive the growth, perhaps not so much consumer itself in the first line. It's more the government investments, and then consumer could come along later on. So very different drivers of growth between different parts of the world, I would say. But overall, still resilient growth when you add it all together.
Beata Manthi of Citigroup, thank you so much. And Beata is talking about the potential for fiscal stimulus over in Europe when Germany announced that will increase federal debt sales by a fifth next year to about $601 billion. So it just highlights how the drivers of growth are changing. In the United States, it's both the consumer being strong, but also this idea that we might get fiscal, as we heard last night, 1776, as well as potentially monetary policy easing. How much, does that really support the outlook for the consumer, Neil, at a time where there are real existential questions about the fundamental labor market?
Enter a new actor in 2026, fiscal spending. We saw fiscal contraction in 2025, especially with all the DOGE cuts. Imagine investment, not only in the U.S., but in Europe, in which it leads to more hiring, more capital spending. It could be quite stimulative. And we have the infrastructure projects in need of that kind of investment, not just AI, but physical infrastructure. So it could lead to a boom in some ways.
I think the fly in the ointment in that, though, is does the bond market finally start caring again? Scott Lincecum of Cato Institute pointed out that with the most recent checks that Trump wants to issue that he talked about last night to military families, that's the 10th thing he said that he would fund with tariffs. This is a market that started to treat tariffs as something that can help the deficit. What happens if you get that fiscal spending and it's taken at the cost of the money that supposedly is coming in? And if the bond market starts to care, does that just tighten conditions and act against everything that they're trying to do?
Frankly, we've seen this already, right? The idea of a steepening yield curve. Some people say that it's just beginning. And this is the reason why, even if the Fed cuts rates significantly, it's not necessarily going to be that stimulative just because you are not seeing long-term yields go down in the same kind of way. We're going to get to that in just a second, in particular with that 1776 10th thing, as Scott Lincecum said, that has been promised with tariff checks. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Good morning, Lisa. Calls are growing for the EU to approve a massive loan to Ukraine backed by frozen Russian assets without the support of Belgium. Kyiv's finances are likely to run out in a matter of months without the boost. Meanwhile, U.S. and Russian officials are set to meet in Miami this weekend for continuing talks on a peace plan. Meanwhile, Micron shares are jumping more than 11% in the pre-market after blowing past estimates for the first quarter and posting better than expected revenue guidance. The semiconductor manufacturer is expecting second quarter earnings to be nearly 80% higher than consensus estimates as the firm benefits from the relentless demand for memory chips used in data centers. And oil giant BP has appointed Meg O'Neill as its next CEO. O'Neill comes to the company as an outsider, leaving Woodside Energy Group after previously working at ExxonMobil for 2 decades. She's the first female CEO for any big oil company, and replaces Murray Auchincloss, who served in the role for just 2 years. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, President Trump's economy.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history.
Henrietta Trey's Aveda Partners joined us next as we look to that speech. What could potentially get fulfilled in the increasing slate of promises? This is Bloomberg Surveillance.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
This is supposed to be a happy time of month where all stocks gain and everybody feels good as they go off to vacation. We're not seeing that. We've had 4 straight days of losses. The losses are mounting for the month, almost down to a decline of 3% for the NASDAQ. This morning, we're going to try again to turn that around, up about 0.5% on S&P futures. The euro-dollar cross seeing a bit of stellar strength coming back into play, but still around that 117 level, and yields in about 2 basis points with the 10-year at 4.13%. Take a look at Micron shares trading in the pre-market. This idea of how much guidance can make a different kind of picture for different tech giants. Broadcom, Oracle, the shares fell after their earnings. Micron shares up 11.3% after this comment from a senior executive. This is the most significant disconnect, Annie, between demand and supply in terms of magnitude as well as time horizon that we've experienced in my 25 years in the industry.
So all those people in that Deutsche Bank survey that were worried about AI being overhyped as the biggest risk for 2026, here's evidence that it's not, that there is so much demand that there is shortage. An interesting turn to this, I think the Wall Street Journal laid it out this morning, that, we talk about the competition for energy assets. This is competition for memory chips. These are also things that go in smartphones and PCs. The threat could be that because all of that is getting routed to AI data spend, what if consumers have to pay more for PCs or smartphones just because of the prices that Micron can now command?
Yeah, they're different bubbles, and they're different ones inflating at different times, and maybe you need to pay attention to which one is the most pernicious. Under surveillance this morning, the focus turns very much to Washington, D.C., President Trump's economy.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history. 1,450,000 military service members will receive a special, we call warrior dividend before Christmas. I'm also taking on the gigantic health insurance companies. I will announce some of the most aggressive housing reform plans in American history.
Here's the latest. President Trump defending his economic record as he looks to reassure Americans about the rising cost of living. Recent polls showing his approval rating slipping near the lowest level of his second term. Bloomberg's Tyler Kendall joins us now. Tyler, what did we learn yesterday, and how much can some of these proposals come to fruition in the near term?
Yeah, hey Lisa, good morning. Well, perhaps we learned that the White House has really been trying to go on defense when it comes to the issue of affordability, and this does come at a pretty critical time considering that we're about to head in to the midterms last year. Now, as you heard, we heard pretty consistent messaging from the president last night, including that Americans should be feeling better about the economy. Yet at the same time, it also appeared that he was seeking to reassure that the full impacts of his economic policies haven't really kicked in yet, right? We heard him say that the U.S. is poised for an economic boom. He also said that the benefits from the One Big Beautiful Bill haven't fully been baked in, that we'll see that next year. And he also, of course, pointed to a new Fed chair he says will lower rates. Now, one of the biggest new policies announced was that warrior dividend check you heard the president talk about there, that he says will be coming in a matter of weeks and is funded through tariff revenue. The thing is, we didn't really get a lot of other new policy proposals from this White House last night. It really was recounting a lot of what we've seen from this past year. So it's going to be something to really watch closely, including what could be rolled out. The president did preview that we'll get aggressive housing reforms. In his words, that's important because on the campaign trail, he did campaign pretty heavily on the idea of deregulation. And there is reporting that we could see some enhanced housing entitlements for U.S. service members. Lisa, at this point, we were expecting that we could get more when it comes to health care. Of course, the issue that's been dominating the conversation here in Washington. President Trump did outline his opposition to extending the Affordable Care Act premium tax subsidies, saying that this would be a way to lessen the money going to insurance companies, but he didn't ultimately endorse any of the plans that are brewing on Capitol Hill.
Tyler Kendall, thank you so much, as always, for that. Neela Richardson with us for the hour. Neela, what did you make of some of these proposals, given the fact that there is a focus on supporting the labor market, but it's unclear how quickly some of this could really come into play?
Yeah, it's interesting whether or not these proposals come through the consumer or come through business, because they have very different effects. Some of them are quite transitory. If you think about a paycheck, maybe it goes to savings, maybe it goes to a down payment. But when you think about like the AI tech workforce, I mean, investing in skills and technology for people who can create this AI infrastructure and echo chamber that we need to produce productivity is really, really important. So I think there is a whole spectrum. Some of them are really important for the labor market and the future of AI. Some of them could be gone in a moment.
Which raises a question, how much is this throwing spaghetti at the wall and how much is this truly laying out a potential plan from the president? Joining us now, Henrietta Trays, Director of Economic Policy Research at Veda Partners. Henrietta, what was your take from the announcement, the speech last night?
Well, it definitely wasn't about the Christmas decorations. 90% of Americans, according to the latest Fox poll, believe that inflation is the biggest problem facing them. And what's a little bit off-putting is that the president touted a lot of data sets that just are not resonating with American voters or factually accurate. So anybody who's turned on the news this year has seen AI and data centers driving electricity prices up 13% for residential electricity prices nationwide on average. You know, if you tell me that the cost of drugs is dropping by 400%, 500%, 600%, which is what the president said last night, that means you're paying me to take drugs. And you don't have to be that good at math to know that that's not how drugs work. And finally, I would say the $18 trillion investment that he touted from the trade wars that he's launched and the deals that he's reached is outrageous. I mean, this is like China's entire GDP. So you need to put some things in context that American voters can actually take with them to the grocery store, and that's not what we got last night.
Henrietta, just that point, I mentioned this before, that Scott Linsacombe of Cato Institute was talking about the fact that this is the 10th thing that Trump has promised to fund with tariffs. I'm going to be honest, ChatGPT helped me with this list, but I was just looking at some of the things that were promised: the military checks, tariff dividend, farm aid and targeted bailouts, child care, social programs, tax cuts or elimination of income tax, foreign or industrial subsidy funds. Henrietta, I know a lot of those are a wish list, to Lisa's point, versus actual policy, but What happens if he does try to fund some of these with the tariff income? Is that even possible with the amount of money coming in?
I mean, first off, find me the votes. If you can find me 51 votes in the United States Senate for a $450 billion, $2,000 check to the American public, I would love to see it. I can't count you the votes. I can't get you a reconciliation bill. I can't even get you a budget for fiscal year 2026. So the idea of even getting these things through is not realistic. And then the bond market, of course, is counting on this, what CBO estimates is $3 trillion in revenue brought in by these tariffs over a decade. And we've already spent it. We've more than spent it. It's only been $89 billion brought in by the IEEPA tariffs going back to October. So, I mean, the money's just not there, and the votes aren't there either.
Henrietta, it's a great point. I also want to get back to one of the other things you just mentioned, too, this idea of the consumer feeling also the affordability pain of what's happening with their electricity prices. We saw the Blue Owl and Oracle deal. Part of the reason it crumbled was because of the politics in Michigan of lawmakers pushing back against tax subsidies. Earlier in the week, we also heard from Bernie Sanders saying that there needs to be a moratorium on building on data centers, partially because of what you're describing with the prices. Is it likely, as affordability becomes a bigger issue, that lawmakers will really start to push back against some of the data center construction and spending that is happening in America?
Yeah, you can see it all over the place in terms of physical pushback. AOC had some tweets about it yesterday. I saw it's definitely a popular talking point. There's not going to be any legislation to prevent it, so this would have to be active, boots on the ground, district-led, sort of protests against the construction of new data centers, and they're going to have to conflict that with the job creation, which in many of these cases is the only job creation that you're seeing in, say, the manufacturing sector. So it's a pretty heavy lift to get something done legislatively, and then certainly to have the protests be maintained in order to actually effectuate those pauses or stoppages.
Henrietta Trays of Veda Partners, thank you so much for being with us. There is this disconnect right now, and I think a lot of people have highlighted it. There's a disconnect between how people are feeling and what some of the aggregate numbers are showing. And Neela, I would ask you, how do you reconcile that? The idea that we're not seeing the labor market fall off a cliff, but according to sentiment surveys, some people feel like this is the worst labor market that they've seen in their career.
Anecdotal evidence is powerful, especially on Main Street. And when you have kids coming home from college and they can't get jobs and they're living with you, that is the only anecdotal evidence that you need, that the labor market isn't functioning in the same way that it used to. And just getting back to data centers, enormously important. There's going to be a lot of job creation in building the data center, but the data center is not a factory. Once it's built, it doesn't produce ongoing labor support for local communities, and there is a risk that it increases electricity prices. So that kind of investment is great in like the 3 to 5 year term, but is it going to fuel an economy, a local economy, over the next 20 years? That's the kind of job creation that we're looking for.
You can see the pain with something like in Virginia. Glenn Youngkin, a governor who's come on this program a lot, has touted the huge build out that's been going on in that state. I think that's a great point. What happens when the build-out is done and it's not continuing to fuel jobs, but just fueling electricity prices?
Yeah, with some $500 billion in lease payments that some of these companies have promised to pay. We'll be talking about the labor market. We'll be talking about central bank policy and how government lawmakers respond to this. Coming up, Yahira Anand with your Morning Movers. Micron jumping on an upbeat forecast as we count ahead to a number of rate decisions. This is Bloomberg Surveillance.
have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Seeing a lift of futures, trying this again one more time, up about 0.5% on S&P futures earlier this morning, keeping those gains. A bigger gain on the NASDAQ after a significant underperformance so far in December, now up 0.8%, largely on Micron, really doing the heavy lifting. Russell 2000 lagging behind with some real questions around the labor market, up 0.3%. If you take a look at the bond space, 2s, 10s, and 30s, a bid into bonds after a kind of motley session led by the front end of the yield curve. The front of the yield curve is pressing down some of the lows that we've seen this year, 3.46%, down 2 basis points on renewed expectations the Fed will cut rates. Is this because of the jawboning of the president? Do you think so? Do you think that he says, well, I want an next Fed chair, it's going to lower rates? Does that actually matter in any way?
Not right now.
But it could coming up. Meanwhile, what you see in the 30-year space is just now a basis point decline, 4.82%. Honestly, this is going to be a really interesting end of the week, given that we have not gotten inflation data coming out since September. We also get initial jobless claims 3 hours away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. Micron is the golden child this morning, and a market still nervous around AI. Shares are popping nearly 12% in the pre-market after the company blew past estimates, saying that demand is far outstripping supply, giving them major pricing power. And analysts say that memory chip price increases are unlikely to abate in the near term. Meanwhile, taking a look at Lululemon, shares also popping 6.8% in the pre-market on hopes that Elliott management can help spark a turnaround. That's because it built a stake of more than $1 billion in the struggling retailer. And we're reporting that it is said to be working with Jane Nielsen, a former executive over at Ralph Lauren, to try and spark this turnaround. And she is viewed as a potential CEO candidate. And we end on Instacart. Those shares are falling 6.6% in the pre-market on a Reuters report that the FTC is investigating its AI pricing tool. The agency is looking at claims that customers may be paying more on the app than in stores, something that Instacart disputes, saying that retailers are the ones that set the prices. But it's no surprise that the FTC is going after these claims, especially after President Trump's speech last night on affordability. Lisa.
Thank you so much, Yahira. On our radar this morning, President Donald Trump pledging $17.76 warrior dividend, that is $1,776 of a dividend for troops this Christmas, alongside new plans for housing reforms. This coming as the president faces mounting pressure about his economic agenda. Some questions remain, Danny, about the feasibility of this, as well as the pay-fors that really come into place.
Right, Henrietta Trey saying earlier, find me the votes for this, and then I'll have a thought on it. But the pay-fors, he continues to promise different legislation, different payouts from this government via tariff revenue. If he is able to get the votes, what does this bond market do? What does this bond market do that's been counting on the deficit getting eaten away from the tariff revenue coming in at a time when the Fed's also cutting and at a time where there is stimulus coming in? It is dual stimulus. How does that occur, and how does the bond market react to it?
And if we take that thought and we translate it all the way to Main Street, which is where I spend a lot of time, these issues on housing and affordability are not new. they're amplified in a situation, in an environment where we have higher than normal and higher than desired inflation. So that's why we keep circling back to housing, because it's housing on top of eggs, on top of everything else that we're spending our money on. And this structural difference in housing over the last 10 years has been the deal maker in terms of wealth creation for the middle class. So the question is, find me the votes, find me the housing stock, and you'll get the votes.
Yeah, which raises a question about how quickly you can actually turn that around, given the backdrop and given some of the structural undersupply. When it comes to some of these payments, though, how much is that going to be sustainable inflation? I mean, this is sort of one of the key questions. We're talking about other types of dividend payments, the $2,000 dividend checks that people also are going to be getting. I mean, is this inflationary akin to the Biden checks that a lot of people are saying is partly responsible for the real elevation in inflation post-pandemic?
Well, I'm a little bit jaded, because I believe an announcement is not necessarily a policy until it's executed. I learned that the hard way. But we'll see. We'll see the effect of how it lands. You know, there were parts of that stimulus package that actually helped working families quite a bit. The child care tax credit, for example, was a big boom to working families. So how it gets distributed is important. I'm not going to dismiss it out of hand, but there is a risk that it does lead to a bunch of spending and not saving, which could be inflationary, something to keep a close eye on.
In the meantime, one stock is getting a little bit of inflation, I guess, in a good way. Micron shares jumping after topping first quarter expectations and posting better than expected revenue guidance. The company sees second quarter earnings to be nearly 80% higher than consensus estimates. Let's just repeat that. Nearly 80% higher than consensus estimates, fueled by relentless AI demand for its data center memory chips. Those shares up almost 12% after rising more than 160% so far this year. I mean, it just highlights how, yes, there are doubts about artificial intelligence, but there's such a robust demand picture that there still are pretty big gains to be had.
There's so much demand, which means that the picks and shovels keep doing really well. But for those that are using it, there's still questions to just how much revenue can come through. So it's this narrative of you need to pick your winners. It is not, if it is a bubble, it's not everything moving in concert higher together. And that's why narratives have become so powerful for this time around, for what's happening in tech. Maybe the previous one, you could kind of say, okay, websites are cool, anyone can build one. We kind of get that. For this, it's this complicated mess of who benefits, what type of chip is doing well, what is the cash burn, how does this technology actually work? The complicated nature of it means that you get this narrative whiplash, which is such a fascinating setup into 2026 with so many hopes and dreams pinned on AI revolutions.
Yeah, hopes, dreams, and fears. And I think that right now the fears have really taken center stage when it comes to whether valuations are too high, whether we're paying too much, and how much is this going to steal from the labor market. And this is one thing that people keep talking about. How much is the Fed keeping rates lower than they otherwise would out of fear that there is going to be a structural imbalance that's going to leave a lot of people out of work? I mean, are we seeing that in the evidence that that's actually coming to fruition?
You know, there's some evidence at the margin that there is going to be a transition in the workforce, but I don't think AI is a field of dreams. I actually think it's a dream deferred. And that means that you have to create that AI infrastructure first before you see the outcomes and the productivity and the opportunity. And we are in a transition period. So the question is, in my mind, will the equity markets be patient to allow for that ecosystem to be built? And will the employers be patient to allow employees to adapt to the skills that they need for the future? This is a game of wait and see and wait and build. And I'm not sure that we have the patience for that right now.
Certainly the financing markets have had some wobbles when it comes to patience. And that, I think, is a big reason for why we have seen recent skepticism. This is only amplified by cases of fraud. U.S. prosecutors charging the Tricolor Holdings founder, Daniel Chu, with defrauding investors through a massive loan collateral scheme. Chu faces multiple felony counts and at least 10 years of prison convicted. And I have to say, read the details of this story with Excel spreadsheets and a junior investment analyst saying, wait a second, this doesn't add up, leading to the unraveling of this entire scheme.
I hope that junior analyst is no longer junior, that he got a nice promotion and a pay raise, because look at what he wrote on markets. It is incredible. And I think so many people want to say, look, this is just idiosyncratic. It was a fraud. It can't be extended. But the fact that you had so many eyes and so many well-respected borrowers in this company and no one caught it except a junior analyst, I think says something. I was speaking to Victor Koslev, SVP, earlier last week, who basically said, we're looking at 15 companies right now that are facing the kind of issues in their over-leveraged in debt that Tricolor was facing. They're not fraud. It's just an over-leveraged balance sheet and the lack of people to really appreciate the issue that presents until it's too late. That doesn't sound idiosyncratic to me. It sounds like late cycle dynamics.
A lot of people are concerned that that is the case. In the meantime, people also focused on the geopolitics of the moment. EU leaders are set to meet today, facing a key decision on using frozen Russian assets to fund Ukraine's defense efforts in the war. Bloomberg's Oliver Cook joins us now from Brussels. Ollie, thank you so much for being with us. We have seen a pop in optimism that there would be some resolution to this conflict before, let's say, March. That has waned over the past couple of hours. What is going on over there in Brussels?
Yeah, that's the big question, Lisa. And I think that going into this meeting, this makes it a very sort of exciting leaders meeting here in Brussels. And I'd say probably one of the most consequential in the last several years, because before the leaders, and I have to say, going into this meeting, I spoke to the High Representative Kais Kallas, the highest diplomat here of the European Union. I just listened to a number of European leaders walking in and speaking to reporters, basically all weighing in on how they feel about seizing these Russian assets and potentially monetizing them. We do not have consensus going into this meeting. We really do not know when this meeting will end. We do not know if they will come to a resolution on the frozen Russian assets. We only know that the Council President, Antonio Costa, says that he's going to basically lock the doors and say that these leaders cannot leave the room until they figure out a way to finance Ukraine going forward. What they're trying to do is get over the line a 90 billion euro loan. That accounts for 2/3 of the funding for Ukraine militarily and the rest of their budget for the next 2 years in order to keep them on their feet in this battle against the Russians. All the while, that is trade negotiations, those peace negotiations going on with the United States in the background, but we do not have a consensus. The German Chancellor Friedrich Merz says there's basically no plan B. The only other option for funding Ukraine, other than seizing these Russian assets, is joint debt. And that probably is the only thing in Europe that is more contentious than actually seizing these Russian assets and monetizing them.
There's also this question of how much they're going to crack down on some of the sanctions on Russian assets, given the fact that energy price is very much in the focus as we do get deeper into winter. How much is there a message for European allies? This is something that a lot of strategists are talking about from what the United States is doing with Venezuela and actually putting some sort of blockade around sanctioned oil tankers.
Well, I think it's very interesting that how far the United States is going on this. We should say that we've had reporting over the last couple of days that the United States is actually considering further sanctions on Russian oil vessels, oil tankers, as well as Russian energy traders. So it's a lever that the Americans are looking to pull potentially. Of course, that they're not going quite as far as Lindsey Graham would like them to go. And we have that bipartisan support for that bill in the United States that would impose secondary sanctions on everybody that's buying crude oil and natural gas from the Russians. Donald Trump has not yet shown the appetite from that, but it does show a little bit that the United States is willing to put a little bit of pressure there on the Russians. For the Europeans, really their last chip to play is on these Russian assets. They've really kind of maxed out their sanction packages so far. So really, of course, energy prices are going to be sort of front and center, but the real question is, are the Americans going to ramp up pressure on the Russians? So far, they've not had the appetite to do it beyond the sanctions they put on Lukoil and Rosneft, which just kicked in a couple of weeks ago, which we should say are fairly significant.
Ollie Crook, thank you so much for that reporting and great interview earlier this morning. A real question here about how much energy prices are really underpinning so much of geopolitics, right? Have lower energy prices emboldened on some level this president and other places to potentially crack down a little bit more on some of these increasing issues?
It's such an important undertone to it all because it's the contrast of what was happening in the Biden administration. When the Biden administration lightened up on some of the sanctions on Venezuela and took a more pragmatic approach, saying you can get some more of your oils, a barrel of oils on the market if you do certain things. What was the difference that time? It was Ukraine and Russia. It was oil prices moving higher, an administration that felt like they had to do something to keep oil prices lower.
And oil prices are important for the trajectory of inflation, right? And so all of these global events, even though they're complicated and they feel a world away, they hit home eventually. And they are the deal maker in terms of the U.S. economy going into the next year.
Yeah, we heard about that $1.99 a gallon, and that was one thing that was driving prices lower. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The U.S. government's acknowledging liability for the deadly mid-air collision between an Army helicopter and an American Airlines jetliner. Court documents state that the FAA violated procedures and that the Army helicopter pilots failed to maintain vigilance. 67 people were killed in the crash on January 29th. Meanwhile, Nick Reiner made his first court appearance yesterday in Los Angeles. He faces 2 counts of first-degree murder in the killing of his parents, actor-director Rob Reiner and his wife, Michelle Singer Reiner. Nick Reiner did not enter a plea. His arraignment was postponed until January 7th at his attorney's request. He is being held without bail. And authorities allege a more than $1 billion fraud by Tricolor founder Daniel Chu was exposed due to an Excel spreadsheet error. One of Chu's top lieutenants failed to reduce the numbers in a column listing the loan's outstanding balances, leaving a glaring mismatch. The discrepancy was flagged by a junior analyst and set off the company's spiral into bankruptcy. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. More on that story later. It really is just amazing. Read all the details. I mean, honestly, the idea that that kind of Excel spreadsheet issue could leave big banks with million-dollar losses highlights just what potentially could be a stake.
And it also highlights that we can't kill Excel for all of the AI glory that's promised out there. Excel,
That's your takeaway?
That's my takeaway.
Okay.
We can't get rid of it.
And we can't kill grunt work. Some things you just have to go line by line through every single row in order to find the hidden treasure there.
Exactly. Grunt work and Excel spreadsheets. Up next, all eyes on CPI.
I'm more focused on CPI because of what it will tell us as to where we're going next. But the story with inflation is really an uncomfortable one, not because it's too high or too low, but because it's kind of stuck in that middle.
More on the state of the economy with Neela Richardson coming up next. You're watching Bloomberg Surveillance.
I just wondered if any of you had a perspective of the reason to, put some of that capital into women's sports.
It's going to create you the fastest return. You will have so much success. If you look at the growth metrics of women's football, selfishly, in this country at the moment, it's phenomenal. We are the fastest growing sport on the planet. Our participation is up in this country. The interest that is around women's football is at a real, to your point, we're at a real moment in time to be able to capitalise on it. And if I was an investor looking to come into football in this country at the moment, I'd certainly be considering women's, because I don't have to invest an astronomical amount to become the best in the world, to really be put on the global stage, to be winning Champions League. Whereas if I wanted to do that in men's football in Europe, that's going to cost me a lot of money.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets. Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
trying to turn the page on 2025 in a positive way. It hasn't worked so far in December. Right now, trying to turn that around, up about 0.5% on S&P futures, up even more on the NASDAQ as a result of what we saw from Micron. Better than expected, absolutely enormous forward-looking growth. We are seeing yields dip just a bit, about 3 basis points decline for 10 years. 10-year yields 4.13%, ahead of the first inflation reading, the first CPI report since September. We will not be getting a comp with October. Nonetheless, it will be some sort of look into what we might be getting come just later this year from the Federal Reserve into next year. When you take a look at these shares in pre-market trading, here is where the lift is coming from, and it has to do with one activist investor. BP shares a little bit lower, down about 0.7% on an executive management change, concerns about some sort of crossover there, but Lululemon shares up 6.7%. Both of these very much in the news due to Elliott Management and their activist stake in trying to enact change. It's just as fascinating to see how this is all coming to roost at the end of the year.
It is. I mean, two completely different businesses, but the common theme is a strategic direction change that Elliott feels needs to happen with a new CEO at the helm. For BP, it's about completely getting rid of renewables and focusing in on a new CEO who, by the way, is the first outsider CEO ever for BP, who comes from a very fossil fuel heavy industry. For Lululemon, it's just the fact that this brand has really been struggling with competition, and it's a consumer that we've been speaking about that's more choosy. So it's not enough just to have apparently a C-suite that's committed to a strategic change. Elliott is saying we need someone at the top, and we have the ability to make that happen.
Yeah, go from spandex to something looser. Compete with Vori. I mean, that's essentially what people are saying with Lulu. They're not actually saying that. Meanwhile, we're looking forward to the economic data we get later this morning. Under surveillance this morning, all eyes on CPI.
I'm more focused on CPI because of what it will tell us as to where we're going next. But the story with inflation is really an uncomfortable one, not because it's too high or too low, but because it's kind of stuck in that middle. What do we do with that? Well, it depends how the Federal Reserve responds to it, and how do consumers respond to it? Well, it depends where that inflation is. The composition of inflation, I think, is going to become even more important on a go forward.
Here's the latest. Traders counting down to November CPI data due in less than 2 hours for the first read on inflation since September, as the Fed weighs both sides of its dual mandate. Neela Richardson of ADP still with us. The expectation is for a 3.1% increase in the headline year over year, a 3% increase in core, still above that 2% level. How clean is this read, given some of the government shutdown and collection issues?
It's not as clean as we'd like. Skipping over October is a major miss. We could do that in the labor market. People kind of skip past that 100,000 plus loss in jobs market because they knew there was a driver. It was government layoffs. We can't easily skip past, even though we're going to be forced to, the October data to see that momentum going into the end of the year. That's such an important piece of information. And, you know, we also know that there are gaps in the CPI data in terms of a few cities that will be missing or metro areas. And so putting it together and having that view is really important. I just wish it was as complete a mosaic as we're used to seeing.
I'm getting ready for the conspiracy theories that are going to inevitably emerge after this report, whether it's too high or too low. I got a number of messages yesterday about owner's equivalent rent and how this is the third of the CPI print, and we don't have a sense of how they're calculating it. I mean, how much will hinge on specific idiosyncratic, if you will, Excel spreadsheets that people are going through and determining exactly how this is measured?
I guess this is the day of Excel. I mean, because the drivers are important. Whether inflation, if we see it or if we don't see it, is it coming from the housing market? Because that's a very different set of factors and drivers than if it's coming from energy prices or the goods sector. We thought the inflation in the goods sector was over. If it starts to rise again, if it blows past services into goods, that's a whole different conversation for the Fed, for policymakers. So those drivers, that momentum, really critical to understanding the complete story.
We'll also go back to some of what we've heard from companies of General Mills saying that they're cutting prices. When it comes to home builders, Leonard saying that they're also having to cut prices and offer incentives in order to get people to actually build homes and buy homes. How much are corporates playing into inflation and maybe lessening inflation right now?
You know, the traffic in the home builder space is really interesting to watch because there is all this tailwind of demographic demand, but is the house at the right price? And right now, there is a sense that companies are absorbing some of those price increases, not passing it on to the consumer because things are still uncertain. Tariff policy is still being set. We don't have a strong read on the consumer right now. And so let's absorb it until we know that we don't have this fickle consumer who will go away from us because we increase the price. So I see that in 2025. I'm not sure companies can continue to do that in 2026. And even though they're absorbing higher prices, they are making changes, and we're seeing that in the labor market. They are not hiring at the same volume at this time of the year as we're used to seeing.
Can I ask, because a lot of these companies are saying it's because of AI. We're rethinking our workforce. We're using more technology. We're being more productive. Sorry, we're announcing these layoffs right before Christmas, but AI made us do that. Neil, how much of that is just an excuse at this point?
I think it is a factor, but I think that these layoffs, these transitions would be happening anyway in many sectors. And if you look at where the sectors are of growth, it's in healthcare. Yes, many healthcare jobs are not AI exposed. That is the case. But there are other sectors like other services like dog walking services and dry cleaning services and leisure and hospitality and restaurants that are still lackluster. So it's not a complete AI is a replacement right now. In fact, there's a sense that AI may augment certain sectors, and you're seeing that as well. So it's just a factor. I wouldn't call it an excuse. Maybe it's a factor, but it's not the whole reason.
Gila Richardson of ADP, thank you so much for being with us this morning. Always wonderful to get your thoughts, especially on a day that is so important economically.
Thanks for having me.
So meanwhile, we are getting a number of rate decisions coming up. We also are going to be getting some earnings. We're getting Nike after the bell. We did just get CarMax earnings. What I find interesting here is that they did beat expectations, but their comp stores used unit sales actually declined more than expected, and you did see a decline overall year over year. I'm just wondering, are we setting our expectations low, and are we still seeing misses on the margins that indicate really a pushback to higher prices and, frankly, to some of these concerns that we see in the labor market?
Maybe it's finally some of these negative sentiment surveys actually showing up, because that's been so much of the picture. You were talking about this idea that the sentiment surveys have been really poor, but people are still spending. It feels like, yes, they're still spending, but what they're spending on has changed. Things like CarMax, like vehicles, the big expensive ticket items, there seems to be some serious pushback. So maybe finally, maybe not on the headline level, but in the individual level, some of that anxiety is coming true.
Yeah, the nuance, the details is what we're going to be parsing through as we get the data to try to understand the drivers, just where the sentiment is coming into play. Coming up next, a Bank of England rate decision. Bloomberg's Lizzie Burden breaks it down. Plus, Thomas Kennedy of JP Morgan Asset Management joins us, Erica Najarian of UBS, and Adrian Yee of Barclays as we await those earnings from Nike after the bell. And of course, the marquee event will be CPI as well as jobless claims for the past week. What we get will determine the move maybe into next year. NASDAQ futures higher, 0.8% gain on the heels of Micron, injecting some optimism into what has otherwise been a pessimistic month so far for the AI trade. From New York City, this is Bloomberg Surveillance.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
The game here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading in cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoin?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. Because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
The data we're most focused on, as always, is the earnings.
The earnings backdrop for the S&P 500 looks incredibly strong.
I do think, though, that there are real questions about the cost of doing AI.
This huge run in margin expansion could come to an end.
The reality is, in 2026, AI needs to continue its march forward. We need the fundamental strength that does exist to remain there.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance, trying to inject optimism into an otherwise pessimistic December for stocks, with futures higher now after 4 days of losses. The Bank of England rate decision coming out right now. They did cut rates to the lowest going back to 2023. ECB up next. Then it's on to U.S. economic data with the first CPI report since September. Danny Berger alongside me. And right now what we are seeing is rate cutting continuing, maybe not here in the United States for the very second, but over in England, they got the green light.
And unlike the rate cuts here, 0 people voted to increase the rate, 5-4 to lower the bank rate. So you did have that divide there. But what happens if it's an ECB that pauses and you get more of a pushback? And Isabel Schnabel talking about hiking rates next year. The BOJ maybe also tightening policy. What happens to the UK and US as they try to do the opposite if bond yields globally move higher off the back of that?
And we did see a 5-4 vote. So if the division in the United States was shocking, well, it's just as divided elsewhere. I'm so pleased to say that Tom Kennedy, the head of real estate investment strategy at JP Morgan Asset Management, is joining us for the hour. Tom, really, I wonder how much this puts some cold water on this idea that the rate cutting cycle globally is over. Is it really, or are people still going to be running their economies hot in a very competitive world?
When the Central Bank of the United States is still on the verge of cutting rates rather than a holder cutting, it's hard to say we're at the end of the cutting cycle, right? This is the global reserve currency, but we are seeing differentiation across economies, which is something we're really not used to, guys. We haven't seen this for the last decade or so, very synchronized movement. But I think when you look across the world and take the big picture step, is yield curves are normalizing. We are 5 years afterwards really normalizing out of this COVID economy. At least that's what I think interest rates are telling us.
Yeah, I'm not sure if the English economy is normalizing or if this is what they want to be seeing, this sort of dual mandate becoming very much tension. Tom Kennedy of JP Morgan Asset Management is going to be sticking with us for the hour. We do want to get more details from that Bank of England rate decision. Let's head over now to Bloomberg's Lizzie Burden in London. Lizzie, a split decision, although the consensus was to cut rates as widely as expected.
Yeah, it looks like that weaker than expected UK CPI print that we got yesterday didn't actually make this more dovish a cut as perhaps was expected. I was speaking to Banu Bueja of UBS this morning. He had thought that maybe it would be a 9-0 vote split for a cut. It is exactly what was expected before the CPI print. 5-4. You've got the governor as the deciding vote, Andrew Bailey going for a cut this time rather than a hold. And you're seeing the market reacting to this. So you've got yields higher on the 2-year gilt yield at 373, up 3 basis points, the 10-year up a basis point at 448. And so reacting to perhaps the fact that they haven't been more dovish in their reaction to that inflation reading. Now, in terms of the guidance, there was no expected change here. They still say that the path ahead is going to be one of gradual easing. They haven't dropped that. It would have been quite confusing, actually, if they had, given that they don't have a press conference today. And in terms of the pound reaction, you're looking at it really pretty much flat as a pancake, $1.33 at the moment. It had been down against the dollar before this. So actually, if you want to call it anything, perhaps this is a hawkish cut, Lisa.
And Lizzie, it does speak to the challenge of the dual mandate that's happening globally at the moment. How does this set us up for an ECB decision in just over an hour's time?
Well, the ECB is expected actually to sit on its hands, do nothing at all. But it's a difficult message for Christine Lagarde to be communicating, because there we do actually have updated forecasts, and they're expected to show inflation, Danny, undershooting the target over the next few years. She's got to balance messaging on that with, if she wants to, pushing back against Isabel Schnabel. We know that she has come out with this hawkish commentary in the past week about how the next move from the ECB is going to be a hike. The market strongly reacting to that. Jens Eichenschmidt at Morgan Stanley saying the repricing is the equivalent to a 25 basis point hike. So if Lagarde doesn't rebut the Schnabel argument, that's going to be saying something. The euro very vulnerable today.
Lizzie Burden, thank you so much for being with us. Tom, I'd love your thoughts on this idea that right now central banks globally are being forced to grapple with the overhang of fiscal deficits that are pretty significant at the same time that they're dealing with sluggish growth. I mean, how much does this create a more compromised independence backdrop for all of these central banks, given these sort of dual mandates coming into play?
I do think it creates a challenge mostly for the market. For the central banks, they need to show transparency about how they weight these two sides of their mandates. And the Federal Reserve, I think, has been doing a good job of, hey, we understand you're worried about inflation, but the labor market is really what drives inflation in the long run in this country. And as wages cool, we should expect core inflation to come down. I think it's just really about transparency, Lisa, and giving us a full, honest picture of how they're weighting these risks. It's not an easy challenge for them.
Which is why you're seeing such conflicted responses and the idea of a 5-4 kind of vote here. Pooja Krumra, European and UK rates senior strategist with TD Securities, joining us now for more. Pooja, what's your take on this, given the fact they did cut rates as widely expected, but what you did see was that fissure increasingly on the committee?
Yeah, no, exactly. It's surprising that the committee is still very divided, as seen from the vote, as well as when it comes to the guidance. They have not given a clear path with respect to the pace of cuts, or we know that BOE is in the upper end of the neutral, which is basically 2 to 3.75. But the guidance around how much below they want to go towards the neutral is really lacking. And I think that has come as a disappointment to markets after yesterday's weak CPI print. And that's why you are seeing gilts actually selling off. Even on the budget side, they consider it to add a point or two on growth. On inflation, they are still seeing medium-term inflation to increase by 0.1 to 0.2. So I think that overall, the messaging is very mixed. Even if you look at Andrew Bailey's comments here, They are looking at the downward trend on labor market, but they still don't want to overread into it. And same with inflation. They don't want to overreact into the numbers that we've seen last time. So overall, I would just say that the mixed messaging is something that's not changed. Markets were still worried about the pace of easing by the BOE. You know, markets were pricing around the next cut around April. And the current messaging does not really change that situation. There's just no pace or what type of momentum in terms of cuts we'll see from BOE. And it's not been consistent as in the case of Fed or in terms of ECB. But I think it's the data that will be speaking. And if we do see that inflation and labor market easing, the next cut should be by Q1 in our view.
And just to the point of the division, Pooja, and the not clear outlook, part of the statement was that judgments on further easing will become a closer call. How much room is there to cut at this moment if the data stays similar to how it is now, Pooja?
So markets-wise, again, there is not much room within. They're just looking for another cut from the BOE. And the timing was around May, and I don't think that changes right now. To us, again, like we also think that BOE definitely has room for one more cut. They will be still in the restrictive stance. If you see the neutral range for them is, as I said, is around 2 to 3.75. So they're actually in the upper end of the neutral. So there is a lot of room to ease, but the evidence in terms of labor market and inflation has been very slow moving in UK, and that's why they want to keep the easing path slower than what should be the case. So we and markets are particularly looking for just one more cut, but I think the risks are for more cuts when it comes to UK.
Pooja Kumra of TD Securities, thank you so much for being with us. Tom Kennedy alongside us this morning, and I am wondering, just zooming back as we await the ECB rate decision and after this rate cut, do we have a sense of just how much more inflationary the current moment is than pre-pandemic? Do we have a sense of what room there is for central banks globally to truly engage in a cutting cycle?
In most of the developed world, I think you have to look to the wage market to tell you what underlying inflation trends look like. In wages in America, we just got ECI prints, which is the gold standard for the central bank in the U.S. You're still seeing wage growth about a percentage point growth higher than what it was pre-COVID. So that would tell you that there is still more inflationary pressure in the economy. But to some degree, that is backward looking. You need to look at more data points. And when you look at the labor market, we finally got the jobs report, and it looked okay. But on the skew, similar to what Pooja's saying, I think you're skewing towards a little bit weaker than what the headline numbers look like. And there I'm looking to breadth of job growth in America. Year to date, most of the job growth is just healthcare. I'm looking to what's happening for young kids coming out of college. The unemployment rate for them is the highest it's ever been relative to the overall unemployment rate. And then just turnover in the JOLTS market. There's not a lot of turnover. So I think if you're a central bank, you say, things look okay, but if we have to do anything, we need to cut. And in the developed world, that's for the most part what's happening, kind of ex-Japan.
But if you're going to be forward-looking, don't you also have to take into account that we're getting cuts and fiscal stimulus at the same time? Not even from the U.S. You mentioned it in the last hour, the fact that Germany is going on a record debt spending binge. Doesn't all of that mean we could also potentially be cutting into an upturn and dual inflation when inflation is still not at target?
Yeah, Pooja hit it exactly right. Where is the neutral rate? Where are we across the developed world? I think most of the central banks say they're still above neutral. So they can cut a little bit and see what happens. And this is the exact reason why, Danny. You look out to 26, the big beautiful bill is going to hit. Best estimates from economists is that's going to add about 1 percentage point to GDP growth. Wow, that's a lot of muscle coming in. And then you can look at, really, as sentiment is turning, what are your forward indicators that you can trust? CEO confidence, small business hiring intentions. So I do think you have to cut, kind of see what happens. I think the BOE and the Fed are kind of in the same exact spot with that. But look, if you're going to really count on the labor market, it's telling you if you're doing anything, you're cutting. I think that's a really important thing for the market, is that the probability of hikes is very, very low in 26. So that can give us confidence to add duration, add diversification portfolios.
Which is what you have been seeing a lot of people saying, although a little pushback recently on the long end of the yield curve. We'll get into that in just a second. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The Trump administration announcing a massive arms deal with Taiwan. It's valued up to $11 billion and includes missiles, drones, and more. China's foreign ministry attacked the move, saying it would violate diplomatic agreements between China and the U.S. and undermine regional stability. Meanwhile, Medline shares soared more than 40% in their market debut yesterday, though they are pulling back this morning. The company raised over $6 billion in this year's biggest IPO. Medline, which manufactures and distributes medical supplies, has a market value of about $55 billion based on the trading. And moderate House Republicans have joined with Democrats to force a vote in January on expiring Obamacare subsidies. The rebellion comes after Speaker Mike Johnson blocked a floor vote on a plan to extend the subsidies with cost-saving changes. The vote will be forced after a discharge petition reached 218 votes, which is a majority of the House. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, bringing the economy back.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history.
Merry Christmas. Bloomberg's Tyler Kindle joins us next from New York. This is Bloomberg Surveillance.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Seeing a lift to markets ahead of the open after a soggy December. We have seen losses for 4 straight trading sessions today, trying to snap it on the heels of Micron. Some optimism coming from that. Futures up about 0.5%. Seeing a bit of euro weakness ahead of the ECB rate decision. We did see, of course, from the Bank of England, a rate cut on the expectations of slowing inflation. And in the United States, ahead of the CPI print, we do have 2 basis points of a decline on the 10-year. With 4.14% in focus. Under surveillance this morning, bringing the economy back.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history. 1,450,000 military service members will receive a special, we call, warrior dividend before Christmas. I'm also taking on the gigantic health insurance companies. I will announce some of the most aggressive housing reform plans in American history.
Here's the latest. President Trump touting his economic record as he looks to reassure Americans' pocketbook concerns. This as polls showing his approval rating slipping near the lowest level of his second term. Bloomberg's Tyler Kendall joining us now. Tyler, this is rare for President Trump. He rarely has given primetime addresses. Last night, there were pretty high expectations. What were the underlying announcements that really came to the fore?
Yeah, hey, Lisa. Well, it's clear that the White House has been trying to hone its messaging when it comes to the economy and affordability, which is part of why President Trump utilized this speech in prime time. As you're saying, not typically expected from him, since we know that he prefers really the larger crowds like we saw the other week in Pennsylvania. Now, President Trump put a few ideas out there, some new, some repeated, some that would require congressional approval. And that's a really important theme to keep in mind here because, of course, every seat in the House of Representatives is up for election next year in the midterms, which could change the political calculus of what ultimately ends up getting passed and turned into law. Now, the newest policy that the president floated was what you heard him refer to as these warrior dividend checks that are going to U.S. service members, and he says will be funded through tariff revenue. Now, he says the checks are already in the mail. At the moment, it is not totally clear the legal authority that's been invoked, though there is reporting this money was already allocated and appropriated under the One Big Beautiful Bill. But of course, it is reminiscent of another idea that he put out there again, which is that we could see tariff refund revenue checks more broadly for Americans. But we do know that that would likely require congressional approval and a whole new separate form of legislation. And I have to say, if you go to Capitol Hill and talk to Republicans about this, many of them would prefer to see that money go towards paying down our national debt. The other bucket of proposals to look out for in the new year, I would say, was focused on President Trump saying that we could see aggressive reforms when it comes to housing. He was light on specifics, though we do know that he campaigned, of course, heavily on the idea of deregulation in the industry. Lisa, I have to say that in the last few weeks, of course, affordability has really been front and center in the conversation here in Washington, and that has to do with health care. We were expecting President Trump to touch on the issue, though, again, light on specifics. He did outline his opposition to those expiring Affordable Care Act premium tax subsidies, saying that he would rather see money go towards consumers instead of as subsidies to insurance companies, but he didn't put his support behind any of the legislation that's currently brewing on Capitol Hill.
Tyler Kendall, thank you so much for being with us. Tom Kennedy of JP Morgan Asset Management still with us. And Tom, the descriptions of the U.S. economy are all over the place. People's sentiment certainly all over the place. Economists' interpretation of the data all over the place. What's your take on why now, ahead of CPI and ahead of a holiday season, did we get this kind of address given some of the backdrop of polls that we see for this president?
It's as if you're around our desk yesterday trying to figure out why the announcement, why now. I think we looked at the polling numbers too. Also think, to your point, we're getting an inflation data print for the first time in a couple months. It's a curious timing. We don't really know. When we look to CPI, we do feel that customers in America and our Chase customers are feeling some pain. JP Morgan has the best data in the world on the consumer, and we bank over 50% of American households. We have at least one product there. It gives us great insight. What we see right now is a very divided consumer in America, that K-shaped economy that we talk about a lot. Top 10% of income earners, which account for about 50% of all consumption in America, are doing just fine. Their spending growth is above the rate of inflation. And in this holiday season so far, we've seen them spend on big ticket items. The bottom 90% of income earners, though, their spending growth is below the rate of inflation. So their real spending is negative. I think that might be some of this economic pain that people talk about a lot. That's a really tough challenge for monetary policy, for fiscal policy, but that could be the reason why he was talking last night.
Well, if you do have a world, which we are in now, where there's basically 0% jobs growth, 3.5% wage growth, and a 3% inflation, that doesn't leave a lot of room for household spending. But to your point, the K-shape means that the spending has occurred. At what point does that stop? And the K-shape is no longer enough to sustain the economy on a headline level.
Yeah, Danny, this is what's driving this K-shaped economy. Income inequality goes on for a long time. You know, that stat, 50% of all consumption happens with the top 10% of income earners. 30 years ago, they accounted for just 35% of all consumption. So income inequality is happening. But I think what also supports this K-shaped economy is that financial conditions, real estate prices going higher, stocks going higher, those are mostly owned by the top 10% of Americans. So what makes it stop? Well, we could see Main Street focus and consumption at the bottom pick up, or if we saw a crack in financial conditions, maybe we would see the top side come down. This is also what makes our jobs very hard. There are two different experiences that are happening. You come back to a central bank. What are they focused on? The bottom side of the K. And you come back to, I think, last night, the president, he's very much focused on the bottom side of the K. So hopefully that's what we get. The bottom side comes up. So I think there's reason to think that will happen in 2026 too, though.
You were just kind of hinting there also what that's done to markets. And it's actually something that I was speaking with Ken Griffin earlier this week too, a world in which bond yields are moving higher because of that pressure, inflation's still sticky, and yet equity markets that love the idea that this economy is going to be run hot. There was a survey done by the other side of the house at JP Morgan basically saying that people were ditching constructed portfolios like 60-40, that they were just putting together their own equity portfolios, and their hedge was gold, not bonds, because of the split that we're seeing. Are you seeing that among your clients too, that there's this real desire that we don't want the hedge from bonds, but man, oh man, equities are hot and maybe we find some diversification elsewhere?
I think you have to start with what most Americans own. They own the S&P 500. Top 10 stocks in the S&P 500, 8 of them are tech companies, if you use tech companies broadly. That's 35% of the index. So you start every conversation with, I know you own the S&P 500, you have a heavy concentration in tech. You could be a tech believer and still say, I need to diversify. Looking backwards, our job was just to add bonds. It was just easy. Inverse correlation was there. And we've been saying it, JP Morgan's been saying it for years now. That inverse correlation is not real anymore. Stocks and bonds positively correlate. We need new diversifiers. Commercial real estate stands out as one that should diversify really well. Just positive income and prices. It's the only asset class where prices haven't come back to where they were pre-COVID. And then you could look at infrastructure, hedge funds, gold. I do think it's funny how much we talk about gold and how small it is in portfolios, but that's, an aside.
I know that you do focus on real estate, and this is a big central part of the president's agenda, and it's also a big question mark because it used to be one of the main stores of wealth for so many different households. That's now obsolete for a lot of incoming household creators who don't have that capacity. How can you get a more healthy market, a healthier market, without prices coming materially lower, right? How can you have a healthier market going forward that doesn't include a good degree of pain that forces some sort of capitulation in the space?
I think you have to start with what is that epicenter of wealth over the years? 2/3 of Americans own their home, and it's the biggest asset they own, okay? Prices go up, they feel good. And it produces a wealth effect as well. But right now, the average first-time home buyer in America is 40 years old, up from 33 7 years ago. So we're creating this generation of renters that are being pushed into the market where they can't get the American dream the way we thought about it. So that creates an income stream for all Americans to access. The democratization of alts is bringing this new investment idea to them, and we're seeing adoption beyond traditional pensioners and insurance funds. So this becomes a way to diversify in a portfolio that more people have access to. And especially if they can't get the American dream kind of idea, this is one way to fill their portfolio.
American Dream Light. Own a stream of revenue from rent. Yeah, exactly, rather than actually the home, because ultimately you've got to diversify. But it's a great point. I mean, this to me is really the highlight. People don't have their money tied up in homes, so it has to go elsewhere. And that's what you're seeing in this space.
And it leads to the anxiety that people feel because they can't tie their money up in homes, because that was the American dream. But yeah, it speaks to the real boom in alternatives right now. How do you find ways to put that money to work if it's not bond markets that's not giving you that diversification anymore?
Luckily, we've got Tom Kennedy with us the entire hour, which I'm so pleased to say, of JP Morgan Asset Management. Coming up, we're going to speak with Erica Najarian of UBS as Wall Street bets on mergers and acquisitions boost. We've already seen quite the boost with a whole host of mega deals on deck. What could come next? Yahya Anand is also going to be joining with your morning movers. Trump media jumping as it gets into the business of fusion energy. We'll explain. We'll attempt to explain. Tom Kennedy will explain. Tom, you'll read it on that in the break. From New York, this is Bloomberg Surveillance. Good morning.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Beirut, and this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Seeing a boost to equities after 4 straight days of losses, led for now at least by big tech on the heels of Micron. What you can see is just about an 0.8% gain on NASDAQ futures. S&P up about half that, about 0.4%. Russell 2000 lagging behind as people question just how much heat there is in the U.S. economy in 2s, 10s, and 30s. That's the reason why you're getting a bit of bid into bonds, particularly on the front end as people look to possibly more rate cuts early next year from the Federal Reserve following what we saw from the Bank of England. 3.46% on the 2-year yield. That 30-year yield just pinned there at 4.83%. Take a look at the pound intraday. You did see a pop initially after the decision came out, 5-4, a hawkish cut down to the lowest level going back to 2023. It's now just about flat, but Danny, really highlighting some of the concerns that people have about the Bank of England's ability to cut more even with a deteriorating economic backdrop.
And the Bank of England highlighted that themselves, the lower propensity of their ability to cut because of what's happening with inflation. It mirrors the conversation happening with a lot of central banks, be it here in the U.S., largely expected to cut, but a division really growing among the board. The ECB, they're expected to hold today at 8:15 a.m. when you had an ECB official just this month saying that maybe the next move is going to be a hike. That's not consensus, but it's a growing divide because of this pressure from the dual mandates.
Nobody on the Bank of England voted to hike rates. So there is that. Right now, 2 hours away from the cash open, here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. Micron to the rescue in this jittery market. We are seeing shares popping now 14.5% in the pre-market after the company blew past estimates saying that demand for its memory chips is far outstripping supply, and that is giving them major pricing power. What analysts are saying is that those price increases for those memory chips are unlikely to abate anytime soon. So it bodes well for Micron. Meanwhile, moving on to Trump Media, those shares are popping 22% in the pre-market on news in the last hour that the social media company behind Truth Social is getting into the fusion power business by merging with TAE Technologies in a $6 billion all-stock transaction. It is an unusual tie-up, but of course, it is tied around this bet on the insatiable power demand needed to run AI data centers. And we end on Medline. The stock is pulling back this morning, down 6% in the pre-market after an explosive market debut yesterday that saw shares pop more than 40%. This is a medical supplies company that does provide everyday gear for hospitals, so it's not a big tech company, and it raised more than $6 billion in the biggest IPO this year, capping off a strong showing for listings here in the U.S. in 2025. Lisa.
Thank you so much, Yahira. Tom Kennedy of JP Morgan here, having done a deep dive into Trump Media and nuclear fusion and the connection between the two. So what'd you come up with?
I'll have to get back to you guys next week. Invite me back.
I'll have you back. Tom Kennedy's hot take on that, our narrator this morning. President Trump saying he will announce his nominee to replace Federal Reserve Chair Jay Powell soon.
Soon announce our next chairman of the Federal Reserve, someone who believes in lower interest rates by a lot, and mortgage payments will be coming down even further.
Fed Governor Christopher Waller, NEC Director Kevin Hassett, and former Fed Governor Kevin Warsh are all considered the top contenders to replace Powell. Really, the ultimate question comes down to how much does it really matter? I mean, Tom, does it matter in any way, shape, or form who the next Fed chair is if it is a committee that has to vote on something and be some sort of consensus?
It definitely matters. But it matters a little bit less when you can acknowledge that it's a committee, and it is a committee when you're in the room. That's exactly the way it will work. But we're used to Fed chairs that gather consensus, and they bring the committee along, and they shepherd the market in a very smooth way. Look, one of the biggest adversaries of an investment portfolio is volatility. So if the Fed chair is adding volatility, that's a big problem. When you look at all three of these, I think the market will accept them and it will be fine. I think Waller is the one who's the known quantity, so we'll bring volatility down. And he still has been very vocal about advocating for interest rate cuts in a framework, data-based way.
Well, it speaks to this idea that one of the important tools the Fed has is communication, that they're able to reshape markets by building this consensus and having a Fed chair at the helm who can communicate that. On the other side of things, Jason Furman, now of Harvard, previously worked in the government, saying, hey, this is a good thing. He's not the only person saying that, but this is a good thing to have a diversity of ideas within the Fed. It's a healthy thing not to have a godlike figure who's at the Fed, is the chair, and decides everything for everybody else.
I know that Jay Powell is very happy that you're implying that he's a godlike figure. Meanwhile, BP appointing Meg O'Neill as CEO, replacing Murray Auchincloss. The change coming as the oil giant struggles to revive its fortunes after a botched pivot toward renewables. O'Neill will be the big oil's first female leader. We'll get into that in a bit with Elliot's fingerprints on this as well. Meanwhile, OpenAI is reportedly in talks to raise tens of billions of dollars in a valuation of about $750 billion. According to the tech news website, the information discussions are preliminary and the details could change. It just highlights how OpenAI is the center of absolutely everything when people talk about their worries about overspend in AI.
Yeah, and maybe the benefit that OpenAI has is that its funding rounds happen in private, in the dark. You don't necessarily see ramifications in public debt markets that you would in an Oracle, for example. And the news that Blue Owl wouldn't be a part of this Michigan data center that they're having, because that is the fear. Maybe we're kind of misplaced worrying about a bubble in valuations. Maybe it's whether just or not that they can continue to get funding for their data center build out. What happens if you have more players and more bond markets starting to rebel against the idea?
Maybe OpenAI will just get purchased by NVIDIA. Maybe this will be one of the M&A deals announced. Actually, no one is speculating about that, but there will be a lot of M&A next year. This is the expectation from Wall Street. Erica Najarian of UBS writing, banks might be more motivated to close larger deals ahead of any potential shift in power in Congress. The first half of 2026 could be a robust time for deal announcements. Erica, I'm so pleased to say, joins us now. Erica, great to see you.
Good to see you.
I'm not saying that OpenAI and NVIDIA are going to merge, but there is this feeling that there is an acceleration in the deal space. Just how much pipeline is there behind that?
I think bankers are not going to have a fun Christmas season. I think they're going to be at their desk working because I think 2026 is going to be the year of big. You know, I cover banks, so whenever we talk about M&A, we think about regional banks merging for synergies. But given the deregulatory framework, and given that you do have the midterms as sort of an important waypoint in time, you know, I think you could have banks and other companies across the space really thinking about where their strategic holes are and addressing it that way. So I think it's going to be more than just, okay, we're going to do deals to cut costs. I think they're going to use this as sort of a, you know, once in a generation opportunity to redeploy capital in a very specific strategic way.
Because a lot of the deals we've seen have been really big. I mean, whether it be in IPOs, the Medline IPO coming on the market earlier this year with EA, the huge amount of numbers that are being put to that. Whatever is going to happen with Warner Brothers Discovery, maybe we add that in, that whole hot mess of a potato in with that too. How much of this and the resurgence of deals are about big size deals versus volume of deals?
I think you could get both, right? So first of all, the sponsors haven't really, exited much, so we're waiting for that. You know, the market is at all-time highs, spreads are at all-time tights. So it feels like now is the time. And I was here last week when I had this analogy that this administration was going to put lipstick and contour on this economy to get it through the finish line for, to the November, midterms, right? And so you could have sort of also a macro backdrop, and maybe we get 1 or 2 rate cuts that's quite favorable for this environment.
By the way, can I just say we should only start using makeup metaphors and no more baseball metaphors. No more innings, only lipstick and contour. I'm absolutely on board with that, Erica. How much of this, though, when it comes to strategics versus private capital? Because to your point, they're still sitting on a lot that they need to exit. Are they willing to take a discount, or has the environment gotten so good that things that they maybe overspent on in 2021 and 2022, they can sell at a price that they agree to?
I think you still have a pretty significant valuation disparity, and I think you also have, your deployment of capital is not going to be as, those investments are not necessarily going to be as good as those that you're trying to exit, right? So I think that's going to be, continue to be a challenge, but nevertheless, I think in particular with I think the advisory pipeline is going to be is actually quite strong, and you had the government shutdown, so the fourth quarter is going to look a little bit light. So that's going to have the effect of pushing a lot of these announcements into the first quarter. And so you're, every sort of Sunday evening or Monday morning is going to be boom, boom, boom in terms of announcements, I think, when we kickstart the year.
Talk to me a little bit more about the financial M&A.
Yeah.
On the strategic side, what are the strategic priorities of an M&A for banks at this point if it's going to happen in the first half of next year?
So scale and completeness, in my opinion. And additionally, an edge in tech. So for example, it's pretty clear that scale is getting to be even more important given the technological demands, the investments that are needed in AI and the like, right? So that's number one. Number two, you work at a company that's very diverse, for example, right? And so the whole idea of a booming money center, complete money center bank, I think is, highly subscribed by the market. So let's say you're an investment bank, maybe you're seeking more of a wealth aspect, or Wells Fargo, has, mentioned potentially expanding in growth areas if it were appropriate. So these are sort of the strategic, points that I think are going to be addressed in the new year.
A lot of people are very excited about financials at the same time that they're very concerned about some sort of glut in private credit, some sort of excess that could potentially come to roost in 2026. Is there a dissonance in this, the idea that people think that there is no credit risk in banks, but there is full credit risk in private credit?
You can't have an explosion without getting shrapnel, right? So I would say a couple of things. Number one, everybody is hyped about bank stocks, but bank stocks rarely outperform the S&P 2 years in a row, right? And when it's happened on the back of a recovery cycle, right? Think post GFC or post the dot-com bubble, right? So the bar is high. Second, we have to watch the sector rather than just say, okay, there's something out there that we have to be nervous about. What do I mean? Is there froth in data centers? Is there froth in, other so it's really a sector issue rather than structure. So really it's going to be, right, what the banks have done is they've indirectly lent to financial institutions that then lent to the companies, right? And we saw in the matter of the, First Brands, for example, that when you have, an explosion, obviously there's fraud, the banks will catch some shrapnel. So we'll see.
Well, Tom, to this point, I mean, how much are people understating some of the credit risks here, given the concerns about the likes of Tricolor or First Brands?
I think what Eric is trying to drive out here, too, is the important piece of this. It can't be just private credit's the issue and not the banks. I mean, let's just acknowledge that up front. But as you're moving through this froth, I think the way you made the comment about the fraud is, when we look back in history, guys, fraud is a bankruptcy. It's not it's fraud, that gets an asterisk. Like, if we have these types of problems that are going to surface, I do think the banks will get tied down to that. So maybe, Erica, last question. As you separate these, which banks are best positioned into 2026 if we were to hit a default cycle? Just the well-diversified banks, or is there something to that, or an angle that you focus on?
And by the way, it's not a coincidence that Tricolor and First Brands were in the same sector, right? So this goes back to what I was saying. It has to be a sector. Look, I really like Bank of America here, right? So all the things that, perhaps was a negative for Bank of America, to directly answer your question, not growing as fast as others, being a little bit more conservative in an environment where, there's a little bit more uncertainty and maybe we are just band-aiding the economy. I think they, could potentially perform well, and the valuation is, not all that demanding. A company like, Capital One, that lower end of the K has taken hits already. Right? I mean, we've talked a lot about the K-shaped economy, but who's been dealing with inflation since 2021? It's been the lower end of the K. So I think that, those two stocks set up really well for 26.
Erica, thank you so much, as always, for being with us. Erica Najarian of UBS. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Calls are growing for the EU to approve a massive loan to Ukraine backed by frozen Russian assets without the support of Belgium. Kyiv's finances are likely to run out in a matter of months without the boost. Meanwhile, U.S. and Russian officials are set to meet in Miami this weekend for continuing talks on a peace plan. Meanwhile, a Warner Brothers Discovery shareholder has approached New York hedge fund Standard General to acquire all or part of its cable TV assets. The Financial Times reports the fund's founder, Soo Kim, has been involved in the talks, which would include the sale of CNN. It comes after Warner Brothers urged shareholders to reject a $108 billion hostile takeover offer from Paramount Skydance. And Trump Media and Technology Group agreeing to merge with TAE Technologies in an all-stock transaction valued at more than $6 billion. The transaction is set to create one of the world's first publicly traded fusion companies. The new venture plans to begin construction on a utility-scale power plant as early as next year. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, inflation signals.
We are yet to see the full effects of tariffs on the inflation data. And sure, while it may be a one-time price shock, I think it's a little too early to declare victory on inflation yet.
Adrienne Yee of Barclays joins us next on The Consumer. This is Bloomberg Surveillance.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Seeing a bounce to equities after 4 straight days of losses. It's coming from the tech sector after the tech has lagged behind. Micron giving a bit of optimism here. Meanwhile, yields bid, but not as much as earlier in the session. Now almost 4.14% on the 10-year. Take a look at Nike shares. Pre-market trading up almost 1% ahead of earnings after the bell. Those shares lower about 11% so far this year. Can they deliver on a turnaround strategy? And what do they say about the U.S. consumer in particular? Under surveillance this morning, inflation signals.
There seems to be this view in the Fed that inflation is really not a problem right now. I think it's a little too premature to think that inflation is going to take care of itself. We are yet to see the full effects of tariffs on the inflation data. And sure, while it may be a one-time price shock, I think it's a little too early to declare victory on inflation yet.
Here's the latest. The November CPI print dropping this morning, set to offer investors a partial snapshot of inflation ahead of the new year. Adrian Yee of Barclays saying the consumer has shown resilience this year, but sees, quote, potential tariff-driven inflation on the horizon. Adrian joins us now. Adrian, thank you so much for being with us. We've seen this when parsing through all of the retail earnings, how different companies have managed through inflation. Do you think this is just the beginning in terms of being able to selectively increase prices on specific goods?
Yeah, actually, we have not actually seen broad-scale inflation across apparel and footwear. I'll talk about kind of year-to-date what we've seen inflation sort of in the hard lines, home furnishing sector. And then the footwear industry was actually ahead of the inflationary price increases. So they broadly, Nike, On, Hoka, they all took price increases up by about mid-single digit in July. Across apparel, we've seen virtually no price increases, but for just modest kind of normal way price increases. And so really what you're seeing with the strength of the economy is pricing that has been relatively benign in terms of inflationary pressure, and yet the cost side of it, the margin side of it, actually still hasn't come through on the P&L either. So all of this is horizon risk for the forward kind of spring season, when you'll see, the other 80% of apparel discretionary actually start to raise prices, and that's when we'll see kind of demand destruction.
Adrian,
yes.
Does Nike, though, have the ability within all of these macro headwinds to also deliver the innovation that should they need to readjust prices or should they not want to keep discounting, they can get consumers to the stores and buying new sneakers?
So this is so what you're describing is turning a product around and a brand around that has lost some of its brand heat and raising prices while doing so. Those two things are incongruous. They are very difficult to happen at the same time. And what I will say is that Nike has cleaned up the marketplace. Remember, there were this big 3 classics, the Air Force One, the AJ Air Jordan One, and the Dunks, which they removed because there was just lack of innovation. So what we're seeing with Nike is strength in their performance run. So the Pegasus, the Vomero, right, the Structure, the Invincible. In that performance run, they're sort of catching up to where On and Hoka had been with that thicker platform. So it remains really to be seen whether they can take that one portion of the performance piece of the business and then bolt on kind of the leisure lifestyle, right, the strength that they typically have seen kind of in the marketplace. Our preview would suggest that they are going to beat the quarter this evening. Usually when you're giving that guidance, you're giving it mid-quarter, you have a very good look at the wholesale order book in the quarter. I think they will talk positively about the forward spring order book. Having said that, they're anniversarying a lot of the reset actions that they did last year. And so they're going to forego some of these low quality sales in the third and the fourth quarter, their fiscal third and fourth quarters. And that may kind of cap the top line. Margins should be better, but the top line, probably will be constrained. And I'll say my final point here is not about FY26. FY26 ending May should be fine. We'll beat the second quarter. We'll kind of temper the back half. But it's really about the forward 2 years where we're looking for 400 basis points of margin expansion with 10% top line growth. Those things don't happen at the same time.
Adrian, I wonder when companies are trying to mount this turnaround, especially with all these headwinds, be it, locally with their innovation or the macro headwinds, how important it is at who's at the top. And I ask this because Nike, new CEO just last year in October 2024. This week, the discussions are around Lululemon with an exit of their CEO and Elliott pushing for a new one from Ralph Lauren. Adrian, can these changes happen if you have the old guard at the top, or for apparel and consumer-facing companies struggling? Do they need to have a rethink of their C-suite in order to succeed?
Absolutely. It's one of the things that we're learning through all this tumultuous time, right, for the past 5 years, frankly, for the past 10 years. We've had the digital economy. We've had COVID. We've had, a supply chain, right? The supply chain was stuck for 2022. So you've had inventory issues, supply chain issues, everything. And what I would say is the guiding factor for investors and for us as analyzing companies is you are investing in the management, and you are investing in the confidence that they can navigate each one of these successively, even though they don't know what the next shock event's going to be, that they have the wherewithal to do that over time. So absolutely. And the final thing that I'll say here is what you're looking for in that management. In consumer retail, you are looking for product, brand, customer experience. Those are the three things you want to hear the management's talking about. And you hear that from Elliott Hill at Nike. You hear that from the new Gap CEO, Richard Dixon. And it's no surprise that you're starting to see some of those changes happen at those companies.
Adrian Yee of Barclays, thank you so much for being with us. Tom Kennedy, a final word here ahead of the CPI and jobless claims. What do you think we're going to be most surprised about heading into 2026? The resilience of the consumer, or the consumer falling off?
I think we'll be surprised about the resiliency of the consumer thanks to the big, beautiful bill and the rate cuts coming through. I think consumer will be resilient. I think the things we need to be looking out for are how persistent can this tariff-led inflation be? The Fed's banking it won't be. It's going to be a one-time shock. So we need to look for that, and then really think that the K-shaped economy will close a little bit in a positive way, where the bottom end comes up. I think that's the most likely outlook for 26.
Tom Kennedy, it is a pleasure having you here. Thank you so much for spending the hour with us. Let's do it again sometime soon. Tom Kennedy of JP Morgan Asset Management. Danny Berger, I believe you're doing 45 hours of TV today, so we're going to let you go prepare for the rest of it. Always wonderful to see you, and great interview with Ken Griffin earlier this week. Really interesting. If you haven't seen it, check it out on YouTube or the Bloomberg website. Coming up next hour, as we do await that economic data, Emily Rowland of John Hancock, Seema Shah of Principal Asset Management, Aaron McLaughlin of the Conference Board, and Brent Schutte of Northwestern Mutual. This is Bloomberg Surveillance. Good morning.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8? Right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked, and we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
There are a lot of tailwinds supporting the economy for next year.
You do have to see an economy that keeps chugging along. If it doesn't, you're going to have a problem.
One of the key themes that we've noted for this year is people really underpricing kind of the macro risk.
We still have a problem with inflation.
There's certainly a risk here that you could see inflation that's a bit more sticky.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. CPI on deck along with jobless claims in about a half an hour as we try to end the year on a high note. Also waiting for an ECB rate decision following that Bank of England rate cut about an hour ago. All eyes very much on the U.S. consumer as we suss out any sense of the U.S. economy heading into next year. David Gura back in the hot seat, I'm so pleased to say, joining us for the next hour. And David, really it is all going to be about what we get in a half an hour time, the first CPI report from the United States going back to September.
Absolutely, and an incomplete one, so we'll see sort of what actual tangible information we get from that. And of course, that dovetailing with, complemented by this ECB decision. Yes, Christine Lagarde's going to be speaking, but Isabel Schnabel, member of the Governing Council, looming large in light of the comments that she made to Bloomberg earlier this week.
The idea of potentially hiking rates, not cutting them. Nonetheless, as we were talking about with Tom Kennedy in the last hour, he was saying, look, there is a bias to cut rates right now because the labor market front and center is clearly showing signs of weakening, possibly beyond what's being shown by headline numbers. So at a certain point, what's more important, CPI or jobless claims with this kind of backdrop from the United States?
The debate continues. I took a few days off, came back. It seems like we're dealing with the same issues over and over again, the kind of preeminence of the central bank versus what's happening in the AI space. Lo and behold, good news in the AI space yesterday, and we see markets reacting strongly to that this morning.
Yeah, just a cheat sheet. We're going to be talking about the same theme for probably the next 6 months.
Beautiful.
So, David, if you take a break, come back. Hopefully you don't take a break. We love having you. Right now, you are seeing a bit of a snap in that 4-day losing streak as people try to get some optimism, as David was talking about. Maybe Micron helping to boost spirits, 0.4% gain on S&P futures. We are seeing Just a bit of euro weakness ahead of that ECB rate decision, 117 on the euro-dollar cross, and 10-year yields lower by more than 2 basis points, 4.13%. Crude still in that $50 to $60 range, although climbing just a bit after yesterday. The potential for some sort of disruption in Venezuela. Coming up this hour, do not miss this. The great Emily Rowland of John Hancock Investment Management as stocks are rising. Siva Shah of Principal Asset Management as Europe's central bank is set to make its final rate decision of 2026. And Aaron McLaughlin of the Conference Board breaking down the November CPI data. We begin this hour with stocks looking to snap that 4-day losing streak. Emily Rowland of John Hancock Investment Management writing, "We are constructive on U.S. equities into 2026. We still see an impressive earnings engine driven from AI productivity gains. The challenge we continue to face is that valuations are rich." And Emily joins us right now. Thank you so much for being with us. Great to see you. I'm curious about valuations. The fact that everyone is so worried about valuations, how much relief does that give you?
Yeah, I mean, look, we're at 22.5 times forward earnings. The highest in history was 24 times, so we're not going to see a lot of multiple expansion into next year. But the good news is that the earnings engine in the United States is on. Analysts are looking at 14% earnings growth for next year, so the denominator is almost more important to us than the numerator here. And there are some tailwinds for U.S. companies into next year. We've got the provisions in the One Big Beautiful Bill, lowering the effective corporate tax rate. We have oil prices falling. That's great for the consumer. It's good for transportation costs for businesses. We've got the U.S. dollar falling. We just saw one of the weakest years for the dollar in modern history. Remember, 40% of the revenues of U.S. companies are derived from overseas. So there's a lot of things happening that I think can go right for companies into next year. It's just, is the bar too high?
Well, is the bar too high for big tech, and can big tech lead? Because all of the companies in the sectors that you just mentioned were consumer-facing, were companies that were not necessarily in this haloed sphere of the Magnificent Seven. I know you have been overweight big tech for the bulk of 2025. Are you shifting that heading into 2026 because of this type of thesis of strength elsewhere?
Yeah, I mean, we are looking for a broadening out in terms of market participation, and we're already seeing that with sectors like healthcare and industrials getting in the mix. We are always firm believers of following where the earnings are going, and we are expected to see earnings delivered by different sectors in the S&P 500 next year. We still want quality. We want to find it at a reasonable price. We want to look for relative value. And look, we still like tech, but there's no doubt about it, it's expensive. The S&P 500 Growth Index trading at about a 50% premium to its long-term average. We like the high-quality parts of tech, but there's been a bit of a dash for trash as of late, as investors have just been dominated by technicals, by sentiment. I have personally been dusting off my technicals books because it's the only thing that's mattered. Valuations haven't mattered at all to this market. I think that gets a little trickier into next year, but it's been about technicals, been about momentum. If a chart's going up, investors are buying it. And that's pretty tricky for people that are focused on fundamentals and economic cycles like we are.
What's your takeaway from what we saw with Micron Technologies yesterday? So high bandwidth memory, I had to look it up, but you talk about the haloed Magnificent Seven. We're moving beyond that. We're talking about the things that complement the chips that we spend so much time learning about and talking about on air here. Seems like a bright spot. Seems like something, again, beyond that core that has been such a focus over the course of this last year. Is there a lesson to take away from that in terms of breadth, moving into something like
I mean, it's a reminder that AI is real. It's producing productivity enhancing technology, which is really accretive for corporate earnings and for the U.S. economy. The challenge, again, is that tech is over-concentrated, it's over-loved, it's overbought at these levels. Tech kind of reminds us of it's been such a big driver for portfolios. You know, the S&P 500's compounding at 20% annualized over the past 3 years. So goes the S&P, so goes tech. It's kind of like, do you ever have one of those go-to outfits in your closet? We all have that. And sorry, I'm looking more at Lisa. I think that's high.
The blue suit and tie, it's a good one.
It's kind of like the way technology stocks feel to us right now. It's like you don't need to get rid of it from your closet, but people are like, did Lisa wear that jacket already?
Hey, this is getting really
Emily.
Carry on, though.
Maybe it's getting a little worn. It's about keeping your go-to piece in your closet, but thinking about like what's the next best thing in Lisa's closet for next year. So maybe it's mid-cap stocks, like maybe it's industrial companies that are benefiting from onshoring and investment in the United States. Maybe it's healthcare names that are cheap and have great return on equity. Like we got to find that next thing to round out the closet without throwing away the tech stocks.
A minute ago, you'll forgive me, you sounded a lot like the president last night talking about what's to come in 2026.
Yeah.
The rewards of the one big beautiful bill, the tax incentives that are coming into effect, maybe more certainty when it comes to the economy based on the trade policy. How much of that is being communicated? We're at a moment here where we're poised to get, yes, incomplete, hard data from the federal government, but the sentiment data is still not great, shall we say. How do you look at those two things in complement?
Well, sentiment data just, again, hasn't been helpful. People are saying that things are terrible, yet consumers continue to buy. We saw that in retail sales being pretty decent. We're seeing this incredible wealth effect. That's the thing that's driving this market. You look at back-to-back 25+% returns in 23 and 24. We're on track for 15+% returns this year. That is feeding into portfolios and helping that higher end consumer who has a record amount of stock holdings right now, feeding back into the economy. So it's almost like the stock market is like the tail that's wagging the dog of the economy right now, which is a twist on the way that we used to think about things. So I think that's really helping the overall picture, even though people are saying that things aren't great.
Which is the reason why people are so focused right now on the CPI report and the idea of what the Fed's going to do with this, how much leeway do they have to actually engage in some sort of rate cutting cycle, and really the proof is going to be in how much inflationary pressure there is. You have been overweight bonds for a lot of this year. You have believed in this bond rally. Are you pulling back from that because there isn't really this lip service being given by the Fed to the financial conditions aspect of this entire story as you were just laying out?
We're actually leaning into bonds more as rates back up. It feels right now like bonds are sort of like dazed and confused. They're not acting right. You have them being kind of jerked around by what's going on in Japan right now. You've got this sort of Fed chair bingo, like which Kevin is it going to be? That's impacting bond yields. You've got all sorts of dynamics, the lack of government data. Yes, we're going to get CPI, but a lot of people are just going to discount it. We're not going to get a month-over-month number because we didn't get the October data. So bonds are sort of backing up, and the bond vigilantes are coming in with concerns about the deficit and the one big beautiful bill. The bond vigilantes kind of feel like that uncle that's coming into the holiday party and disrupting the mood. Once bonds wake up, they should see bond yields move lower into next year based on the macro picture.
So you're talking about strengthening the consumer, supporting a broadening out, at the same time that you're talking about bonds reclaiming their haven as some sort of defensive trade. How do both of these things work together?
Yeah, well, I didn't say the consumer was doing awesome. The top 10% of earners are doing well, and they're controlling, 50% of spending, but we've got some real cracks in the labor market here. Things are not looking great. Investors are completely brushing past this, these negative months that we've seen in terms of non-farm payrolls. We think that's important. Layoff tallies are picking up significantly. But the thing that I don't think people are talking about enough is the housing market right now. Shelter's 35% of headline CPI. It is weakening notably, not according to the BLS data. That's probably really backward looking. But if you look at Zillow, for example, home prices are flattening. They're up about 0%. Apartment List is telling us that rental prices last month just dropped the most on a month-over-month basis in 15 years. -1% on apartment listings. So what we're seeing is that shelter disinflation, we think that starts to show up into next year. Those layoff tallies we talked about, there's usually a 6 to 8 week lag in terms of when that shows up in initial jobless claims. So I think the labor market's probably weaker than it looks on the surface right now, and that shelter disinflation is also going to prompt the Fed to cut probably more than the bond market expects next year.
Emily Rowland, so good to see you. Thank you so much for being here. Emily Rowland of John Hancock Investment Management, and I will not be wearing this blazer next time that I talk with her.
I love it.
My go-tos, I've got to say, went very close home in the right way. I mean, truth be told, don't we all have that, though?
Yes.
I mean, honestly, some people really enjoy the shopping thing, but maybe I'm revealing too much of myself.
Fair enough.
Anyway, let's move on. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Donald Trump announcing a holiday bonus for military service members. In honor of the nation's founding year, those in the military will receive a warrior dividend, a check of $1,776 before Christmas. The president's also planning, quote, the most aggressive housing reform in American history. Those are expected to be rolled out in the new year. Meanwhile, Australia announcing sweeping new hate speech laws in the aftermath of the terror attack that saw 15 people killed at a Hanukkah celebration in Sydney. The laws include a new offense for aggravated hate speech, a new federal offense for vilifying those based on race, and making it easier for the country to refuse visas for those found spreading hate. And Washington, D.C. ramping up pressure on Caracas. President Trump ordering a blockade this week of sanctioned oil tankers going in and out of Venezuela. And according to data compiled by Bloomberg, the move is helping to push inflation in the country over 500%. This as a Chinese official expressed support for Venezuela, saying it opposes, quote, unilateral bullying. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, the ECB set to make its final interest rate decision of the year. Seema Shah of Principal Asset Management with us to break down the results. After what we got from the Bank of England, a rate cut, don't expect a repeat from the ECB. It is likely to be a bit of a different tone. This is Bloomberg Surveillance.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome back to Bloomberg Surveillance. We are getting an ECB rate decision. They voted to hold rates steady, saying they're not pre-committing to any kind of rate-cutting path. They're looking at data dependency, meeting by meeting, keeping the deposit facility rate at 2%. That was the estimate. Let's get some details from that decision. Jamie Rush of Bloomberg Economics here with the results. Jamie, when you parse through all of the details, what stands out to you?
Well, I think it's more about what is it that Lagarde's going to say at the press conference about the outlook for inflation, how that appears to be weakening, and what that means for interest rates. Because of course they have held interest rates steady. That was widely anticipated. The question now is, what is the next move? Is there any more room for them to cut? Do they see more space to cut, or are they going to endorse Isabel Schnabel's remarks on the executive board there? That perhaps in the future the next move could be a hike. I mean, I think those are the things we're going to be watching, looking for the inflation outlook, looking for her remarks about the near-term policy outlook.
Yeah, especially, Jamie, given the fact that they're talking about economic growth accelerating next year, raising their economic growth forecast to 1.2% for 2026 in the Eurozone from 1%. Granted, it still is 1.2%, not necessarily 2 or 3% that you see in other regions. Nonetheless, how much does that indicate this focus on inflation that you did talk about with Isabel Schnabel discussing?
Well, I mean, the key thing here is that growth, as you mentioned, is still slow. It's still potentially even below the trend growth rate of the economy, or very close to it. And of course, it's not guaranteed. What we're seeing is significant struggle for economies like Germany to gain momentum as China is slowing and its exports markets are not keeping pace. And of course, we haven't yet felt the full impact of higher tariffs, which are still feeding through to the Eurozone economy. So the outlook is, as usual, uncertain. Growth is tepid. This is an outlook where you need to be vigilant. You need to be thinking about whether you need to provide more support to the economy. So I would say that it's not a settled matter that the ECB has left rates today at 2%. There could be more to come in the year, as we proceed through the year.
JB Rush of Bloomberg Economics, thank you so much for being with us. Right now, what you do see in markets is the euro just pulling back from earlier losses, almost flat with the dollar, and you are seeing muted moves across the board. What stuck out to me was the fact that 2026 inflation is now expected to be 1.9% versus a prior forecast of 1.7%. Sure, an increase, but still well below that 2% goal. David, it doesn't seem like this is screaming inflation, even as they do upgrade some of their growth forecasts.
Absolutely, and again, I think picking up on what Jamie was saying a moment ago, I think we want to get more insight into what this good place, as Christine Lagarde has called it, looks like, how she sees it shaping up over the course of these next few months. Then just going back to those comments from Ms. Bell-Schneider, hard to understate how seismic the reaction to those comments was, the prospect that there could be a rate hike here in the near-term horizon. Again, her relative comfortability with that, I think, is something that we're going to want to hear more about from the president of the ECB when she speaks in a few minutes.
Yeah, let's talk to Seema Shah of Principal Asset Management, who joins us now about just that. Seema, thank you for being with us. We are seeing some forecasts here that are interesting. When you take a look at the ECB's projection for 2026, inflation, stripping out food and energy, they now see at 2.2% versus the expected 1.9%. How much is this an ECB prioritizing inflation above potentially allowing growth to truly accelerate in the euro region?
Hi, Lisa. Yeah, I think this is key. I mean, look, the ECB, unlike the Fed, is going to be solely focused on inflation. That is their mandate. So they're going to put a little bit more emphasis on that. And so to the point that, yes, growth is certainly looking a little bit stronger next year. There's been upgrades throughout the year. In fact, unlike the US, where you've seen consensus forecasts drop since the beginning of the year, European forecasts have actually increased since the beginning of the year. So there has been an improvement. Their sole focus, though, has to be on inflation, which means that they're likely to keep, at least I think Lagarde is likely to maintain a slightly hawkish narrative, but I don't think that she's likely to kind of reinforce Schnabel's comments about the next move being a hike.
Won't reinforce them, but I wonder how she addresses them effectively. So we've seen kind of the moves since those comments were made in that interview with Bloomberg, and I think just the fact that they exist, that specter kind of looms large here over the shadowing itself over the course of this meeting is significant. What does she have to say? How should she address? How do you anticipate she's going to address those comments?
Well, I think she's going to allude to the significant uncertainties that there are about the outlook. You know, as we've heard her say before, they feel like they're in a good space. Good space being that they have managed to navigate this year's various challenges with regard to trade tariffs and managed to get to a spot where they feel like growth can be stronger next year without really suffering a major inflation shock. So that's a good space. What that implies is that they have the time, the patience almost, to sit it out and see how the economy responds, how inflation responds. So if anything, we do think that Lagarde is likely just to keep the door open, not really promising any kind of forward guidance, but just talking about almost the data dependency and seeing how inflation, above anything on the economic growth or labor market side, but how inflation expectations evolve over the coming months.
Forgive me for going back to growth, but I heard Jamie Rush characterize it as tepid growth and talk about all the uncertainty that Europe is facing, certainly so many economies are facing right now. Yet if you look at all of these forecasts in aggregate, I think of OECD, IMF, World Bank, ECB now, even comments from the Federal Reserve that are rosier than they had been, there is this sense that things are improving and getting better. And I wonder how you square that with this overarching uncertainty that still looms large here. If it has to do with tariffs policy, if it has to do with fiscal spending, there's still so much that we don't know here. Given all of that, Seema, how much credence can you give to the forecast, the likes of which we see today?
Well, so the improvement in the forecast is something to do with the idea that, look, Europe hasn't been as badly hit by trade tariffs in 2025 as expected. And so some of that is expected to follow through to 2026, and some of the concerns that existed just after Liberation Day about Europe potentially being hit by a 30% trade tariff have faded, of course. So that's one thing. But I think the main reason that you've seen these upgrades to forecasts is around the fiscal stimulus, which is going to be coming through. Now, the uncertainty around that still exists in terms of what is the allocation of that fiscal spending going to be, how much does it feed through to the economy, but just the size of that fiscal stimulus is enough, I think, to lift economic growth forecast by a bit. But to your point, these are still quite small upgrades. This is still growth, which is expected to be meaningfully less in the US. So you don't want to get too excited about it. But certainly there does feel like there is a little bit more optimism than there used to be around the European story.
But is there a broader takeaway from central banks globally that see the fiscal impulse and are not shying away from either rate cuts or holding rates steady because they want to allow growth to take off? Does that make you more inclined to buy the equity side of the story than, say, the fixed income side of the story because there is this focus on growth?
Absolutely. You know, I think the equity market story has become more attractive for a lot of places. Of course, you've got to take it into the valuation side, but the fundamental stories for a lot of these countries have improved. And you can see a significant disparity with the countries which haven't really embraced that fiscal stimulus. And the UK is a perfect example where they have continued to tighten fiscal policy. And you've seen that equity markets and general investor sentiment towards the region has deteriorated, whereas it has improved for Europe. So I think that is a key narrative. It's one that's likely to persist through 2026 as well. There could, of course, be the ramifications for the bond market and how yields are going to be performing. But at least from an equity market side, a lot of these countries do look more attractive because of that fiscal story.
You know, the ECB just sort of underscores this narrative that's taking hold, certainly in the United States, that you can have growth without inflation. You can have a productivity-led growth that's going to allow central banks to hold rates either at neutral or even potentially keep cutting while growth is powered by the AI story. How feasible is that? Do you think that people have gotten a little bit too carried away with that narrative?
Well, I think it's a narrative which is important, but I don't think it's specifically very important for today. And I think there's two contrasting stories. For Europe, the concern isn't really around what the deflationary impact of AI is. I think the concerns on the deflation side for Europe is really around China's exports as they try and move their independence away from the US and trying to broaden their export partners. So then really flooding European markets with slightly cheaper exports could put some downward pressure on their inflation. For the US, I think the AI story is a little bit more pertinent because AI adoption has been so much more significant. But even in the US, certainly we are expecting that for 2026, for example, inflation is going to be somewhat elevated, certainly above the 3% level, but that is something that equity markets, general markets can actually absorb, and actually that central bankers can be fairly comfortable with, even if they don't specifically say that 3% is okay for the near term.
Seema Shah of Principal Asset Management, thank you so much for being with us and breaking down the ECB rate decision. I'm struck by some of these forecasts talking about growth of 2.1%, talking about inflation at 1.9% next year, and then getting concerned that maybe rates are too low and need to be hiked. I mean, it's such a different scenario heading into US CPI that we're going to be getting in 5 minutes' time.
Absolutely. It's fun to look at all of these in complement because, of course, you had this Bank of England meeting on the heels of their CPI report yesterday, the way that colored their decision today or didn't, the degree to which inflation's weighing on the CCB decision. I don't know. It's fascinating to kind of get a look at them all together, Lisa.
Yeah, you're looking at European growth expected to be 1.2% next year from an expected 1%. Is that a concern for inflation? In the United States, November CPI data is set to cross with the expected 3% headline year-over-year number. Aaron McLaughlin of the Conference Board and Brent Schutte of Northwestern Mutual both joining us to break down the numbers. Right now, a lift to equity futures ahead of that decision. This is Bloomberg Surveillance. Good morning.
know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
25 seconds away from that key economic data coming delayed. Nonetheless, better late than never. What we are seeing in markets is a positive lift, this expectation. Maybe we can restart this rally up about 0.5% on S&P futures. Yields decidedly lower after the ECB and Bank of England rate decisions, down 4 basis points on the 10-year to 4.12% as we do get that key inflation data coming out of the United States. Just crossing now. Let's head over to Bloomberg's Michael McKee with the numbers. Mike.
Well, better late than never is a good way to put it, Lisa, because the news is pretty good on a 2-month basis. Remember, we didn't get October CPI, and we're not going to get much out of that. 2.7% for the year-over-year move in CPI. That is down from 3% in September, the last release we got. The core CPI on a year-over-year basis falls from 3% to 2.6%. So good news on inflation. Meanwhile, good news on the job front with initial jobless claims falling to 224,000 from 237,000 revised the week prior. On a continuing basis, claims are at 1,897,000. That's up from 1,830,000. And finally, we've got the Philadelphia Fed numbers coming out now. The business outlook falls to negative 10.2 from negative 1.7. The prices paid index falls, though, to 43.6 from 56.1. Employment at 12.9 versus 6.0. So pretty much all of these numbers are better in terms of their trend. We'll break down what the CPI numbers are telling us while you break down what the markets are telling us.
Well, right now, Mike, the markets are cheering. Well, we'll get back to you in just a second. Right now, this is a collective scream of joy in Wall Street because what you're looking at are yields substantially lower across the board on 2s, 10s, and 30s. And you're seeing equities with a lift. This is giving the green light to the Federal Reserve to cut interest rates. You can see that rally building at the front end now, down more than 3 basis points. The equity front, take a look at that rally, turbocharged, particularly for the Russell 2000. It had been up about, less than 1/3%. Now we're looking at more than a 1% gain, a similar move on the NASDAQ. S&P futures up by 0.6%. When you bleed this through the currency space, we did just get an ECB on hold. We are going to likely get a Fed that potentially could be cutting rates, which is leading to dollar weakness, as you would expect. Michael McKee, you've had a couple of seconds to look through this. Does anything stand out to you that really does seem to move the needle one way or another?
Well, one thing that is important to note about this is that October and November, there's no October data, so we don't have the month-to-month changes in most of the categories here. Some come in electronically, and looking at those, we can see the gasoline prices in November were up 3%. After falling 2.1% in the month of October. Another one we have is new vehicle prices. They were up 1/10 in October and up 2/10 in the month of November. Used cars up 7/10 in October, up just 3/10 in November. So an improvement there. Most of what we're getting is year-over-year numbers, and we can say that food, 2.6% was the increase on a annual basis there, and food at home, the grocery prices people are unhappy about, up 1.9%. So some improvement in inflation in all of these areas. I'll continue to dig into this as we try to figure out what really drove the numbers this time.
Michael McKee, thank you so much. What?
Yes, he's very fast.
It's just amazing.
Yeah,
he's absolutely fantastic. I am curious, though, about the line items. I do think the line items are going to matter more than usual, in particular, due to questions around how this was calculated, given some huge gaps in the data collection.
Yeah, and just kind of what the use or utility or veracity of all of this is, I think is going to be an open question. We'll see sort of how maybe this gets colored politically over the course of the day, given the lapse that we've had.
I'll give you a hint. I'm watching Truth Social for cut rates now.
Some reaction there, market reaction on that one as well.
100 basis points. Aaron McLaughlin of the Conference Board joins us now for more. Aaron, how should we view this in light of everything that we've been talking about with respect to the complications around data collection, but also this look to the Fed and potentially how much of a constraint this is or isn't on them cutting further?
Well, obviously good news for consumers, and that's important. I think that we were already anticipating a possible cut in January. You know, once the employment numbers come in early January and we have some clarity, you know, which we didn't necessarily get with the employment numbers due to the shutdown, due to the blip over the last couple months. So I think this would certainly support that theory a little bit more. When folks are thinking, well, how many cuts are we going to get next year? I think that's the big question, is what does 2026 really look like?
Well, and also, how much are you seeing some of this disinflation, or not disinflation, but this idea that we're not seeing inflation run away? How much are you seeing that reflected in sentiment? Because this is what David was sort of referring to, this idea politically, there is a response to inflation that has been cumulative over 4 or 5 years, not necessarily a disinflation, right? So how much is this actually being felt?
Well, it's not being felt yet. So our latest consumer confidence numbers at the Conference Board, that is one of the main things that we do, has really moved sideways, you know, after a drop in April, after Liberation Day. And then it did proceed to drop further in November. And so, you know, and that was sort of on the heels of the government shutdown. And obviously, even within public policy and elections, the concepts around affordability are still being discussed. You know, for American consumers, food costs more, insurance costs more, housing is still, you know, double what it was 7 years ago. And so in medical costs as well, which I don't think we spend enough time talking about. So those really big costs are still weighing on the consumer.
I think that the president's going to like the collective scream of joy in markets that you mentioned a moment ago. Yes. But I think you're getting at something really crucial here, and we saw it during the last administration. That is, the data can be good or trending better. The White House politicians can tout that fact. Yes. But as you well know, sentiment is so crucial here, and it's hard to kind of make that up if people aren't feeling great about where things are and where they're headed.
Right. Your average American consumer is not necessarily paying attention to today's number, and they're paying attention to what their insurance costs are, how much it costs to buy a car. You know, we've noticed that, you know, the average price of a new car is now over $50,000. Wow. And people used to take out 5 or 6 year loans on a new car. They're taking out 6 or 7 year loans on a new car. So it's just, there's sort of these big decisions that consumers face, and also the small decisions at the grocery store that impact them.
Just quickly here, the labor market side of things, the jobless claims, how much can the Fed cut if we don't see any kind of pickup in layoffs or real weakness accelerate?
Well, I think that's a great question. So we don't have great data for the last couple months. We also saw that a lot of the data that we saw most recently was due to the government shutdown and due to folks in the government workforce perhaps, you know, exiting at the end of that federal year at September 30th. And where we see growth is in healthcare and in some other industries. So I think it'll be really important to sort of look underneath the job numbers to see, you know, if we're peaking at 4.6, you know, what's growing, what's not growing, and then that will be able to tell us more about how next year is going to be.
Aaron McLaughlin of the Conference Board, thank you so much for being with us. Really appreciate it. Brent Schutte of Northwestern Mutual Wealth Management joining us now. Brent, what's your first reaction to the CPI print? How much does it color how you see investing next year and the backdrop for the Fed?
I think it certainly helps the parts of the market that you mentioned before, small caps that have been harmed by higher rates. And so if you think about the economy the past few years, it has certainly been bifurcated, as has the market. It's been narrow, both in the economy and the markets, where you've had the heavy lifting done by a few stocks tied to higher income consumers and the AI theme. And I think as you look at 2026, we do see broadening, where you see small caps doing better, where you see the average S&P stock doing better. I think it's a risk management tool, but it's also in 2026 a return enhancement tool. And so that's my first thought. My second thought is what's happening underneath in the economy when you see inflation pull back this much? How weak is actually demand? And you mentioned the labor market, which I think people are giving coast all clear because of non-farm payrolls being around 60,000, which I remind you, they were overstated by 70,000 in the data going through to March of this year. And the Federal Reserve Chair Powell mentioned he still thinks they're being overstated by 60K. So they are right around zero. And that's where I think there's some risks still that are out there.
Do you think that the market response, that if this gives the Fed the green light to cut rates, then that's positive for equities, is correct? Or do you think that it's coming more from the labor market weakness that you were just referencing?
I think it's positive for a broader set of equities. And that's where I think I come back to it. No one knows exactly what's going to happen in the next 6 months. I think forecasting is always difficult, but there certainly is this odd kind of mix of policy that is out there. And I think you can see that through the Federal Reserve eyes, where if you had all 19 voters voting, it would have been 12-7. And you see those dissents. And that's where I just think it's hard to figure out what's going on in the near term. But if I think about the long term, I do want to pay attention to valuation. And that's where I go back to those areas of the market that people have largely ignored. They haven't done as well because of the impact of higher rates. I think pushing forward in 2026, you have valuation with you, and you have potentially the impact of rising earnings in those parts of the market for the first time in a few years.
Brent, let's have some fun here with counterfactuals. You've opened the door, so I'm going to drive my truck right through it. I'm very curious, if we'd gotten these data before the last Fed meeting, how that conversation in the Eccles building would have been different, if at all. I mean, we talked a lot about this being an insurance cut. There were certainly a lot of questions about whether the Fed should move then or wait till January. Do the data that we've got today give you any sense that it would have the outcome would have been different last week had Fed officials gotten them?
Potentially, but I don't think people's concerns about inflation in longer term are going away. This could be certainly tied to the government shutdown with inflation coming down. It could certainly be tied to the labor market weakening. Look, I think inflation is a longer term phenomenon. We have not yet returned to 2%. The Fed's dot plot doesn't show returning till, 2028, which is 7 years since. And this is where I think there's concerns about what happens next year when stimulus gets layered on, what happens next year when we get a new Federal Reserve chairman, and what happens longer term to help pay back some of that debt. And that's just where I think inflation probably still is the longer term outcome. And that's where I think the concern of some of those people on the Federal Reserve would not have gone away. Perhaps he would have swayed one or two more people. But I think there are still legitimate concerns and questions about, do we get back to 2% inflation absent some sort of economic contraction in 2026, which no one is pricing in right now.
Brent, the overlay here, of course, is this AI story. We've been tracking that day in and day out, all the ups and downs. Certainly Micron, the latest kind of chapter in that narrative. We heard policymakers engaging more with this issue of productivity, what this is going to mean for the economy, or could mean for the economy going forward. How are you thinking about that in light of what you're talking about here, the kind of the persistence of inflation into 2026, the challenges facing this U.S. economy going forward?
I mean, we'll see on the productivity aspect of it. I think companies are still trying to figure out how to use it to increase employees' productivity. And I think that's a prime question as you head into 2026. I think the reality is you are starting to see it move through different parts of the economy. So it started out in the picks and shovels, I guess, and now it's moving along to companies like Micron. I eventually assume it will do much like the internet did, which is increase the productivity and efficiency of all companies who actually use it. And so that's where I think you're seeing winners and losers change. I think you will continue to see that in the future. And that's where I think anyone investing solely in AI right now or concentrating their portfolio in it is taking risks they don't need to be taking, because I think there are opportunities as it continues to shift, as it continues to spread through the economy for those companies and stocks that have previously been left out to start benefiting from it. And that's where you saw this broadening in 2000 through 2007 that occurred post kind of the concentration in 1998, 1999, which is eerily similar to today, where a few stocks did the heavy lifting for a few years. People concentrated in those, unfortunately, and then the game changed going forward, which I think is what's going to happen as you push forward into 2026 and beyond.
We're talking as we do get that broadening out, at least in the initial price action this morning. If you are just joining us, we did get the CPI print from November, the first inflation read in the United States going back to September. It was well below expectations, coming in at 2.7% year over year versus the expected 3.1%. Core CPI, stripping out energy and food costs, looking at 2.6% year over year versus the expected 3%. Then that is good news, disinflation, what we kind of would like to see. On the flip side, we didn't see initial jobless claims tick up. We actually saw them come in slightly below, the good kind of downside surprise, with 224,000 versus the 225,000 expected new jobless claims. The response in markets has been a screaming joy of success. You could see that gain right now. NASDAQ futures up 1.4%, a similar gain on the Russell 2000. Brent Schutte, do you think that this is sustainable into year end? Is this enough for what people need to see?
I think it is largely. I mean, I think the question of AI is still out there. And this is where I go back to 99, and I think the risk is similar today as it was back then, which I think was a very mild recession. What impact does the potential market have on the economy? So usually I think of the opposite. I think of the economy impacting the markets. That's why we pay so much heed to it. But this time, the markets are trading at record multiples. There is a lot of speculation that is still occurring with non-profitable tech stocks and all the other things that are out there. And this is where the economy now is dwarfed by the market, which I believe the market is now 2.3 times the economy. Is the risk there that the AI theme starts fizzling out just a bit? And that's where I think today's news is good, because I think it allows other parts of the economy potentially to have some life. But that's where I think this AI theme is incredibly important pushing forward. And we'll see what happens as we move through the day. If the market holds these gains, I think it's a positive. But certainly over the past few weeks, you've had trouble holding it based upon what's happening in crypto, what's happening in AI. Right. And that's where I still think it's a dominant theme to be seen.
Brent Schutte of Northwestern Mutual Wealth Management, thank you so much for being with us. Let's head back to Michael McKee, who's been digging through this report for details. Mike, what do you see?
Well, I think, Lisa, the most important thing here is that we don't have the monthly numbers for almost all of the categories. This press release has a lot of blank spaces on it. So you have to look at the year-over-year changes, and we'll have to do some math to figure out maybe what it is on a month-to-month basis. But when you look at the changes in some categories, they are good news. Food at home, for example, was up 2.7% on a year-over-year basis in September, but only up 1.9%. In November, in the 2 months that we had no data, that they came back down again. The goods prices, commodities, ex-food and energy, up 1.4%. That's down from 1.5%. And services up 3% over the 2 months on a year-over-year basis. That's down from up 3.5%. And finally, the BLS measure of home prices, owner's equivalent rent, up 3.4%, down from 3.8%. So all of the categories, all the major categories that people watch are down on a year-over-year basis. So it looks like in October and November we had some month-to-month declines, so some better stuff. And that's about all we can say at this point. And you asked the question earlier, does it change what the Fed might have done? I don't think so. There's not enough detail in here for them to really make any kind of decision on what it means for the future. But for right now, it is good news, and it does show unexpected progress on inflation.
Michael McKee, thank you so much, as always, for breaking it down. It does seem like markets are enjoying this. You aren't seeing, though, a huge pop in the expectation for a Fed rate cut come January. David, it seems like people are looking into the jobs picture as potentially the greater impetus to cut, given the fact that inflation still is well above that 2% target.
Yeah, still lingering there. I think that was telegraphed by the Fed chair during that meeting last week, that that's likely to persist. And I think those concerns about cracks in the labor market persist here as well. Again, just looking, as Mike said, at this press report, seeing all of those empty spaces is certainly glaring. And again, I think over the course of the day, we'll learn more just sort of how this all fits together in that broader picture of inflation here in the U.S.
What a fascinating moment. We got a Bank of England rate cut going down with rates to the lowest going back to 2023. At the same time that we got an ECB 5-4 split decision to hold rates steady with concern about inflation, even though inflation is sub 2%. And we have now a Federal Reserve very much in focus to potentially cut rates because inflation didn't come in at 3%. It came in at 2.7% year over year. It just highlights how different different the picture really is for everybody.
Totally disparate. It was earlier this week I was going through that long list of all the central bank announcements that we were going to get, and I think we talked about what would be interesting, what wouldn't. Certainly some interesting news today from all three of these.
Let's hear from the ECB President, Christine Lagarde, who is currently speaking at the news conference over in Europe. This is
the new Eurosystem staff projections show headline inflation averaging 2.1% in 25, 1.9% in 26, 1.8% in 28, 1.8% in 27, and 2% in 28. For inflation excluding energy and food, staff project an average of 2.4% in 25, 2.2% in 26, 1.9% in 27, and 2% in 28. Inflation has been revised up for 2026, mainly because staff now expect services inflation to decline more slowly. Economic growth is expected to be stronger than in the September projections, driven especially by domestic demand. Growth has been revised up to 1.4% in 25, 1.2% in 2026, and 1.4% in 2027, and is expected to remain at 1.4% in 2028. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. In particular, our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. The decisions taken today are set out in a press release that is available on our website. I will now outline in more details how we see the economy and inflation developing, and will then explain our assessment of financial monetary conditions. Looking at the economic activity, the economy has been resilient. It grew by 0.3% in the third quarter, mainly reflecting stronger consumption and investment. Exports also increased, with a significant contribution from chemicals. The sectoral composition of growth was dominated by services, especially in the information and communication sector, while activity in industry and construction remained flat. The pattern of services-led growth is likely to continue in the near term. The economy is benefiting from a robust labor market. Unemployment at 6.4% in October is close to its historical low, and employment grew by 0.2% in the third quarter. At the same time, labor demand cooled further, with the job vacancy rate at its lowest level since the pandemic. The staff projections see domestic demand as the main engine of growth in the years ahead. Real incomes are set to rise further, and the saving rate should gradually come down from its still high level, supporting consumption. Business investment and substantial government spending on infrastructure and defense should increasingly underpin the economy. However, the challenging environment for global trade is likely to remain a drag on growth in the euro area this year and next. The Governing Council stresses the urgent need to strengthen the euro area and its economy in the present geopolitical context. We welcome the European Commission's call for governments to prioritize sustainable public finance, strategic investment, and growth-enhancing structural reforms. Unlocking the full potential of the single market is crucial. It is also vital to foster further capital market integration by completing the Savings and Investments Union and the Banking Union to an ambitious timetable, and to rapidly adopt the regulation on the establishment of the digital euro. Looking now at inflation. Annual inflation has been in a narrow range since the spring and remained at 2.1% in November. Energy prices were 0.5% lower than a year ago, after a larger decline in October. Food price inflation was 2.4% after 2.5% in October and 3% in September. Inflation excluding energy and food was steady at 2.4% as goods and services inflation moved in opposite directions. Goods inflation declined to 0.5 in November from 0.6 in October and 0.8 in September. Services inflation rose to 3.4% in October and 3.5% in November from a 3.2% in September. Forward-looking indicators such as the ECB wage tracker and surveys on wage expectations suggest that wage growth will ease in the coming quarters before stabilizing somewhat below 3% towards the end of 26. Inflation should decline in the near term, mostly because past energy price rises will drop out of the annual rates. Staff expects it to stay below 2% on average in 26 and 27, with energy inflation negative over most of this period and inflation excluding energy gradually declining. Inflation should then return to target in 28 amid a strong rise in energy inflation. This, in part, reflects the upward effect on inflation of the EU emissions trading system 2, which is now expected to start in 2028, a year later than assumed in the September staff projections. Inflation excluding energy is projected to stabilize at around 2% in the final years of the projection horizon. Most measures of longer-term inflation expectations continue to stand at around 2%, supporting the stabilization of inflation around our target. Let's look at the risk assessment. While trade tensions have eased, the still volatile international environment could disrupt supply chains, dampen exports, and weigh on consumption and investment. A deterioration in global financial market sentiment could lead to tighter financing conditions, greater risk aversion, and weaker growth. Geopolitical tensions, in particular Russia's unjustified war against Ukraine, remain a major source of uncertainty. By contrast, planned defense and infrastructure spending, together with productivity-enhancing reforms, may drive up growth by more than expected. An improvement in confidence could stimulate private spending. The outlook for inflation continues to be more uncertain than usual on account of the still volatile international environment. Inflation could turn out to be lower if the rise in US tariffs reduces demand for euro area exports, and if countries with overcapacity increase their exports to the euro area. Moreover, a stronger euro could bring inflation down further than expected. An increase in volatility and risk aversion in financial markets could weigh on demand and thereby also lower inflation. By contrast, inflation could turn out to be higher if more fragmented global supply chains pushed up import prices, curtailed the supply of critical raw materials, and added to capacity constraints in the euro area economy. a slower reduction in wage pressures could delay the decline in services inflation. A boost in defense and infrastructure spending could also raise inflation over the medium term. And extreme weather events and the unfolding climate and nature crisis more broadly could drive up food prices by more than expected. Turning now to the financial and monetary conditions. Market rates have increased since our last meeting. Bank lending rates for firms have been broadly stable since the summer, after falling in response to our policy rate cuts over the previous years. In October, they stood at 3.5%, unchanged from September. The cost of issuing market-based debt was 3.4%, also close to its September level. And the average interest rate on new mortgages, again, held steady at 3.3% in October. Bank lending to firms grew by 2.9% on a yearly basis in October, unchanged from September. Corporate bond issuance rose by 3.2%, broadly unchanged as well. Mortgage lending strengthened, growing by 2.8% after 2.6% in September. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability. Euro area banks are resilient, supported by strong capital and liquidity ratios, solid asset quality, and robust profitability. But geopolitical uncertainty and the possibility of a sudden repricing in global financial markets pose risks to financial stability in the euro area. Macroprudential policy remains the first line of defense against the buildup of financial vulnerabilities, enhancing resilience and preserving macroprudential space. So in conclusion, the Governing Council today decided to keep the 3 key ECB interest rates unchanged. We are determined to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it, in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions.
And today the first question goes to Balazs Koranyi of Reuters. Balazs, please.
Good afternoon and thank you. 2 questions, President Lagarde. The first one is about interest rates. And the question is, are we still in a good place? Whenever the interest rate moves next time, is it more likely to go up or down? Do you have clarity on that? Second question is about economic growth. Given your second straight fairly large revision in the growth outlook, is this just simply resilience to uncertainty, or should we be rethinking our entire assessment of the growth profile? Are we catching perhaps a windfall from the AI boom? Are firms more resilient and adapting to the new reality better? Is there some fundamental change about growth, or is it just a one-off improvement?
Well, thank you very much for your 2 questions. I'll try to unpack because there's a lot there. On interest rate, we reconfirmed that we are in a good place, which does not mean that we are static. There was a unanimous decision that was taken today concerning the rates that we decided to hold. But there was also a unanimous view that all optionalities should remain on the table, and that we would stick to the meeting-by-meeting, data-dependent approach with no rate path set and no set date for any move. And it was a unanimous view around the table. So I think that addresses your first question. Your second question is always an interesting question from you, but it's an interesting question because it raises issues that we will probably review in deeper details at our February projection next exercise, because we will also be looking at the surveillance report that we produce. We will be looking at the fiscal monitor. We might look also at the supply side review to go a bit deeper in some of the facts that would answer your question. We think that there is some change taking place in our economies. And if you look in particular at the drivers and what has surprised us on the upside, it's characteristically investment. And it's not just spending by the public sector, which there is, but it's also the private sector, the corporate sector, both large corporates, but also SMEs as well. And their investment, based on the data that we collect, based on the surveys that we conduct, is largely attributable to the development of AI. And AI takes multifacets, but certainly computer capacity, telecommunication, additional investment in intangible, more than tangible capex is really characteristic of what we are seeing at the moment. So that is something that we can already analyze, but I think we will be able to go a bit deeper in February, as we will see a bit of a longer interval to determine whether that's a long-lasting fact that is characteristic of this new growth. But that is clearly in play. The second one, which came as a bit of a surprise to us, is the contribution of exports. We had anticipated that exports, particularly out of the chemical industry and out of Ireland notably, but not only, would really correspond to a buildup of inventory and to a front-loading in the early months after the decision to increase tariff, or pre-decision to increase tariff. Well, that has been sustainable. And the contribution of exports has surprised us on the upside. So we don't know whether it's entirely attributable to the weight-losing drugs that are largely exported, or to other phenomenon, but the contribution of export has surprised on the upside, when in fact we believe that trade is more likely, as a result of tariffs, to be a drag on growth going forward. So that's also something that we will be attentive to. Thank you.
And the next question goes to Annette Weisbach of CNBC, please. Annette.
Thank you very much. President Lagarde, I have a question as well, going back to Isabel Schnabel's comment on the rate hike. Are you as comfortable with how the market is pricing in the current rate expectation as she is? Second question is on the fiscal stimulus in Germany. We were waiting for that for this year. Now there's hope it comes next year. What is your assessment, what it does as well to other countries in your area when it comes to the growth outlook for the whole? Thank you.
Well, thank you very much for your two questions. Certain things have changed and others have not changed. So when we look at activity, we have upgraded our projections. They've moved to the upside across the projection period. When we look at inflation, we've also increased our inflation projection for 26, and we have taken into account the movement from 27 to 28. So there are lots of things that have moved in that respect. One thing that has not changed much at all, and which, if anything, may have actually worsened, is uncertainty. And uncertainty is not a comfortable position. So I think we all suffer from that degree of lack of comfort. And we are all attentive to uncertainty, how it pans out, whether it's uncertainty related to geopolitics, whether it's uncertainty related to the movement of trade from countries with overcapacity in particular, what happens at the borders of Europe. So there are lots of factors that are in play and that will evolve over the course of 26 that are generating uncertainty. And as far as the future is concerned, as I told your colleague just earlier on, there was unanimous agreement around the table about the fact that all optionalities should be on the table and that we should stick to the meeting-by-meeting approach, to the data dependency, and we will be looking at all sorts of data in the field of wages, salaries, the decomposition of it. We will be particularly attentive because it plays a significant role in relation to services. And we do not have a set path for our rates going forward. I know this is, everybody would like some forward guidance, but we simply, in the current situation, with the degree of uncertainty that we are facing, we simply cannot offer forward guidance. Now, second question related to government spending, public investment, and we take into account the documents that are filed by the various member states with the Commission to review the path of investments going forward. And we have an impact on growth for certain countries, Germany being, obviously one, in 26, in 27, and still a bit in 28. And so much can change in the meantime. But it does have an impact, and it is a driver of growth in the investment section that I was describing earlier.
And the next question goes to Mark Schroers of Bloomberg. Mark, please.
Yes, so thanks a lot. The first one, unfortunately, also on rates. The discussion today, was there
That's
any...
what we decided today, so you're right.
Okay, perfect. Was there any discussion about a cut today or about hikes today, just to have more clarity on the discussions today?
I don't have to wait for your second question. The answer is no.
Okay. The second question is on the revamp of the executive board over the next 2 years.
Revamp, you say?
The revamp, right. Yeah. That also includes your role in 2027. I know it's a long time off, to be honest, but there's already a discussion in Germany whether it's time for a German to become the ECB president. And just wanted to know if you think that would be good after 25 years of the institution, if a national from the largest euro area member states would become the ECB president. And as you already publicly said that Klaas Knot would be a good candidate. What do you think about Isabel Schnabel and Joachim Nagel, who both recently...
Okay, well, let me clarify one thing. I don't have any favorite candidate, and I did not say that Klaas Knot was the good candidate. There are plenty of very good candidates, and Isabel is one of them, but there are plenty of them, and I'm sure that there will be more in the future. Why not? I find it terribly... satisfactory, in a way, that so many people want to have my job. It's a great job. And it's one when you feel that you can actually matter and affect the life of people and try to deliver for the European Union and for our currency, the euro. But as to who it is, what nationality, it's not, I'll have nothing to say about that. It will be for the European Council, and the decision will be made outside this beautiful institution. So, whatever they decide. But thank you. You have still a long time to ask all those questions, huh? Phew.
Next question goes to Aude Kersulik of BFM Business.
Thank you. Good afternoon, Mrs. Lagarde. The euro's nominal effective exchange rate is at record levels. I know it's not a part of your mandate, but has this point been discussed by the Governing Council? And second question, still regarding to currency, how do you balance the benefits of a strong euro for import prices, good for your mandate, with the risk of greater exposure to China, which is an important issue for Europe at the moment? Thank you.
Well, thank you very much for your question. I might give you the answer that you expect, which is that we do not target exchange rate. And we do refer to exchange rate in the risk section of our monetary policy statement, if I recall, when we refer to a possible higher exchange, an appreciation of the euro. So I'll refer you to that section in the risk segment of the monetary policy statement. And obviously it is something that we look at carefully as we look at the way in which currencies are positioned around the world. And obviously the current situation of the renminbi is one that we pay attention to, yes.
Next question goes to Olaf Storbeck of the Financial Times. Olaf, please.
Thanks for taking my questions. I have one question on inflation. The higher inflation in 26 was justified or explained with higher services inflation. It's gone up to 3.5 in whatever it was, November, up for and it was on an upwards trajectory in the past few months. How concerned are you about service inflation overall? Could this be kind of turn into a nasty surprise? And my second question again is on ECB succession. One of the sitting members of the executive board has basically showed interest in becoming your successor. What's your reading on the law in terms of, is it possible legally to appoint a sitting member of the executive council as ECB president? Because as far as I understand it, it clearly says terms are non-renewable. And would that be in line with the law and also in line with the spirit of that rule, which I think is intended to kind of prevent governing council members or executive board members to kind of jostle for their next job in their current job? Thanks.
Thank you for your two questions. On your first question, thank you for focusing on inflation on services, because it's clearly one domain that we will be attentive to going forward. So you are right that service inflation has increased. It went from 3.2 in September to 3.4 to 3.5. So there is a trend that we look at carefully. A lot of that is related, based on the staff study, is related to wages. And wages have surprised us to the upside. If we look at compensation per employee, for instance, we are at 4%, which is more than had been anticipated, in particular in the September projections. So with wage having increased more than anticipated and being a strong contributor to most activities of services, not all of them, but most activities of services, it's hardly surprising that services inflation is higher than anticipated and contributing to the current inflation number that we have. It's balanced out by goods, as you will have seen in the monetary policy statement, is they go in opposite directions. Goods go down, services increase, and we anticipate two things in relation to that. Number one, that wages will follow a slightly declining trend going forward, and we have wages slightly below 3% at the end of 26. And that is based on measurements instruments that we have, whether it's the wage tracker, which incorporates all the negotiated, the collective bargaining agreement that are negotiated and which roll out into either 1 or 2 or 3 years, depending on the countries, and under which we cover now 8 countries with quite a large number of employees, workers, or whether it is the surveys and the corporate telephone survey that we conduct asking, corporate, where do you see salaries, where do you see wages, how are the negotiations going? So on the basis of all that, we believe that this compensation per employee should decline in the course of 26. But we are attentive, because while we believe that a lot of the catch-up, for instance, has taken place, a lot of the one-off specific payments have occurred, we were surprised between September and December in our projection, and that is reflected in our numbers. So we are humble. We look at as many details and data, and we look at the vacancy, of course, to see what's likely to happen. We look at PMI numbers, but that's where we are, and it's a big contributor to services. And we have, sorry, because this is one that we really debated quite a bit and that we looked into, and that staff is working really hard to get to the bottom of it. Services is a big package. You have lots of things in there. You have accommodation, transportation, telecom, IT, financial services. There's a lot in there. And some of those sub-sectors of services are labor intensive, are wage intensive, others less so. So we have to sort of balance out and distribute the wage increases that we expect in between all that. But there is really a solid work done in that respect. So your question is, can a sitting member of the executive board be eligible for another board position or the position of president of the executive board? This matter was looked at in the past. It was looked at when Christian Noyer, the then vice president of the ECB, was possibly considered for presidency. It was looked at for Benoît Cœuré, who was then an executive board member and who was also considered possibly for the replacement of Mario Draghi. I think in both those instances, the determination by the jurists, the lawyers of various corners of Europe was that it was not possible. But I think the matter needs to be looked at again in order to ascertain, what is possible, what is not possible, what are the conditions. And it's not for me to pass a judgment on that. I think it needs to be cleared so that everyone knows where to stand.
The next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Thank you for the opportunity. President Lagarde, I have two questions on financial stability, as it was also mentioned on the statement. So financial stability and the international role of the euro could be threatened by the reparations law for Ukraine using the cash balance of Russia's asset. However, so far, the euro has been quite resilient in spite of Putin's retaliation threats. So what is your assessment of this kind of resilience of the euro so far in this respect? And also on financial stability and the Digital Euro project, which is making progress. The Council orientation these days is a milestone, and the Digital Euro is viewed more and more as an anchor to strengthen financial stability in the euro area. So, in your opinion, could the ECB become a role model in the world to assess the importance of central bank digital currencies? Thank you.
I think I'll start with your second question. I know these are important moments for the digital euro because we have done our work, we have carried the water, but it's now for the European Council and certainly later on for the European Parliament to identify whether the Commission proposal is satisfactory, how it can be transformed into a piece of legislation or amended. Our ambition is not to be role models. Our ambition is to make sure that in the digital age, there is a currency that is the anchor of stability for the financial system. For the moment, that anchor is central bank money, which essentially has material form. It's the banknotes that you have in your wallet. But in the digital age, it has to be a digital expression of that sovereignty and a digital anchor for the purpose of the financial system that we have. So that's what we're pursuing, in addition to making sure that it is user-friendly, not costly, fast, efficient, private, that it can work online, offline. I mean, I could go on and on because you know that I've followed that very carefully with my Italian colleagues, and both Luis and myself are very strong supporters of this initiative, and we place great hopes in the work that will be done in Parliament once the Council has made its view, has determined its views. You know, on the other topic that you raised, I'm not going to expand on this matter because it's something that is under review, that is under work at the moment, which is of the competence of the European leaders and which is the expression of foreign policy. So it's not for a central bank to have either political views or central bank's choice as to what is appropriate or not appropriate. Our job, and we are trying to do it as much and as well as we can at the odd hours of the day or the weekend, is to respond to the request that are put upon us to determine that whatever choice is made by the leaders is going to respect the treaty, is going to respect the international rule of law, and will not damage financial stability. This is the remit of what is our duty. Beyond that, it's something that is outside our remit. Thank you.
And now Jan Malin of Plato. Jan, please.
Thank you for the opportunity. Madame Lagarde, I have a follow-up question on your first comment about the changing growth profile and due to AI. Isabel Schnabel made a similar comment in her interview with Bloomberg, where she said that the natural interest rate might rise because of that. Do you agree with that assessment? And my second question is on stablecoins. They have gained significant importance globally, but many experts see this as a threat to Europe's monetary sovereignty and are calling for stronger support for stablecoins in Europe as well. What's your position on that? Thank you.
Sorry, I just want to clarify your second question. You don't say that the digital euro is a threat to sovereignty. You said stable coins, right?
Stable coins,
okay,
yeah.
Okay,
yeah.
I had misunderstood.
Oh, okay, sorry.
Yeah, no.
Thank you.
My mistake. So, we are lucky in Europe to have something that is called MiCAR. So it's the legal framework within which instruments like stable coins can work and can be supervised and can be regarded as safe. So our view is that an instrument that is in compliance with MiCAR is an alternative form of payment, which might have its benefit, might have a business case for those that issue the stable coins. My concern, because I have a concern, so that's, to the extent that it conforms to MiCAR, that it is properly organized, that it has the right one-to-one guarantee for the users, I don't need to have a view. Supervisors need to have a view. Those who control that there is actually the reserve. Where I have a concern is when you have something that is getting a bit technical now, if we go there, is the situation of multi-issuance currency for stablecoins, because without going into the details of how it is structured, it exposes the reserves, the resolution mechanisms, and the redemption mechanism in Europe, as is organized under MiCAR, to other currencies under which the stablecoin would be issued, and which could be a threat and a drain on the provisions of MiCAR that apply in Europe. So on that particular area, I think that we need to be extremely attentive to what the potential risks are for the system itself and for the holders of stablecoins. On your first question, look, I'm not going to agonize over the issue of, where and how is the R star and the rate which is ideal because it neither stimulates nor restricts our economies. There are multiple factors that can affect it. Productivity is obviously one of them. If we draw a lot of productivity out of artificial intelligence, it will impact. But there are multiple other factors as well that will impact R star. And one of the characteristics of R star is that you can only sort of identify it eventually in completely stable circumstances. I don't think that we can call the current circumstances as perfectly stable and predictable. There is, as I said earlier, too much uncertainty, too much risks, and too many shocks under the spell of which we still are to actually identify R star and have a view as to whether it's going to increase. So, as I said, it's not observable, so to speak, and I think it's a very good debate to have, but I'm not sure that this is the one that has caught the attention of the Governing Council. It's certainly not one that we debated today, or yesterday for that matter.
And the last question goes to Philippe Lacour of AFP. Jean-Philippe.
Thank you, Wolfgang. Bonjour, Madame la Présidente.
Bonjour, Monsieur Lacour.
Switch in English, of course. I have two questions on the same issue, if I may. It's related to Ukraine. You know that in these hours, the 27 head of states meet in Brussels with a bold agenda. And one of the points is to try to agree on this reparation plan for Ukraine. So a single question is, are you confident that they will succeed to find a solution? And the second one is, earlier this month, yes, ECB said we cannot provide a backstop for, to use the frozen Russian assets to finance Ukraine. Simple reason, it would likely breach the treaty, prohibiting monetary financing is the other point. But in these several times, shouldn't the overriding interest of the people of Ukraine to have the right to rebuild their country and live in peace not come above all kind of purely factual legal considerations? And as you said before, for the case of Mrs. Schnabel, would it be possible to maybe look at again, if the question is again raised? Because, I mean, there is overriding interests of the people of Ukraine that may be, above the pure legal considerations. So I would like to have your point on this.
Well, thank you for your question. First question, there is work going on at the moment. Again, it's not our remit, it's for the leaders to decide. And given the importance of the matter, given what is at stake, I am fully confident that they will find a solution. It might be in the usual European way, going in circles and being time-consuming and giving rise to a lot of speculation as to whether it will work, it will not work, there will be one camp or the other. But I'm confident that they will find a solution because it's too important. You know, we are an area of the world which praise itself for respecting the rule of law. And this is one of the characteristics of our democracy. The leaders will decide, okay? And I'm sure that there are solutions that can be debated and discussed, and there are constructions that can be elaborated. But it is not for the central bank to actually encourage or support a mechanism under which we would be called upon and scheduled to breach Article 123 of the treaty. This is, you know, monetary financing is not allowed under the treaty. You cannot expect me to validate ex ante a mechanism under which there would be monetary financing. This is pretty obvious. Thank you. And if there is no more questions, then I'm happy to wish you all a Merry Christmas, happy holidays, whatever is convenient, to those of you who celebrate or don't celebrate. And we look forward to seeing you in the new year, bright and ready. And
that was ECB President Christine Lagarde speaking in Frankfurt. This is Bloomberg Open Interest. I'm Matt Miller alongside Danny Berger. She's back.
Yes, I would also like to wish a Merry Christmas, Happy Holidays, whatever is convenient to everybody out there.
Happy Hanukkah, Kwanzaa, all of the holidays that are in the next
what a great note to
few
end
months.
On from Madame Lagarde.
In terms of what they did or didn't do, it's more interesting, I think, what they didn't discuss. They didn't even debate the neutral rate.
Right.
They didn't talk about a hike.
Or a cut.
Or a cut.
Has to be like the most boring meeting ever that they all sat around. They're like, so we're going to hold? Yep. Okay. See you all in a couple months.
No talk about a digital currency. That's a matter for Parliament or for the European Council.
Right.
Yeah, they just put a lot of things, I guess, off.
Yeah.
You know, and she's not giving any forward guidance.
Nope. She's being very steadfast about that, saying that what they did agree on was that they're taking it meeting by meeting, and that's exactly what we're getting from ECB's Christine Lagarde.
We got a cut from the Bank of England.
Yes.
We've had a lot of central bank action. We still have a lot of central bank action this week, but it's interesting. We have had a tough time in stocks here in the U.S. 4 days in a row down, but markets are up today. You can see futures are higher on the S&P. Futures are higher there on the NASDAQ. If you look over in Europe, the Stock 600 also hitting new all-time highs. I'm told by a trader, one of my buddies messages in, hey, we're at new all-time highs here. So there is a lot of optimism out there.
There is, and that's thanks to CPI. We're going to talk about that to Michael McKee in just moments, but core reading coming at 2.6 versus 3%. You add to that Micron earnings, and that is the rally that we have underway. By the way, let's get a check on Micron because shares are up 16% 5 minutes into the open. It boosted tech sentiment with a rosy forecast. Revenue blew past estimates on its strong demand and pricing power, saying that there is more demand than they have supply, completely reversing yesterday's narrative, which was, oh no, Oracle's not going to get funding. The AI house of cards is going to fall.
All right, we also had, I think, really a fascinating merger of equals story out this morning. You may not know how much faith I put into mergers of equals.
Spoiler, not a lot.
Very little. But Trump Media agreed to combine with TAE Technologies in an all-stock transaction valued at more than $6 billion. The two companies say it'll create one of the first publicly traded nuclear fusion companies with plans to construct the first utility-scale fusion power plant next year, which is amazing because nuclear fusion has never been achieved to create energy. It takes a lot more energy to heat up the thing than it does, than it gets from the thing producing.
Let alone...
Like over 100 times in the most successful nanosecond experiments.
Okay, yeah. And so I don't know why a media company would have any more luck at doing that upon a merger, but an interesting one nonetheless.
Yeah, I think fascinating, and we're going to talk to Will Wade about that later this hour. Underlying U.S. inflation, as Danny mentioned, rose in November at the slowest annual pace since early 2021, an unexpected improvement following months of stubborn price pressures. Let's break down the data, which could be considered noisy, with Michael McKee, Bloomberg's international economics and policy correspondent. I say that because rent and housing costs were assumed, what, to be zero in October?
Yeah, the whole thing is kind of weird, and when you look at the release, it's mostly just blank spaces. So you have to impute a lot. It'd be like saying, well, the stock market's up today, but we can't tell you what stocks have actually moved. And that's the situation here. We do have they did get some numbers because they were non-government collected numbers, numbers that companies sent in. As Danny mentioned, the core, a big drop to 2.6%. Headline also dropping to 2.7. Food at home, 1.9. Now, these are year-over-year numbers that are 2 months. So in the 2-month change from September to November, we see food at home move down to 1.9%, gasoline up just 0.9%, and used cars still rising in price. Now, the caveat that Matt mentioned is the owner's equivalent rent dropped during the 2-month period, but to get that number, according to the folks at Inflation Insights, Omer Sharif, you'd need to have a 0 increase in October, which is just not possible, he says. So do we trust this? We don't know. It's also true that with the late data collection might have been biased by holiday sales because we got to the end of November, and of course, everything is on sale for Black Friday. Other mostly good economic news out today. Initial jobless claims fell. Continuing claims were only up a little bit. The Philadelphia Fed headline number was worse, but the prices paid numbers and employment numbers were better. So all in all, you look at this and you can see why maybe the market's excited for today, but I don't know how much weight you can put on any of this at this point.
All right, Mike, we're going to talk to you again in about a half hour's time. Because it does...
Happy Festivus. I want to join
Thank
in
you.
with you.
For the rest of us.
Yeah.
If you know that.
It's Seinfeld, thank you.
Thank
I
you.
do know
Good,
it,
good,
yes.
good. Let's bring in Morgan Stanley's Chief Investment Officer, Cross Asset Solutions. Jim Caron joins us. Jim, great to have you here on, I mean, there's so much news, which is weird, you know, just a week ahead of Christmas, but we have rate decisions, we have Micron out with great earnings, which helps obviously the AI sector. We have inflation that's better than expected. What do you make of it?
Yeah, it's a good question. There's a lot to sift through, but I think it's important not to lose track of the bigger picture and the trend. So the information that I'm getting today, let's start with the ECB. The ECB is saying, listen, you know, we expect there to be better growth and inflation is pretty close to target. So we don't necessarily feel as though we have to continue to add accommodation. The Fed is adding some accommodation, and the inflation rates have been coming down. Now, maybe that's more noisy, but essentially what we're starting to see is basically what looks like higher productivity in markets going forward. So what we're saying is that we're getting decent growth expectations in the future, but we're not getting a lot of inflation that's being associated with that. So it's enough for central banks to readjust their rates, get to where they need to be, but we're starting to see the early signs of what a CapEx-led recovery cycle looks like, which is what we're in right now, alongside higher productivity, which means you get higher growth with lower inflation. And so all of the issues that we've been discussing and talking about is really positive. It's a really positive backdrop for earnings and earnings growth and earnings potential going forward into next year.
Jim, does that mean that this yield curve steepening, which we've been witnessing over the past month or so then, is overdone if that threat of inflation is somewhat diminished by the productivity gains?
You know, that's a really good question, because I do have a view that the yield curve can continue to steepen, but a little bit. Meaning that if I'm looking at 10-year treasuries somewhere around 410 to 415 in yield, could yields go higher if you get better economic activity and maybe the Fed doesn't have to cut rates as much? Sure, absolutely that could happen. Maybe 10-year yields go to 425, maybe they even go up towards 450. But if we're in the backdrop of a relatively stronger economy that can support that movement higher in yields, then that yield curve steepening is actually another component of stimulus going forward. A steeper curve is usually a positive sign for forward earnings and for future growth.
Is this stimulus that we're going to get, I mean, one big beautiful bill is cited a lot, but we've also heard now from President Trump last night about checks going out to members of the military, the warrior dividend, he called it. There's another $2,000 that he wants to give everybody, I'm assuming on the lower end of the income spectrum for health care. Is that going to, combined with the faster growth and lower inflation, help take care of the K-shaped economy concerns that we've heard so much about this year?
So, so this is what the market's trying to figure out, and there's a lot of speculation here. But let me pose this. What if it works? I mean, I know I watched President Trump last night on TV, and I know it's largely about messaging and things like that. But what if he's somewhat correct, and what if it does work? What if you do get this movement towards higher demand, higher consumption, that there is a dividend from some of the tariffs, that it is able to support that bottom part of the K during this soft patch that we're going through in 2025 and is likely to spill over into the first, let's say, half of 2026. So we get that fiscal stimulus from taxes and everything else that can support the lower end of the economy to keep that consumption high and keep that demand, so that in the second half of 2026, which is really when we expect all of these policies to really gain traction in terms of investment, in terms of hiring. We expect the jobs market to really start to recover, really starting at around June. If that starts to happen, then you are likely to see a more higher pressure economy going forward. And certainly the Fed will not be cutting interest rates in that environment. But before we get there, we may get one or two more cuts first.
Jim, this just brings me right back around to the confusion of the direction of bond markets from here. JP Morgan did this survey where it basically said that a lot of retail investors are moving away from structured products like 60-40. Instead, what they are doing is they are constructing their own equity portfolios, just equities, so being very over allocated there. And then for a hedge, adding in something like gold or something less traditional, basically anything but bonds. What do you make of that as a sort of portfolio construction, maybe just on its surface, and the risks of that into 2026?
So this is a theme that we've been talking about for several years, moving away from the 60-40. The 60-40 portfolio works as a passive investment when you have a steadily declining interest rate environment and bond returns are very, very stable. That's not where we are today. Bond yields are likely to move sideways over the foreseeable future, which means they're going to cycle with equities, which means that bond returns are going to be more correlated to equities. So we need to find a different solution. So the way that we start to think about markets is in much more of a thematic way. We're doing a lot of the same things at Morgan Stanley Investment Management, where we're creating baskets of equities to play certain themes in the markets, like policy-driven initiatives that's driving cash flow, that's driving sectors and driving industry and driving companies. Looking at AI and how we play AI beyond just buying semiconductors, but thinking about the beneficiaries, and creating a structure and a portfolio that manages the risk, similar to what a 60-40 is supposed to do. And certainly bonds are included in this, but it's not as easy as just saying 60% passive equities, 60% passive bonds, and that's all you need to do. It's really about being a bit more thoughtful within the portfolio construction. Now, whether that's adding a little bit of gold, sure, there's nothing wrong with that. Also adding a little bit of inflation protection. But at the same time, why not start to look at value and quality stocks that are adopting AI technology that is likely to unlock economic value in the future and is being supported by government policy, taxes and things like that. And let's combine that together and construct a portfolio. In my view, and our view, is that we would have a more durable portfolio with good returns and lower risk.
Jim, it is going to be an interesting 2026. I think that's fair to say. We're looking forward to having more conversations with you in the new year. Morgan Stanley's Jim Caron, thanks so much for joining us this year. Coming up on the show, Micron's strong demand and pricing power for its memory chips is giving it a boost on Wall Street, lifting overall markets. We'll have that story coming up next. You're watching Bloomberg Open Interest.
belief for climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power. This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Micron's upbeat outlook is convincing Wall Street. The memory boom is stronger than expected. Bank of America is raising the company's shares to a buy. Morgan Stanley said Micron's earnings are rising so fast and look so durable that valuation worries aren't even meaningful. Let's dig into Micron's results with Bloomberg Tech co-host Caroline Hyde. And this is, I think, one of those things that's gone from super boring to absolutely fascinating, right? From commoditized DRAM to high bandwidth memory. What's the story?
AI is the story.
Yeah.
And the ever-needing infrastructure that actually really is focused on high bandwidth memory, which only has a few players involved. Micron has been leading here in the United States, SK Hynix over in Asia, Samsung's desperately trying to play catch up. But basically already the CEO is saying, I'm sold out for fiscal 2026 already. That gives such pricing power. You're also getting pricing power, though, even in the PC part of the business, the more boring part of the business, the NAND part of the business, because that too is now suffering supply issues because everyone's focused on the high bandwidth memory. So Micron is up 200% this year alone. It's not even at a record high that was touched earlier in December, but you're seeing just market cap spiral ever higher and people really feeling resilient. Like analysts, only one says sell, nearly all of them say continue to buy. And in fact, we've got one analyst, Rosenblatt, saying this could go as high as $500. You're currently at $257.
I wonder if that sell analyst is getting some angry phone calls this morning. I think the point about PCs and smartphones is super interesting because with AI, we've been talking a lot about this idea that it's crowding out energy usage, and that means people are paying more when it comes to electricity. Are consumers going to feel this as a secondary bite of AI, that all of a sudden your smartphone and maybe your PC are more expensive because the memory chip input into it are also getting more expensive?
It depends whether a smartphone maker decides to pass that on to the end consumer or sucks it up a bit themselves. But already you've seen Dell saying, I'm going to have to increase my prices. That was reported by a different outlet earlier last week. Why? Because of the price of memory is going up so much. This has been a pressure point on the likes of HP as well. But a lot of these companies are also trying to dovetail into the world of AI PCs. Now, trying to work out who the end buyer for that really is. It seems to be a corporate enterprise that's going in first and foremost. But maybe you will be willing to pay that much more for an AI-enabled smartphone or PC, and therefore they can suck up that higher cost rate. But look, this is just a glorious time to be selling these sorts of chips. But what's interesting is this has always been a sort of higher, lower, really cyclical type of the business. This time, is it different? You always hear from Micron that it is. They're trying to build out. They're spending more on capital expenditure. They're raising it to 20 billion versus then 18 billion. That's up from about 15 billion for this year. They need to spend more to build out their supply. Like, they're adding in Boise, Idaho. They're looking to build right here in New York, but that doesn't come online until like 2030. But again, it's all just, as you say, all areas of the economy that get so affected by this.
So true.
How much memory do we need for AI? And it's so fascinating because if you use ChatGPT, I'm just talking about on a consumer level, right? Or Gemini or any of these models, it remembers everything that you've told it and stores all the photographs that you put in. So,
and depending where they're storing it, are they using cloud? Are you going to do more on your edge computing? Are you wanting it to be done on your phone? That's sort of where many think eventually it will be done. Apple leads the charge there in terms of trying to give security to what you do. But yeah, these little bits of nano chips become ever more important.
Caroline, thank you so much. By the way, we're going to catch up in an hour. Word on the street is there's a fun rocket launch on its way. So we'll talk about that. We'll talk about that in about an hour's time. Caroline Hyde, also catcher on Bloomberg Tech, also in about an hour's time. Elsewhere, activist investor Elliott has built a stake of more than $1 billion in Lululemon. Joining us now is Poonam Goyal, Bloomberg Intelligence Senior Analyst for E-commerce and Athleisure. Poonam, it seems that the concentration of Elliott at this moment finds a new CEO.
Yes, I think, this is just positive reinforcement that a new leader at helm at Lululemon in 2026 will hopefully make the right moves to really put a product-led turnaround in place, because what we saw over the past few years has just been fueled by execution missteps that is actually causing Lululemon sales to turn negative for the first time since the pandemic in the fourth quarter of this year.
So what can they do? I've heard you, Poonam, in previous, over years, talking about ideas to make Lulu more profitable. One of them, I think, was maybe a skincare or some kind of lotion product that I'm not sure if they came out with. They went into or dabbled with shoes, for example. What else could Lululemon do in terms of product offering? Or do they just need to appeal again to like a higher income demographic?
Right now, I would not worry about them branching out into adjacent categories. The focus should be on turning the women's business around. That is where the pitfall has been, and that is where they need to compete more effectively as competition has really encroached on their space. So they need to get product there right, and they need to get the marketing message out right, with women believing that Lululemon is still the best wear for them when it comes to performance and it comes to going out.
Poonam, yeah, but like they still have, just quickly here, can they really overtake Aloe and Vuori too? 30 seconds.
I think they can. I think it's all about product. They have to show a material difference in their product. And if the product stands out, they can drive a turnaround. They do have the brand equity still in the consumer's mind.
All right, Poonam, thanks very much. Poonam Goyal there of Bloomberg Intelligence covers the retailers for us. Coming up in the next hour, retail goods, I should say luxury retail goods. Coming up in the next hour, Raquel Odin joins us from HSBC. She's overweight U.S. stocks as valuations remain below prior cycle peaks. Plus, we talked about alternative investing in things like Hermes handbags with Luxus CEO Dana Auslander. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
CBS News on the Hour, sponsored by Eggland's Best.
I'm Deborah Rodriguez. Stocks are rising in early trading on cooler than expected inflation data from the government. Correspondent Michael Wallace has the numbers.
The Labor Department's latest consumer price index grew at an annual rate of 2.7% in November, down from 3% in September.
And that is much lower than was expected.
Bankrate financial analyst Stephen Cates says the tightening labor market is having an impact.
If consumers are not running out to spend as much, then that's going to have less upward pressure on prices.
Cates says if the December CPI also shows inflation cooling, the Fed may cut interest rates again in early 2026. Michael Wallace, CBS News.
The Dow is up 325 right now. NASDAQ's ahead 303. President Trump touted his economic record and blamed the Biden administration for inflation in last night's address to the nation. CBS's chief Washington analyst, Robert Costa.
There is frustration inside the Trump administration about how the economic record's being received by some voters, how it's playing out in the press, and even among Republicans in Congress. A lot of people close to the president told me this was a speech about reassuring not only the American people, but many Republicans to stay in line, to stay with the president as the midterms approach next year.
We've learned about a massive arms sale to Taiwan. CBS's Jennifer Kuiper.
In a move that is likely to not sit well with China, the Trump administration announces a sale of medium-range missiles, howitzers, and drones as part of a package worth more than $10 billion.
Breaking news from Boston. A jury has just sentenced Brian Walsh to life in Massachusetts State Prison for the grisly murder of his wife. She disappeared 3 years ago. Her body never found. So much for your favorite fruitcake or bouche de Noël. Just in time for the holidays, the stomach flu's on the rise. It's spread through food, water, and contaminated surfaces. CBS News medical contributor Dr. Celine Gounder.
Every time you have a new strain, whether it's norovirus or the flu or COVID, people don't have as much immunity to it, and so you're going to see more cases as a result.
Health officials in L.A. say wastewater tests show a 154% increase there over the past 3 weeks. Jeff Bezos' Blue Origin is set to launch 6 people into suborbital flight on the company's New Shepard rocket next hour. CBS News space contributor Christian Davenport.
What we're seeing is a move where accessing space is becoming a little bit more routine, and it's opening up to people like this who are using a wheelchair and actually will make it outside of the atmosphere, which I think is a significant detail.
German aerospace engineer Michaela Benthaus going up. She uses a wheelchair, will become the first to fly in space. This is CBS News. A wedding crasher in the UK looked awfully familiar.
Abby and James Hotchkiss sway to the strains of All My Love for their first dance as man and wife. At the piano, none other than Coldplay's Chris Martin himself. The groom's mother had asked the singer for a video message to be played at the wedding, but he went one better, helicoptering to the venue, serenading the couple. Then, after giving bride and groom a hug, he disappeared back into the English night. Vicky Barker, CBS News, London.
Merry Christmas from the Windsors. Prince William and Princess Kate are ringing in the holidays today by posting their annual greeting card to their Instagram account. It features a photo of the couple and their 3 children taken last April. They're all dressed in earth tones, smiling for the camera in a field of deep green grass dotted with tulips. The simple message, wishing everyone a very happy Christmas. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we are streaming live on YouTube. So head over to youtube.com and search Bloomberg Podcast, and that's where you'll find us. Lots of news out there today. We had that CPI print came in lower than expected, so we'll get some commentary on that. Jake Silverman is going to join us here, Bloomberg Intelligence semiconductor analyst. Talk about those Micron earnings here. Poonam Goyal is going to join us as well. She's at Bloomberg Intelligence on the retail side. Apparently, Elliott Management, the activist Elliott Management, has built a $1 billion plus stake in Lululemon, so there could be some changes there. Christina Hooper, Chief Market Strategist at the Man Group. She's going to be in our studio. We'll get her thoughts on these markets here. And this is one I need to spend some time on. Simon Casey, Managing Editor for Energy and Commodities on Trump Media to merge with TAE Technologies in an all-stock deal. So that's a little bit of a head-scratcher, but the stock of DJT, Mr. Trump's company, is up pretty significantly here today. So we'll break that down coming up. Right now, let's go to Lisa Mateo and get a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by IBKR. Will the average global temperature in 2025 be greater than 2.45 degrees Fahrenheit above the 20th century average? Well, at IBKR Forecast Trader, the yes recently at 6%. Start predicting today at ibkr.com/forecast. The last trading day for this contract, January 9th, 2026. Well, it looks like traders welcoming the slowest increase in consumer prices since early 2021. That's after core CPI increased 2.6% in in November. Now that compares with a 3% annual advance 2 months earlier. The overall CPI climbed 2.7% in November from a year ago. Now that said, we have stocks advancing. The NASDAQ was already getting a boost from Micron's upbeat forecast. Micron shares are up about 12%. We go to the NASDAQ up more than 1%, 303 points. The S&P 500 rising 1%. The Dow up 0.7%. In the yield space, the 2-year 3.45%. That's down 2 basis points. The yield on the 10-year 4.12%, and that's down about 3 basis points. A busy day for global monetary policy decisions. The ECB, they left interest rates unchanged for a 4th straight meeting. Then we go to the Bank of England, cut rates to the lowest in almost 3 years. Let's head over to company news. Paul mentioned it. Trump Media and Technology, their shares are up about 31%. That's after announcing that merger with clean fusion energy company TAE Technologies. And then after surging 41% in its trading debut, shares of Medline, well, they're falling. They're down about 3%. The medical supplier raised $6.26 billion in the year's biggest IPO. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Scarlett, Phil, and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's take a look at some of the stocks on the move. Today we can do that with Bloomberg's Alexandra Semenova. Alex, what are you looking at?
Good morning, guys. The first name I'm looking at is Instacart. The stock is falling this morning after Reuters reported that the FTC sent the grocery delivery company a civil investigation demand. The FTC is seeking information about one of the company's AI pricing tools. Apparently, a study showed that some shoppers got prices up to 23% higher. The FTC declined to comment on this, but they told Reuters that they are, quote, disturbed. In a blog post dated December 18th, Instacart said that recent reports around that surge in pricing inaccurately blurred together fundamentally different things: A/B price tests, dynamic pricing, and surveillance pricing. So it will be interesting to see what the FTC finds. The stock right now is down about 1.5%, but a lot less than it was in pre-market trading.
All right, good one to watch for. What's next?
Of course, we have Lululemon today. Activist investor Elliott Management has built a stake of more than $1 billion in the company. Elliott apparently has been working for months with retail executive Jane Nielsen. She is a former chief financial officer and chief operating officer for Ralph Lauren. Nielsen is viewed by the activist investor as a potential CEO candidate. Of course, the company had said that CEO Calvin McDonald would be stepping down at the end of January. Just taking a look at shares right now, they're up about 7%. The stock rallied 11% since Friday when they boosted their full-year outlook and also announced the departure of McDonald. However, if you look at Lululemon shares, they're down about 46% this year, so completely understandable that Elliott would want a turnaround in this company.
Micron.
Yeah, a positive sign for the AI trade. Looking at shares of Micron right now, they are surging about 11%. This is, of course, the largest U.S. maker of computer memory chips. The company gave an upbeat forecast for the current quarter. They also signaled a surge in demand, and supply shortages are allowing the company to charge more for their products. Analysts had estimated about $4 billion in revenue for the average period, but Micron actually blew out expectations. Their revenue will be $18.3 billion to $19.1 billion. It is benefiting from the voracious appetite for AI computing components. Its executive vice president of operations said that this is the most significant disconnect between demand and supply that he's seen in 25 years.
Wow, that gets your attention there a little bit.
Absolutely, and this is a stock that is up now 200% so far this year, even though it had been on a little bit of a decline before today's big rally. All right, Alex Semenova, thank you so much. Alex Semenova covering our market drivers for us. And for more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Paul, I think we need to take a closer look at Micron, given the roaring comeback it's made this year.
Yeah,
I mean, memory chip maker, that's an old school product, but it's having its day. Let's bring in Jake Silverman, Bloomberg Intelligence semiconductor analyst, to recap these results. Jake, let's start just with the big, massive gain Micron has seen this year, up 200%. What were investors pricing in, and did they get what they wanted with yesterday's earnings report?
Yeah, I think investors were expecting a little bit more of a subdued outlook for the second fiscal quarter, primarily just due to typical little bit of conservatism for management, but also, the February ended quarter tends to be a little bit more seasonally weak. You get the December portion of that, but usually consumer products, PCs and smartphones tend to see a little bit of a sequential decline just off of strong holiday seasonality. We all kind of knew that pricing was going to be the most important factor going into the quarter, and obviously demand from AI is pretty strong. But there are areas like high bandwidth memory where Micron's actually somewhat constrained in terms of their ability to supply, just simply because they haven't invested in that much additional capacity, and they need to improve yields, and they're transitioning over from HBM3E to 4, which is to support NVIDIA's next architecture and other customers. So there's a few factors going on here that I think had investors a little bit more maybe conservative in terms of what they were expecting.
I don't know a lot about semiconductors, and I want to keep it that way. But what I do know is it's a cyclical business. Has this AI spending thing kind of evened out the cycles, or just said throw the cycles out the window?
It's a little unprecedented. I don't think that we're necessarily at that point where we can say that there aren't going to be cycles, or at least not in the next, I don't know, call it 5-10 years, something like that. Typically what we see with memory, I'll just focus on that specifically, we tend to see something like 7 to 10 quarters, about 2 years plus of up cycles. And then what happens from there is that we tend to see some sort of cyclical decline, and that really is because of supply ending up being a little bit more supply growth relative to demand growth. AI is structurally limiting some of that. We're seeing AI inferencing demand being really strong. That's both for DRAM and NAND. At this point, DRAM is more important for Micron. It's a much larger percentage of their sales, and that's where high bandwidth memory is included in their revenue. And so what this does to the cycle, it's definitely extending it. It's elongating what we would expect, and it's making it a lot more difficult for investors, I think, to capture what will be the ultimate peak of the cycle. But on the other hand, we have to look at what's happening with pricing. If customers like PC, smartphone, automotive, run the gamut, if they can't get supply, someone's going to need to meet that, which means that Micron or their peers are going to at some point need to expand capacity. They're kind of working on it. They hinted at it with the additional CapEx increases for the fiscal 26 going up from 18 to 20 billion. But it's just a question of how fast and to what magnitude can they actually increase capacity.
Right, and I'm glad you bring that up, because we know that the industry is shifting production to the more advanced technology for AI data centers, and therefore there's a shortage now of this less sophisticated memory chips for PCs. Doesn't that mean that Micron has the upper hand when it comes to Dell or HP, and they can call the shots more? I mean, what does a Dell, what does an HP do then if they can't get what they need?
Yeah, it's complicated. So Micron has to decide how they want to allocate that capacity that they have, whether that goes to PC. I think that when you're a larger customer like Dell, HP, you kind of have to just take the product at the price that Micron is offering it. Now, I do think if you could buy in larger volumes, you can, mitigate some of those price increases. But at the end of the day, you're kind of, you're being dictated by the market demand, the market forces. But also, when prices have declined in the past, PC makers have also benefited from that.
Yeah.
So if there is a cyclical decline, which I expect to happen at some point, they'll also benefit from a decline in memory pricing as well.
Where does Micron manufacture its chips?
Yeah, so it's primarily in Taiwan, but also in Japan as well. And they have a fab in Manassas, Virginia, but they're also expanding now to Boise, Idaho, and they're eventually going to bring a fab online in New York. So it's pretty geographically
where in New York?
diverse.
Do we know?
Clay, New York.
Where's Clay, New York?
I'm going to say it's up near Cornell.
Upstate. Okay. Yeah. So not near us.
No, upstate. There's, I didn't know there's upstate. Then I think there's mid-state. Some people call it.
Well, everyone in Manhattan thinks upstate is like Westchester. So
right. Yes. But I learned this during the pandemic. There's different regions of the state of New York. I have to go Google that now. I wasn't aware of that.
Well, you're a New Jersey guy, so there's just a city and then that's it.
That's exactly right. All right, Jake. Thanks so much for joining us. Jake Silverman, semiconductor analyst, Bloomberg Intelligence. joining us live here in our Bloomberg Interactive Broker Studio. And again, Micron up, 200% this year. So here's a company that's, we say, which companies are getting the tailwind of AI? Boy, that's one of them.
And it's such a contrast to the reaction that the market gave to Broadcom and Oracle's results.
Yep.
So there's already a little bit maybe of concern heading into these results. And, for now, definitely Micron is living up to the hype.
Yep, Micron got a market cap of $280 billion. So some real shareholder wealth being created today with that stock up about 10%. S&P is up 52 points. That's about 0.8%. The NASDAQ doing a little bit better, up 238 points. It's about 1.05%. The Tom Keene Memorial VIX, that comes in. We're now below 17, and the 10-year Treasury yield comes in at about 4 basis points here. We're right around 4.11% on your 10-year. More coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. We've got stocks advancing. This is after a downside surprise from shutdown delayed inflation numbers for November. We'll start with the NASDAQ. It's up more than 1%. The S&P 500 rising 0.8%. The Dow up about 0.4%. In the yield space, we'll start with the 2-year, 3.45%. That's down 2 basis points. The yield on the 10-year, 4.11%, and that's down 3 basis points. That's it. Commodities. COMEX gold, $4,358 an ounce. It's down about 0.3%. Brent crude up about 0.6%, $60 a barrel. WTI crude $56 a barrel. The Bloomberg Dollar Spot Index is little change. Let's go to shares of CarMax. They're down about nearly 1%. That's after the company said it sold fewer used cars than expected last quarter. Then we go to Darden Restaurants. They raised their comparable sales forecast. That was following better than expected growth at Olive Garden and also its Longhorn chains. Their shares up nearly 2.5%. And Lululemon on the rise. Their shares up 6%. Sources saying Elliott Investment Management, well, it's built a stake of more than $1 billion in the company. And I got to add in Birkenstock because their shares are down 7%. Predicted slower pace of sales growth in the coming year. It's sandals and clogs. Well, they're dealing with the impact of a weaker U.S. dollar and also, yes, tariffs. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
All right, Lisa, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio in New York City. And we're streaming live on YouTube as well. As Lisa just reporting, activist investor Elliott Investment Management has built a stake of more than $1 billion in Lululemon Athletica. The stock is up 6.5% today, but I think the problem is it's down 42% year to date. So let's see what's going on over there at Lulu. Poonam Goyal, senior U.S. e-commerce and retail analyst, Bloomberg Intelligence. She's based down there in Princeton. She joins us. Poonam, what's going on with Lululemon? What's the problem here, and what do you think Elliott believes it can do to fix it?
The problem is that they've had plenty of execution missteps over the past 2 years, led directly to product innovation. And as they search for a new leader at helm, the candidate that he's outlined seems like a strong one. She's led a turnaround or helped lead a turnaround at Ralph Lauren in the past, at Coach, both iconic brands that struggled in that time, and she helped lead that turnaround. So I think Lululemon, while a different turnaround, she has the track record, if she is put at the lead, to really help drive this turnaround.
Poonam, tell us a little bit more about the role of Chip Wilson. He founded Lululemon, and he's been making comments, really agitating for change, accusing Calvin McDonald of killing innovation and some serious strategic missteps. But he is not part of management at Lululemon. So why does his voice carry such weight?
I mean, he was the founder, right? He did find this brand. He did grow this brand very quickly into a strong, loved, well-known brand. And I think the brand emerged by having great product. Like, if you think about Lululemon in the past, it was all about product. You could not find Lululemon product or something like it anywhere else. Leggings that made you feel good, leggings that performed. That's how they made their mark. And the question is, what's next? Have they been able to innovate fast enough to prevent competition from encroaching that space? And the answer is no. And that's the struggle that they're having right now.
Is it just a question of money, putting more money into, I don't know, research and development of leggings? I don't know how that works.
I think it's execution, right? It's about staying ahead of trends and really innovating faster than competition. Clearly, today with AI and other mediums, there is the ability for a competition to come on faster. But that said, Lululemon was ahead of the game, and they've kind of fallen behind. So they do need someone who knows the product story and can lead a product-led turnaround.
Before I let you go, Poonam, I just need to ask you about Nike. It's going to be reporting earnings later today, and there's a big question in terms of where it's at with its turnaround effort. I don't think they've given a full year outlook in quite a while. Are they in a position to start doing that now?
I don't think they're in a position to start doing that just yet. Remember, the first thing they need to do is clear inventory. They still have a lot of excess inventory that they're clearing through their direct channel. And we do expect inventories to decline when they report this evening. Though I would say in terms of a turnaround, we're still probably a quarter or two away to really understand what's the strategy to drive a sustained turnaround. And for that, we need to help them help us understand where they're going with running and basketball and just back into performance. They've made a lot of progress this year, and I think they are doing better in the categories where they've innovated. The new shoes that they've launched, whether it's the Kobe's or the Pegasus, they have had great response, but there's still a lot of old stuff that needs to be cleared.
All right, very good. Poonam Goyal, thanks so much. We appreciate that. Poonam Goyal, she is the senior retail analyst at Bloomberg Intelligence. I think the hardest job as an analyst is biotech, because you have to understand all the
science.
The science. The second one is, I think, retail. I mean, not only do you have to, like every other skill set, I have to have my modeling so I can get my earnings forecast and blah, 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 blah. But then I got to figure out, what fashion is going to work and have an opinion on that.
There's no science on that either.
No.
That's like a gut call.
That's right. That's right. So
you talk to Mickey Drexler, he's like, you know it or you don't know it.
Yep.
But absolutely. You can't, you don't go to business school for that.
That's why, I listen to Dana Telsley on the retail stuff. She just has a feel for it.
Yeah, very sharp.
So she's just got a feel for it. All right, let's get back to these markets. We've got a lot of green on the screen here. If you just look at the headline number, the inflation story is getting a lot better out there. Although Cameron Kreis said the data is basically worthless. Don't put too much.
Don't pay attention until when? Early January?
Well, December data would be better. I mean, as we go along, they'll get a little bit better. But so I don't know. We'll see how it goes. But the markets certainly like it. The markets certainly like it. Christina Hooper joins us. She's Chief Global Markets Strategist for the Man Group. She joins us here in our studio. Christina, it looks like we got some data this week, and yes, it may be less reliable than ordinary, but we got data on the labor market and on inflation, and it seems like the market's pretty positive on that.
Well, absolutely, because all signs point to more Fed easing being able to occur, regardless of who's in the Fed chair seat. So I think that is positive. But let's face it, bad news can be good news when it comes to markets. And I think we're seeing an increasing amount of decoupling between Main Street and Wall Street. And this is part of the story. For me, I'm quite concerned about the state of the labor market. And I think it was it was almost overlooked when we heard from Jay Powell last week about how the jobs data is overstating payrolls by about 60,000 a month. I think that should have sent more tremors through markets.
Well, you're fairly, you talk about being concerned. You're looking for potentially a mild recession here. So your concern goes a little bit further than I think most people, because I hear the consensus as, things are looking good. It's been a good 2025. That's going to continue in 2026. Inflation is resolved. No one's really thinking too hard about that. So how are you thinking about positioning because of this potential recession, mild recession?
So what I think can happen is we could see a 2026 where we could see a stock market drawdown earlier in the year, almost a forecasting of a mild recession, then a recovery, and we could actually end the year with U.S. stocks up. But having said that, I think what we're likely to see is stock markets perform better elsewhere. So I think it's important to be well diversified, have that exposure to emerging markets equities, European equities. I think fiscal stimulus is going to matter a lot next year. And it's not just every government spending dollar is equal. It's going to be what kind of fiscal stimulus and what's the multiplier effect. And so I think that's going to favor areas like Europe. I also think it's about being well diversified within fixed income and, of course, having EM bond exposure. Also being in alternatives, having diversified strategies, and in particular, I think precious metals is an attractive play for next year because you have sort of the safe haven status of gold, but also the industrial applications for a lot of precious metals.
Even with gold where it is right now?
Even with gold where it is right now. It has a history. If we go back in time and look at stock market corrections and bear markets, it has a history of producing positive gains on average. Not every single time, but on average positive gains.
So what's typically an international allocation for you guys? And are we overweight international or non-U.S. right now for you guys?
Well, there's no one size fits all. We have so many different portfolio managers on so many different strategies. But when I think about the average investor in the U.S., they're likely overexposed to U.S. equities, well underexposed to European equities. And that can just be a function of not rebalancing and having let their winners run over time, because we know U.S. stocks have outperformed for so long. I think we could actually be seeing the story change a lot. We've already seen it this year, so I suspect that when investors look at their calendar year returns for 2025, they say, oh, gee, I need more exposure to Europe. I think they need significantly more exposure to European equities, more exposure to EM, bonds, and equities. I think this is a time to really examine portfolios and reallocate.
You made headlines, Christina, earlier this month when you said the Fed may need to turn back to quantitative easing to lower long-term borrowing costs if bond investors start questioning the independence of the next Fed chair. And of course, we don't know who that's going to be just yet, but you point to the Liz Truss moment in the UK as perhaps an example. What kind of ramifications would QE by the Fed have globally on those other markets that you say perhaps provide more value?
Well, I certainly think what we could very well see with QE is a tamping down of yields globally. I mean, what we've seen this year is the opposite of that. Yields, for example, in Japan have brought up bond yields globally. And so I suspect that if we were to see some significant quantitative easing, that could be positive for global bond yields in terms of bringing them down. I think there is a real concern around bond vigilantes. That cannot be addressed, or at least hasn't been addressed yet, in terms of reducing fiscal deficits. Doesn't look like that's going to happen in 2026. So it needs to be bond buying, and bond buying of longer dated securities to get us to there. And that could be the case no matter who's in the chair at the Federal Reserve, who's in the seat of the Fed chair.
We've seen the dollar weaken 10% in the beginning of the year on some of the trade uncertainty. It's kind of stabilized, I guess, since there, but it hasn't come back higher. What's the dollar call, do you think, for 2026?
So I think the dollar is modestly weaker in 2026. I don't think we're going to, as I said, I don't think we're going to see the growth we're going to see in other parts of the world. And I would anticipate that what we're going to see is a stronger euro. The ECB doesn't have a reason to cut right now. And I think, of course, we're going to see a stronger yen given where the Bank of Japan is going.
What's your highest conviction call for 2026?
Well, this might be a cop-out, but it's diversification. I think it's absolutely critically important to be well diversified, and that includes alternatives. Having that exposure, because I think what we're likely to see are micro or mini rallies and drawdowns over the course of the year, also rotations. We could easily see significant rotations based on different areas of uncertainty, like, for example, tariffs. If we were to see a Supreme Court decision that ends tariffs, that could cause a very significant shift. I think we're going to see risk-off periods during the year, and we're going to see risk-on periods during the year.
When do we get that U.S. Supreme Court on the tariffs?
I feel like it's kind of any day pending situation, right?
I think so. That could be, that could be very important for the market. I don't know how, if they overturn it, does everybody have to repay the money?
Well, nothing's going to happen quickly because this is the U.S. government.
Yes, okay, good point, good point.
So it'll take months before we know.
All right, Christina Hooper, thank you so much for joining us. Christina Hooper, Chief Global Markets Strategist for the Man Group, joining us live here in our Bloomberg Interactive Broker Studio. And again, we're sitting kind of at the highs of the days here, of the day. S&P's up 80 points, that's 1.2%, and the NASDAQ's up call it 395 points, that's 1.7%. So some big moves higher today on the back of that in lighter than expected inflation print. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Wall Street getting a relief rally. That's after a CPI downside surprise. We look at the NASDAQ up more than 1.5%, 422 points. The S&P 500 rising more than 1%, 87 points. And the Dow up 0.8%, or 410 points. The 2-year yield 3.45%. That's down 2 basis points. The yield on the 10-year 4.11%, and that's down 3 basis points. The Bloomberg Dollar Spot Index is little changed, and we have Bitcoin up more than 3.5% at just above 89,000. Over to company news this morning. The Information reporting that OpenAI held early talks with investors to raise as much as $100 billion at a valuation of about $750 billion. And in other news, OpenAI, as well as Anthropic, they're looking to expand their office footprints in Dublin, showing their growing presence over in Europe. And Coinbase Global, the biggest crypto exchange in the U.S., well, it has announced its entry into prediction markets and equities trading. It'll be available to U.S. Customers in the coming weeks. And finally, Big Oil has its first female chief. BP has named industry veteran Meg O'Neill as its new CEO. She'll take over the role in April. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is your Bloomberg Business Flash. Scarlett and Paul.
Lisa Mateo, thank you so much for that Bloomberg Business Flash. This is Bloomberg Intelligence with Paul Sweeney and Scarlett Fu, and we're just talking about some CEO changes in Big Oil. Let's stay with the energy theme here, because the newest company to get into the energy sphere, admittedly in nuclear energy, is the Trump Media and Technology Group. DJT is the ticker, of course, and it's President Trump's company, basically a social media company because it owns Truth Social, but they are now in nuclear fusion. So we want to understand what's going on here. Simon Casey is Bloomberg News' managing editor for energy and commodities. Simon, Trump Media and Technology is now a nuclear fusion company. How does this work?
Yeah, I don't think anybody had this on their bingo card this morning. We certainly didn't. It appears that they are a fusion company as much as they're a social media company or a crypto company now. They're merging with a company called TAE. It's far as we can see, a credible fusion player. They've been around for over 2 decades. They've raised money from the likes of Goldman Sachs, from Google, and various other big investors. I think Chevron, the oil company's venture capital arm, has put money in as well. This deal gives them, I believe, something in the region of $200 million of a cash infusion to continue their work. For DJT, they are touting this as a pivot to the exciting world of nuclear fusion, which is the future of cheap, affordable, abundant energy for everybody. And that's been the dream for decades, of course. There was a breakthrough in 2022 where fusion was actually created for a brief moment in a laboratory, this Lawrence Livermore Laboratory. And that was a fairly significant achievement, and it's been recreated since, but only sort of sporadically and not at commercial scale. We're a long way off. It's very technically challenging to do this, let alone commercially.
Well, I'll ask the elephant in the room question. Where are we on conflicts of interest with this president and this administration and investments in business and that type of thing? Where's the market kind of evolved to? This is before the Trump administration. This stuff, I would say, rarely happened.
It almost, I struggle to remember it happening now. It's commonplace, isn't it?
Yep.
And let's be clear, the Trump administration has a very robust, I would say, very sort of clearly outlined energy agenda, an energy dominance agenda. They are pro-fossil fuel. They also support the nuclear industry, and the nuclear industry has has gained a lot of momentum since that discovery I mentioned in 2022. But since Trump has come in, he's been very supportive of the nuclear industry to build new nuclear reactors. Look, we have serious issues here in this country with with power demand from the AI industry and how we're going to service that demand and keeping a lid on prices. The Energy Secretary, Chris Wright, is also very pro-nuclear, been very vocal on that front. But yeah, it's kind of amazing, nevertheless, to see this kind of deal this morning.
Well, just looking at the DES function for DJT, 12 employees. That's, I guess, in the trailing 12 months, 3.7 million of revenue, 1.3 billion of cash, though, 950 million of total debt. So what does Donald Trump Company, Trump Media and Technology Group Corporation, what is that? What did they really bring to this deal other than maybe some cash?
The name, I guess, the ticker.
Okay. Right.
Yeah, it's to a large extent, it is a meme stock, I think, it's fair to say. And with a cash pile, and if they can use some of that cash pile to fund nuclear research and development, then maybe that's a sensible use of that cash.
Yeah, name recognition goes a long way in 2025 and 2026. Simon, how big is the investable universe of nuclear companies right now?
Wow, that's a good question. I mean, in terms of fusion companies, I think this will be the first company, fusion developer, that's actually listed on a stock exchange. So there's a handful of these companies. Some of them on the East Coast here. There's a cluster around the Boston area, and they're all privately held, apart from this one. In terms of other nuclear stocks, there's a handful of them. There's a company called Fermi, which has had a lot of interest recently, which is trying to develop a campus down in West Texas that would include AI data centers and potentially a new nuclear reactor to power that data center. That's a very ambitious project. Then you have a handful, as I say, of other companies that are trying to develop small, medium-sized nuclear reactors. And this is the other thing that the Trump administration is very keen on, to kind of lower the cost of entry, if you like, into the nuclear industry.
What can you tell us about the timetable associated with commercially deploying utility-scale fusion power companies?
So, well, if we're talking fusion, it hasn't been proved at commercial scale. So we're probably talking decades before, I would say. It's fair to say.
I'm just looking at the Bloomberg reporting, and the combined company plans to begin construction next year on the world's first utility-scale fusion power plant. So that's going to take a long time to construct that.
I mean, we don't even know if it can work at a commercial scale. Now they can pour the concrete and build the foundations. Nothing to stop them doing that.
And this sounds like a multi-billion-dollar type of plant for these things.
Potentially, no one's ever built one before, so we don't really know. I mean, we know that conventional fission reactors, which have been around since the end of the Second World War, the last one built in this country went over budget, and it was over $10 billion, I believe.
Who's going to provide the financing on all that?
I think if it can work at scale, then a lot of more investors might take a look at this, including mainstream investors. But it's so sort of hypothetical at the moment. It's almost impossible to say. What is the return on investment going to be for something like that?
It's early innings, not even first inning at this point?
This is very early innings. I mean, the sort of the well-worn joke, it's not even funny anymore, that nuclear fusion is the future. And it's always been, it's the future 30 years out, and it always will be 30 years out. That's kind of where we've always been. It exists in the textbooks. It now exists in the laboratory, which, don't get me wrong, is a big step forward. But transferring that, creating nuclear fusion for a fraction of a second and then evolving that to where it's on all the time and being able to power a town or a city is a quantum leap.
SMR, small modular reactors.
Yes.
That seems like pretty cool technology to me, but that's still years out.
That is, again, probably years out because it's technically challenging, but it does exist. I mean, you use them in nuclear submarines and aircraft carriers.
Yep.
So there's nothing to stop you taking one of those out of a ship and having it on land. The challenge there is actually possibly more regulatory. And again, that's something that the Trump administration is actually trying to address in terms of permitting reform and so forth. So there are companies that are listed that are developing these things. We haven't seen one yet that's been sort of produced and it's been proven it can be manufactured at scale, but it's more achievable, I would say.
All right, that sounds like something to think about. Simon Casey, managing editor for energy and commodities for Bloomberg News, joining us live here in our Bloomberg Interactive Brokers studio. Because I'm probably in the camp as it relates to powering all this stuff. We're going to need everything. I'm going to need wind. I'm going to need solar.
Yeah, but
I'm
this is, as Simon says, this is looking decades down the road here.
Yep. So it's going.
I mean, we have nuclear power plants, fission. We don't have nuclear fusion yet, except as he said in the textbooks and now in labs.
All right, we'll figure it out. S&P up 88 points at the high of the day. The Nasdaq is up 420 points. That's 1.8%. So a big move higher in risk assets. The 10-year Treasury yield that's down about 4 basis points, 4.11% on the back of that inflation print. This is Bloomberg Morning.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Scarlett Fu and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So check us out there. We got some more earnings. FedEx coming up. We want to talk about that. Walmart, we got a cool story on the Bloomberg Terminal. Walmart's $115,000 pay and better rigs draw women to trucking. How about that? So we're going to get all that in coming up. Lee Klaskow, Bloomberg Intelligence, Senior Transport, Logistics, and Shipping Analyst, joins us here. Lee, let's start with FedEx here. What are you looking for with their earnings?
Yeah, I think it's going to be some decent growth year over year on volumes, probably low to mid-single-digit growth. On the earnings side, you're probably going to have, at least where the street is, around 2% EPS growth on 4% revenue growth. They're still dealing with a number of headwinds from a tepid economy. Obviously, what I think we're most interested in is their insights into how peak season is going. This is a quarter that ends for them at the end of November, so they get a little taste of what customers are doing and consumers are doing, and that's probably a nice read through not only for the economy but for a lot of retail names out there as well. Also on their freight business, which is their less than truckload business, that has been impacted dramatically by the soft industrial production and manufacturing economy. The ISM manufacturing index has been down 35 out of the last 37 months, which is a really kind of a good indicator for LTL or less than truckload demand. We expect lower tonnage to be mitigated by decent pricing. That's a consolidated market where they have some pricing power, so we could probably see mid-single-digit rate increases there.
And just to be clear, less than truckload is a shipping method for smaller freight that doesn't fill a whole truck, so businesses can share truck space with other shippers. Yeah, because I hear this term so often, and I don't know what it means necessarily. Lee, what about tariffs? Because initially, FedEx was seen as incredibly vulnerable from the direct impact and indirect impact of tariffs on demand from consumers for goods, for parcels, from businesses as well. How has that played out?
Yeah, probably the biggest impact to them is the removal of the de minimis exemption, which allowed lower value freight, $800 or less, to come into the country and not have to pay duties. So this really drove a lot of volume, especially coming out of China into the United States from companies like Temu and Shein. But those kind of companies took advantage of that, and the Trump administration wanted to reduce that loophole, and that actually had bipartisan support. The Biden administration wanted to reduce that or limit that as well. It just came to fruition during the Trump administration. So I think that is a pretty big impact. You could see volumes between China and the U.S. for all parcel carriers down 25 to 30% because of that.
Lee, we've got one of the most highly read stories is about Walmart and attracting women truckers. I didn't know how big Walmart's trucking fleet was. Talk to us about what's going on Walmart and maybe women in trucking.
Yeah, so they're like I believe the second largest private fleet out there. I think Pepsi is the largest. Hopefully I'm right in saying that. And Walmart is known to be a great employer for truckers. They pay well above the average. They have better benefits. And it's a good place for somebody to learn how to become a truck driver. They do hire a lot of experienced people, but they also have their own programs where I think it's 14 to 16 week program, which is significantly more than, you and I could get a CDL probably within 4 weeks. I probably wouldn't advise you or I being a truck driver just for a safety factor. But they produce not only better paid truckers, but they also produce safer drivers because of their more intensive training. And the industry has been reaching out to women to become truck drivers. It is a very difficult job. A lot of truck drivers are not home every night, and so you have to be willing to be away from home for maybe like 5 days at a time. And it's also a tough lifestyle, right? I mean, you're not going to have maybe the food choices that you want on the road. Again, you're away from your family, and rest stops maybe aren't the best places for people to stop, and some truck stops, never really catered to women before, and I think that has slowly changed. There's a great organization that I recently attended and spoke at their conference, Women in Trucking, where they really are advocate for women within the freight transportation industry, and you are seeing more and more women gravitating to that, which is can be an excellent profession for folks.
When you say Walmart pays more, how much more are we talking, Lee?
The average trucker makes anywhere between, this is going to be a huge range. You can probably drive a truck through it, but $50,000 to $100,000. And, Walmart tends to pay, well over $100,000 for their drivers. And, I'm not quite sure if that also includes benefits and overtime, but, they are known for being a better employer when it comes to compensation.
Yeah, just amazing. All right, Lee, good stuff. Lee Klaskow, Senior Transport, Logistics, and Shipping Analyst for Bloomberg Intelligence. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Coming up, we're going to have a spaceship launch coming up here. The Blue Origin will launch its New Shepard NS-37. That's a 6-person crewed flight that will lift off from West Texas.
The flight's only 10 to 12 minutes, but it's an exciting one.
It is. So, especially if you're in it. So we're going to bring that to you in just moments. It's scheduled for the top of the hour. We'll see how it goes. You know how these astronauts are with their timing and things like that. This is
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Bloomberg Intelligence here, Paul Sweeney and Scarlett Fu. This is the second hour of our program on this Thursday morning. We're, of course, coming to you live from the Bloomberg Interactive Broker Studio. We've got a lot going on this hour, including the launch of New Shepard NS-37. It's a 6-person crewed flight that will lift off from West Texas. We will bring you there live when it begins. Following that, we're going to speak with David Kudla, founder, CEO, and Chief Investment Strategist at Mainstay Capital Management, to get his outlook on the markets. And Craig Trudell, who is a Bloomberg Global Autos editor, will talk to us about CarMax and how its used car sales miss is the latest blow for this company. And following that, John Tozzi will be joining us on Bloomberg's latest series about cancer capitalism. He has a story called One Generic Cancer Drug Costs $35 or $134 or $13,000. It all depends on where you go, what hospital system you use. But first, we want to bring in Charlie Pellet for our Bloomberg Business Flash.
Right, I thank you very much, and here's what's going on. The Dow, the S&P, NASDAQ all advancing. CPI Thursday, stocks rallying, data showing inflation cooled last month, ignited stock and bond markets, bolstering bulls with more prospects for more decisive Fed rate cuts in 2026. Right to the numbers, the S&P 500 index up 86, gain there of 1.3%. Dow Industrials up 418, up 0.9. NASDAQ Composite Index ripping higher now by 1.8%, up 411. NASDAQ 100 Index up 1.9%. And the Bloomberg Mag 7 Index surging 2.4%. 10-year 4.11% with the 2-year 3.45%. Gold up 0.1%, 43.44 the ounce. West Texas Intermediate Crude 56.39 a barrel, up 0.8. And Bitcoin now rallying 2.8% to 88,303. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide, goldencrestmetals.com/guide. Underlying U.S. inflation did rise in November at the slowest annual pace since early 2021, an unexpected improvement following months of stubborn price price pressures. Micron Technology shares surging after earnings. MU on the ticker, up now by 11.2%. The warm reaction to the Micron report sets the company apart from Broadcom and Oracle, which you recall jarred shareholders with their results last week. Today, Oracle up 1.8%. Broadcom trading lower by just about 0.2%. After the close of trading today, we will be hearing from both FedEx and Nike. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Powell, thank you so much. We appreciate that. Green on the screen. Let's take a look at some of the stocks on the move today. I'm Paul Sweeney alongside Scarlett Fu, and we're joined by Bloomberg's Nora Melinda. Nora, what are you looking at?
Well, there was a big selection to choose from, but I'm looking at shares of Accenture, that is ticker ACN. We're seeing shares lower, down about 1% right now as we speak. This is after the company gave a second quarter revenue forecast with a midpoint that fell below what analysts had expected. We did have Vital Knowledge, the analysts over there, saying that they do think that the company put up respectable numbers, but they say that the company is often grouped in the AI losers basket amid fears that its model will be disrupted by new technologies. So we are seeing shares a touch lower, and it hasn't really been a pretty year for the company. Shares down about 23% so far this year.
And my favorite shoe company
is it?
Yes.
I was
also
wondering
with some news. I have like 20 pairs of
I have a friend
Birkenstocks.
that's obsessed with Birkenstocks. I didn't know if people are still buying Birks.
I have sneakers, like Birkenstock sneakers.
See, I didn't know
just
this
gives me some
existed,
range.
so you're loyal.
Several, like at least 4.
Well, shares of Birkenstock are lower, ticker BIRK, down about 9% right now. This is after the company gave an outlook that was seen as disappointing. They're essentially forecasting slower sales growth for the year ahead. This is, of course, due to the impact of the weaker U.S. dollar. They also cite tariffs. So we really are trying to see the CEO coming up with some sort of turnaround story, but right now it doesn't seem as though it's paying off as it currently stands. Shares of the company are down about 26% so far this year.
Are Birkenstocks cool?
Are they comfy?
Or are they just comfy?
You break them
they're
in?
both. They're both.
Okay.
They're very comfortable, and they're wide in the toe box, which is important for me.
Okay.
And they have, an arch support, so that's also good.
All right.
The only criticism I have is that the sole it wears down pretty quickly.
I do see that. I've never owned a pair. Never owned a pair, but I know some
the
people
ones that
do.
look like mushrooms, I think it's the Boston one. Those are really popular right now.
Now I have to look up all the photos.
I know, now we have to do that.
We're going to get Paul Sweeney in some Birkenstocks.
I'll pay to see that, please.
All right, CarMax.
CarMax, ticker KMX. Also lower earlier. Now it's in the green, but we did see shares earlier falling more than 6% in this trading session. This is after the company warned about fourth quarter margins. They're saying that they expect lower retail used margins in the fourth quarter in order to improve price competitiveness. The company also plans to boost its spending on marketing. So it doesn't seem as though this is what investors wanted to hear, but we are seeing shares bouncing back just a tad, up about 0.8% right now as we speak. But it really hasn't been a great year for the company. Shares have down about 50% so far this year in 2025.
All right, good stuff. Thank you so much, Nora Melinda. She is our Bloomberg Television Markets correspondent. And for more conversations like this, subscribe to our Stock Movers reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. So, Paul, we had some economic data this morning. It was delayed, as everything is these days, and it didn't really do much for the market in terms of changing the narrative, the existing narrative.
Well, I think, the markets are rising higher here on this inflation data. Just if you take it at face value, which a lot of folks are saying don't do that, it suggests that, okay, maybe inflation's not a problem. This Fed can cut rates. So let's talk to somebody who actually did go into the details. I'm not in the I talk to detailed people, and they tell me what to say. And that would be Mike McKee. He covers all the economic stuff for us here at Bloomberg. Mike, again, I get a core year-over-year 2.6% inflation rate. The consensus was 3%. Is that a good number? Tell us about the quality of that number.
It would be a good number if the quality were high, and we don't know. You could have done the details on this one, because if you open the report and the charts, they're pretty much blank spaces throughout. They didn't have any month-to-month data. They just basically had a 2-month change in the price levels. And so they calculated things on a year-over-year basis, and we saw a drop to 2.7% for the headline, 2.6% for the core, which is exactly what the Fed wants to see. But those are really big drops, and it implies some real changes in prices going down a lot. And a lot of people are pointing the finger at housing, that the Bureau of Labor Statistics, for whatever reason, just presumed there was zero change in the price of housing in October, and that has biased the numbers down. Now, the people who get nerdy about all this and follow it, as you mentioned, have put out a lot of notes saying, I'm not so sure about this. And so we'll wait for the December numbers come out January 13th, and that'll give us a better idea.
Will those be better quality?
They'll be a better quality because they get the whole month's data. It'll be a little different because they don't have all of the November data, but they'll have more November data, so they can do a month-over-month change, which we didn't see in these 2 months.
Okay, so it's a very incomplete CPI report when it comes down to it. Mike, I know that you look over all the economist notes, you look at what people are saying. What is the feedback from the peanut gallery? How are people interpreting this data point when it comes to understanding the economy and where we are?
Well, the interpretation would be, this is good news. We're seeing a decline in a lot of different areas. There's still inflation, particularly a lot in food, but it has come down. The rate of inflation has come down. Now the question is, are the statistical quirks in this going to continue to tell the same story when we get to the December numbers in January, or is this kind of a one-off weirdo report that will kind of be forgotten by the time we get the next set of numbers?
Well, the market's certainly reacting with the S&P up 1.4%, yields coming in about 3 basis points, 4 basis points on the 10-year. At the very least, can we say it doesn't appear that we have more inflation in the economy? Maybe it's not 2.6, but it doesn't appear to be something north of 3.
That seems to be the case. It could all change. The biggest thing is because, as we mentioned, that housing is the issue, and housing is about 30% of the CPI. So it could weigh down an awful lot on the number. The question is, did also, because they got started late collecting the data once the government shutdown ended, did they collect more data during the period that we were seeing holiday sales, Black Friday sales and things like that at the end of November? And then did that bias it down as well? So a lot we don't know about how accurate this is.
Okay, so, I mean, investors can only do with it what they can. They're going to take it at face value, and it seems like that's what's happening right now. Mike, are we caught up to date on all this delayed data, or we still have more data that's going to come rolling out over the next week from, way back in September, October?
Well, we still have some more data that people will be interested in. Next week, we get the GDP numbers for the third quarter, which we would have gotten back in October, and we get updated PCE spending and income numbers, and we'll get an updated PCE inflation report, although probably the economists are going to be able to put together a number in advance of that, so we have a pretty good idea of what it is. And after that, most of what we'll see is lesser import. So we're almost caught up to the things that we care about.
Got the initial jobless claims. That used to be kind of important. 224,000 in line with expectations. The continuing claims, which people like you tell me I need to pay attention to, came in a little bit lighter than expectations. So nothing alarming, at least in those numbers, really, on the labor front?
No, labor front, nothing changes there. That story doesn't change. The Philadelphia Fed number, the headline number, came in at negative 10.2 after negative 1.7 in the prior month, which would sound bad, except the underlying numbers weren't bad. Prices paid went down.
They're selling fewer cheesesteaks.
Employment went up.
Philly?
So the picture is sort of status quo after all the data we've gotten now.
I mean, this is a loaded question, but did the president have this data, the inflation data in particular, when he spoke on the economy yesterday?
He should have, yes.
Oh, okay. So
he would have gotten, I mean, the way it usually is handled, they would deliver it at 6 p.m. the night before. Last night, the night before it was released, 6 p.m. last night, to the chairman of the Council of Economic Advisors, who can then share it with the president. But interestingly enough, the problem is, if you're the president, you're going to make a speech about inflation. You can't quote any of the numbers.
Right.
So
you're speaking broad brushstrokes.
He may have had it, but as has been pointed out by many people, the numbers he used about inflation were not tethered to reality.
But I mean, it's fair for him and for the administration to say, economy's growing, inflation's moderate, the labor market's still going strong, things are good.
Yeah,
That's a fair statement.
and there's a big difference between what you do if you're a Wall Street economist or Wall Street trader and what you do if you're a politician. A politician, you claim credit for everything and point out the good stuff and hide the bad stuff. The administration's problem has been, and the dissonance last night was that they're claiming credit for things people don't feel like they see. Yeah, okay, you're telling me food prices are down, but I go to the grocery store and food prices are still high. So that's a tough sell for them. And then he also makes up a lot of numbers. So we don't know, it's hard for him to make a case.
Yep.
Didn't his administration say, I feel like it was a Scott Bessent or a Howard Lutnick, that at some point he would own the economy, that early on in his administration, it was Biden's economy. So whatever happened was Biden's fault, but they would own the economy at some point. Are we at that some point?
Oh, we passed that point. I think if you had to put a time period on it, you would sort of look to the beginning of summer or at least the passage of their big bill. And if the numbers are good, they come out and say, it's our economy. If the numbers are bad, they say, well, we're still dealing with the Biden economy. And it's, of course, disingenuous, but I can't say that they're any more disingenuous than any other administration at doing
This is what you do.
This is what you do.
What should the economy expect, or what should we expect from that piece of legislation, the One Big Beautiful Bill? What should we expect in 2026?
Well, we should expect some stimulus because it does change tax law. There will be maybe bigger refunds this year. And we will also see certain categories of people. It's not as broad as the president was saying, but some people won't have to pay taxes on tips. And some seniors get a expanded tax credit for Social Security because they're seniors. It's not a tax refund in that sense. And some people get no tax on overtime. So they'll have a little bit bigger take-home pay.
Back when I was in the tip game, nobody reported tips.
But now people put it on their credit card bills, so I think it's a little different.
It may be harder now because back when they were still using Confederate money then.
I was a bartender in Richmond, Virginia for 3 years. So.
The other side of this, though, is if they don't solve this problem with Obamacare subsidies, anything that comes into your pocket
will go right
is
out.
going to go right back out again and more. So it's really hard to know how the economy is going to develop.
So that's an interesting point. Do you see that coming up in people's forecasts for CPI?
No.
Shouldn't it, though?
Well, part of it is the way these things are calculated. The CPI uses the profit margins of insurance companies to try to impute what the rate of inflation is. PCE does it a different way. PCE measures what the insurance companies receive as opposed to what the customer pays. And so at this point, it's
They're not
hard to know
measuring my
exactly.
out-of-pocket costs.
It's not. We can guess that it will push inflation in healthcare up, but we can't have a good grasp on by how much yet. And all this could change because they're blasting that extension out of the House with the discharge petition. So around the first of the year, they may be able to solve this problem. But that's something to keep in mind and keep an eye on.
Yeah.
See whether it takes money away from people.
And it's serious money. I mean, it's for material amounts of money here for 22 million Americans. I mean, I would think that would be political suicide. I mean, I'm not a poli-scientist, but I would think that'd be political suicide.
Common sense would tell you that.
Common sense would be like, get something going.
Well, the Republican congressmen who have to run in districts where it's a close race are pretty upset because
Yeah, they're leading the way on
that
the
doesn't look
revolts.
good.
Yeah. All right. We'll keep an eye on. There's a lot of stuff to keep an eye on. But again, market's definitely reacting to that better than expected PPI number. We'll see how that number gets, or I guess, trends out over the next several periods. Mike McKee, thanks so much for joining us, helping us understand what's going on out there. Mike McKee does all the economic stuff for Bloomberg Television, Bloomberg Radio. We appreciate getting a few minutes this time. Again, the stocks are moving here, folks. We are pretty much at the session's trading highs. The S&P up 90 points, 1.35%, and the NASDAQ up 440 points. That's almost 2%. So that's some moves there, folks. And the VIX 16 coming in here. So we're in good shape. More coming up. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. CPI Thursday. Stocks are surging. Data this morning showing inflation cooled last month is igniting stock and bond markets, bolstering bulls with prospects for more decisive Fed rate cuts in 2026. S&P 500 index is now very close to session highs, up 91, 68.12. That is a gain of 1.3%. Dow Industrials up 440, up 0.9%. Nasdaq Composite Index up 1.9%. The Nasdaq 100 Index up 2%, and the Bloomberg Mag 7 Index up now by 2.6%. The 10-year at 4.11%, the 2-year 3.46%. Gold up $30 the ounce, $43.69 now, up 0.7%. West Texas Intermediate crude oil up 0.8%. Right now, WTI's at 56.45, and Bitcoin 88,120. Bitcoin up 2.5%. 2.5%. Trump Media and Technology Group, the company behind Truth Social, is getting into nuclear fusion. Company says it will merge with TAE Technologies, a closely held fusion developer founded in 1998 in a transaction valued at more than $6 billion. Shares of DJT, they're up by 32.9%. After the bell today, FedEx and Nike. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet, for that check on the markets. We do have a rally on our hands here with the S&P 500 gaining for the first time in 5 days after some cooler than expected consumer inflation data points. Let's bring in David Kudla now. He is founder and CEO and chief investment strategist at Mainstay Capital Management, joining us right now from Troy, Michigan. David, how are you thinking about the inflation data that was long awaited and at this point, if you take it at face value, seems to confirm that we don't have a whole lot to worry about when it comes to inflation?
Good morning, Scarlett. Well, unfortunately, the way I'm taking it is it's a meaningless number. What we've learned is where they didn't have the data for certain categories, you just entered a zero. So it's so far away from the trend, and knowing what the errors are, it may have been better to not report it again, but they at least should have the caveats out there about the number. So and here's what I'll say: if we look at it, moving into 26. I hope this doesn't, let me say this, I hope this doesn't give anybody hope that inflation is we're headed right back down towards target because we're not. And we're not with what's going on with the debt crisis we have in this country and around the world, what's happening with just the level of supply for bonds that are coming to market, for debt that's coming to market, treasuries, and we're going to move into a higher inflationary environment. So if anything, this number should not only be thrown out, it could give somebody a real misread. Kevin Hassett may want to do victory laps about it, but it's not a complete number. There's data missing.
Sorry, are you surprised by the market's reaction here in the stock market?
No, if you look at it, the NASDAQ was down 4 days in a row. So it's, we were due for, like we say, we're due for a correction or we're due for a little bit of a pullback. When this number came out, there was no, qualification around it. And boy, it looks great. Stocks would rally on that. But, we've had a tough, this is December 15th and December 31st. Is seasonally a very good period for stocks. You have the Santa Claus rally and you have the pre-Santa Claus rally. And we've had 4 days of a sea of red. So it's about time to have a nice up day.
Okay, that's fair enough. We did mention the first rally in 5 days for the S&P 500. There's been a lot of concern over AI bubble fears. Micron seems to have provided investors a report that pushes back against that AI bubble fears, at least for now. How are you thinking about the Micron data point after Broadcom and Oracle's results were so poorly received?
Yeah, it's it's encouraging, and I'll tell you really the macro or a larger data point I think is meaningful in terms of is this an AI boom or an AI bubble or an AI boom that's becoming? We still say AI boom. Does it have bubble-like characteristics? Yes. Is it scary when you look at an Oracle and what the amount of debt these companies are taking on could potentially do to them? These these companies that have otherwise fortress balance sheets, wide moats, very healthy companies, but just massive amounts of debt they're taking on for AI CapEx spend. But we look at tech stocks are up over 25% this year, and what's happened to valuations? Because that's what people want to do, right? Compare it to .com and all the problems back then when you had companies that had multiples of 50, 100, 150, 200. The valuations of tech stocks are right where they started the year. Yep. So earnings forecasts are keeping up with price. So it's not that they're becoming significantly overvalued, even though they've gained over 25% this year. it's being reinforced. And we're in a great corporate earnings period in terms of reported earnings, the beats, and gross margins.
You got in your notes here, the Yukon Cornelius rally. I get the reference. Very cool. It's one of my favorite characters. How does it apply to 2026 here? I mean, we can't have the same expectations in 26 in terms of the performance that we got in 25.
I will say this. We are still very bullish on gold, silver, and the precious metals, hard commodities in general. When you get into palladium, platinum, copper, let's just take gold and silver, right? Gold, speculative investment. It's about the central bank buying. It's, the amount of central bank buying has gone up 5 times since 2022. I mean, they're looking at what's happening to fiat currencies around the world. They're looking at this debt crisis, and they want insurance. They want to diversify their reserves. They want insurance. China's been selling a lot of U.S. treasuries to buy gold. So we have that along with investors looking at it the same way. How can I get some insurance against inflation, which we think is going to go higher in 26, at least for a period of time.
Right.
Silver has incredible industrial demand as well.
Yep.
That with the AI boom has grown even more.
Right. All right, Dave, thanks so much. Appreciate it. As always, David Kula, founder, chief executive officer at Mainstay Capital Management here. We got a rocket launch coming up in just a moment. Blue Origin will launch New Shepard NS-37, a 6-person crewed flight that will lift off from West Texas. We see the clock up here, T-minus 2 minutes and counting. We're going to bring in some folks that can help us understand what's happening here. Sana Pashankar, she's Bloomberg space reporter, and George Ferguson, Bloomberg Intelligence senior aerospace, defense, and airlines analyst on this new rocket launch here. Sana, talk to us about what's going to happen today.
Yeah, so on this New Shepard launch, the New Shepard rocket will boost up to the Kármán line, which is the internationally recognized boundary of space, and it will bring a crew of 6 up there for a quick experience of weightlessness. They will be able to see the Earth from space, and then, they'll come down, the engine will cut off, and the capsule will come down under parachutes. The trip lasts roughly 11 minutes.
Yeah, it's pretty incredible that this all takes place within an 11-minute span. George, tell us a little bit about these New Shepard rockets. What makes them special?
Yes, I mean, New Shepard is largely been designed just to work, roughly in the Earth's atmosphere. That's why they just get to the edge of space. It's an advancement. It's one of the first new engines developed in many, many years to operate inside the atmosphere. I think it helps to, continue to push space exploration forward, even though it's a tourism mission, by, working new ways to lower costs, reuse parts of the rocket. Again, this is largely a tourist mission, though, and really stays roughly inside the Earth's orbit, so not cutting edge.
Yeah, to that point, there's 6 people on this flight,
Sorry,
including
not orbit.
The
Not
first
orbit,
wheelchair
atmosphere.
user to fly to space.
Yes.
You know what? The clock has stopped, Paul.
Yeah, so we're back on a hold here at T-minus 58 seconds. So
I think high winds have been a problem.
Okay, well, it's West Texas.
It is. It's West Texas, and it was due to start at 11 a.m. Eastern time, so it's already 30 minutes behind schedule. But Sana, let me come back to you for a moment here, because George was talking about how this is a tourist flight. There's 6 people on this particular flight. How do you get on this flight? How much does it cost?
Yeah, so, Blue Origin has really not disclosed much publicly about their recruitment strategy, and they also do not disclose the price of their tickets. But Virgin Galactic, which is another space company, which does space tourism flights, charges around $600,000 for a similar experience. But, Blue Origin has never said how much a seat costs on a New Shepard flight.
George, to what extent are Jeff Bezos, Elon Musk, do they work with some of the defense contractors, the rocket defense contractors? Is there any kind of cooperation there?
Yes, I mean, Jeff Bezos, Blue Origin, they're developing New Glenn as well, right? New Glenn is sort of their heavy lift rocket that's already done some missions for the government. I think it's also going to sort of take the mantle in pushing, Project Kuiper, or I think it's now called LEO, the Amazon low Earth orbit constellation into space, into large numbers. So look, I think, what both of them are doing, SpaceX and Blue Origin, it's absolutely great, right? We're taking money from the private sector. We're developing ways to go to space cheaper and cheaper. I don't think they're going to make a lot of money going to space. I think the opportunities in space are all about what you put in orbit and what you do beyond orbit. But it's great to see, again, SpaceX, Blue Origin spending the money to develop, the rocket motors, develop the processes. They're going to lower the cost of space and let us access it more, and I guess drive into the brave new world.
Blue Origin, privately held company. SpaceX, privately held company, although it may go public next year, as we've been learning. Sana, we know that Blue Origin's last New Glenn rocket sent 2 NASA satellites to Mars. What is the role of NASA right now in space exploration?
Yeah, so one really key mission is that they will be launching their Artemis missions to send astronauts back to the moon. And, the one with American astronauts sending them back to the moon will happen in 2027, but they have another mission in between that is likely to happen early next year. So that's a really big part of NASA's, space exploration capabilities. But even like you said, they're always doing science experimentations and science launches. So the last New Glenn launch, it sent 2 Mars satellites, on their way to explore the Martian atmosphere. So they're constantly doing science missions, working on telescopes. And then when it comes to human spaceflight, I would say that Artemis is their probably main, spaceflight mission.
George, on the defense front, on the rocket side, I guess what I've heard on the missile side, something new, is a new term for me, is hypersonic missile. What is that, and who makes that?
Yeah, so the U.S. makes it. China, Russia make them. Hypersonic missiles are high-speed missiles. They fly Mach 4, Mach 5. Obviously, it's an attack weapon, unlike the old ballistic missiles, where you'd be pushing something up into an orbit and coming down with on a trajectory into your target. Hypersonics are closer to the Earth and moving at high speeds, and very high to defend against. And I think probably where you're going, part of that defense, part of Golden Dome, I think, is going to be putting a constellation of satellites up over the U.S., or at least focused on the U.S. area, that will allow you to see things like hypersonic missiles, ballistic missiles, see them sooner, track them, and it's all about the future missile defense for the homeland, where you'd be able to track them, and then potentially we're going to put interceptors into space. We could fire on things like hypersonics coming into the continental U.S.
And is that something that Blue Origin and SpaceX are actively involved in, George?
Yeah, so it's early days, right? The Trump administration's announced $175 billion towards this effort in the latest defense budget. We think this is something it's a never-ending journey, because there'll always be sort of the cat and mouse game of the adversary makes something faster or stealthier, and we have to find a way to discover it and then intercept it, destroy it. I think that both Blue Origin and SpaceX will be involved in probably deploying the satellite constellations. I think because they're just a cheaper cost than companies like United Launch Alliance that are Boeing Lockheed joint venture. Although my guess is ULA is involved as well, depending on what level of secrecy we need for some of these missions. But I think, again, sort of the reduction in the cost to access space and access, build these constellations in the Earth's atmosphere, the lower it is, the more we can deploy up there. And so I think they all help sort of to develop space and develop the opportunities we're going to get from it.
All right, George, thanks so much. Appreciate that. George Ferguson, Senior Aerospace and Airlines Analyst for Bloomberg Intelligence. And Sana Bashankar, she is a space reporter for Bloomberg News. She's based in Washington, D.C. And we are on a hold here, T-minus 58 seconds. So we were on a hold there at 10
I know,
minutes.
so close.
And then we got down here and another hold here. So we'll come back to it if we get like a live launch.
Yeah, this is the 16th human flight that Blue Origin has launched, or it will be launching, the 37th overall. It's already taken 80 individuals past the Kármán line, which indicates that you've entered space. And there have been 6 repeat passengers.
Oh, really? Cool.
Yeah. Can you imagine saying, I did that and I want to go
Yeah,
again?
I want to go again, exactly. You get frequent flyer miles. Maybe we'll see about that. All right, so we'll come back to that if we get some action there. And meanwhile, the stocks are just ripping here, folks. Let's get a little bit of a reset here. We'll go to Charlie Pellet for a Bloomberg Business Flash.
Thank you very much. Ripping like a rocket, Paul Sweeney with the Dow, the S&P, NASDAQ solidly in the green. This Bloomberg Business Flash brought to you by the Harvard Business School Executive Education, a world-class learning experience for aspiring and established change makers. Prepare for the next elevation for your organization and for yourself. Learn more at hbs.me/breakthrough. The Dow, the S&P, NASDAQ all higher. S&P right now best level of the day, looking at a gain of 1.4%, up 93. CPI Thursday, Dow Industrials up 451. On the Dow, a gain right now of 0.9%. NASDAQ is surging 2%, with the 10-year currently yielding 4.11%, and the 2-year 3.46%. Gold up 0.7%, 43.70 the ounce. West Texas Intermediate crude up 1.3%, 56.69 a barrel, and Bitcoin now up 2.6%, 88,173. Data showing inflation cooling last month, igniting stock and bond markets, bolstering bulls with prospects for more decisive Federal Reserve rate cuts in 2026. But Dave Kudla, the founder and chief investment strategist at Mainstay Capital, right here on Bloomberg Intelligence, he told us this data point carries zero weight with him.
Unfortunately, the way I'm taking it is it's a meaningless number. What we've learned is where they didn't have the data for certain categories, you just entered a zero. So it's so far away from the trend, and knowing what the errors are, it may have been better to not report it again, but they at least should have the caveats out there about the number.
Dave Kudla of Mainstay, interviewed on Bloomberg Intelligence. Keeping an eye on Micron Technology shares after earnings, stock surging now by 11.9%. Recapping, stocks higher, S&P up 1.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Phil and Paul Sweeney. We are live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. I'm looking up at our screen here. We're still that rocket launch still at a hold, T-minus 58 seconds. So we'll see how that plays out going forward. Big take story. We bring those big take stories to you every day. They are the Bloomberg News, really featured stories, great topics, deeply sourced, great graphics. So they're just outstanding stories that highlight really interesting stories out there in the global economic and finance. And this one focuses on healthcare. Hundreds of hospitals across the U.S. are marking up old cancer treatments. In some cases, hundreds of times what Medicare pays. Just another part of the financial side of healthcare. I had no idea how that stuff works. John Tozzi, he's a healthcare reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio. John, what was the aim of your story? What did you guys look to really report on?
Yeah, so we know that when hospitals administer drugs to patients like chemotherapies, they basically set the price, negotiate the price with insurers. So they buy the drug for one price, and then they have a reimbursement rate that they get with insurers. We were trying to figure out what those prices look like in the marketplace, because we were getting reports from big plans, union plans that cover lots of patients, that they were seeing some prices that looked irrational, some prices where they were paying thousands of dollars for drugs where Medicare would pay a tiny fraction of that. So we were really trying to get some data and reporting to understand what was going on in this market.
And one of your takeaways is that hospital systems often charge insurers up to 5 times what Medicare has to pay for those same drugs. And if you had to boil it down to why that is, what's the reason behind it?
Yeah, the hospitals are trying to turn a profit on their commercial plans because they say they lose money often paying, providing care to people on Medicare or Medicaid. What's interesting is that there's a huge variation in the prices we're finding. And, many hospitals in our data set were just charging like 1 or 2 or 3 times the Medicare price. Then we found examples of some hospitals charging hundreds of times the Medicare price.
All right, I'm as guilty as anybody. When I get the bill from the doctor or from whatever, I don't know what it is.
Because you have good insurance, Paul.
I do have good insurance. I have the best insurance. But it just, when the numbers on the bill itself, no idea. So,
And sometimes the numbers are bananas,
I
too.
just look down at the bottom and say, thank you, insurance. But for a lot of people, they don't have that luxury. Tell us about Ida Martin.
Yeah, so Ida Martin was a patient treated for colon cancer in Chicago. She was on a Union Health Insurance plan. Her first chemotherapy treatment for a drug called oxaliplatin, it's a more than 20-year-old cancer medication, generic, relatively inexpensive on the market. Her first infusion was billed at more than $13,000. That's the amount that the insurance plan, her Union Health Fund, paid for her care.
To the hospital.
To the hospital. She went down the street to a clinic still within the same health system for her next infusion, and it was $134.
Jeez.
So we're just seeing the kind of huge differences
And do we
in
know
price.
what, like, a dumb way to phrase it, what's the list price of this thing? What is it?
Yeah, that is a complicated question.
I know.
But the Medicare, one way to think about it is for her dose for this drug, the Medicare rate, which is based on a benchmark Medicare determines to be the average sales price of this drug. So the average that hospitals can acquire this drug for, they use that number plus 6%, and they would have paid $35 for this dose.
So you spent a lot of your reporting really digging into trying to figure out the pricing, like you said, and that's a Herculean effort because everything about this healthcare system is about, not being transparent, about, having your leverage points and getting what you need. But I remember that under the first Trump administration, they were pushing for more transparency. They wanted hospitals, they wanted insurance companies to reveal their prices. Did that get anywhere?
Yes, it did. And there is actually a lot more price transparency now than there was before that policy, which started under Trump. It was continued under the Biden administration. It is sort of, I would say, fits and starts. It is imperfect. A lot of the data is difficult to interpret, but and incomplete. But it is much better than where we were a decade ago. And some of the reporting and analysis we brought to this piece wouldn't have been possible without some of those regulations.
Fair enough. John, really appreciate your joining us, and it's a great story. I think a lot of people can relate to it, and anyone who has to get medication through
And John's
insurance.
story, this is the 5th story in a series about how the hunt for profit can harm cancer patients. And you can find those stories on the Bloomberg Terminal and Bloomberg.com/bigtake. And that is there's a rule of thumb out. I mean, there's definitely a feeling out there, particularly among cancer patients, that this thing is, the incentives here
It's
are
a big
not,
racket?
It's a big racket. It's a huge business. And so the incentive for a cure per se, I don't know.
What is the series called? Cancer Capitalism?
Capitalism.
Okay, Cancer Capitalism.
Good
Great stuff, John.
Yep.
Thank you so much.
Thank you.
All right, let's talk a little bit about company news. CarMax coming out with some information that is discouraging for those who are hoping that the economy is getting better. CarMax is flagging some margin pressure. And certainly, we already know that new car prices are expensive. Used car prices have gotten really expensive as well. Craig Trudell is Bloomberg's Global Autos editor. He joins us now from London. Craig, what did we learn from CarMax?
Yeah, these are some soft numbers from CarMax, and it's not a huge surprise in that they actually just had some pretty substantial management changes quite recently, where they warned that sales were going to drop for this quarter that they just reported this morning, and the outlook for the coming quarter is also pretty weak. I think there's definitely some pressures that you alluded to, that is sort of industry wide of pricing is pretty it is very strong, but questions about just, how sustainable that can possibly be. Real questions about, lending practices and maybe some need to kind of tighten up standards on that front. And then I think there's also some sort of idiosyncratic issues with CarMax where you have, the Carvanas of the world or Amazon even, moving more of the car buying process, at least for used cars, online, and that pressuring a used car retailer like CarMax.
Yeah, I'm just looking at the stock here, Craig. It's down 50% year to date. So, I mean, some of those competitive headwinds you mentioned are pretty significant. Craig, just talk to us about the used car market in general. I read something recently, I think maybe the average age of a U.S. automobile is like 12 years or something.
Yeah, I mean, and this has been like this long-term trend where we've seen, consumers hold on to their vehicles for longer. This is, of course, a positive if you're a manufacturer to some degree, in that it sort of speaks to, the idea that the cars you're making are sort of, built to last, and yet it is also a demonstration, I think, of a lot of trends. One of them being, affordability is so much more of an issue for people buying new vehicles, that we're seeing more and more consumers being priced out of the new car market. And so you have, consumers who, it's taking them longer to pay off the loans on their cars. In some cases, they're underwater, for quite some time. And that is really leading to these trends that we haven't seen before in terms of term loan lengths being longer than they've ever been. The sort of 5-year car loan is now the 7-year car loan, if you will. So these trends have been sort of longstanding, but have been really fascinating to watch. It becoming sort of the new norm.
Yeah, because the affordability is really an issue. I mean, just the average price of a car is so much higher than it used to be. Or an automobile so much higher, because that's, I guess, what people want to buy and drive the big trucks and so on. Can CarMax fix its problems, do you think? What's the feeling out there?
Yeah, I mean, I think, I mentioned the management changes that have been made. I do think they also, maybe don't necessarily get a ton of credit for the idea that they have, sort of up their game online, at least to a degree. I think Carvana manages to kind of, portray itself as this like entirely online company, and yet, it has substantial sort of, real world, retail presence as well. I think Amazon has been, this long time sort of boogeyman if you're, following this space, in that if they enter this space more meaningfully, it spells trouble for both of those companies potentially. And yet, it's been sort of patchy, their ability to crack this market. We've seen Hyundai sort of move first and Ford follow recently. I think if we see more of those dominoes start to fall, where more manufacturers and brands put their used cars on Amazon, that would be, reason for concern, I think, going forward.
Hey, how about specifically, Craig, for used Teslas? Where do they go?
It's interesting. They actually, do end up with the likes of CarMax or Carvana. You do, of course, have a unique circumstance here, where because Tesla owns its stores and is apart from the rest of the industry in that regard, they do try to, at least to the degree they can, get sort of vehicles returned to the company, but it's not necessarily in their control, right? If you or I want to turn in our Tesla and buy from elsewhere, that car is ours to own, and we can take it to, say, a Chevy dealership and use it as a trade-in. So they don't have total control of that.
Yeah, and Craig, boy, you mentioned Carvana there. That stock is up 3.5% today, but it's up 127% year to date. What's the story there? Is it just, what CarMax is losing, maybe Carvana is gaining?
I think there's some of that. I also think with Carvana, it's just been this, kind of story stock. It's sort of the Tesla of car retailing, in that it's very volatile. Just a few years ago, we were seeing that stock just absolutely rip during the pandemic. They went through some boom times and then really had this absolute collapse where there were concerns about whether or not it was a company that was going to survive. So I think they're coming back from those darker days, and it's really been a roller coaster the last half decade.
And we got some big news, Craig, recently, Ford taking that big write-down. What's been the kind of the fallout from that? Is that, to me, it just felt like that's a big step backward for the whole EV movement here in the U.S. What's the fallout?
Yeah, I think, the U.S., the electric vehicle transition in the U.S. is really, sort of a negative story that keeps sort of getting darker, I guess. With the policy outlook that we have under the Trump administration, we don't have vehicle tax credits. We don't have a credit system that has been so important to Tesla for so long, where if you don't comply with fuel economy or emission standards, you can sort of make up for it by paying for credits from Tesla. That's gone away. The outlook for EVs industry-wide is bleak, and I think you also have to some degree, sort of wear it if you're Ford. I think they tried to make this concerted effort to compete with Tesla, and they had some failures on their own part as well.
Rachel, Craig, thanks so much. Appreciate it. Craig Trudell covers all the auto industry stuff for Bloomberg News. He's based over there in London. Some red headlines crossing the Bloomberg terminal. This is from Blue Origin. We are standing down from today's mission. So Blue Origin delays the launch of a crew on a space tourism trip. So they were at that hold at T-minus 58 seconds, so they're going to stand down for the day. We'll have more reporting on that. More earnings out there, this time from our friends at Darden Restaurants. Put out some, I think, surprisingly pretty good news out there. Let's check on Rachel Fuller. She covers the restaurants for Bloomberg News. She joins us here in our studio. Rachel, what did we hear from Darden today?
Yeah, so the company has done well today. It saw same-store sales rise. It actually raised its sales forecast, and stock is up as much as 4.5% today, which is the biggest gain in almost 7 months. And I mean, while sales are up, though, its profits have kind of taken a hit because of high beef prices. Yep. We've been hearing about that. That has affected their earnings for a little bit, but now they do expect beef prices to hopefully come down in the near future. Okay.
I guess their fast casual is kind of their stuff. So like, I'm sitting down, I've got a waitress, I'm doing all that stuff, but it's talk to us about their brands and what they're saying about their brands.
Sure, yeah. So I guess they would call themselves a bit more casual dining. Okay, yeah, than fast casual. I guess, this industry has their terms. But yeah, they're actually kind of saying that it's actually still been pretty resilient. Their target audience are these like middle and high income customers, and those haven't been so much affected by the economy. Maybe they're a bit more worried, but that hasn't really stopped them from spending. And they see these restaurants as kind of a treat to them. And for many consumers too, I think they're starting to see these restaurants like Olive Garden and Longhorn Steakhouse as a place where they can kind of get pretty good food for a pretty good price right now, especially when you see places like Kava and Chipotle, which those are your fast casual places, and they're pretty expensive now with inflation, and so the comparison is like as a consumer, why don't I just pay a little bit more and I can get a better experience at an Olive Garden?
So they're raising their full-year forecast. Is that more on the revenue side, or is that costs, or what are they doing there?
So they actually increase their same-store sales, the comparable sales, and so they do expect consumers to keep coming. They have other tools in their belt to kind of keep drawing the consumers. Like they introduce like smaller portions. They are on Uber Eats now, but yeah, they actually maintain their earnings per share guidance just because of commodity prices.
So again, what are some other? Are you seeing differences within the restaurant industry, from the lower end to the higher end, about just sales trends, how their customers are doing, or is it a different discussion?
I think it's a different discussion. I think we've heard a lot about how a lot of the fast food chains, a lot of the fast casual chains, they're still getting hit by your lower income consumers kind of pulling back, like inflation and commodity prices are high, whereas your casual dining restaurants, they seem to still be pretty resilient. Like Chili's is another example. They're still able to draw that consumer, who are still able to spend a little bit more.
So as a reporter covering the restaurant industry, you got to get out of New York City because we don't have a lot of that stuff
that's
here.
true.
So you got to travel around the country, right? Go to where the Cracker Barrels are and the Chili's are.
Yeah, you definitely have to. I think for most of us, I mean, in New York City, unfortunately, you have to try to get into Times Square just to get that buy one, get one pasta, which is not the most fun.
Yeah,
experience.
exactly. So what's the format, what's the buzz within the restaurant industry these days about, like, maybe the format, or is there a new cool company? Like, for a while there was Shake Shack and all the burger stuff and the smash burgers and all that stuff.
I mean, I think Chili's was the cool company for a bit. You know, they had really good social media. You know, a lot of their items were going viral. I think with Olive Garden, you know, I think what we've seen today is the popularity of smaller portions seem to be something that consumers are gravitating towards. You know, especially with some of them, you know, going on weight loss drugs, some, you know, becoming more like health conscious. You know, this might be actually a good play for them.
Yeah. So was that ever a thing with the GLP-1 drugs in restaurants, or is that faded?
I think they're still trying to figure it out. I think, you know, I think we are still trying to figure out too, like, how many people are actually really going to go on the drugs, how, you know, are people going to go off it? I think they are also watching it. They did say they are slightly affected, like they're seeing some diners cut back on appetizers and desserts, but they also say that it's mostly alcohol, which we have, that they're pulling back on, which is the longer term trend.
All right, Rachel, thank you so much. Appreciate it. Rachel Pua, earnings specialist, Bloomberg News, joining us live here at our Bloomberg Interactive Broker Studio, talking about some decent numbers out of Darden restaurants here today. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. Looking at the markets here, even though David Kudla said the data point we got today, the CPI is, in his words, kind of worthless, that's not what the market's saying. The market's certainly reacting to that, and maybe it's a bounce back from, you know, a little bit of selling pressure we've had over the last 4 or 5 sessions. But the S&P up 1.25%, that's 84 points. The Dow's up 300 points, that's about 0.6%. But the tech-heavy NASDAQ, as they say, up 435 points, 1.9%. So some big moves there. The volume today is kind of right in line with historical levels. No panic or crazy buying, but still, there's buying across the board there. We see that in the VIX, which is lower, sitting right at 16 right here. We're going to have more coming up. Bloomberg Radio with the latest market news coming up right now.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. The government reports consumer prices last month rose 2.7% from 1 year ago. That's a better showing than September, when they rose 3%. CBS's Kelly O'Grady.
It doesn't mean prices are dropping. It just means that they are rising at a slower rate than they were. You peel back the onion, there were a number of products, though, that actually did see a price decrease. But then on the flip side, a lot saw a huge price increase. Beef, as people are thinking about their holiday dinners, were up over 15%. You also saw electricity, utility gas, fuel oil.
The report comes hours after President Trump's primetime defense of his record on the economy and other major issues. CBS News White House correspondent Weijia Jiang.
The president insists that his economic policies are working, and any wins that have happened so far since he came into office in January are a result of his decisions. He also took a lot of time to make an argument against his predecessor, former President Joe Biden, and how Biden's policies, according to Trump, are the reason why there are any economic problems right now.
House Republicans passed a health care plan that does not extend Obamacare subsidies, and CBS's Caitlin Huey-Burns says that prompted a mini revolt.
We saw 4 Republicans buck their party leadership and support that discharge petition to essentially force a vote on the House floor to extend those Obamacare tax subsidies. Now, House Speaker Mike Johnson told us last night that according to House rules, you need 7 days at least to consider any sort of discharge discharge petition, so he won't be able to bring it up until the next year.
Health Secretary Robert F. Kennedy Jr. has just announced new proposals that would effectively ban gender-affirming care for transgender youth.
We're done with junk science driven by ideological pursuits, not the well-being of children.
Now to Boston, where just days after being convicted of murdering his wife, Brian Walsh was sentenced.
The jury, having returned a guilty verdict on charge 1, murder in the first degree, he was sentenced to the state prison for the term of your natural life.
Anna Walsh disappeared 3 years ago. Her body was never found. Prosecutors relied on Walsh's online searches about dismemberment and disposing of a body to secure the conviction. Pope Leo today named a fellow Chicagoan, Bishop Ronald Hicks, to be the next Archbishop of New York.
I very much look forward to working closely and collaboratively with the priests, the deacons, the religious, the lay leaders of this archdiocese.
And checking Wall Street, right now the Dow is up 274 points. The S&P is up 79. This is CBS News. The pot increases in a major lottery game.
Check your Powerball numbers yet? Sorry.
Tonight we have our life-changing jackpot.
You are not a billionaire. No one won last night's $1.25 billion prize. That ups Saturday night's stake to $1.5 billion. The last time someone won the game was in September, when 2 players split $1.7 billion. The next drawing will be just before 11 p.m. Eastern in the Florida Lottery Draw Studio in Tallahassee. Tickets are $2 to play. Odds of winning, 1 in 292.2 million. Deborah Rodriguez, CBS News.
President Trump has refashioned a West Wing walkway he calls the Presidential Walk of Fame, with plaques that include references to sleepy Joe Biden and call Republican icon Ronald Reagan a fan of a young Trump. They call Barack Obama one of the most divisive presidents in history. Steve Kathan, CBS News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
A day after the president says prices are dropping, he gets the evidence. Welcome to the Thursday edition. As the latest CPI shows, prices rising at the slowest pace in over 4 years. We're going to get the latest from the White House. We check in with Bloomberg's Tyler Kendall, and we'll look under the hood in this report. Not everything's going down. When we spend some time with Bloomberg's Michael McKee, the White House looking to private business for cyber help, defensive and offensive. We're going to talk with Bloomberg's Jamie Tarabay, who got the scoop. And generations of Republican orthodoxy up in smoke today as the president is expected to sign a rescheduling of cannabis. We will inhale with our political panel. And it's all after a look at Wall Street. Charlie Pellet has the latest on the markets on a Boppo day here, Charlie. Is that you, Santa Claus?
Indeed. Look at that. Dow, S&P, NASDAQ, a lot of green right now. We have got the S&P 500 index as we get right to the numbers here, up 70 at 67.92, up by about 1%. This after data showing inflation cooled at a startling clip last month. That ignited stock and bond markets. The Dow up 219, now up 0.5. Again, the S&P up 1%, while NASDAQ right now higher by 1.6%. The NASDAQ 100 index doing a little bit better, up 1.7%. And the Bloomberg Mag 7 index outperforming, up by 2.3%. The 10-year, 4.11%. The 2-year, 3.46%. Gold now at $43.47 the ounce, up 0.2%. West Texas Intermediate crude oil up 1%, $56.51 a barrel. And Bitcoin up 1.4%, 87,200 now on Bitcoin. Underlying inflation rose in November at the slowest annual pace since early 2021. Reaction to the report and what it means for consumers from Erin McLaughlin, senior economist of the Conference Board.
Obviously, even within public policy and elections, the concepts around affordability are still being discussed. You know, for American consumers, food costs more, insurance costs more, housing is still, you know, double what it was 7 years ago. And so in medical costs as well, which I don't think we spend enough time talking about. So those really big costs are still weighing on the consumer.
Erin McLaughlin of the Conference Board. Yes, we'll have a whole lot more on the CPI report with our Michael McKee coming up in just a moment. Bottom line here, stocks higher though. S&P up now by 1%. Micron after earnings. Micron Technology, it reported last night, up now by 11.9%. You recall last week we did hear from Oracle. Oracle shares up by 0.8%. Broadcom up by 0.3%. Both Oracle and Broadcom sold off after their earnings reports. After the close of trading today, FedEx and Nike. I'm Charlie Pellet. Balance of Power continues now. Back we go to Washington once again. Your host, Joe Matthew.
All right, Charlie, thank you. Yeah, we're looking forward to another busy after-hours session. Romaine Bostick will have that for us in the late edition of Balance of Power. Could Nike have good news? We'll find out together. Welcome to Thursday. You made it to the little Friday edition of Balance of Power here on Bloomberg Radio. Satellite radio channel 121 and always streaming live on YouTube. Find us if you want to watch the radio on TV by searching Bloomberg Business News Live. Yeah, you made it to Thursday, and we're brushing out the cobwebs after a late night here in Washington. The president speaking in prime time, and he will potentially hold forth later on today. I'm looking at the guidance from the White House, signing an executive order, 1:30 p.m. Eastern time. Well, that's during the show here, and you know what they're saying. This is going to be the big cannabis EO, rescheduling marijuana, which we'll discuss a little bit later on with our political panel. He's got a Christmas reception on the calendar as well. I think my invitation got lost. I don't know about you, producer James, but I'll keep looking. Now, if I learned anything last evening, I'm going to take a cue from the top here, take a cue from the President of the United States. This is 2025. There's a whole new style here. And so I'll begin the program by telling everybody here that I just inherited a mess from Paul Sweeney, and I am fixing it. We're bringing this network back from the brink of ruin. It's not done yet, but we're making progress. That was the message from the president last evening. Listen.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history. 1,450,000 military service members will receive a special, we call, warrior dividend before Christmas. I'm also taking on the gigantic health insurance companies. I will announce some of the most aggressive housing reform plans in American history.
The president speaking to the nation in prime time from a Christmas-adorned White House, raising the question in living rooms across the country, why are we yelling? He was actually distorting the microphone at times, cranking through the copy. You barely heard a breath. Clearly trying to display high energy in a room that had no audience. And so we've been spending the last couple of hours dissecting not just the language, but the optics of what Americans were treated to last evening. We're going to have more on this a little bit later on with our political panel. But let's go to the White House right now, where they're still recovering from the big speech. Tyler Kendall is on the North Lawn on a chilly day in Washington, our Washington correspondent. Tyler, the White House thinks this was a slam dunk, to be clear, right?
Right, Joe, and I think we should also say that we should offer Paul Sweeney a defense there, because you did encapsulate exactly what we heard from President Trump. He really did blame his predecessor, which is something that we often hear from this White House, which is interesting because we know the administration was trying to use this platform to frame its messaging, because it may seem like we're far away from next November, but we are about to kick off into the new year and head into midterm season. But you're right, we heard from officials out out this morning, really praising this speech. And President Trump really used it to tout his policies from the last year and try to reassure Americans when it comes to the economy. I will say, though, we should point out that we also did hear from him that some of these policies that he's implemented this past year are going to take time to work their way through the economy, an argument often heard by his officials, like the Vice President J.D. Vance, who has urged patience, right? President Trump saying that the U.S. is poised for an economic boom next year, that some of those tax incentives in the One Big Beautiful Bill will come into fruition next year, that there will be a new Fed chair next year, and sort of pointing us forward. In terms of actual policy, we can get into, he of course hit on a lot of topics, but perhaps the most tangible new one is him announcing, as you heard, those warrior dividend checks that they're being called. These are payments to U.S. service members. He says are being funded by tariff revenue. They're already in the mail. He says they'll come in time for the holiday season by the end of the year. Joe, we should point out there are reports that this money was previously allocated and appropriated under the One Big Beautiful Bill. That's important when we're talking about some of the other initiatives that were floated, like tariff refund checks for the rest of Americans. That would need Congress to do separate appropriation if that was going to come to fruition.
Fascinating. Tyler, sounds like something's going on there in Lafayette Square. Is somebody on a loudspeaker? Are they trying to get on the air with you? What's happening?
I mean, maybe. It is actually a beautiful day here. The chill isn't that cold, and it's absolutely packed in front of the White House. There is a protester, a little bit muffled. I can't quite tell you what he is protesting.
No, that's fine. Well, I just, people wonder what the heck you sound like you're at an airport. I thought maybe it might be the construction site, but Tyler, thank you. We'll get back. Listen to that. It's wild over there. Producer James and I will have to go check this out after the program. I want to stick with this for now because we're delighted to have Michael McKee with us, and we're going to look at the CPI report. And we only have a couple of minutes to do this, but I need to get Michael's take on the speech last evening. He said a lot, Michael McKee. The price of a Thanksgiving turkey, he said, was down 33% compared to the Biden Thanksgiving last year. Eggs down 82%. Everything else is falling rapidly. Is that true?
No, but you wouldn't necessarily expect it to be true. I would point people to the fact checks in the major newspapers and other things today that have quite a long list of things that he exaggerated or lied about. But that's kind of par for the course. I think the most interesting thing is what Tyler was just talking about, and that's the payments to service members. That money was already appropriated as housing money for that they would have gotten anyway. So it's sort of like somebody walks into your house, sees the presents under the tree, picks one up and gives it to you and says, oh, here.
Interesting. 1776. The checks are going out. So we got CPI today, and I know that it's incomplete. So some people are calling this garbage. The White House is embracing it, I'm sure, because it came in a little bit better than expected. Can you take us inside the report here, Michael? Because it's one of these deals where the headlines are pretty great, actually, but we're seeing a lot of prices skyrocket as well, especially with food. Beef prices soaring here, coffee prices up 20%, banana prices up 7%. There are a lot of goods in the report that are being touched by tariffs. How do you look at this as a larger picture?
Well, it's kind of something you have to look through or look beyond. I could say I inherited this mess from Tyler Kendall, but it's basically because of the government shutdown, there was no data in October at all, and there was very little data in November. They had to go back and reconstruct it and find stuff. And so when you open the report, it's almost all blank spaces. And what they did was calculate the change from September to November, the end of November, on a year-over-year basis for things. So that's why we got the drop there in the headline and the core. But there's some statistical anomalies in there that are really bothering a lot of the economists. And the biggest one is for housing, which is the biggest component in the CPI. They assumed, it appears, that there was zero housing inflation in October, which, according to those who spend their lives buried in spreadsheets, would be impossible. It just would not have happened. And so at this point, there's a lot of questions about exactly what this is telling us. And I think we have to kind of wait till we get the December numbers, which will be a complete month. We get those January 13th to get a much better picture of inflation.
Well, so in our remaining moment or so here, is the conventional wisdom on point that this guarantees a cut in January?
That's the funny thing. Everybody's looking at the stock market and saying, the markets are overjoyed and planning on continual lower rates from the Fed. But when you look at the Fed funds futures, they're only pricing in a 25% chance of a January cut. That's up from like about 20% before this number. So it doesn't look like the people who are putting money on this are convinced yet.
Interesting. That meeting is going to be really something. It's the final week of the month, right? What data will we have between now and then? It'll help fill in the blanks.
Oh, we'll have a lot. We'll get the third quarter GDP, which we have not had yet, and we'll get PCE numbers updated, but also we'll have a new jobs report, new CPI, new PPI, and retail sales numbers. We'll have an idea of what the holiday shopping season was like. So the Fed will have a much clearer picture for the January 28th meeting.
Good to see you, Michael. You did a good job with that mess that you inherited, and I appreciate the time and the effort here. Bloomberg International Economics and Policy Correspondent. I don't know. I say we dug out of the hole. We are making this network better than ever before and faster. You know it. I know it. Everyone knows it. Jamie Tarabay is coming in next with her great scoop on what's happening at the Pentagon. They're reaching out to private cyber companies to help play offense. We'll have that story next, only here on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We are well off session highs. Stocks do remain higher. Traders are welcoming the slowest increase in consumer prices since early 2021. Right now, the S&P is up 51, 67.72. That is a gain of about 0.7%. The Dow up 66 points now, up 0.1%. The NASDAQ Composite Index, 23,000 even. NASDAQ right now is up 304 points, up by 1.3%. NASDAQ 100 Index doing a little bit better, up by 1.4%. And the Mag 7 Index, the Bloomberg Mag 7 Index, up now by 2%. 10-year yield at 4.12%. Spot gold, little change, down $5.50 the ounce to 43.32. West Texas Intermediate crude up 1.1%, 56.55 a barrel. And Bitcoin right now, 86,000 even. We got Bitcoin up by about 0.1%. Trump Media and Technology Group, that's the company behind Truth Social, getting into nuclear fusion. The company says it will merge with TAE Technologies. That's a closely held fusion developer founded in 1998 in a transaction valued at more than $6 billion. Shares of Trump Media and Technology Group, ticker DJT, up now by 34%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, thanks. Tell us again what we have after the bell, Charlie. It's Nike, and what's the other name we're looking at?
FedEx going to be definitely keeping, a real good indicator of what the U.S. economy is doing. FedEx shares, I mentioned right now, up by 0.5. Nike, we're going to find out about the turnaround plan. Nike right now up by about 0.5%. So two key reports after the close of trading. Can I just do one more earnings report for you? Micron, they reported last night up 11.8%. So certainly
jumping off the page.
Yeah, and in sharp contrast to what we saw out of both Oracle and also out of Broadcom last week. Oracle up 0.7 right now. Broadcom up by 0.2%. We got you covered.
Don't you feel great for selling Micron right before that report? Charlie, thank you. As goes FedEx, so goes the nation, which is why we'll be talking about it on the late edition of Balance of Power. We do power moves every evening with Romaine Bostick, one of the best things we do all day around here, and he'll square things away after the bell. Thanks for being with us on the Thursday edition. You made it to Little Friday, and we have a lot to talk about here in Washington. Our political panel is back together. Rick and Jeannie will be with us a short time from now, and we'll have more on the markets, by the way, when Charlie Pellet updates things in just about 20 minutes' time. This story jumps off the page, speaking of which, jumps off the terminal with a scoop that you're not going to hear about anywhere else. As usual, Jamie Tarabay is way ahead with the headline, "The Trump Administration Turning to Private Firms in Cyber Offensive." Yeah. You know, we ask this question a lot around here when we talk to cyber officials with the White House, smart folks at CSIS. What are our offensive capabilities? Can we do a Stuxnet around here? Can we turn the lights out in Moscow if we need to? Nobody ever answers that question. Have you noticed that? I get really long answers, but not really a sense of what we can do or what the country is interested in doing. Enter Jamie's story. The administration preparing now to enlist private companies in more aggressive efforts to go after criminal and state-sponsored hackers, according to people familiar with the matter. She's with us right now, Bloomberg National Security, Capital Influence reporter. Great work, great to see you. Are we talking about the CrowdStrikes of the world, the Palo Altos, or is this a different class of cyber company?
There's a different kind of company that you don't really hear a lot about, particularly people who've come out of the intelligence community. They've left NSA or CIA, and they create their own companies. And what they do is they have technology that they've developed that could be considered dual use, but they frame it as defensive tech. And so it's usually contracted to US Cyber Command, which is really the place where a lot of this offensive cyber normally happens. And they can deploy it for defensive or offensive means. But the fact is, once that contract is signed and the tech is handed over, the company does not then know what the government does with the technology. Yeah.
And these are privately held companies, not publicly traded companies that our listeners own shares of right now.
I don't think so, but you never know. I think that definitely this is the signal that this is sending is to industry that there's an opportunity here. So a lot of people are very excited about it. Some of them are extremely gung-ho, but others are quite reticent because it does get rid of that gray area where they can say that they're developing defensive use versus offensive use tech. But also because, if they do have shareholders or investors, for some people, they could be very leery about getting on the wrong side of that. There's a lot of risk inherent in the activity and in the operation. And so we still don't know any of the details, but there's been speculation, and I've been tracking this since April this year. So there's been a lot of conversations and chatter about what this would look like and what that posture is.
Well, we've got a lot of questions for you here. For starters, is the United States government not capable of doing this work? Do we have the brain power? Do we have the resources to do this on our own? Or is this clearly telling us that we don't?
We have the brain power. I don't know that we have the scale. And that is something that people who have left government will tell you, as well as people who are in government. And we saw this in the previous administration, the cyber workforce gap of 500,000. The new National Cyber Director, Sean Cancross, thinks now it's closer to 1 million short. And this is something where industry is saying we can bridge the gap. And that's really, you're dealing with adversaries, for example, China, which denies a lot of the cyber attacks, or Russia, which don't really see a divide between military and civilian, and they just throw everything they can or they want to at different targets. And this is combating not just all those nasty ransomware attacks that we've been reporting on for so long, but also the nation-state activity, which is the espionage, the sabotage, the intelligence gathering, the IP theft. So it's a whole of house approach. Very, very aggressive.
Wow, this is fascinating. Speak to us about the legality of this. Now, I guess if the companies don't know what you're doing with the software, that's the whole point, right? Because technically what you're describing is a new class of defense contractor. Are you not? Wouldn't Congress have to have say in that?
I think that we know for sure there's going to be at least one executive order once this strategy is announced sometime next month. But no one I've spoken to says that that's going to be enough. There needs to be legislation, because that EOs can obviously turn on a dime, be cancelled, etc. So that doesn't really give anyone any kind of real legal protection. It doesn't spell out or codify authorities or protections for people who want to be doing this. So it's going to be really interesting to see how the Hill takes it. And I know I've been reporting that there have been obviously investigations into what that policy would look like. But everyone that I've spoken to about this, people who have been very senior in the intelligence community, have come back to me and said the devil is in the details. We don't know what it looks like yet. So so we're still waiting.
Well, to that end, you write that a new national cyber strategy to be released by the Office of National Cyber Director will outline this plan that you're talking about. I'm picturing you in some sort of dark parking lot being handed a copy of. Have you seen this draft? What's it going to say, and when's it coming out?
There are 6 pillars under the strategy.
You've seen this draft.
It's 5 pages long.
It's 5 pages. Okay.
And it's being shown and shared to industry, think tanks, former government officials, former security officials, to get their take, get their feedback. Some of the wording may change, but the substance of it is going to be the same. And the thing that everyone was struck by was how short it was, but also that the first pillar in these 6 pillars was the offensive cyber and, quote unquote, unleashing the private sector.
Wow. So what do our allies think about this? And are they going to get in on this game? Will they start hiring these same companies?
So some of the conversations that I have had with folks overseas is that they have been really waiting for something like this. And it's going to be really interesting to see how the US threads this needle legally and what example or precedent that will set for its allies. I have people in the UK who are very keen to see this happen, people in Japan who are very keen to see this happen, people in Europe. But what it does say is that there's a sense of urgency. There's a sense of necessity of scale, and that everyone sort of feels like they've just been taking these hits for so long that they really want to start pushing back and doing it in a very aggressive way.
Does this create a new family of digital Blackwaters?
That's the risk, and I think that that's why everyone's waiting to see what the legality is, because right now, the way that it's sort of described to me is when private contractors go and work for an agency, they share the same keyboard. right? And now under this new policy, potentially they could be working off different keyboards, and they may even know who they're targeting. Or they could say, you know, go into this electricity grid and take this actor out of the infrastructure, like just out of the networks, get them out. So they'll know. They're not stupid.
Correct.
You know, and so,
hence the Blackwater.
but it also exposes them. So if I'm going after you and I've seen you in like a network and you see me and you're like, you know what, I'm going to go in there and I'm going to burn your entire architecture.
Oh my God.
So it does. So it has this. So the sort of the there's almost a kinetic response to this, but it also can. The fear that I've heard from a lot of industry CEOs who do have shareholders is the fear of, you know, people who are already on Putin's bad list, possibly being indicted or extradited if their companies are known to be carrying out this sort of activity for the government.
Yeah.
So there's this.
I can just imagine the congressional hearings a couple of years from now, right?
But it really tells you that there's so much that we don't know, but at the same time, there's so much that everyone is talking about. People have been looking at this in so many different ways. The idea of letters of marque, which is what privateers operated under during one of the American wars in the 1800s. I can't remember the date exactly, but what it allowed them to do was the idea that they go in, they disrupt the British Navy or whoever, and they take the booty, right? As in maybe this happens now. That has been dismissed by a lot of the experts, but a representative in the House has introduced a resolution regarding letters of marque. So it's not out of the realm of possibility.
This is absolutely, so this is the future of warfare.
Definitely one side of it.
Mike,
Cyber is a tool.
We spend so much time talking about spending billions of dollars. It's the first $1 trillion defense budget this year for all of this hardware that will purportedly be used in a war with China someday. When you're talking about a whole different level here, are these companies prepared to meet these requests? Because I'm guessing these would be monster contracts with the Pentagon.
There is $1 billion in the One Big Beautiful Bill under Indo-PAC that is meant for offensive cyber operations. The money's there, and industry. It's going to be interesting to see who steps up and who.
I bet you they're getting ready now.
Those conversations are happening.
Absolutely.
Like, I'm being told that they're happening, and everyone is waiting to see what the contracts look like. So we don't know yet.
Yeah.
We have to see.
I want to know who Jamie's talking to here. Now, just quickly, we've got about a minute left here. Are we talking about what I mentioned, something in the spirit of Stuxnet, turning the lights out, or is this about embedding ourselves in infrastructure the way China's done to us?
That's a really good question.
We don't know, maybe.
We will never know what NSA and Cybercom do for all sorts of reasons. They could be there right now. We have no idea.
This is too much. The call's coming from inside the House, and it's Jamie Tarabay. Great reporting. Jamie, thank you for bringing that to us. If you didn't know about this story, find it on the terminal and online. The Trump administration turning to private firms in cyber offensive. Now that we got you good and scared, we'll assemble our political panel next and reflect on the big primetime speech last evening. Did it help the president? We'll have Rick and Jeannie straight ahead on Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are pushing higher. CPI Thursday and data showing U.S. inflation cooled at a startling clip last month, ignited stock and bond markets. The Dow, the S&P, NASDAQ are all advancing. S&P right now up 0.9%, higher by 62 at 67.83. The Dow up 148, up 0.3%. S&P, to be sure, off session highs. NASDAQ up 1.6% right now, with the Bloomberg Mag 7 index rallying 2.3%. The 10-year currently yielding 4.12%, with a 2-year at 3.47%. Spot gold, little changed, up $3 the ounce to $43.40 now. West Texas Intermediate crude up 1%, 56.50 on WTI, and Bitcoin up 0.3%, 86,199 on Bitcoin. Underlying inflation rose in November at the slowest annual pace since early 2021. National Economic Council Director Kevin Hassett was on Fox Business this morning talking about the report.
It was just an absolute blockbuster report. You know, we before the numbers come out, we look at the forecasts from everybody we can find on Bloomberg. We've looked at 61 forecasts, and this number came in better than every single one of them. Not a single economist surveyed by Bloomberg got it right.
National Economic Council Director Kevin Hassett speaking on Fox Business this morning. Some Tesla owners are buying glass breakers and other accessories to help escape their vehicles in case the electronic doors malfunction. A Consumer Reports online petition has been signed by nearly 35,000 people calling on automakers to fix their electronic doors after numerous incidents of people being severely injured or dying when they were unable to escape vehicles. A Bloomberg News investigation found more than 140 consumer complaints to U.S. auto safety regulators relating to door handles on various Tesla models. Tesla shares are gaining now. They're up by 4.7% at $489.30. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. Balance of Power continues right now. Back we go to Washington. Once again, your host, Joe Matthew.
All right, Charlie. Many thanks. Charlie, we'll have more on the markets. See if we can keep the rally going here coming up at 1 p.m. Top of the hour, 1 p.m. Eastern, as we welcome our global television audience to the conversation. We're keeping tabs on what is happening on Capitol Hill, with John Thune, the Republican leader in the Senate, now saying that Democrats' 3-year ACA extension, this is the discharge petition we talked to Mike Lawler about, the one a few moderate Republicans joined to force a floor vote in the House. He says it won't pass the Senate. And frankly, that shouldn't be news because they already tried. Last week it failed, and that wouldn't probably change this week. So we're heading for the cliff. That happens in 2 weeks' time, end of the month. And there is some glimmer of hope here following the Republican plan passing last evening and the discharge petition that I mentioned. We're going to talk about all of this with Republican Congressman Jody Arrington, who is chair of the House Budget Committee, coming up at the top of the hour. We'll be joined as well by Democratic Congresswoman Sarah Elfreth of Maryland to hear from voices on both sides of the aisle on an awfully important matter. President Trump set to sign an executive order, or we're told at least, reschedule cannabis before our program is out, about an hour from now. Something we'll be discussing a little bit later on with our political panel. 6 p.m., he's set to sign the annual defense authorization spending bill in the Oval Office. Last evening, it was the diplomatic reception room, the venue for a primetime address from the White House, adorned with the Christmas trees and decorations, the president walking into people's living rooms to deliver a message, well, I guess on a lot of things, but mainly affordability and the fact that the guy before him made all of this a problem. President, as we mentioned a little bit earlier, starting with 11 months ago, I inherited a mess. That was the first line out of his mouth, and I am fixing it, he went on to say. The reviews have been interesting this morning. White House, of course, says he knocked it out of the park, and that's been the case pretty much from MAGA Twitter. The Atlantic described him as drenched in panic. The president racing through the script, barely taking a breath and speaking at high volume, right up on the microphone, actually distorting it at times. Axios calls it a fiery, combative president, insisting the economy is stronger than people think. Trump's speech, Mike Allen writes, was closer to a Festivus airing of grievances than a Christmas message of hope. A Festivus for the rest of us. Listen.
Here at home, we're bringing our economy back from the brink of ruin. The last administration and their allies in Congress looted our treasury for trillions of dollars, driving up prices and everything at levels never seen before. I am bringing those high prices down and bringing them down very fast.
18 minutes. They say it was the speech that Susie Wiles wanted him to give in Pennsylvania last week. Worth noting, did not hear the words hoax or con job with regard to affordability. So let's play it to the panel. I have intentionally not had a conversation with Rick or Jeannie. I wanted to save this for air. They were both watching, just like you were. And they're with us now. Bloomberg Politics contributors, Republican strategist Rick Davis, partner at Stone Court Capital. And there's Jeannie, Democracy Visiting Fellow at Harvard Kennedy School's Ash Center. All right, Rick, did anything change in this speech? And what were people thinking in their living rooms who don't follow politics every day?
Well, first of all, I'd like to say it was a beautiful speech in the sense that it was a really pretty location. I love the festive nature of it. It's different than most presidents do, where they show the long hallway with a red carpet. So, you know, kudos to the events folks at the White House for doing such a pretty thing. But I would say, you know, I think it was an attempt to change things. It was very clear that the goal of this speech was to get Donald Trump out of the hot box that he put himself in by calling affordability a hoax and the disastrous speech he gave in Pennsylvania that did the same. So clearly they were rocked by that at the White House, needed to get something done before the holidays. This was the one opening he had. They'll follow this up with a North Carolina visit. And with hope that he doesn't do the meandering, negative Donald Trump on the economy and on affordability. But I think they did accomplish that goal. He spoke about affordability in a way that you would pretty much want him to do it. But other than that, the balance of the speech was kind of a waste of time. I think, you know, even though it was a short speech at 18 minutes, I think he could have done the whole thing in 5, considering what I thought was the good parts.
Wow, okay. Lindsey Graham, ally of the president, of course, on Twitter. High energy, great delivery, grand slam, home run on making the case that the best is yet to come. Jeannie, is he right?
You know, Donald Trump came across last night. He was screaming. He was red-faced. He looked like he was some kind of prisoner who didn't want to be there giving the speech. And in fact, afterwards, he told reporters in the room that Susie made him do it. And I thought that was a perfect encapsulation as to what happened last night. He did not want to be there. He does not have the interest he said he had on the campaign trail of making lives better for all Americans. His interest is apparently retribution and attacking his opponents. And that's what he spent most of the speech doing. He started off on Joe Biden and he never got off him. And how does that help? He's been in office 11 months now. Everybody knows it is his economy. And much of the facts he talked about were not true. So I don't know what speech Lindsey Graham heard. This was not a home run. This was a home run if you are a Democrat and want to run against Republicans in the new year.
Wow. Okay. Rick, let's talk about style. You know, he was shouting and he raced through the script. Wasn't a lot of breathing. He was clearly trying to be high energy and impactful, and I get that. But did it remind us that Donald Trump needs an audience to be effective?
I could. As you point out, there was no audience for this. It was basically like a stage with only a few aides standing behind a camera. It was also a different kind of camera in the sense that the teleprompter was directly in front of him. Normally he likes to move that head back and forth, reading the teleprompter, driving the teleprompter operator crazy because he'll stop and tell other stories. The quote meandering that he likes to do, none of that last night. So it is not the Donald Trump that we have gotten to know. And again, I mean, I think you must punctuate it with this. I mean, I don't think Donald Trump in his lifetime has given a speech that didn't get to 20 minutes. I mean, that was really amazing in and of itself. And as you say, stylistically, rather than meandering, he rushed through this thing. I mean, it was, how quick can I get this done and, get back to my, watching the White Christmas episode. So, I mean, like, I really thought I was seeing a different guy up there. Maybe they got a doppelganger to call this one in.
When I got into the radio business, Jeannie, it was a really different experience than it is now. And everybody was fast talking and deep voices and whiz bang and lasers and the rest of it. And there used to be a term in the newsroom called news on a speedboat. That was literally what you were trying to deliver. It was insane. The president kind of did speech on a speedboat last night. Can you deliver stylistically, as you move away from the politics here, just as a communicator, can you deliver a message that lasts with voters on a speedboat?
You absolutely can if your heart is in it. And the problem with Donald Trump last night was the fact he was talking fast, obviously just watching and listening to him because he didn't want to be there. And that's what he told the pool reporters after. Susie made me do it. What he wanted to say was everything is great, everything is fantastic. If it's not, which the polls say people don't believe it is, then blame Joe Biden. That was his message. And that is not a winning message. And so that is the problem. You couple that with the number of misstatements, I think is the best way to put it, that he made on everything from inflation to unemployment to immigration to tariffs. I mean, the list goes on. And he simply cannot find his way back to where he was on the campaign trail, saying to people, I understand what you're contending with, and I am here to make it better. That message he has not been able to deliver since he's gotten into the White House. And so, yeah, you can talk fast and do it, but he was not able to do that last night. And so I think the big question is what happens in North Carolina?
That's right. Friday night, we're all going to be listening, see if it is a little more like Pennsylvania or was a little more like last night. I think we probably know what to expect here, but I wonder if you guys saw what the president did with the so-called Presidential Walk of Fame outside the White House colonnade, right outside the Oval Office. This is where he hung all the pictures of the presidents and put a framed photograph of an auto pen in place of Joe Biden. He's added plaques that add context and biographical information. There you go. If you're with us on YouTube, thank you, Cece. You see what I'm talking about here. It looks like something you'd catch in a museum. These are like brass plaques below the framed photos. In the words of Caroline Leavitt, the White House press secretary, as a student of history, many were written directly by the president himself. Indeed, Joe Biden's reads, Sleepy Joe Biden was by far the worst president in American history, nicknamed both sleepy and crooked. Obama. Barack Hussein Obama was the first black president, a community organizer, one-term senator from Illinois, and one of the most divisive political figures in American history. George W. Bush created the Department of Homeland Security, but started wars in Afghanistan and Iraq, both of which should not have happened. Bill Clinton served as Attorney General, governor of Arkansas, before winning the presidency in what was called a major upset over George H.W. Bush. In 2016, he writes, Clinton's wife Hillary lost the presidency to Donald J. Trump. Rick, taxpayers are going to have to pay to have these removed, right?
Yeah, I'm sure taxpayers have already paid to have them put up, and that should anger some taxpayers because it is an incredible waste of money. Look, if Donald Trump wants to write a history book and settle scores, I think it's great, right? Write it. You can even do it while you're president. I don't care. But then at least people who buy it with their own money, and he's not writing it with taxpayer money. The White House is an iconic building that should not be partisan in and of itself. And the fact that these are tacked up there indicates a different kind of role for that structure.
Jeannie, Ronald Reagan was a fan, he wrote, of President Donald J. Trump long before President Trump's historic run for the White House. Likewise, President Trump was a fan of his. Even Republicans get a backhanded compliment here.
That's right. I'm sure George Washington was a fan of Donald Trump's too as well, Joe. Listen, this is indicative of what we saw last night. This is somebody who is much more interested in attacking Rob Reiner, who is interested in putting up plaques, attacking his predecessors, who is interested in doing all kinds of things except dealing with the health care and the issues and the cost of living that people are feeling. That he rushes through.
I'm starting to think the speech didn't change any minds, at least on our panel. Jeannie Shanzano and Rick Davis will be back with us in our second hour with a lot more to talk about, including our conversation ahead with Jody Arrington, the Republican who runs the House Budget Committee. Straight ahead, only on Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
A glimmer of hope as we head for the cliff. Welcome to the Thursday edition as House Republicans pass their own health care plan. The same day, a petition to extend Obamacare subsidies got enough signatures to hit the floor. We're going to discuss the way forward and what might happen next year in this whole story, with subsidies set to expire in just about 2 weeks when we talk to Republican Congressman Jody Arrington, who's chair of the House Budget Committee, and by Democratic Congresswoman Sarah Elfreth of Maryland. They'll both be here coming up this hour. The latest CPI out today shows prices rising at the slowest pace in over 4 years. We'll discuss with Liz Pancotti at the Groundwork Collaborative, looking under the hood at the data with analysis from our political panel. Rick Davis and Jeannie Shanzano are with us for the hour. And we start, as always, with a look at Wall Street. Not bad today. Charlie Pellet has the Thursday trade live from New York. Hey, Charlie.
Well, hello there, Joe Matthew. Indeed, still in the green. You alluded to the CPI report. We did get data showing U.S. inflation cooled last month. That did ignite stock and bond markets. And right now, the S&P off session lows, off session highs, but it's up 70, 67.92, a gain there of 1%. Dow Industrials up 183, up by about 0.4%. The Nasdaq Composite Index surging 394 points, up 1.7%. The 10-year yield, 4.12%, with a 2-year at 3.47%. Gold is down 0.1%, 43.32 the ounce on the precious metal. West Texas Intermediate crude, 56.41 a barrel, up 0.8%. And Bitcoin is up 0.5%. Bitcoin, 86,340 right now on Bitcoin. Helping spur the rally today, Micron Technology shares are up 12.5%. The largest American maker of computer memory chips rose by the most in 8 months after the company gave an upbeat forecast for the current quarter. Now, this warm reaction sets the company apart from both Broadcom and Oracle, which jarred shareholders last week after their results. Oracle up today by 0.7%, and Broadcom up by just about 1%. Warner Brothers shares falling below Netflix's $27.75 offer price. Traders are betting that what once looked like a potential bidding war for Warner Brothers Discovery is turning into a one-horse race, with Netflix winning out over Paramount Skydance. Again, recapping, stocks higher, S&P up now by 1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues right now. And back we go to Washington. Once again, your host, Joe Matthew.
All right, Charlie, many thanks to Charlie Pellet. He'll be watching Wall Street for us throughout the hour here with another update on the markets in about 20 minutes' time as we talk politics here in Washington on the Thursday edition of Balance of Power. Thanks for being with us on Bloomberg TV and radio, streaming live on YouTube and on your satellite radio at channel 121, with big questions about health care and what will happen at the end of this month with enhanced COVID-era Obamacare subsidies that you hear us talk about every day set to expire. We do have a bit of a status update. A lot happened yesterday, and you heard much of it take place here in real time on Bloomberg. We spoke with Mike Lawler just a short time after he and 3 other moderate Republicans crossed the aisle to sign a discharge petition that would force a vote on a 3-year extension, a clean extension. This is the Hakeem Jeffries discharge petition, and so that was a pretty big deal that they walked across the aisle on this. But there is more. You know, the House Republican leadership also had its own bill. It emerged Friday night. We've talked about this as well. It does not extend Obamacare subsidies, but it did pass on a party line vote, 216-211, while you were out at the holiday party last night. So what's going on here? Is it possible to avoid the cliff? Senate's getting ready to go. Even if these things pass now, you can't do anything about it till January, right? That's when the discharge petition would see action on the floor. Either way, Hakeem Jeffries, the Democratic leader in the House, thinks everybody ought to stay until it's done. Here's what he said.
Under no circumstances should the House of Representatives adjourn until we successfully extend the Affordable Care Act tax credits for tens of millions of Americans. The American people deserve a vote today, not tomorrow, not next week, not next year, today.
Of course, that would require a Christmas miracle. And that discharge petition I mentioned, that's 7 legislative days before it hits the floor. That brings us likely well into January. So let's figure out the path forward here and exactly how we're going to fund the government past the end of the month in January. Will there, in fact, be regular order? Jody Arrington is with us right now, live from Capitol Hill, the Republican congressman who chairs the House Budget Committee, the voice of Texas, with us on Bloomberg TV and radio. Mr. Chairman, welcome back. It's great to have you on Bloomberg, and I'm wondering what you see here with it, what seems like a dozen different bills to attack health care reform or extend subsidies to some extent. Is there any chance of a deal coming together between now and the end of the month?
Not one that's going to become law, Joe. Let me start by saying Democrats created this additional layer of COVID or Obamacare subsidy during COVID, and then they extended it for another 2 years. So they had total control of Congress. They had the White House. They didn't extend it then. They didn't make it permanent. They did make the green energy tax subsidies for corporations permanent. So they had a choice. So these are expiring as designed, just like every other COVID program has wound down as COVID is behind us. So the other piece that is important is the COVID subsidies and the underlying program, Obamacare, has increased deductibles and premiums every year. So the question should be, how do we make health care affordable? And at least the bill that was passed, I don't think it will become law, but the Republicans passed out of the House last night, will reduce premiums, according to CBO, by 11%, save $30 billion. Those are the things we need to be working together on, not throwing good money after bad and propping up a failed system.
Well, you know, Congressman, we've even had some Democrats on the air here who say you're right. This is a program that needs reform, but we also need a bridge, whether it's a year or two, whatever the extension needs to be, so people don't get bit when they wake up the first morning in January with what I realize are already higher premiums. But you've got open enrollment that goes to the 15th. Is there a world in which that could be extended and a shock absorber essentially could be put on?
You know, I don't believe so, Joe, and I got to tell you, my position is we already have tax subsidies built into Obamacare that effectively subsidize people at the bronze level at 90% of their premiums. So that's the subsidy that taxpayers front at about 60 to 70 billion a year. Now that cost has doubled when you add these COVID-era subsidies. So you would have to do a lot. The Democrats haven't included any of these things, but you'd have to put an income cap so you're not subsidizing wealthy people. You've seen the CBO reports and the GAO reports about the tens of billions of fraud, the millions of ineligible people. So I understand some of my colleagues wanting a bridge, but the point is we're well beyond COVID. They designed these things to wind down and go away. We should focus on the things like we did in last night's bill, close the loophole that allows insurance companies to actually direct people to higher cost coverage plans that they don't want or need, and that will start reducing the premiums and the cost of care. And there are plenty of other ways to do it, many of which, Joe, are bipartisan. So I think we throw plenty of subsidy. Unfortunately, we're throwing the subsidy at the wrong place. It's to the insurance company and not to the individual and family. So we should work together to make ACA actually affordable, the private market affordable, and bring costs down altogether.
You saw the Republican bill in the Senate, inspired by Senator Bill Cassidy, that features health savings accounts. Mr. Chairman, is that an idea that we should be considering in the House?
Absolutely. We actually we expanded health savings accounts in the big, beautiful bill that passed. We should do more, again, to provide federal assistance to people, let them keep more of their money to provide health care for their families and not line the pockets of insurance companies. They're the only ones that have actually done well since the advent of Obamacare. So there's that. There's the health reimbursement accounts. It's similar, where small businesses can provide these health savings accounts for their employees. There are things that we're doing now that are just plain ridiculous. We're paying hospitals more for the same outpatient procedures that we pay physician groups to do. And if we equalize those payments, by the way, the outcomes are the same. If we equalize those payments, we'd save $150 billion, and we'd stop this consolidation of physicians in one big hospital, big insurance, big pharma. These monopoly forces are making the markets not competitive, and they are not giving the choices to the consumer and patients. Yeah. And that, at the crux of it, that's what's the problem is. Too many mandates, too many loopholes, too many regulations, too many taxes. We got to clean it up and let competitive markets do what they do best, and that's providing the best quality at the best cost for a product for consumers.
You're the chairman of the Budget Committee, of course, Congressman. What are we in for here when you come back in January? Because there seems to be a little bit louder talk, and I realize Chuck Schumer was very clear he doesn't want a government shutdown, but there's talk about sleepwalking into a shutdown again with a lack of trust between Democrats and Republicans. Maybe we want to park that over here from now, because I know that you're hoping to see regular order come back into fashion on Capitol Hill. Do you have enough time to write a budget and pass it?
We do, and what I would hope is that we could actually use budget reconciliation again, because unfortunately, Joe, I don't think that Democrats and Republicans are going to be able to work together. I think many of the Democrats, not all, but the leadership wants health care to be a wedge issue for November. There are others who want to actually address it. We have different ideas on that, but Republicans have the tool that actually Democrats use to create these COVID-era subsidies called budget reconciliation. It gives us the simple majority in the Senate, so we don't need Democrat support. We did that with the big, beautiful bill. Let's do it to make health care affordable, not just lower taxes, not just better energy policies, not just cutting spending so we can actually reduce the pressure on the higher prices and inflation. Let's make health care affordable. That will bring costs down, make life more affordable, cost of living will go down, things will get better, but health care's got to be addressed, and I think the only way to do it, Joe, and unfortunately, because I think it's better when we can work together, but we shouldn't apologize for using reconciliation and having taking a unilateral approach as Republicans if we believe in our policies, and I certainly do.
Well, it gives us a bit of a sense of where we're heading in the new year. Mr. Chairman, it's great to have you back. Thanks for being with us. He's chairman of the Budget Committee in the House, Jody Arrington of Texas. On this CPI day, I know you're having trouble following the data. Everyone is right now, because it's dropping at various times still because of the government shutdown, the longest in history, and we don't even have a complete view. Not all the data were collected here, but we've got a number for November on inflation in this country. Dare I say affordability? The president talked about it a lot last night, and what we have here is the headline he was hoping to read. Core CPI easing to a 4-year low in shutdown-impacted report. First person we wanted to call today was Liz Pancotti, the Managing Director of Policy and Advocacy at the Groundwork Collaborative. She's been digging through the numbers since 8:30 this morning, with us now live on Bloomberg TV and radio. Liz, it's great to see you. Do the numbers, when you look under the hood, fulfill the headline?
You know, it's tough to see what we're looking at under the hood today, given the missing data that we've got from BLS, given the effects of the government shutdown. It feels a little like we are flying blind. You know, the headline number ticked down a little bit. I assume the president had seen that by the time he gave his primetime speech last night. But when we look under the hood, there is a little bit of funny business going on. For one, the BLS imputed zeros for shelter inflation in October, giving missing data. Unfortunately, as a result of that and some other collection issues, we probably won't have a really solid, accurate accounting of inflation until probably the April print as things iron out. And so I think as the Fed looks at this ahead of their January meeting, I think we're probably set to really look at that January print for December data and potentially even into February with that January data to see things iron out.
What worries you in here? I know the core number impressed a lot of people. Markets are feeling pretty good about it. We're talking about a rate cut in January, but you're still at beef prices up 21% in November, coffee up 19%, banana prices up 7%. Real people buy this stuff, right?
Yeah, that's right. I think especially as we head into the holidays here, we are really seeing grocery prices affect people. Utility bills are up, energy is up 6.9%. I think those pressure points in the winter are always a little bit tougher given, you know, large holiday gatherings and high heating bills, especially in the colder regions, the Northeast and the Midwest. Those are really going to take effect on people. At Groundwork, we had analysis out just 2 weeks ago that showed that popular holiday gifts are up 26% this year, given so many of those are imported from China and tariff rates are just really high. So while the headline number, you know, might seem a little bit optimistic, as we look at what expectations are, you know, the New York Fed's November survey, Conference Board data, University of Michigan, all of those are showing that American families don't feel like relief is coming.
So does the market have this right about January, or does the Fed need to see more?
I think the Fed will want to see more. I think given the missing data, we'll see where PCE comes in and what was imputed for that. But just given the lack of data we have for October, November, I think the Fed is going to want to see things iron out a little bit more. Also with the labor market ticking, the unemployment rate ticking up earlier this week, I think that the combination of those things will probably see the Fed hold off in January to get a little bit more information under our belts. Additionally, I think as part of the price collection for November, a lot of that data was collected during Black Friday sales and other promotions. And so just waiting to see what price decreases or lower price increases stick. I think the Fed will want a little bit more information before making a policy move.
You stay up late to watch the president last night, Liz?
I did, though it wasn't a very long speech. As you said, we're running on a speedboat, I think, a couple minutes ago.
That it was a speech on a speedboat, but he talked a lot about what you and I are talking about. And in fact, ran through prices. He had Thanksgiving turkey down 33%, eggs down 82%. He said everything else is falling rapidly. Here's a sense of the president in his primetime address.
We're bringing our economy back from the brink of ruin. Wages are rising much faster than inflation. There are more people working today than at any time in American history. 1,450,000 military service members will receive a special, we call, warrior dividend before Christmas. I'm also taking on the gigantic health insurance companies. I will announce some of the most aggressive housing reform plans in American history.
Okay, a lot of that. We're bringing the economy back from the brink of ruin. He said there, Liz, wages rising faster than inflation, more people working today than at any time in American history. Is all of that supported by data?
What we saw in the jobs report this week, we saw the unemployment tick up a little bit. We have seen retailers say that they are hiring a lot fewer seasonal employees this year. Real wages are not looking so hot. I don't see a lot of truth in the president's statement. It was kind of funny. I think Mike Conzel pulled the spreadsheet of CPI data and just sorted by descending to see what price points he pulled out. I was confused by airfares and sports tickets, but I thought those were funny ones to pull out. And apparently, if you just sort by the biggest numbers, that's where you got them. I think for most families, they're not even thinking about the price of airfares or sports tickets right now because they're struggling to pay the grocery bill and the electric bill.
Oh, you're making me want to fly somewhere. Just 30 seconds here left. Liz, are you still waiting for the real impact of tariffs because of front running? When does it show up?
Yeah, I think we're seeing this in Christmas presents right now under the tree. Harvard Pricing Lab shows that goods prices are up about 7% from their pre-Liberation Day trend. And I think Goldman still has the estimate at about 55% of tariffs being passed through. I think we are at the tail end of those inventories that were kind of inflated, rushing ahead of that Liberation Day. The president has still not figured out exactly what's going on with China. So TBD there.
Yeah. TBD. Could be an interesting new year for a lot of reasons following our conversations with Liz Pencotti. Thank you, Liz. And Jody Arrington. Better fasten the chin strap. Our conversation coming up with Congresswoman Sarah Elfreth, the Democrat from Maryland, on Bloomberg.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks advancing. The Dow, the S&P, NASDAQ solidly in the green. CPI Thursday. We've got NASDAQ up now by 1.8%, higher by 407 points. Data showing inflation cooled last month, igniting a stock and bond rally. Right now we have got the S&P up 74, up 1.1%. Dow Industrials up 213, up by about 0.5. NASDAQ 100 index up 1.9%. 10-year at 4.12% with a 2-year, 3.47%. Spot gold down $5 the ounce, 43.33, down 0.1%. And West Texas Intermediate crude oil up 0.9%. WTI 56.45 a barrel. Bitcoin up 0.6%, 86,450 now on Bitcoin. Instacart shares are lower after Reuters reported that the Federal Trade Commission has sent the grocery delivery company a civil investigative demand. The FTC declined to comment but told Reuters it is, quote, disturbed by what it's read in the press about Instacart's alleged pricing practices. Instacart down now by 2.3%. And just getting word that Sterling Anderson, the executive leading GM's tech push, is emerging as the front runner to eventually succeed CEO Mary Barra when the 63-year-old retires from the storied automaker. Now, Anderson joined the company as chief product officer in June after working for Tesla and co-founding the autonomous trucking company Aurora Innovation. GM shares are up now by 0.8%. Recapping stocks higher, S&P up 1.1% for on-demand news 24 hours a day. Subscribe to Bloomberg News now wherever you get your podcasts. Balance of Power continues now, and back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, thank you so much. He'll have more on Wall Street in just about 20 minutes' time, live from World Headquarters in New York. It appears the paranoia was well placed. The paranoia we discussed among marijuana investors just a couple of days ago with Nathan Dean at Bloomberg Intelligence. There was fear that Lucy might be about to pull the football again. Yeah, big house party set to start in about 7 minutes at the White House with the president putting pen to paper or Sharpie to something to sign a rescheduling of cannabis that would unlock a more favorable tax treatment status, they say, for cannabis companies around the country. But pot stocks have turned decidedly lower today, with great disappointment about what this order apparently will include. A briefing with reporters earlier reportedly includes that the president will direct the Attorney General to expedite and complete the marijuana rescheduling process and allow doctors to prescribe CBD products that would be eligible for Medicare coverage and more. CBD products are different than THC products, so don't smoke them if you got them, because that might not be covered. We're going to find out shortly when the president emerges. We haven't seen this on a piece of paper yet. Now, I've got more for you. The press secretary, Caroline Leavitt, just a short time ago announcing on social media that there's a new name for the Kennedy Center. Taking to X to write, I have just been informed that the highly respected board of the Kennedy Center, some of the most successful people from all parts of the world, have just voted unanimously to rename the Kennedy Center to the Trump Kennedy Center, congratulating in this note not only President Trump, but likewise, she says, congratulations, President Kennedy, because this will be a truly great team long into the future. We need to get to Tyler. She's on the north lawn of the White House right now, Washington correspondent. Tyler, everyone saw this coming, right? The president made himself the chairman of the board.
Right. This was, I guess, long expected, considering it's really the latest effort under this Trump administration to remake the institution here in the nation's capital. Of course, you'll recall back in February, we saw that major shakeup of the board. Many members that had been appointed under the last administration were fired. And as you mentioned, we saw President Trump himself appointed as the new chair. Now, there is reporting that this vote happened with President Trump phoning into the meeting. That's according to some media reports that have already started circulating after this tweet was posted by the White House Press Secretary Caroline Leavitt. Worth also mentioning the last part of that post on X. She says that the building will no doubt attain new levels of success and grandeur, in her words. Important context here, you'll recall when the One Big Beautiful Bill passed this summer, tucked inside of it was $257 million appropriated specifically for a renovation of the Kennedy building. So, Joe, this really, as we're discussing, is the latest in what has been a series of steps this year, both with the institution itself, but of course the backdrop that this is in the nation's capital. And President Trump has tried to assert his authority here in the nation's capital, including when it comes to the National Guard and crime and working with the local government.
We've, of course, seen ticket sales impacted by the politics around the Kennedy Center, and even some touring shows cancel appearances. Tyler, I thought only Congress could rename the Kennedy Center. Is that the case?
I'm going to have to get back to you on the exact specifics of that. According to the White House press secretary, this was a vote by the board, which, as we've been discussing, was experienced a shakeup earlier this year under the Trump administration. So I'll get back to you on the exact specifics on how this happened, but as you alluded to, widely expected.
I appreciate this, Tyler, and we'll keep our eyes on this EO signing that's set to begin a couple of minutes from now, and it looks like they'll be running late at the White House. Tyler Kendall on the North Lawn today with news on now the Trump Kennedy Center. We'll see if that's codified. Sarah Elfreth was listening to our conversation. The Democratic Congresswoman from Maryland joins us now on Bloomberg TV and radio, live from Capitol Hill. Congresswoman, it's great to have you back on Bloomberg. I didn't think I'd be asking you about this, but does Congress need to have a say in renaming the Kennedy Center? And as a Democrat, would you buy tickets at the Trump Kennedy Center?
Thanks, Joe, for having me on. And I was giggling over here while I listened in on that conversation. Just like the president trying to rename the Department of Defense, the Department of War, this is a similar situation. It requires an act of Congress. And so this is pretty make-believe at the moment. And unfortunately, taxpayer dollars might be used to change the name on the wall, but the truth of the matter is we have a system of checks and balances and shared governing here in Washington, and Congress is going to have to approve that. I would be a no vote. As you mentioned, ticket sales are down. There's kind of ramifications of the president's getting so involved in the Kennedy Center politics. I don't quite understand it when we have so many other issues, serious issues the American people are counting on us to address. Why he's spending so much time on this, it boggles the mind.
Well, it's just something we thought we'd get your take on, Congresswoman. And we're a little more interested in your take on health care right now because we had a remarkable conversation yesterday with Mike Lawler, the Republican from New York, who signed on to Hakeem Jeffries' discharge petition to extend Obamacare subsidies. He was one of 4 Democrats to do so. Now, I realize Republicans passed their bill last evening that doesn't touch Obamacare subsidies. Right. And I'm wondering what you think about the next step here. I just asked Congressman Jody Arrington this same question. Is there a deal to be had here, or we're as good as over the cliff?
Listen, I'm an optimist. I wouldn't be in this business if I weren't. I would like to believe that cooler heads can prevail, particularly as upwards of 20 million Americans are set to experience this huge affordability crisis on January 1st because Congress has chosen not to act. House Speaker Johnson has willfully chosen not to negotiate with Democrats to get the votes he would need to pass something actually meaningful and lower the cost of health care insurance for tens of millions of Americans. Maybe we'll get a Christmas miracle. Cooler heads can prevail and we can come together. I'm grateful for Mike and the 3 other Republicans for signing on. I think they saw the light, they heard from their constituents. They're doing something about it. That's what everybody watching at home should expect of their members of Congress. But, do I think the speaker's going to call that up for a vote before we adjourn in, I don't know, maybe an hour? Not likely.
Maybe an hour. Well, yeah, because I guess by the rules, with it being discharge, that would likely put you into the beginning or middle of January when you get back, right? Is this the issue that defines the midterms? Is this what brings Democrats back into power?
I think this is one part of the issue that brings, hopefully the confidence of the American people back to the Democratic Party. It's the affordability crisis broadly. You were just chatting about the impacts as we're going into the holiday season. I spent, my Small Business Saturday a few weeks ago, visiting small shops in Annapolis and in Ellicott City in my district, and just talking to those business owners about the tariff hits that they took, purchasing a lot of the products they had on shelves for the holiday season pre-tariffs, and then to come to find out that they're going to have to pay, depending on the country, 30% tariffs. They can't afford to eat those costs. They're being passed on to the American people. And that's just one part. We talked about groceries before. We talked about, I just paid my electricity bill, and it was staggering. We talk about health insurance, housing, childcare. I hear constantly, the Republicans promised to solve it. The president promised to solve it on day one of his presidency. We're almost a year into that with no meaningful impact. At least folks back at home in my district aren't feeling the impact of his actions. And so I think this is a mantle that Democrats are really charged up to lead on over the next year and prove not just that we're against the president or against Republicans, but we're actually for solving this affordability crisis.
Congresswoman, you represent Maryland's 3rd district, which includes all of Annapolis, and of course that means our great Naval Academy. You're also a member of the Armed Services Committee, so I'm sure you're knee-deep in conversations and briefings around what the president's referring to as a naval blockade around Venezuela. There was a closed-door briefing earlier this week, and I'm wondering what questions you have going forward and whether you think this is the march to war in the Caribbean.
It's really unclear. I was in 2 closed-door classified briefings this week, and I left with more questions and answers that I have received from both Secretary Hegseth, Secretary Rubio, and the Navy. 14% of our fleet is now engaged in some type of conflict, undefined conflict. I was with the Secretary Hegseth, when he talked just 2 weeks ago about not entering the American people and our service members into meaningless and endless wars, and yet our goals with Venezuela are completely undefined. And as a member of Congress, member of the Armed Services Committee, that really troubles me. It's keeping me up at night with so many of my constituents, including a lot of folks from the Naval Academy down there right now. At the same time, the American people deserve to have answers. This is, months-long engagement in a part of the world that the president can't define our goals or why we have 14% of our fleet down there in the first place. And as I've said, I can't tell you how many times in my first 11 months in the House, our founders and framers structured the Constitution intentionally putting war powers in Article 1 with the Congress. Unfortunately, we had 2 resolutions yesterday that did not pass to kind of regain some of that control. I hope the American people are equally concerned.
14% is a remarkable number, Congresswoman. I've only got a minute left. The president said yesterday, having framed this about drugs until now, that this is about the oil, he said. Venezuela took our oil illegally and we're going to take it back. Is that what this is about, oil?
I don't know what it's about. I also think that it's a false bill of goods that he's selling to the American people. Listen, I've had family members who have unfortunately lost their lives to fentanyl, but if we were focused on fentanyl, we'd be focused on China and not on Venezuela. What they're taking, what they're sinking, are boats carrying cocaine, not boats carrying fentanyl. And at the same time, the president is pardoning literal drug kingpins who have been convicted by juries of actually killing people through the drug trade. So there's a mismatch of messaging here that is also deeply, deeply concerning.
Democratic Congresswoman Sarah Elfreth of Maryland. It's great to have you, Congresswoman. Thanks for being part of our conversation. We'll assemble our political panel next, only here on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. CPI Thursday. Stocks stage a comeback with the Dow, the S&P, and NASDAQ all advancing. S&P right now up by 1.2%, higher by 82.6803 where we stand on the index. The Dow up 284 now, up 0.6%. The NASDAQ Composite Index up 430 points, up 1.9%. The NASDAQ 100 Index up 2%. And the Bloomberg Mag 7 Index pushing higher now by 2.6%. The 10-year, 4.12%. The 2-year, 3.47%. Gold, little changed at $43.37 the ounce. And West Texas Intermediate Crude, $56.40 a barrel. WTI up by about 0.8%. Bitcoin now higher by 0.7. Bitcoin at 86,517. Data this morning showing inflation cooled last month, ignited stock and bond markets. Meanwhile, a key executive departure at Uber. Gus Foldner, Senior Vice President for Safety and Core Services, will be leaving Uber in January. That according to his LinkedIn post. Uber is facing lawsuits from passengers who say they were sexually assaulted or harassed by Uber drivers, with more trials set to start early next year. Uber shares now up by 0.9%. Crosstown rival Lyft, based in San Francisco, up by 4.2%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. And Balance of Power continues right now. Back we go to Washington. Once again, your host here is Joe Matthew.
All right, Charlie, thank you so much. The voice of Wall Street with us on Bloomberg TV and radio. Charlie Pellet live in New York. He'll have more in about 20 when Bloomberg Business Week Daily gets rolling at the top of the hour. We are watching Wall Street with Charlie and with the help of Nora Melinda and the help of Micron Technology. A big story today with another batch of earnings after the bell. We're going to turn to FedEx and Nike, but right now it is MU on the rise, up 14% here, or $30 a share. Boy, things change quickly. The whole story, the narrative going into the earnings session last evening after hours, was that the whole AI bubble was popping and everyone was losing faith in the AI spend. Dare we bring up OpenAI? But a day like this, rising tide, lifting all boats, we see a lot of green. And we wanted to talk to Nora Melinda about that. Bloomberg Markets correspondent with us now on Bloomberg TV and radio. Nora, how should we be reading the gains here? Is this as much a relief rally, a bargain hunting move, or do we have a whole new dose of FOMO thanks to Micron Technology?
Well, Micron is certainly pulling a lot of its peers higher. We are seeing it as one of the biggest gainers in that group here. I mean, as you look at Micron, of course, we did get the rosy outlook, and that is really just bolstering expectations for the future. They're actually talking about the fact that they are seeing the company being able to charge more for their products. They're pointing towards supply shortages, limited inventory, and surging demand as some of the things buoying this stock higher. And you really are seeing the street celebrating, as you mentioned just a tad earlier. I'm looking at shares of Micron up about 14%. You're seeing double-digit gains on the screen right now. And if you look at the stock year to date, it's really been on a tear. Shares up more than 200% so far this year. So great time to be an investor in Micron here.
All right, Nora, thank you so much. Nora Melinda, live from New York. Something important is happening at the White House. They're bringing the pool into the Oval right now. So I'm just going to apologize to Rick and Jeannie in advance. You guys will get off the hook early, it looks like. The president reportedly set to put his name on an executive order to reschedule cannabis. Bloomberg Politics contributors Rick Davis, partner at Stone Court Capital, and Jeannie Shanzano, democracy visiting fellow at Harvard Kennedy School's Ash Center, are with us right now. We'll note that pot stocks are heading lower, so it's not entirely clear what the language is going to read. Jeannie, is the president taking an issue away from Democrats?
That is a fear amongst many of the liberal groups. They're saying, you know, there's quotes like, he's taking marijuana right away from us. And, you know, it does for those 18 to 34-year-olds, almost 3/4 of them who supported Trump in 2024 support the legalization. But this is obviously not legalization. It's a rescheduling, should say that. But that is where they're headed. So, you know, it is a concern amongst liberal groups. Donald Trump also had a number of cannabis groups donating to him for his inauguration, his campaign. And Tony Fabrizio, one of his chief strategists, has long worked for cannabis companies. So, you know, there's some push there, and he thinks it's good politics.
All right, Rick, I think you're saved by the bell. The president is talking now with the pool standing right in front of the Resolute desk. Let's bring you in the Oval live on Bloomberg TV and radio.
American patients suffering from extreme pain, incurable diseases, aggressive cancers, seizure disorders, neurological problems, and more, including numerous veterans with service-related injuries and older Americans who live with chronic medical problems that severely degrade their quality of life. And it's so really, I mean, just, I can't tell you, I think I probably have received more phone calls on this, on doing what we're doing. I don't think I received any calls on the other side of it, but hopefully this reclassification, which by the way polls at 82%, will help many of those patients live a far better life. We're joined today by Secretary Robert F. Kennedy Jr., who's doing a fantastic job, Administrator of Centers for Medicare and Medicaid Services, Dr. Mehmet Oz, the FDA Commissioner, Dr. Marty McCary, Director of the National Institutes of Health, Dr. Jay Bhattacharya, and the Director of the National Institute on Drug Abuse, Dr. Nora Valkow, as well as Dr. Ilana Braun from the Dana-Farber Cancer Institute, Duke University's Dr. David Casseret, the National Commander of the American Legion, Dan Wiley, and my friend Howard Kessler. Howard, how are you feeling? I'm telling you, he looks better than he did 20 years ago. But I don't want to go through what you went through to get there, right? But it looks like you're doing great. I'm proud of you. I want to emphasize that the order I am about to sign is not the legalization, or it doesn't legalize marijuana in any way, shape, or form, and in no way sanctions its use as a recreational drug. It has nothing to do with it. Just as the prescription painkillers may have legitimate uses, but can also do irreversible damage and never, you know, if you look at some of the damage that can be caused, wreck lives, and if it's abused, it's never safe to use powerful controlled substances in recreational manners, and especially in this case, if you take a look, illegal and unregulated drugs, very, very bad thing. So I've always told my children, don't take drugs, no drinking, no smoking, and just stay away from drugs. I have been, they would look at me and they said, Dad, would you stop saying that? I would say it every time I looked at it practically. Young Americans are especially at risk, so unless a drug is recommended by a doctor for medical reasons, just don't do it. At the same time, the facts compel the federal government to recognize that marijuana can be legitimate in terms of medical applications when carefully administered. In some cases, this may include the use as a substitute for addictive and potentially lethal opioid painkillers, and they cause tremendous problems. This can do it in a much lesser way, can make people feel much better that are living through tremendous pain and problems. 40 states and multiple U.S. territories have already recognized the use of medical marijuana. This reclassification order will make it far easier to conduct marijuana-related medical research, allowing us to study benefits, potential dangers, and future treatments. It's going to have a tremendously positive impact, I believe. We're also asking Congress to reconsider its classification of hemp-derived CBD to ensure seniors can access CBD products they have found beneficial for pain and other reasons. Some people are literally dying, and they're dying with tremendous pain, and this can, in many cases, literally stop it. And they have their senses about them, as opposed to painkillers, which don't allow that, don't allow them to die with dignity, frankly. I promise to be the president of common sense, and that is exactly what we're doing. This is really something having to do with common sense, and it's something having to do with the fact that so many people that I respect ask me to do, people that are having problems, big problems. They are having big problems with illness, with cancer in particular. I now want to ask Dr. Oz to say a few words, followed by Dr. Braun, Dr. Casseret, Dan Wiley, and Dr. Valkow. And we'll sign the order as soon as they're complete, and we'll take some questions. Please, go ahead.
Mr. President, thank you for always bravely pushing for common sense change, as you call it.
All right,
So
there you have
President
it. Trump speaking live from the Oval Office alongside Dr. Oz and a couple of other doctors behind him, as well as some military veterans, as the President of the United States makes it official. Rescheduling cannabis, what he says does not equate to legalization, remembering that this order will not legalize marijuana in any way. But as he says, marijuana can be legit in terms of medical applications, and this will open up some opportunities for research. It will also allow cannabis companies, as we understand it from analysis at Bloomberg Intelligence, to have a much more favorable tax treatment by the federal government. Let's get back to our political panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis with us. What's your thought on this, Rick, the way the president just framed that? He's careful to say that we're not legalizing marijuana, but many would suggest that this reclassification is undoing generations of Republican orthodoxy. What do you think?
Yeah, really, Joe, what I picked off in his comments were that he didn't hear from anybody that said this wasn't a good idea. And I would remind him, 22 House and Senate Republicans signed an open letter to him asking him not to do this. And then more recently, another 9 sent letters, Republican members of Congress, to the Department of Justice asking them not to do this. So there is a group within the Republican caucus want to stick their heads up over the fence and say, hey, we don't think it's such a great idea. And I would remind him there's a reason that almost all the states that have had zero tolerance laws toward marijuana are governed by Republican state legislators and Republican governors. And so, yeah, there's a divide politically on this issue. And I think this is another example where, you know, maybe Donald Trump is doing something commonsensical, but it certainly does create a lot of pressure within the coalition that made him president.
We're watching cannabis stocks, which have been on fire recently, Jeannie, and they're all tipping lower today. The MJ ETF is down 6%. MSOS, which we follow more carefully because it's all U.S. cannabis companies, not mixed in with Canada, it's down 13% right now. I don't know if we end up calling this a sell the news situation, but did progressives, did cannabis activists want more?
They probably did. And I think you hear the president there in the remarks, at least I read them, as him trying to be cautious. You know, the medical community has long said that the 1970 Schedule I designation for marijuana didn't make much sense anymore because it includes the idea that there is absolutely no medical use for marijuana. And most members of the medical community say that's not true. So I think that President is on the right side when he says there is medical research use, it needs to be rescheduled. But of course, for people in the cannabis community, they have long wanted more. And I think what Rick's talking about is a really important aspect of this. The president is sort of caught between these two divides in his own party. And I think he's trying to walk a middle that may not make anyone happy. But it is the next logical step. And I think betting markets had this happening at about 90%. So, you know, I think it was expected, but probably not what everybody in the community may have wanted.
Well, he did suggest that it was coming on the campaign trail. Rick, we saw an op-ed recently from Roger Stone urging the president to take this move. So clearly he's got a lot of people around him, to your point, who are suggesting this is a good idea. But you mentioned the senators, and I'll point to those in the DEA who think that they've been abandoned here, having seen in many cases some of their colleagues killed in trying to enforce anti-cannabis law. What kind of a dynamic is the president creating within the administration on this?
Yeah, I think it's a little bit of stress. It's not the first policy that he's, you know, taken a position on where he doesn't create that kind of stress. I mean, he is not a, you know, doctrinaire ideologue. He very much talks about his ideology as common sense. And in his world and the advisors around him, like you mentioned, Roger Stone, you know, they're saying, hey, this is common sense. Of course, you're going to do this. And so, yeah, I think he buys off on that. And yet that does create a lot of stress within the government agencies that have long since seen the negative effects of this in communities. And then, of course, as we've talked, the political organizations that have campaigned against this and continue to do so to this day in states that are still having referendums on this topic. So, it is, you know, it's a step toward legalization, but not in total.
Rick Davis and Jeannie Shanzano, many thanks to our great panel for the insights. It is official, the president rescheduling cannabis with a cadre of supporters in the Oval Office. Bloomberg Business Week Daily will have more on this as he is expected to take questions from reporters. So keep it right here on Bloomberg TV and radio.
Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very happy Thursday, everyone. Good afternoon across Bloomberg platforms. This is Bloomberg Business Week Daily. Carol Masser, Tim Stenivek, live here at Bloomberg headquarters in New York City. Hey, We got stocks bouncing off their lows. I've been watching yields. We did get an inflation print earlier today. At the longer end of the yield curve, we are seeing yields a little bit lower, shorter end, maybe a different trade.
Yeah, we're going to have more from Charlie in just a minute on the trade, but the Dow is up 0.4%. The real action, though, happening in tech stocks. The NASDAQ up 1.7%. The S&P up a full percentage point, Carol. And if we take a deeper dive in there, only energy, real estate, and consumer staples are in the red.
You know, it's funny that you say energy. We're going to get to that a little bit later on this hour. What I do want to say is that on the trade, we're going to kind of dig into all of that. CPI, Micron Technology soaring in today's session, bringing up most of the chip names. We're going to get into all of that that's coming out to investors. Get a look on the trade.
Yeah, investors, too, I think have a lot of questions going into next year. We got Jason Granite stopping by in just a few minutes. Chief Investment Officer over at BNY. He's got 6 for 26. These are essential questions, but also maybe some answers for investors.
Yeah, looking forward to that. Frank Sorrentino will have some answers as well. He's founder and CEO of Connect One Bank. Great read on small business, great read on construction. Curious to see, too. We talked to him just after the November election, so curious to see what he has to say about residential and housing and costs, again, in New York. We've talked about this with him in the past.
Yeah, he's going to be joining us a little later this hour. And you mentioned energy, the reality of energy and sustainability. The CEO of Honeywell Energy and Sustainability Solutions joining us a little later, too.
Pretty cool stuff coming your way in the next 60 minutes.
Funny how that works. Got a great team who puts it all together for us, right?
Thank God for them.
Yeah.
Hey, also thank God for Charlie Pell. Let's get a check on the trading day here. He is right here in New York.
All right, I thank you very much. Focusing right now on what's happening with U.S. markets, higher across the board with the Dow, the S&P, NASDAQ, all advancing. Will the gains stick? Stay with Bloomberg Television and Radio right into the close to see how things shake out. But right now, S&P up 67. It is a CPI Thursday. We're looking at a gain now of 1%. Dow Industrials higher by 158, up 0.3. NASDAQ up 366 now. NASDAQ up by 1.6%. The Bloomberg Mag 7 Index higher by 2.3%. 10-year, 4.12%, with the 2-year currently yielding 3.47%. Gold, little change, down 0.2%, 43.29 the ounce. West Texas Intermediate crude up 0.7%, 56.31 a barrel. And Bitcoin right now retreating by 0.3%, 85,675 on Bitcoin. Bottom line here, stocks are advancing as a cooler than expected inflation report lifts hopes that the Fed will cut interest rates further. Right now, looking at wheat stocks, they are higher. We've got shares of Canopy Growth up by 5.2%. Tilray right now up by 1.1%. But interestingly, the marijuana ETF, the Amplify Alternative Harvest ETF, ticker MJ, it is down by 6.9%. President Trump saying his executive order on marijuana will make it far easier to conduct related medical research, and that his administration will ask Congress to reconsider its classification of hemp-derived CBD. The president saying his order will not legalize marijuana in any way. Again, recapping, stocks are advancing, S&P up by 0.9%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it, Charlie. Thank you so much. Well, Micron Technology, man, that stock is soaring in today's session. We saw that play out after it reported late last night after the close. The stock right now, Tim, is up about 13% in today's session. Company came out, rosy outlook, thanks to the AI boom fueling demand for memory chips. So it pushed up the Philadelphia Stock Exchange Semiconductor Index with it. The stock's up more than 4% at its intraday high today.
Yeah, 12.7% where it is right now, higher. That's pretty good.
Yeah.
What about 200% for the year?
That's like what?
Pretty unbelievable.
Unbelievable outperformance. I was looking at it is about 1.5% of the NASDAQ 100, just about 0.5% of the S&P 500, but about 7% of the SOX. So I'm just trying to look at where it's being felt here in today's trade.
Okay, so that's the micro from Micron.
Yeah.
The macro, this morning's read on U.S. inflation, CPI showing underlying U.S. inflation rose in November at the slowest annual pace since early 2021. The data, though, Carol, a bit muddled thanks to that, U.S. government shutdown.
All right, add it all up. We have stocks bouncing around a little bit. We did see a rally earlier on, and we also did see yields, most notably at the longer end of the yield curve, moving lower. Let's get our market roundup, and for that we head to Ed Harrison, senior editor and author of the Everything Risk newsletter. He's in the Bloomberg News Washington, D.C. bureau. Ed, good to have you here. Markets are bouncing around a little bit, but we did see a rally, and we still are up about 1.6% on the NASDAQ 100. Do we just say Thank you, Micron. Thank you, CPI. It feels like Micron has a lot to do with this.
Yeah, I think you're right, Carol, because Micron was up 14% pre-market, and now it's up 13%. So it's basically held onto its gains, and even before we had the CPI, that's what the situation was. The CPI only helped that, but the CPI, it was a bit dodgy, the data, to be honest, because of these imputed prices, and I can go into some of that with you.
Yeah, let's do that. Why is it murky?
Yeah, so owner's equivalent rent in particular, shelter is the biggest component. I looked at the numbers, and if you look at the actual number for August and you compare that number to for September and compare that to November, you get an annualized increase of something like 1%. Now, if you go back and you compare September to July, you get an annualized increase of 4%. So what's clear that happened is that they did something to make the October number the exact same as the September number, and then they based the November number off of that, which artificially lowered the shelter cost, which is the largest component of CPI. Now normally you would think that would come back out in December, but the reality is that owner's equivalent rent is only calculated once every 6 months. So the next survey is January or February, which means essentially that these numbers, this zeroing out of October, will be carried forward for another 2 to 3 months.
Ed, forgive us. We've got to run to the White House, the Oval Office. President Trump signing an executive order in terms of the reclassification of marijuana, but he's also taking some questions from reporters. So let's listen in.
Money go to the people directly and let the people buy their own health care. And they'll get much better health care than they get with the Unaffordable Care Act, as it's known by a lot of people. It is virtually unaffordable for people. It's a bad thing. We can have a great thing. Let the money go directly to the people and let them buy their own health care.
But this is an urgent problem, Mr. President. Is there anything you can do now, Mr. President?
Can I answer, Mr. President? This is going to be right now, as far as I'm concerned. Go ahead.
We just got data today. We have federal exchanges where people come shopping for the ACA. And the president hasn't heard this yet, but we've talked to the team. The percentage change from last year was down 2.7 to 2.8%. Not the massive numbers that have been predicted. And there's many possible reasons for this, but right now Americans are signing up for these programs despite all the things that have been going on. 2.8% is a tiny fraction of what many had claimed would happen, and I think it speaks to the fact the American people appreciate these ACA plans are already subsidized over 80%, so it's a good deal, even if you don't get the extra 15, 20%.
It's a great solution to much better health care at a much lower cost. Yeah, please.
But do you want Congress to extend these ACA subsidies?
Well, I'd like to be able to do it. I'd like to get right into this, and I'd ask Oz this question in particular, but I'd like to see us get right into this. I don't know why we have to extend. This could be done rapidly if the Democrats would come along. We have a problem. The insurance companies own the Democrat Party. They own it. And the Democrats having a hard time. They give a lot of money to the Democrats. Very little money to Republicans, by the way. A lot of money to Democrats. And they're going to have to decide, do they want to do the right thing or do they want to be beholden to the insurance companies? They're making a fortune. I want the money to go to the people. Go ahead, Oz. How would you say that?
I agree with the president. We have some ideas out there. Congress is working through some concepts. But I just want to emphasize that the ACAs are not imploding based on the data we just received from the federal marketplace.
This can go very quickly, actually. Yes, please.
Mr. President, can I ask you, clarify something for me on the Federal Reserve? How many people are you interviewing for the Fed chairman, and what did you think of Chris Waller?
I think he's great. I mean, he's been a man who's been there a long time, somebody that I was very involved with in the sense of his career, and he's a fantastic man. I met him yesterday. Again.
So how many people are you looking at?
We're talking to 3 or 4. I think every one of them would be a good choice, honestly. We'll be making a decision pretty quick.
Is Michelle Bowman on that list too? Are you going to interview her?
She's fantastic. She's a fantastic person.
Thank you, Mr. President. Some GOP lawmakers have written to you in recent days saying they're concerned this executive order could normalize drug use for youth. How would you respond to them?
You're talking about this particular today? Well, I think I'd let one of the doctors respond to it because he can do it a lot better than me. But I can only tell you that when you see polls of 82% of the people want this, when I have friends that are really, really sick and they've gone through, I guess you could say, unfortunately, I don't want to become too involved in it because I don't want it happening. But these are people that really know what's going on. Very smart people. This is one of the most successful people in the country and a very brilliant guy. And when they go through this horrible ordeal of cancer or other things, and they realize that this is something that makes them feel better without all of the side effects of some of the drugs where you're just totally knocked out and out of it. But I'd like to have one of the doctors maybe respond because you people do it better than anybody.
I'm happy to respond.
Yes.
I mean, and my answer is we have had cannabis scheduled for how long? And it hasn't protected neither the adolescents nor the adults. We have 20 million people in the United States with a cannabis use disorder. This is not legalizing it. It's making easier to do research so that we can use it when it is indicated and optimally.
So it's also a big part of this is research. In other words, you'll now have a much larger sample and you'll be able to see if it's as good as many people say it is. I mean, people say it is beyond good, and you'll be able to find that out now.
On housing, you talked in your address last night about housing.
Yeah.
Are you still considering a national emergency over housing?
I'm looking at it.
What would that look like? What would that mobilize?
You know, there's two thoughts on housing. You have a lot of people have housing that because we have such a strong time and such a strong market, their houses are very valuable. It's a big part of their net worth, their house. I don't want to knock those numbers down because I want them to continue to have a big value for their house. At the same time, I want to make it possible for young people out there and other people to buy housing. In a way, they're at conflict. In other words, you create a lot of housing all of a sudden, and it drives the housing prices down. So I want to take care of the people that have houses that have a value to the house that they never thought possible, that have sort of made them wealthy and happy, and especially in their later years. Got to be careful with that. I want to keep them up. At the same time, I want to make it possible for people to go buy houses. Daniel, please.
Mr. President, you announced the Warriors dividend last night in your primetime speech. Very patriotic, very generous. What was the rationale and the thought process? How did you come up with the idea? What made you want to give back to
Well,
our
the
troops?
1776 was easy to come up with because we're actually at 1775. The number was 1775, and I said, wow, I think we can afford one more dollar. But they came up to me, it was $1,775. So I said, well, let's add $1 to it. I think we can find that. And very simple, we've had a military that, in my opinion, by other presidents, was not treated well. They're incredible. They're our finest people. They're protecting us. And because of tariffs, we're taking in billions and billions of dollars more than we ever have before, with no inflation, by the way, with no inflation. You saw the inflation numbers. They just came out today. What great timing. Practically no inflation. And yet we're taking in hundreds of billions of dollars. And this is small potatoes by comparison, but it's a way of taking care of our warriors, our soldiers. And I appreciate that question, Daniel.
Yeah, and Caroline,
it was an easy one.
She just posted on X, your press secretary, that the board members of the Kennedy Center voted unanimously to rename it the Trump Kennedy Center. What is your reaction to that?
Well, I was honored by it. The board is a very distinguished board, most distinguished people in the country. And I was surprised by it, and I was honored by it. We're saving the building. We saved the building. The building was in such bad shape, both physically, financially, and every other way, and now it's very solid, very strong. We have something going on television, I guess on the 23rd December. I think it's going to get very big ratings, and the Kennedy Center is really back strongly. It's in very bad shape, very, very bad shape physically. And we're also to get Congress to put up a lot of money and other people to put up a lot of money. We had a lot of donors come in for record-setting numbers, so we saved the Kennedy Center, and I was really, this was brought up by one of the very distinguished board members, and they voted on it, and there's a lot of board members, and they voted unanimously, so I was very honored by it. Thank you.
Mr. President, will you be seeking any authorization
Congress for any land attacks on cartels in Venezuela?
For anyone?
For any land attacks on drug cartels in Venezuela?
I wouldn't mind telling them, but it's not a big deal. I don't have to tell them. It's been proven. But I wouldn't mind at all. I just hope they wouldn't leak it. You have people leak it. They are politicians and they leak like a sieve. But I'd have no problem doing that.
Mr. President.
Yes, please.
Mr. President, there's a meeting this weekend on Ukraine in Florida. What are you hoping will come out of that meeting?
Well, they're getting close to something, but I hope Ukraine moves quickly. I hope Ukraine moves quickly because Russia's there. And, every time they take too much time, then Russia changes their mind. 27,000 soldiers were killed last month. Think of that. What do you think of that, doctors? 27,000. It's like a half a football stadium were killed in 1 month. And it's that way. It's anywhere between 20 and 30,000. Mostly soldiers. Also some people from Kiev and other places. But largely it's the soldiers. They're losing their lives. Nobody's ever seen anything like it. It's the worst since World War II. And, you've heard me say I settled 8 wars. Some going on for 35 years, one going on for 37, one going on for 32. And 8 wars, and I thought this would be an easier one. This is because of the animosity, the hatred. It's a little bit more difficult than we thought, but there's a chance we can get this done maybe soon.
Sir?
Remember that 25 to 30,000 people being killed a month, young people being killed a month. Steve, please.
When do you expect to make your announcement about the new Fed chair, sir? Before the end of the year? What do you think?
Over the next couple of weeks. I mean, I don't know before the end of the year, but pretty soon.
And then the Rocky Mount, North Carolina tomorrow night. Tell us what your message is going to be there, sir.
Say what?
When you go to Rocky Mount, North Carolina tomorrow night, what's your message going to be there?
Well, it's not going to be that much different from what I did last night. I mean, we've had tremendous success. We're bringing prices down. We inherited a mess. And part of what we inherited was the worst inflation in 48 years. I say history, but we had the worst inflation. It drove prices up. And now we're bringing those prices down. But I'll be talking about that. I'll be talking about the fact that we secured the border where literally nobody can come into our country illegally anymore. They came in from prisons and mental institutions and drug dealers and, a lot of bad people from all over the world. Venezuela emptied their prisons into our country. We had Tren de Aragua, which supposedly, the doctors don't know this, it's the meanest gang of them all. Okay, doctor? You don't have to know about it. You got other problems. But they let a lot of bad people in here. And so I think I'll be talking about that. I think I'll be talking about the tremendous success we have by sending the National Guard into various cities. D.C. is the ultimate example. People walk to work and they thank me all the time. People in the White House, they just walk to the White House from 10 blocks away. Before I came into office, they couldn't do that. They were getting badly hurt in many cases and beyond hurt, killed. So we were losing people. We were losing, on average, a person a week. Can you believe it? More. And now we haven't lost anybody in a long time. I consider the 2 people that got so badly hurt, the National Guard, that's a different city. That was terrorism. That was terrorism. And probably terrorism, maybe terrorism because they were unhappy with the tremendous success we've had because they don't want to see this country be successful. But Washington, D.C. now is a safe, beautiful city where the restaurants are booming, the town is booming. People walk to the restaurants with their wife or their children and have a good time. We were losing all the restaurants. We were losing our life in this. We were just the whole heritage of Washington, D.C. was down the drain, and we brought it back. And now everybody's thrilled to be here. It's the hottest. It's a part of the hottest country anywhere in the world. We become, in 10 months, the hottest country anywhere in the world. And I say it all the time, we were a dead country 1.5 years ago.
Do you expect to meet Prime Minister Netanyahu while you're down in Palm Beach?
Yeah, he would like to see me. We haven't set it up formally, but he'd like to see me. We've had great success. Peace in the Middle East, aside from everything else. We now have peace in the Middle East. Yeah, he'll probably come to see me in Florida.
The Egyptians as well? Are they coming
I'd love to have him. El Sisi, he's a friend of mine. Yeah, I'd love to have him. Thank you very much, everybody.
All right, everybody, you've been listening to President Trump there in the Oval Office. The main order of business for the day was about signing an executive order on the reclassification of marijuana, which is why you see cannabis stocks certainly rallying in today's session, making it easier, certainly in terms of access and for businesses. But having said that, as he often does, Tim, taking questions from reporters on a range of topics.
Yeah, including the Federal Reserve. He said talking to 3 or 4 Fed chair candidates, every one of 3 or 4 Fed chair candidates would be great. He said Michelle Bowman is great. He said he'd be making a decision very quickly on the Fed. Then a few minutes later, that he said that decision would come probably in the next couple of weeks. Fed chair announcement over the next couple of weeks.
Yeah, she and Chris Waller were the two that were kind of singled out in that conversation as a result of questions from reporters. Michelle Bowman, of course, vice chair, member of the Board of Governors at the Fed. And so, yeah, we're keeping an eye. We are expecting that decision maybe before the year wraps up. All right, folks, just a quick check on the market trade, if we may, because we are seeing stocks bouncing around here. Just up about 57 points, up almost 0.9% in the S&P 500. NASDAQ 100, some outperformance there, up about 1.6%. We've talked about Micron Technology soaring, bringing stocks up, and really the overall tech sector. And then we had that CPI print, but Ed Harrison got cut short of Bloomberg, but sending us and reminding us that there are a lot of caveats to that report. So we're still waiting for maybe some really clean data that wasn't necessarily impacted by the government shutdown.
Yeah, I would encourage everybody to check out our live blog, our Markets Live blog on the Bloomberg terminal for all the updates, not just today, but every single day with all the market moves. And Ed has a blog post coming soon there that explains the inflation. Just the challenges with the most recent report and sort of the intricacies and the nuances.
Which is why all of our, earnings reports have been so important in terms of getting some color from CEOs. But we're just about done with that, and we're getting ready for a new one come January. Hey, we want to stay, though, on the markets and the outlook. We've got a great guest to do that, and also to get into some new research that they had out late last month, 6 for 26, essential questions for investors. Investors probably have a lot of questions going into the new year. Back with us is Jason Granite. He's Chief Investment Officer of BNY right here in studio. How are you?
I'm great. How are you? Love the new studio.
Thank you. Thank you.
Very cool.
We're kind of loving it too. How are you loving kind of the market environment right now, and how are you thinking about the new year?
Yeah, so if I go back and think about this year, and we're at the beginning, you think about all the wild things that happened. We went through the new administration, liberation. People forget that the U.S. military was engaged in a war back in the spring. The one big beautiful bill in negotiations, the long government shutdown, these mega AI deals that happened over the course of the year. And what happened? Kind of what everyone thought would happen. Policy rates are a little bit lower, risk assets are higher, but it was very nonlinear. And so if I think about 26, I think it's probably going to feel somewhat similar. There's going to be weeks, maybe months, that don't feel that warm and fuzzy, but pretty strong backdrop. You have the stimulus coming from the one big beautiful bill.
Will that be inflationary, though, and cause some problems perhaps for the Fed and the next Fed chair, whoever that may be, he or she?
So, I mean, look, we're talking a lot about the inflation data today and questions around it. Obviously, the headline was softer, but markets are not reacting, believing that the underbelly of that data is as clean as it could be from a hangover from the shutdown. I'm not convinced that it's going to be super inflationary. It could be a little... It could put a little pressure against it, and I think, but if you look at where policy rates have been trading for the end of 2026, no matter what we've talked about, all those things that happened, all the questions about all these different Fed people, they've been right between 290 and 310. And so the market kind of has this credibility around where it's heading, no matter all these kind of balls that are thrown at it.
Well, I wanted to just talk about the Fed a little bit because the president did say he's speaking to 3 or 4 different candidates. If you look at Polymarket, for example, the money's still on Kevin Hassett, but Kevin Warsh is a close second favorite. Christopher Waller's on there too. Michelle Bowman, who he mentioned, is still only at 1% at this point. Does it matter to you, of those 4, who gets picked?
Yeah, so we've had a lot of names. I think there were 5, then there were 1, now there's 4. Back to my point, markets seem to be anchored at a certain point, no matter where the winds swing on these choices. What I would say is we're still talking about a committee. We're still talking about consensus on a committee. If you look at the dots that come, it looks like a scatter plot. There's a lot of work to do to bring people together. So while I think that it does matter ultimately over a long period of time, obviously who the chair is, if we're talking about the near term, this is about building consensus, getting the views, and quite frankly, this is a tricky environment. You know, Carol, you raised the underbelly of inflation.
Yeah.
We have the labor market that's a little weak. These are tricky times for both the Fed and global central banks, quite
All
frankly.
right, so you guys have whittled it down to 6 for 26.
Well, we
essential questions
tried,
for
we
investors.
tried,
Was
yeah.
it hard whittling it down to 6?
Yeah, look, I mean, we tried to catch the big themes that are out there, right?
Yeah.
You know, obviously central bank, obviously the dollar, obviously AI. We try to capture all those different things.
Let's go through a couple. Can the global economy maintain its delicate balance through 2026? And you just talking about forces balancing toward growth acceleration, and I guess those that might not be towards that.
Yeah, look, it's fragile. This is what we're talking about. I mean, we think that it can maintain our conviction when we went through and did the work to put that out, as we think that the tailwinds continue to outweigh the headwinds, but there's some fragility.
Yeah.
The labor report showed you that it's kind of not every sector with strength. Obviously, the questions about the inflation data, where things are happening. You know, we think it does have the support behind, but it's more a closer call than not.
Jason, we're going to jump around a little bit in the report.
Please.
The question that you have posed, I think a lot of people have right now when they look at the U.S. equity market. Are U.S. equities overvalued? Yes or no?
Yeah, I mean, obviously, this is you know, everyone's
Are some
question.
overvalued?
And what I would say is there's always some that are overvalued and there's always some that are undervalued.
But are there some more right now than usual that are overvalued?
Yeah, look, there's a lot of price for perfection in the market in certain sectors, right? That being said, we are getting some stimulus that's coming into the market next year. We do have easier, not tighter monetary policy on the horizon. We do have fiscal stimulus, corporate tax benefits that are there. I think a lot of it's in the price, but we think there continue to be a little support on risk assets here into next year for sure.
Jason, what do you do? Who do you talk to? What is the research that you guys look at to figure out whether the AI trade, the AI spend, the AI build out is getting frothy? Is it just a case of looking at valuations, or who do you talk to kind of get an idea?
So you can't just look at valuations. These are new technologies and new horizons where on some level the raw valuation doesn't really matter as much as what are the fundamentals? What's the forward of the different projects? What partnerships? You're seeing all these partnerships come out. So there's a whole series of strategic alliances that are going to be developed over time.
Are you comfortable, though, with the circular financing and complicated relationships and kind of cozy relationships?
Yeah, look,
it feels
I'm a bond guy, so I'm always a little nervous. That's how it works.
So are those folks when they look at Oracle, right, and what's going on in their balance sheet.
Yeah, I think what you're seeing across the horizon is that we're starting to sift through and think about who some possible winners and losers are, but this is a long game. You know, if I think about back in the spring, people were questioning Google. What's going to happen to search? What's going to happen in that ecosystem? Now people see Google as, maybe the biggest winner. So these things can change very, very, very quickly. And I think that we're early enough, and we have a little chart that shows how early we are kind of in the journey here. And that's what I think it's important for folks to remember. We're early days in whatever this AI adventure will be. It's not going to be all highs or all lows, but there's going to be some sorting that goes through.
What's the risk? The main risk for 2026? What gets the train off the rails?
Yeah, look, like I said, there's a lot of fragility. I think obviously for the Fed and for policy here in the U.S. is clearly the labor market. You're seeing a lot of unevenness across the labor market. You know, growth is strong, but probably slightly below potential. So is there a point where taking folks out of the labor market brings growth down and that starts to fall further below potential? And then, look, we've had rate cuts last fall. We've had rate cuts this fall, and we still have 10 years that won't get off 4%.
Yeah, exactly.
And so, to me, that's something that has to manifest itself through the economy still as well.
Yeah, it's so funny because we had dipped below for a moment, it felt like, and then we had some guests maybe even talking about moving, closer to 3, and yet here we are at 4.1, and we're sitting there for a while.
Yeah, it's pretty stubborn there.
Well, you said, you're a bond guy, so the diverging, one of the things that you guys are talking about, the 6 essential questions for investors, how are diverging rate paths shaping fixed income in the U.S., Europe, and emerging markets? And this is on a day where the BOE and ECB reined in with rates. We get a decision from the Bank of Japan tomorrow. We had the Fed recently. There are diverging policies among some central banks.
And Carol, I would say beyond diverging policies, the agreement is not there. The Bank of England had a 5-4 vote, very tight. As I said, look at the dots, it's all over. The ECB, listen to what they're saying. It's not everyone is student body right, student body left at all these different central banks. So not only do you have different speeds across these, but you also have inside, there's still some sorting that happens. So when you ask about the risks and the things, you can see the confusion in the market, and even from the experts who make these decisions.
So it could go a lot of different ways in 2026.
Yeah, let's have fun. That's what makes this that's what makes it fun to do.
It does sound like there's a consensus that we got to keep our watch on Washington, whether it's policy out of the White House in so many different ways, or policy over, monetary policy from the Fed. There's a lot that's going to be coming our way that way.
Yeah, people are policy, and so you got to listen to what the people are saying. They push it through, and that's what happened this year, right? They drove all these undulations, but if you talked about where we were at the beginning, I think we are where we thought we'd be at the end, but it wasn't that smooth.
No, and there were points where you never thought it was gonna end out this way.
That's right.
Jason, happy holidays.
Happy holidays.
New
Great
Year.
to see you. Enjoy your break.
We'll see you in 2026.
Okay, see you in 2026. Best to everybody.
Yeah, same to you. Jason Granite, Chief Investment Officer at BNY, right here in studio.
Hey, coming up next, we're going to talk about financials as a whole. They're up 13% so far this year. If you get more specific, the KBW Bank Index, it's up close to 30% year to date. Frank Sorrentino from Connect One Bank Corp is going to join us next. In the meantime, though, a check of the day's trade and top business stories. Here he is, Charlie Pell.
Hi, thank you very much. And here's what's going on. We've got the Dow, the S&P, NASDAQ all advancing. 90 minutes to go ahead of the closing bell. And, of course, coming up after the close of trading, we'll be hearing from FedEx and Nike, Bloomberg Television and Radio. We got you covered as those stocks break. S&P right now up 59, gain of just about 0.9%. Stocks are advancing as a cooler than expected inflation report lifts hopes that the Fed will cut rates further. The Dow up 130, up 0.3%. NASDAQ up 1.5%. The NASDAQ 100 index up 1.6%. Small cap shares taking part in the party. They're up by 0.9%. But the outperformer right now, our Mag 7 index, the Bloomberg Mag 7 index up 2.1%. 10-year 4.11%, but the 2-year currently yielding 3.46%. Gold down $4 the ounce, down by about 0.1%, 43.34. West Texas Intermediate crude up 0.4, 56.15 a barrel, and Bitcoin now down 0.4, 85,590 on Bitcoin. You heard it on Bloomberg Television and Radio. President Trump signing an executive order directing his administration to move cannabis into a less restrictive federal category, setting in motion a regulatory shift that could alter the legal and commercial landscape for the drug nationwide. The order instructs the Justice Department to begin the steps needed to shift cannabis to Schedule 3, a tier reserved for drugs with accepted medical uses and lower abuse potential. Now, we do have the marijuana ETF. That is the Amplify Alternative Harvest ETF, ticker MJ. It is down by 5.9%, but among individual marijuana stocks, weed stocks, Canopy Growth up now by 2.8%. Tilray is advancing by 2.1%. And sources tell Bloomberg UBS is set to begin its latest wave of job cuts in mid-January. UBS shares up now by 2.9%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Well, Bloomberg has reported out, as have many other news organizations, something you and I have talked about a lot, Tim, about how some, including...
Or you could just open up the app formerly known as Twitter, and you can just see this.
This is true. It's about how some that are wealthy, and just some in general, are concerned about some of the priorities of incoming New York City Mayor Zohran Mamdani. On that, we caught up with Kathy Wild, outgoing president and CEO of the Partnership for New York City. They represent a lot of the city's corporate leadership. So we're talking about real estate developers, PE firms, banks, law firms. By the way, Bloomberg LP is a member of the Partnership for New York City. Kathy Wild, also part of New York City Mayor-elect Zohran Mamdani's transition team. And she addressed some of his policies that he campaigned on, including higher taxes. Check it out.
You may raise the rates of taxes, but that may not result in more revenues if you scare people away, or if you scare companies away, or as we've seen lately, we've seen a real threat to jobs in New York. We, for the first time, in my experience over 50 years, are seeing a decline in the number of jobs in our financial services industry. Scary thing, that's 40% of our state income tax revenues. We don't, I mean, these are... You know, we've got to pay attention, and I think he gets that. But we've got to be at the table discussing these issues and helping figure out how do employers help solve the child care problem.
That's Kathy Wild, outgoing president and CEO of the Partnership for New York City, also part of New York City Mayor-elect Zohran Mamdani's transition team. Carol, curious what our next guest has to say about all this.
Yeah, great to have back in studio Frank Sorrentino, chairman and CEO at the publicly held New Jersey-based community bank, Connect One Bancorp. They are the parent company of Connect One Bank. Great to have you here. How are you?
Great to be here. Great to be in the new studio. It's fantastic.
Thank you. Yeah, we've been working on, real estate around here. Tell us about the environment. You are kind of consistently optimistic and have been a lot over the past year. Is that still the case?
I'm very, very optimistic about where we are.
Yeah.
And especially the journey we've taken this year to get here. It's been it's quite the roller coaster, up and down. And we certainly didn't start the year in the same place, but I really felt the foundation was there for a very solid end to 2025. But that foundation now has really created, I believe, an unbelievable ramp into 26. And I think we're going to have a lot less of the noise that we heard during 25 and more focus on how this economy is building strength as we move through 26.
I want to go to what Kathy Wild was saying about concern over New York City. She has a close relationship with many business leaders. She's also part of the mayor's transition team. Last time you were on with us, it was just after the election. We spent a lot of time talking about politics, specifically housing because of your construction background.
It was a great conversation.
But the New York City side of things, I mean, you've got locations in New Jersey and New York and Florida as well, but you've got locations here in New York City, so you understand the economy. What are you hearing from your New York City-based clients?
Look, I think the economy in general is very strong, but we are, as you just heard, we are on the precipice of, if there are changes that drive the sentiment to think that New York is not a friendly place to do business, we could see change. And so certainly that's a concern. We certainly know there's a concern about affordability in New York City. But overall, I think it's all going to work out. It always has before.
Does it make you optimistic that somebody like Kathy Wild, who has the ear of so many in the business community, is involved with the incoming mayor?
Yeah, absolutely. And there's others who are joining the team who I think we would all say we're happy they're there. Look, at the end of the day, I don't think anybody can argue with some of why this mayor was elected, right? The issue of affordability, trying to make a fairer system for everyone. I think we could all get around that. How we go about doing that is a different story.
How do we? I know we talked about this with you, and
but you're a builder, so that's why we talk about it with you, because you understand these things.
I'm trying to unpack this. I mean, a builder's not going to build a building if it's not going to be profitable, right?
Look, there's been numerous studies across this country and across various time periods. It doesn't matter when, how, or where you look at it. There's a really interesting story right now in the Twin Cities, where one city is trying to maintain affordability by government control. And then the other city is doing it by free market. Let's let the builders build.
Yeah.
Because, to me, some of the laws of economics, they're like the laws of physics. You may like to agree or disagree, but they are what they are. And if we increase supply, we're going to have lower prices. And that's something I think politicians don't typically understand. I mean, if you look right now, even in like the rent regulated portfolio, rent stabilized portfolio in New York City, there's 50,000 units that are unoccupied because they're uneconomical to put back on the market based on what they're rent stabilized at and the investment needed to get them back in order. You would think that that would be a priority. We want to get those units back into the marketplace because that would help those who need the help.
So if you were advising a politician, the incoming mayor perhaps, or
I'd love
city
the opportunity to do that.
What would you be
You haven't talked with him?
Not yet.
Okay.
We'll have our opportunity.
So what would be the suggestion to actually fill those vacant apartments?
Oh, there's a number of things we could do, right? We could mean test for the people that live in rent stabilized apartments. There are incentives the city could provide to entice the builders to be able to invest make the investments they need in each one of those apartments to make them viable. Since they're vacant, allow for vacancy decontrol up to some level. I mean, there's so many common sense things that we could do, probably over a dinner napkin, that would get those apartments back online in 90 to 120 days.
So why is this so hard? Is it politics?
It's how politics works. I don't know. And it's a mindset, right? There's a mindset that government can do a better job than the market can do, when in fact, we've learned over and over and over again here in the United States, the market generally is able to solve these problems, and in a very efficient way, mind you.
All right, I want to broaden out. We always do like to talk to you because you have such great exposure to small business and construction generally. How are both of those areas doing? And I'm also curious about small business, as we had a story this week about PayPal looking to apply to become a bank and really tap into the small business area. It doesn't happen overnight, so I'm just curious. You laugh. Do you think that's...
I think it's fine. What I find fascinating is all these companies that want to be banks, because in the current regulatory environment, it's fashionable, profitable, and whatever to be a bank.
Banks have done really well this year.
There are other times in history when being a bank is a little bit more difficult than that. And the banking industry is not just one particular point in time. It's built to last for very, very long periods of time. And so we'll see how they like the regulatory environment at other points.
So small business.
Small business, I think, is doing very, very well today. Again, the noise is out of the marketplace. People are feeling good. I think one of the biggest things we're hearing, notwithstanding some of the employment or unemployment information, is that small business is having a hard time hiring qualified people to fill positions. I think they're getting their arms around what's happening with tariffs. I think they're getting their arms around whether or not there's real structural inflation in the economy, and it appears there really isn't. There's been some price setting that's been going on, but overall, the vast majority of the small to medium-sized businesses that we represent at Connect One are doing quite well, and they're seeing. What's more important, they're seeing pipelines and backlogs that are taking them into 26, which is one of the reasons I feel so optimistic about where we're headed in 26.
So we got the environment side of this. Let's get to the actual running of the banking business. We saw an uptick this year in M&A. You mentioned a favorable regulatory environment. We saw you guys actually close on First of Long Island. That deal was announced last year.
Yep.
Any more M&A for you in the new year?
Listen, this is, I think, our fourth or fifth transaction we've done over the 20 years that we've been in business. And we always like to say we're very opportunistic based on where we are, where the market is, what opportunities are in the marketplace. We've gone through stretches of 3, 4, 5 years at a time without any M&A. That's okay. I do think there's going to be a robust organic growth engine for us as we continue to move forward. But there could be opportunities for M&A. And right now, one of the things that I think would promote that is a regulatory environment that's a little bit more favorable towards it happening. We did not have that when we announced the last transaction. There were only a few that were done that year.
That's what I wanted to follow up on, is that you are in an environment that's much more favorable. So as someone who runs a bank and knows that you haven't done that many over the entire lifespan, but you're in an environment where it is much more favorable.
Well,
does it make you say, maybe
no,
I do something
it's not
more?
so much that it makes us say it, because it has to make financial sense.
Okay.
It has to be something that for us, we can say this is a good opportunity for us to take advantage of.
Yeah.
The better regulatory environment, though, provides more opportunities, because then there'll be other institutions that think they're better off if they partner with somebody. And, in the last 3, 4, 5 years, that hasn't been the case, right? Many institutions are saying, hey, we don't want to take a risk here of trying to sell ourselves or partner with someone, and maybe that doesn't happen, or it takes too long to happen. And they hurt the franchise.
So that's probably a no for 2026?
It's hard to say.
Okay.
Well, just geographically, just in 20 seconds, geographically, the most appealing area where you want to be, where you're not right now.
Look, we're a New York Metro, based institution, so that's a big market. There's an awful lot.
So you want to grow here?
Yeah, we want to, and as I always joke here, Florida is part of that market. So I like the growth prospects here in the New York Metro market. I like what's going on in Florida.
Okay.
We'd be remiss in terms of Fed policy and what we get in terms of a new Fed chair. And we did get that additional rate cut last week, Frank. The bank
We said we were going to have a rate cut last time we were here.
Just real quickly, 30 seconds. How's the bank managing the rate backdrop in the steeper yield curve that we're seeing? Just quickly.
Listen, I think it's great for banks, and I think you see it, in the market reaction to banks over the last 30, 45 days, right? Bank valuations are up pretty strongly. Banks are now, favored in portfolios today. I think part of it is the steepness of the yield curve, and I think part of it is the optimism around the economy going into 26.
So still optimistic.
Yeah, very.
Kind of love that, right? We could use some optimism. Frank Sorrentino, thank you. Have a great holiday.
Oh, you Happy New Year.
Yeah, really
Fabulous.
appreciate it.
Fabulous.
Founder, Chairman, and Chief Executive Officer of Connect One Bank right here in our studio.
Hey, let's get an update on the business day, the trade, as we do get close to, just an hour and 15 minutes away from the close of equity trading. Here he is, Charlie.
All right, thank you very much, Tim. Looking at green on the screen right now with the Dow, the S&P, NASDAQ, all advancing. CPI Thursday, stocks are advancing as a cooler than expected inflation report lifts hopes that the Fed will cut rates further. Right now, the S&P is up 51, 67.72 where we stand. That is a gain of about 0.7%. Dow Industrials up 75 now, up by about 0.2%. The NASDAQ Composite Index up 294 points on NASDAQ. That is a gain of 1.3%. The Bloomberg Mag 7 Index climbing higher by 1.9% with a 10-year currently yielding 4.11%. The 2-year 3.46%. Gold is down $8 the ounce, down about 0.2%, 43.29. West Texas Intermediate Crude 56.01 a barrel, up 0.1%, and Bitcoin now down by 1.5%, 84,601 on Bitcoin. The activist investor Elliott Investment Management has built a stake of more than $1 billion in Lululemon. Lululemon Athletica shares up now by 4.1%. Instacart shares are lower after Reuters reported the Federal Trade Commission has sent the grocery delivery company a civil investigative demand. The FTC declined to comment but told Reuters it is, quote, disturbed by what it has read in the press about Instacart's alleged pricing practices. Instacart down now by 1.4%. Recapping, S&P higher up by 0.7%. Two key earnings reports coming up after the close of trading. We'll be hearing from both FedEx and Nike. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Hey, a story that definitely caught our attention. Trump Media and Technology Group, it's the company behind Truth Social, getting into, drum roll please, nuclear fusion.
Yeah, this is interesting because they do financial services, they do social media, they have the crypto part of it too.
Right.
The company's saying today it will merge with TAE Technologies, a closely held fusion developer. It was founded back in 1998. The transaction valued at more than $6 billion.
Yeah, we're going to get into this deal next hour, especially the fusion play, the reality of it. But we thought maybe our next guest might have some thoughts as well because they play big time, certainly in the energy space. We head to Charlotte, North Carolina. Ken West, he's president and CEO of Honeywell Energy and Sustainability Solutions. Starting in the first quarter of 2026, this business will be renamed Process Automation and Technology. Ken, welcome to Bloomberg Business Week Daily. So good to have you here. How are you?
Well, first, thank you for having me. I'm doing great, and it's great to be able to talk to you a little bit about how Honeywell's focusing on continuously providing solutions to our customers around energy expansion and security.
Well, I want to hear about this, and I've got to be fully transparent. My dad worked for the company many years ago, but it was originally Bendix, which was acquired by Allied Signal, which was acquired by Honeywell.
And there you have the history of U.S. industrials in a nutshell.
It's just really wild. I remember it so well, all the acquisitions. Hey, your business, though, a lot of energy exposure. Tell us about it and lay it out for us, for those who might not be so familiar with the current Honeywell, which right now is divided into 4 units, soon to be 3, with a spinoff later on.
Well, that's exactly right. So at Honeywell, we're continuing to focus on the evolution of energy and how we can provide end-to-end solutions for our customers. In energy and sustainability solutions, we bring more than 100 years of technology across decades of development in determining how we can help solve those world's problems, from originally processing some of the first gasoline to developing unleaded gasoline, and now today developing some of the new renewable fuels that are providing sustainable and affordable options for energy expansion for tomorrow.
You know, we look at, and we talk about this each and every day, but the challenges that we're seeing, at least with energy production and demand here in the United States, and the grid certainly not being able to keep up. Where is the bottleneck from where you sit?
You know, take a look And first, you're absolutely right. The need on energy is greater today than it has ever been. And as we look out into the long term, we see the need just continuing to grow. Many forecasts would put it at anywhere from 20 to 40% growth over the next 20 years or so out to 2050. When we take a look at that bottleneck, it really is in being able to develop the infrastructure behind the scenes that can produce that power. And so one of the first areas that we address that challenge is really inefficiencies. And we really come together at the intersection of the technology needed to produce power and then digital and optimization capabilities with Honeywell Forge that we use to provide sustainable and reliable solutions that allow those refineries to produce even more power than they did before. So if you take, case in point, a refinery that we are able to help become 5% more efficient, do that across 20 refineries, we've created a refinery without having to put any brick and mortar into the ground.
Yeah, I feel like that's, Ken, the next focal point, right? We went, especially when it comes to the AI build out, we went to, chips, the chip play and the data center play, and then it was all of a sudden like the power demands and building that out. But now I think whether it's chips, whether it's power centers, we're thinking about how to make all of this much more productive because that will help everybody meet the energy demand.
It truly is. It both meets the near-term and long-term energy demand and also does it in a way that's economically viable, which is just as important as coming up with a solution. So one of the ways that we're able to do that is by connecting to our plants. And when we create a connected plant, we're bringing in billions of data points every day. And we're connected today to more than 1,000 process units around the world. And we take those billions of data points and we can provide predictive potential solutions for those customers to improve reliability for tomorrow and to augment their workforce. As I travel around the world, one of the things that I clearly hear from all of our customers is a challenge in getting experienced workforce there to operate these facilities. We're able to take our connected plant solutions that run on Honeywell Forge and augment that existing workforce. So we can take a control room operator that may have a few years of experience and provide them the capabilities of a control room operator that may have had 40 years of experience. That in itself allows our customers to become more efficient and continues to improve both reliability and safety of the expansion of energy.